markets are shut today. So China, Japan, Hong Kong, all of them are shut in trade. So what are we looking at? We have the Taiwan index that's managing to hold on to some bit of actually a cut that has come in today's trading session. 1.31% downtick is what we are seeing for the Taiwan index. Australian index, that's the other one that is open as well, and also that is trading with not much of an excitement coming in today on the street over there. But the Indian markets, as of now, what is a Nifty implied open indicating for us? It's a positive start, 100 points, 115 point uptick. So gap up start is what we're watching out for from the Indian markets, Vamakshi. But more importantly, I think we'll keep an eye out on the US markets because that's where we're getting the handover from, right?
Well, absolutely. When in the US market, Wall Street ended higher on Friday as Wall Street saw better than expected non-farm payrolls report for the month of April, which eased recession fears and lifted S&P 500 for its longest winning streak in just over 2 decades. The Dow Jones jumped 500 points, S&P 500 posted its longest winning streak in 20 years, and the Nasdaq jumped over 200 points. CNBC's Julia Boosteen gets us a wrap of all the action on Wall Street.
U.S. markets were higher across the major indexes on Friday after a better-than-expected jobs report boosted stocks across the board. The Dow jumping 564 points, the S&P 500 up for 9 straight days and on its biggest winning streak in more than 20 years added 83 points. And the tech-heavy Nasdaq higher by 267 points. 177,000 jobs were added last month, according to the Labor Department, above the 133,000 predicted by economists, despite concerns over President Trump's blanket tariffs on trading partners. But the monthly number is still down sharply from the 228,000 jobs added in March. The unemployment rate stayed at 4.2%, which was in line with expectations and indicated the labor market is relatively stable. TikTok is facing a more than $600 million fine in Europe over privacy concerns. After a 4-year probe, Ireland's data privacy watchdog said TikTok's failures, which include admitting that it stored European user data in China, was in violation of EU data protection laws. The agency ordered TikTok to stop transferring user data to China within 6 months and said it would speak with its EU counterparts about possible further action against the social media platform. TikTok said it disagreed with the decision and plans to appeal. That's what's happening here in the U.S. Back to you in Mumbai.
Thanks so much for that. But let's move on. And Jan Hatzius, who's Goldman Sachs chief economist, discusses reactions to the most recent economic data. Listen in.
There were some downward revisions, so overall it was probably closer to a wash, but it could have been worse for sure. So, I do score this as reassuring. I think yesterday's ISM number was also less bad than certainly it could have been. I thought that was going to come down more. So I don't want to overreact to that. But most recent information is certainly consistent with the economy not going into recession for now. That is our baseline, but there's still a very significant risk. But our baseline is 3 cuts, 75 basis points starting in July, but that concern.
Well, let's also listen in to Jeremy Siegel, professor at Wharton School, and get his views on the U.S. economy and the impact of Trump tariffs.
There's no question that traders expect a big pullback from the tariff position that Trump now maintains. That a lot of these, many of these, most of these are going to be taken off, before that July 2nd deadline of resumption of the reciprocal tariffs. There's a huge tailwind. I mean, we know about the headwinds of the tariffs. There's a huge tailwind of the 10, 12% decline in the dollar for the multinationals in terms of bringing profits back from Europe or elsewhere in the world. They're going to be enhanced. So some of the tariff problems are going to be offset by the fall, and not all of them.
Well, that's all the global market action we have. But how will all of these overnight skews impact our own Indian markets? We now have our research team joining in with how the trade setup looks like and the stocks that are likely to be in the news. First up, Hormaz joins in to get us all the market cues we need to watch out for today. Good morning, Hormaz.
Morning, Mamakshi. And indeed, we have been stuck in this range, right, all through this last week. But we are making highs, but we are failing to sustain at those levels. And if you could take a look at the last 3 sessions, the cumulative gain that the Nifty has had is all of 18 points. So not much movement on the benchmark index, and these tensions at the border is what is keeping sentiments in check on the benchmark index. Although that does not take away from the fact that there is a lot of stock-specific activity that is taking place, the earnings reactions that are coming in, particularly in the broader markets, and they are at the extremes as well. Even on Friday's session, we saw stocks like Godrej Properties, Phoenix Mills, Indus Towers, all of them reacting to results. All of them were smashed anywhere between 8 to 14% in Friday's session. And today, a big determinant of how the Nifty moves will be subject to how the Nifty Bank moves, and that will be subject to how SBI and both Kotak Bank react to their respective results that were reported on Saturday. And even the Nifty Bank as well, that 55,000 range on the downside remains the important level to watch out for. The Nifty is stuck in that range, of course. The Friday's high, which is 24,589, remains the key level to watch on the upside. And on the downside, of course, it will be last Monday's low of 24,054, which is an important level to watch out for. Of course, keep an eye out on the Nifty Pharma Index this week because there are a lot of pharma earnings that will be reported. And of course, keep an eye out on JSW Steel, which was the top Nifty loser on Friday. See any follow-up action there as well. But for now, there is a gap up start is what the GIFT Nifty is pointing to. No significant cues from Asia because most markets are shut. But remains to be seen if this gap up sustains as the day goes by.
Absolutely, will be important to see if this gap up sustains. Thank you so much for that, Hormaz. But now over to Ria, who's here to tell us which are the important stocks to watch out for in today's trading session. Morning, Ria.
Well, yes, good morning. Let's take a look at the stocks that are going to be in focus today. First up is SBI on the back of its Q4 numbers. The net profit has seen a decline of around 10% on a year-on-year basis, and the net interest income has seen an increase of around 1.5% to rupees 42,774 crores. The gross net profit ratio in this quarter has declined to a 14-year low. We also have Kotak Mahindra Bank reporting its Q4 numbers. The net profit this time around has seen a decrease to around 3,551 crores, but the net interest income has increased on a year-on-year basis to 7,283 odd crores in this quarter. Moving on to Indian Bank, the net profit has seen an increase of around 32% on a year-on-year basis. Net interest income has also gone up by around 6% to rupees 6,389 crores. DMart has also reported its Q4 numbers. Revenue has seen an increase of around 17% over the previous year, but the margins this time around have come in at just about 6.4% versus 7.4% that we saw in Q4 of last year. City Union Bank, net interest income has seen an increase of around 9.8% on a year-on-year basis, and the provisions this time around have come in at 78 crores versus 75 crores that we saw in Q3 of this year. Adani Ports has come out with its operational update for the month of April. The cargo volumes have gone up around 4% on a year-on-year basis, and the logistics rail volumes have also seen an increase of around 17% over the previous year. NTPC will be in focus since its arm has declared commercial operations of 60 megawatts out of the 150 megawatts at the Gujarat solar PV project. Concord Biotech will remain in focus since the US FDA has issued Form 483 with 4 observations for its Dholka-based API facility. Shilpa Medicare will also be in focus since its biologics arm has received the EU GMP clearance for its Dharwad plant. Aircon International has bagged orders worth rupees 458 odd crores from Northeastern Electric Power Corporation. Azad Engineering has signed a long-term supply agreement worth around rupees 452 crores with GE Steam Power based in Switzerland for the manufacturing and supply of stationary airfoils for power generation. Lastly, AU Small Finance Bank will be in focus, and sources suggest that a big block deal has been launched in this company, and the total deal size will be rupees 600 crores, and the floor price has been set at rupees 650 per share.
Well, thank you so much for that, Ria. And finally, we now have Mangalam joining in with cues from the F&O space. A gap up start, Mangalam, but what is the F&O outlook looking like?
A gap up start. Let's see where it goes. Why do I say that? Because if you look at the previous trading session on Friday as well, the Nifty consolidated. We had the midcap index, which was under pressure, and the Nifty Bank also almost gave up all of its gains. In fact, That's been the trend all of last week and some parts of last month as well. If you look at, Nifty from April 24th, 25th, 29th, and even May 2nd, which was Friday, they hit highs of 24,350 to almost 24,600. And from highs, the close was either 100 or almost 300 points lower. On Friday as well, it was 246 points lower from the highs itself. But what's good is that the FIIs, they continue to show love for the Indian markets. Both FIIs and DIIs have bought nearly 7 sessions in a row together, but FIIs themselves have bought for 12 consecutive sessions in cash, and that is a fairly strong support that has come in. Additionally, they've also continued to nibble around in the index futures. They bought about 295 crores, added about 1,500 long contracts, and as a result of which their net exposure stands at 47%, and net shorts are at just a negligible 8,500 contracts itself, which is a long way away from what we saw sometime last week itself, which was at 35,000 on the short side itself. On the way up, though, 24,500 call writers are fairly active for a premium of 91 rupees. 24,400 put writers on the way down are equally active for a premium of 200 rupees, telling you 24,200 to 24,600 is the broad range that the option writers are positioning themselves for. Were we to break down below that range, then the 200-day moving average, which is also the April low, comes into play, which is 2451 for the Nifty. The index to watch out for today will be the Nifty Bank. Does it hold on to that 55,000 mark? The question to that will be answered by how SBI and Kotak Mahindra Bank fare. In fact, SBI is better than expectations. The stock ended higher on Friday. Kotak Mahindra Bank, slight miss on expectations. The stock actually ended lower on Friday ahead of numbers.
Okay, Mangalam, thank you so much for that. Surely we'll be keeping an eye out on Nifty Bank and especially SBI as well as Kotak as well. But on that note, we're going to step into a very short break. We'll get you excerpts of Warren Buffett's comments from the Berkshire Hathaway AGM. So wait out for that after the break.
Is on this global economic uncertainty, particularly the US and China part of that and what it means for us. And so I was able to be briefed on that, what's happening in markets and what it means for the Australian economy. So clearly that's the immediate focus. And again, I think one of the reasons why we got this big majority last night is because people recognised that if you wanted stability while the global economy was going crazy, then a majority Labor government was the best way to deliver that.
We are committed to take firm and decisive action against terrorists and those who support them. We thank Angola for their support in our fight against cross-border terrorism.
Angola foi das primeiras a reagir
Angola was one of the first countries to react after the sad events that happened in Kashmir region, killing a number of human lives. And in due time, the Angolan authorities sent to the Indian people and authorities the heartfelt condolences due to that.
Welcome back. You're watching Power Breakfast on CNBC TV 18. Now, it's the end of an era at Berkshire Hathaway as Warren Buffett announces he will retire as CEO by the end of the year, ending an iconic 6-decade leadership tenure. In the 60th annual shareholder meeting, he recommended Greg Abel as his successor. The Oracle of Omaha also commented about tariffs and American exceptionalism at the event. Let's listen in.
Greg should become the chief executive officer of the company at year end, and I want to spring that on the directors effectively and then give that as my recommendation. Let them have the time to think about what questions or what structures or anything they want, and then there's a meeting following that, which will come in a few months. We'll take action on whatever the view is of the 11 directors. I think they'll be unanimously in favor of it. And that would mean that at year end, Greg would be the chief executive officer of Berkshire. The main thing to do is not use, trade should not be a weapon. And the United States, we've won. I mean, we have become an incredibly important country starting from nothing. 250 years ago, there's nothing been anything like it. And it's a big mistake, in my view, when you have 7.5 billion people that don't like you very well, and you got 300 million that are crowing in some way about how well they've done. And I don't think it's right, and I don't think it's wise. I do think that the more prosperous the rest of the world becomes, it won't be at our expense. The more prosperous we'll become, and the safer we'll feel.
On that note, we're going to slip into a very short break. But up next, we get to our special Trump Watch segment, so stay tuned in.
And terrorism is something that Angola condemns wherever it happens, no matter where it happens, but Angola does condemn.
Terrorismo e Angola, obviamente, que condena qualquer tipo de terrorismo, não importa onde ele seja cometido.
Welcwelcome back. You're tuned into Power Breakfast on CNBC-TV18. Now, getting you to the latest updates related to Trump. What are the developments there? We have Dia joining in with us for our special segment, Trump Watch.
Starting off with a series of sharp remarks from President Donald Trump. In an interview with NBC, he said he was not seriously considering running for a constitutionally barred third White House term and blamed his presidential predecessor, Joe Biden, for the bad parts of the current economy. Let's listen to what he said.
There are many people selling the 2028 hat, but this is not something I'm looking to do. I'm looking to have 4 great years and turn it over to somebody, ideally a great Republican, to carry it forward. But I think we're going to have 4 years, and I think 4 years is plenty of time to do something really spectacular.
Shifting gears to economic policy, President Donald Trump insisted he does not plan to fire Federal Reserve Chair Jerome Powell despite sustained criticism over the pace of interest rate cuts. In an interview with NBC, he said, and I quote, "Why would I do that? I get to replace the person in another short period of time." President Donald Trump also said he is willing to lower tariffs on China at some point because the levies now are so high that the world's 2 largest economies have essentially stopped doing business with each other. In the interview with NBC, he said, and I quote, "At some point, I am going to lower them because otherwise you could never do business with them. And they want to do business very much."
At some point, I'm going to lower them because otherwise you could never do business with them. Yeah. And they want to do business very much. Look, their economy is really doing badly. Their economy is collapsing.
In a bold move targeting the global film industry, President Donald Trump said he was ordering new tariffs on all films made outside the United States, claiming Hollywood was being devastated by a trend of U.S. filmmakers and studios working abroad. On another front, at the tech standoff, President Donald Trump said he would give social video platform TikTok another extension of a deadline to sell to a U.S. owner if it was needed to reach a deal. Trump has already extended a deadline for TikTok's parent company ByteDance to divest the U.S. operations for another 75 days in April. Turning to criminal justice now, President Donald Trump said in a Truth Social post that he has ordered the reopening of Alcatraz as a prison to house America's most ruthless and violent offenders. Trump said he is directing the Bureau of Prisons, the Department of Justice, the FBI and Homeland Security to rebuild and substantially enlarge the former maximum security facility. That's all. Now back to you.
Well, thank you so much for that, Dia. But, that's all we have on Power Breakfast this morning. But don't go anywhere because Bazaar Morning Call comes up next.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call, coming to you as always from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Surabhi and Nigel. Guys, hi, good morning.
Hi, good morning, folks. Morning, Nigel. Morning, Prashant. There are no holidays this week. There are no holidays right up till the 15th of August. We have lots of earnings, lots of news flow, global and local. Let's get started.
Well, that's right. And, more practical measures is what we're hearing, at least the commentary coming out of President Trump.
Yeah.
So hopefully that stays as well. And the big central bank meets later this week. So
FOMC middle of the week.
Yeah.
Let's take it from the top in terms of I'll sort of go a little back and forth because I'll start with what came out on Sunday, which is the Meet the Press interview on NBC, where President Trump, and the graphics will start to come up, where he said basically that he's willing to lower tariffs on China at some point. I mean, again, nothing very new, but it got picked up. He praised some statements that China has made recently as positive. I mean, those comments which we put out on last Friday, which China said, well, is evaluating, comments coming in from US, etc. No confirmation that talks are going on or anything. And of course, he also said that any deal between US and China has to be fair. So is this new? I don't think so, but there is so much heightened focus on US and China and whether they're talking or not. I think it's worth putting it up right up front. One other thing which the Wall Street Journal reported on Friday was that China was weighing a fentanyl order to the US to kick off trade talks. It's like a concession because US has been complaining that a lot of the starting chemicals in terms of the fentanyl, which is a big drug menace in the US, is actually coming in from China. So the Wall Street Journal reported that the Chinese authorities are actually planning to do something about it as a way to sort of, kickstart these trade talks. The other trigger on Friday, and I'm going back around the time when markets opened, as always, was the April jobs report, which was actually pretty strong. So the non-farm payrolls number was 177,000. The median forecast was for 140,000 jobs to be added. And that is the reason why you had a pretty good session for US markets. I mean, these were the two drivers. The non-farm payrolls report, the jobs report in the US, and of course this WSJ report, which kind of, at the margin indicated that maybe things are in the process of thawing a little bit. So S&P closed higher for the 9th straight session. It's been the longest winning streak since 2004, November of 2004. So got to go back a long way to find this. On Friday, S&P was up 1.5%, NASDAQ was up 1.5%. And I mean, just look at these numbers. S&P is down just 3% on a year-to-date basis now, and it's about 8% from its all-time highs. So it's been fast and furious as it's come up. And of course, we've also completely done a round trip. If you look at the April 2nd Liberation Day announcement and the losses therein, the S&P has done a full round trip. It lost, and it's basically recouped all those gains. We're basically on the S&P back above at a higher level we were on the 2nd of April. So quite incredible. I started by saying that it's been 9 days of gains. Logically speaking, we should be at the end of this winning streak. I mean, it's highly unusual. And where do you kind of look at levels for this outperformance, this streak to end? The 200-day would be a good place. That stands at 5,746. I think that should act as a significant resistance and maybe a dip back to the 50-day moving average. We'll see. So this is the US for you. Macro markets, the 10-year yield was up 9 basis points. Actually, the 2-year, the front end, which is most sensitive to macro developments, that went up almost 10 basis points. 4.31 on the 10-year. Dollar index at about 100. Oil prices continue to fall. We're at about 61.6. And, on Friday, I said oil is down, 9% in 9 days, make it 10% in 10 days. So we've had a big pullback coming through. And on Saturday, by the way, OPEC Plus said that they're going to increase output by about 400,000 barrels per day next month. For the second straight month, they've done this. So, this is something to be noted as well. So just to tie in the levels here, we here in India have continued to outperform the rest of the globe. We've continued to climb the wall of geopolitical worries, which is India, Pakistan, and of course, tariff worries as well. Nifty is up about 11% since the April lows, which was, of course, peak tariff worries. FIIs have basically bought about $4.5 billion in 11 sessions since April 14th, and they've reversed about 25% of everything they sold on a year-to-date basis. Still a long way to go. And of course, I mean, if you take a look at the last 7-8 months, I mean, the number is about $25 billion net negative still. So where does it leave us? I mean, on Friday morning as well, I said that in case, the locals are short, HNIs are short, and in case this India-Pakistan thing does not flare up, and it's been many days, and naturally, the level of engagement, etc., has dropped off quite a bit, we could see a fair bit of move higher. We saw a move higher, sharp move higher, but we basically ended flat. The intraday rally meant that we broke above the earlier high of 24,457, and we also took out the 61.8% retracement of the full fall, which is 24,545, but then we ended absolutely flat. So these remain the immediate kind of resistance levels, the high and, of course, the 61.8. And we should find support at the 30th of April low, which is 24,198. For the Nifty Bank, support comes in again at the 30th of April low, 54,723. And the resistance for the Nifty Bank will be around the 56,000 level. So that's essentially the picture as we start this morning this week as well. GIFT Nifty will give you a quick sense of how we are starting. It's a 100-point higher. Once again, let's see, unlike Friday, if you're able to hold on to some of the gains by close. Surabhi.
Absolutely. Even always very interesting and sometimes very entertaining comments from Mr. Donald Trump, right? In that interview, he also went on to say that the first quarter contractions was Biden's problem.
All the bad things are
Biden. All the good things are for me. And as far as the contraction, I've only been in office for 3 months. So what are you talking about? So in fact, let's listen into that soundbite. Donald Trump on the prospects of lowering China tariffs.
At some point, I'm going to lower them because otherwise you could never do business with them. Yeah. And they want to do business very much. Look, their economy is really doing badly. Their economy is collapsing.
So China's economy is collapsing. The U.S. is going to be very, very rich, he says. Now, China and a lot of other Asian markets are unable to react to any of that commentary today because a lot of the local markets are shut for holidays, the regional markets, that is. Wall Street futures, after that 9-day winning streak for the S&P 500, they're pointing to a little bit of a consolidation. But the Japanese market is shut today. South Korea, Hong Kong, China, all are shut for various holidays. There's Children's Day in Japan, I think. There's a Buddhist holiday in some of the other regional markets as well. The Fed meeting is, of course, going to be in focus. We will be reacting to it on Thursday. Right now, consensus is saying 97% as per the Fed Watch tool, 97% consensus that there will be no rate cut, no change in rates. That's what we're going with. This oil fall, I mean, oil this morning is down 3.5% to 4% as well, both on NYMEX and on Brent. And Brent has finally come below, $60 a barrel. Let's see if we can, we've got the Brent rates on the screen up for you. So that's, of course, great news for India because of this increase in output, 411,000 barrels added. And in the last 2 months, between the last the meetings, OPEC Plus has hiked output by 800,000 barrels. This at a time when global demand is under a bit of a cloud. So oil has really cratered this morning. By the way, speaking about trade, slight bad news coming in on the India-UK FTA. Because it seems despite the Commerce Minister's trips over there, lots of parleys, it seems there are several niggling issues, sticky points still that remain. So that FTA announcement may not happen as quickly as what people had hoped for. Early May was what the indication was earlier. Sticky points include the UK carbon tax and the fact that India has very stringent data localization laws. So that still needs to be thrashed out. For the market, last week by Friday, the gains started tapering off. For the week as a whole, the Nifty did manage about a 1% increase. The midcap index was up about 0.3%, 0.4%. The small cap index was actually down. So the broader market euphoria started narrowing. Let's see if this week is going to turn that around because the flows picture is still very strong. We were talking about the Thursday numbers coming down. Thursday, remember, the FPI flow was just about 50 odd crores. But Friday, it picked up again. Very solid numbers, 2,770 crores of FPI buying. Domestic institutions, not bad at all, almost 3,300 crores. So flows are not a problem for this market. Can earnings be a bit of an issue? Let's quickly glance over some of the numbers. SBI is particularly important. The asset quality is great. In fact, gross NPAs have improved by 25 basis points. However, the OPEX is higher, but treasury gains were solid for SBI. The commentary is a bit cautious, I must say. This was during the weekend press conference. Mr. C.S. Setty said that there could be margin pressure as the rate cut cycle kind of plays along. He's saying there's a lag of 12 to 18 months for deposits to get repriced. So the advances obviously get repriced for earlier. The loans that we borrow, they get cheaper, but deposits might take some time. So therefore, there might be some pressure. And in terms of growth, he's actually lowered the guidance a bit. from earlier 14 to 16% to 12 to 13%, and also seeing that there's moderation in the corporate loan growth that the bank is noticing. That's SBI. Lots of other earnings. Kotak, no problem there. Good deposits and advances. NIMs are steady. Asset quality is improved. So Kotak is looking good. DMart is subdued, as we've gotten used to from DMart. Kabel, and we'll talk to this management, looking very solid, very good set of numbers. And if there's an earnings casualty I'll watch out for this morning, it could be Utkarsh Small Finance Bank. NIMs are down 100 basis points quarter on quarter, and NPAs have surged from 6.1% to over 9%. Watch out for this one in trade. So, Nigel, plenty of earnings and plenty to keep us busy.
Well, that's right. Plenty of earnings, plenty of news flow as well. But the sense you get is that, the broader markets have been doing a relative underperformance. And that's because a lot of smart domestic players, they're waiting by and they're watching what's going to happen on the border. So my interactions as well with various large Asian suggest that there are some cash levels that have been raised. There is some money that's sitting on the sidelines as well, just in case things, do get a little bit ugly on the border itself. So that's the sense I get. And even if you saw on Friday's trading session, the Nifty Bank, they did okay. However, there was an underperformance coming in for the broader markets. So that's telling you there is some mild profit taking that we're seeing with an eye on the border. What about positioning? The FI net short positions have come down to the lowest we've seen in multiple months, only around 9,000 contracts, while the clients, they are net short now, with close to around 27,000 contracts on the short side. And as I've been mentioning, that's the first time we've seen all the way since October 2024. Moving to what the FIs did, though, in the options market, well, they bought quite a few calls, and they bought more calls than puts. However, what's telling you that at higher levels, we could see some resistances. They're writing way more number of calls than puts. And that's what we saw even in Friday's trading session. So it appears we're still in a bit of a range, going by the call writing that we have seen. Moving to the options data, two big strikes that are active, 24,500 call, 24,000 put. Put both of them on the screen, and in fact you have the premiums as well, and you get a broad range that you're looking at. The recent high on the Nifty and the recent low, that seems to be a bit of a range. So that 24,550 odd mark, that seems to be a bit of a resistance zone. We went there, in Friday's trading session. We couldn't conquer that. So that's the important resistance mark. You want to end above this level, 24,500, 24,550. However, on the downside, you have a reference point as well. This 23,800, 23,850, that's a very, very crucial support zone that you're looking at. In the last few trading sessions, the Nifty consistently has been going 24,350, 24,450, 24,550. Just take a look at the levels. For the last many trading sessions, close to around 7, we have gone to that vicinity, but we're unable to conquer that mark. Stocks that I'm looking at, the Nifty Bank, I've been making this point for the last many trading sessions, that the Nifty Bank is facing resistance at around the 56,000 odd mark, and that's the way it's played out as well. The couple of stocks that will be reacting to its earnings, Kotak Mahindra Bank, irrespective of what they were going to deliver, when you have a stock running up more than 25% in the last 6 months or so, it's going to face a bit of a challenge irrespective of what it does. So I'll keep an eye out on that stock. How does the street take its numbers? And SBI actually has done a relative underperformance, so it has some cushion out there. We'll keep an eye out on both these two earnings reactions. And the macro tailwind for India is crude oil prices have dipped. Few sectors you look at paints, you look at these OMCs as well. I'll keep an eye out on a few of these names in today's trading session.
Okay, all right. Got that, Nigel. So plenty to track and watch today. Let's actually, before we kick off the action, let's also talk about the big Berkshire weekend. And it's the end of an era at Berkshire Hathaway. Warren Buffett has announced that he will retire as CEO by the end of the year, ending an iconic 6-decade leadership tenure. In the 60th annual shareholders meeting, he recommended Greg Abel as his successor. The Oracle of Omaha also commented on tariffs and American exceptionalism at that event. Listen in.
Greg should become the chief executive officer of the company at year end, and I want to spring that on the directors effectively and then give that as my recommendation. Let them have the time to think about what questions or what structures or anything they want. And then at the meeting following that, which will come in a few months, we'll take action on whatever the view is of the 11 directors. I think they'll be unanimously in favor of it. And that would mean that at year end, Greg would be the chief executive officer of Berkshire. The main thing to do is not use, trade should not be a weapon. And the United States, we've won. I mean, we have become an incredibly important country, starting from nothing. 250 years ago, there's nothing been anything like it. And it's a big mistake, in my view, when you have 7.5 billion people that don't like you very well, and you got 300 million that are crowing in some way about how well they've done. And I don't think it's right, and I don't think it's wise.
Your thoughts on what we saw over the weekend from Omaha?
Well, I think it's the end of an amazing run for Warren Buffett. I mean, he's right up there in the history books as one of the greatest investors of all time. Certainly among the greatest value investors, and it's great that he's done so well, and that he's retiring after such a phenomenal performance. He's retiring on a high.
And of course, I mean, that record cash level, I saw there was a question asked whether, he's, all that cash is to give his successor a clean slate. He kind of laughed it off and said, I'm not so generous. If I found something to do, I would do it. So it's actually more to do with the market, Ed, right? I mean, there's a lot of discussion around that.
Yeah, well, I think Warren Buffett is very disciplined, and he's really stayed true to what's called it's called the Buffett ratio, I should say, after Warren Buffett. And Buffett has always said that he looks at the price to sales ratio as an indicator, the market cap of the S&P 500 to its revenues, and that usually gets him nervous when it gets to 2. Well, it got to 3 this time, and recently it's corrected down to like 2.3. So from that perspective, I think he's simply said that the market's overvalued and that he wanted to take some of his profits, and so far he hasn't been able to. But I think there's also something to that, a clean slate. I think he's also giving his his followers here an opportunity to show what they can do.
Ed, hi, great to have you on the show today. So I'm looking at futures right now slightly lower because the market's had a good run, right? I mean, 9 consecutive days of gains in the S&P. Is some sort of a de-escalation in China now already priced in? What would you expect as we get into peak summer, given the cut and then a bounce? And it's been a decent bounce for the U.S. market.
Yeah. Well, look, it's pretty clear when this all started. It all started on Liberation Day, Trump announced these ridiculously high tariffs, and the stock market took a dive on it. And then I think about April 8th, the bond market started to protest that things weren't right in the financial markets. And so it was on April 9th that we had a postponement of Liberation Day. And that was an indication that Trump was blinking, that he wasn't going to stay adamant about these tariffs. And meanwhile, I think the expectation is that there are negotiations going on and that Trump is going to declare victory. He'll probably get some signed pieces of paper. There won't be formal treaties. There'll be letters of understanding with lots of countries, including India, that will indicate the move towards fairer trade. And I think Trump will then conclude that he's not going to impose these reciprocal tariffs after all. But the key negotiation question is China. It's not clear that negotiations have actually started, but there's indications that both sides would like to start some negotiations and would like to calm this trade war.
Hi, Ed. Good morning. Good to see you. When, Ed, I was looking at Warren Buffett and all the takeaways that we got, and his commentary on emerging markets, he said, avoid countries with currency instability as well as hyperinflation. I think India is well placed out there, but that's me talking. He didn't say that. He said he'd rather, avoid emerging markets. Talking about the US market, so that's the mother market, and you have more rational thoughts and sound bites coming out from President Trump. In the past, we've been talking about the S&P 500 go to that vicinity of around 6,000 odd, which was in doubt. But now with this rational thinking, What's your expectations? By the end of this year, where do we see the S&P 500 headed?
Well, I started the year very optimistic, thinking we could get 7,000. And I guess everybody else, I got caught up with the idea of animal spirits coming in and focus and tax extension of tax cuts. But Trump really started out with the bearish policies on tariffs. And so I did lower my outlook for the S&P 500 to 6,400 in early March, and then to 6,000 by the end of March. And I'm going to leave it there. I think we're going to recover, but the year overall will be flat compared to last year.
All right. Very quickly, before we let you go, what's the expectations from the Fed? The street is not expecting any kind of cut, at least in this meeting. But what do you expect?
Yeah, I've been in the none and done camp for a while, thinking that the Fed, there's no reason for the Fed to lower rates. I've been in the camp that believed the economy was going to prove to be quite resilient. I conceded that there could be a recession, but I didn't think it was not my base case. So I think with the payroll numbers we just saw, and with inflation heating up from the tariff uncertainties, the Fed will do nothing.
Okay, all right. Ed, good chat as always. Thank you very much for joining us. And thank you for your perspective. Well, let me just quickly run you through the interactions which are lined up here coming up in the next 2 hours or so. Latent View Analytics is the first management of the show today at 8:35. So we'll talk about earnings and the outlook. Harish Krishnan of Aditya Birla Sun Life Mutual Fund will be our market march of the day. 9:30, you will hear from the manager of Bajaj Auto as we discuss April sales and what the year ahead looks like. Godrej Properties speaking to us at 9:40 after earnings. 9:50, Kabel will be with us on their wires and cables business and the outlook there. It's the economy with Lata as she analyzes results of SBI versus other top 4 banks with Santanu Chakrabarti of BNP Paribas 10:15.
All right, time to slip into a short break. We've got a lot of stock-specific action to track for you. We'll get to that in just a bit in our special Top 10 segment. We're looking at Marico, Kabel, NetWeb Tech, as well as Tata Motors. All of them will be reacting to positive news flow, while we have SBI, Avenue Supermarkets, Kotak Mahindra Bank, CDSL, and AU Small Finance. All of them will be reacting to negative news flow, and we'll keep an eye out on the crude sensitives as well, because there'll be a mixed reaction out there. Slip into a break, come back, we'll get into further detail on all of these names.
Welcome back. Lots of stocks and earnings to go over. Our team is standing by with the CNBC-TV18 list of top stocks to watch. So let's straight away get to it. I mean, otherwise the opening is likely to be good. But what about individual names? Abhishek, let's kick it off with SBI. What did you make of the numbers?
Well, other income actually aided the PNL and higher write-offs actually aided the asset quality for SBI. Take a look at PNL versus ARPOL. The NI and PAT is a beat on ARPOL. However, the PAT is largely aided by the Forex as well as Treasury gains, which are kind of a one-off as well. 19-quarter high write-offs are coming in at 10,000 crore plus versus 1,949 crore in the previous quarter. That aided the asset quality to be one of the best in last 10 to 15 years. 15-quarter low net interest margin coming in at 3% versus 3.01% in the previous quarter. The NI growth was at just 2.7% YOY, perhaps the weakest growth that you are seeing in last 5 years. 5-quarter low with respect to return ratios, ROA at 0.68% and ROE less than 20%. Now slippage ratio, that's a heartening point to see, is at 10-quarter low of 0.41% versus 0.41% in the previous quarter. And CASA ratio on the positive side has improved for the first time in last 12 quarters, coming in at close to 40% versus 39.2% in the previous quarter. Now the loan growth has disappointed. It's below the analyst estimate, coming in at 12% YOY, which is the lowest growth rate in last 12 quarters. And management in an interview to us did highlight that they will trim down their loan growth rate in FY26 from their earlier guidance. So they are now trimming it to 12 to 13% versus 14 to 16% guidance that they had at the end of the previous quarter. Back to you.
All right. Abhishek, thank you very much for that. DMart is the next one we want to focus on. Mangalam is here with numbers there. The margin, of course, was the much talked about point. Mangalam, morning.
So the margins for DMart were weak this time around, and it's actually the competition from quick commerce and the competitive intensity in the retail space which is now beginning to show up in their performance. If you look at it, the revenues, the street was fairly apprised of that in their fourth quarter update. The gross margins dipped. The EBITDA came in a little over 950 crores. The street was working with a number above, 1,000 crores, around the 1,050 crore mark as well. So to that extent, there was some weakness. And the company said, increased competitive intensity in FMCG has impacted gross margins. Surge in wages for entry-level positions due to high demand has also impacted their margins, and they've continued investment in their improvement of their service levels. So that's also increased the costs for the company. They had a higher number of store openings during the quarter, so that also increased the expenses. But more importantly, the 2 points that stood out from their commentary: one, gross margins in matured metro towns will remain soft for a period of time, so no outlook on improvement of margins going further. And also profitability for the standalone online segment could be some time away, even as DMart Ready is scaling up. So those two factors not particularly good for their operational performance. That's something we'll be watching out for. Expect the stock to open in the red today.
Okay, all right, Mangalam, thanks a lot for that. Well, let's hop across to Abhishek. He's here to tell us about Kotak Mahindra Bank. Abhishek, the stock had such a big run. Any which ways, it's going to be dicey for it. But how do you read the numbers?
Well, weakest business momentum, that is deposit plus advances. That momentum is one of the weakest that you are seeing in last 3 years. And that is why the NI and PAT is below ARPOL. So take a look at NI. It is at 7284 crores versus 7434 crores that we were expecting. PAT has come in at 3552 crores. We were working with a number of 3,746 crores. So deposit growth is at 11.2% YOY. YOY, it's the weakest deposit growth in last 11 quarters. However, sequential growth is around 5.5%, which is the highest in last 4 quarters. Advances growth rate has disappointed. It has come in at 13.5% YOY, one of the lowest in last 15 quarters, largely impacted by the MFI and the corporate segment. The NI growth is at just 5.5% YOY, one of the weakest growth rate that you are seeing in last 14 quarters. Operating profit growth is at just 0.2% YOY, which is on the weaker side and the lowest growth rate that you are seeing in last 11 quarters. Now, the core operating profit, that is NI plus fees minus OPEX, that is also weak. It has declined by about 0.9% YOY, the first time that you are seeing a decline in last 13 quarters, and it's declined sequentially as well by 0.3%. Now, PAT has declined for them by 14.1% YOY, which is the highest decline in last 9 years. In terms of subsidiaries, the YOY and quarter-on-quarter PAT decline was seen for Kotak Mahindra Life Insurance as well as Kotak Securities. Asset quality, one of the best in last 3 quarters, with gross NPA ratio at 1.42%, and cost to income ratio is at 5-quarter high of 47.7%. Expect the stock to be weak in trade today. Back to you.
Okay, that's Kotak Mahindra Bank. So also on our radar, some people sort of finding some issues maybe with growth not being as strong as expected. Thank you for that, Abhishek. Let's move on to Marico. Mangalam, morning. How are the numbers?
Well, for Marico, optically there are slight miss on margins, but the revenues are above expectations, as are the volumes. So largely in line with what the fourth quarter update the company had given us itself. Revenue 2730 crores. The street was working with a number of 2665 crores. Volume growth of 7%. Here's the beat. The street was working with a range of 5 to 6%. The EBITDA came in at 458 crores, largely in line with expectations. But because the revenue was higher, the margins have come in slightly lower than expectations. The net profit, again, in line with the street expectations. The outlook is fairly strong. They maintain double-digit growth momentum for FY26 with double-digit operating profit as well. And more importantly, the diversification trend that Marico has been on is something that is likely to continue itself. They expect, share of foods and premium personal care to cross 25% of their overall revenues in FY27. And this will be margin accretive because they expect the margins for this business to be 300 basis points higher at a gross level than their overall portfolio. Expect some green on Marico today.
Okay, all right. Thanks a lot for that, Mangalam. Well, Vamakshi joins in to run us through a few more reviews or a few more results that we got over the weekend. Morning, Vamakshi, take it away.
Good morning, Nigel. Let me first start off with RR Kabel, going with the green for this counter because the numbers have come in much stronger than what the analysts were expecting. Revenue is seeing an uptick of almost 27%. When you look at the margins, they have improved from 6.5% to 8.7%, and resultantly, the EBITDA is up nearly 69%. The net profit too has surged higher by almost 64%. The next stock on our radar is CDSL, going with the red for this counter because the company has reported a miss on its revenue as well as operational profitability. The revenue has dipped by 19.3%. The margins have contracted substantially by 900 basis points to 48.7%, and the net profit too has declined by almost 23% sequentially despite the spike that we saw in other income. As far as segments are concerned, the large hit is coming in from the data entry and storage segment. Depository activity has also seen a dip of almost 18%, but repository on the other hand is up nearly 15%. The margins have contracted across the board. For depository activity, it is down nearly 1100 basis points, and for data entry it is down nearly 878 basis points. So overall, it's not a great set coming in from CDSL, going with the red for this counter. And lastly, let's also focus in on NetWeb. The company reported a very strong set of numbers. They've managed to meet the full year revenue as well as PAT guidance. The revenue saw an uptick of almost 24% sequentially, so very strong performance as far as Q4 is concerned. The margins too have improved to 23.8%. The net profit is up 42%. The order book has dipped sequentially, but that is mainly on account of higher conversions. Analysts say it's a strong beat on sales, but miss on margins. Order pipeline also looks healthy despite the miss in Q4.
Okay, all right, Vamakshi, got it. Thank you very much for that. Let's go to Sudarshan, who's tracking some news on Tata Motors this morning. So, good morning.
Morning, Surbhi. So, as per the report from London Times, we understand that JLR, after a month of pause, has started the shipments of its cars to the US. And the reason it's important because US market forms nearly 30% of total volumes of JLR, and 70% of Tata Motors' consolidated revenue comes from JLR. But we'll have to hear from the company that if there is anything that company has heard related to US tariff, because tariff of 25% remains on all the foreign-made auto cars. So we'll have to hear from Tata Motors. We are yet to, but we can go with minor green just for now, because as far as JLR is concerned, at least they have started the shipments.
Okay, all right. Thanks a lot for that, sir. So we'll watch for some green on Tata Motors. Finally, let's wind this down. Abhishek is joining us to tell us about AU Small Finance Bank. Abhishek?
Well, there is a block that is to be launched at AU Small Finance Bank. That is what sources do tell us. The size on offer could be about 1.24% of the equity. The total quantum could be around 600 crore. The floor price is about 3.9% discount to yesterday's or Friday's closing price. Seller could be True North as well as a few others over there. The BRLM to the issue is Kotak Securities. So we'll watch out for that in trade today. Back to you.
All right, Abhishek, thank you very much for that. Well, oil sensitives should be in focus. I mean, the 10% 10-day fall should matter. Sudarshan is here with that list. Sudarshan.
Morning, Prashant. So in the last 2 or 3 sessions, we have seen a sharp fall in the crude, and now Brent is below $60. It's at nearly lowest levels in last 4 years. Now, why this fall that we are seeing in the crude? So basically what has happened over the weekend, that OPEC Plus, which is led by Saudi Arabia and Russia, have decided to increase the production, and this increase in production is a sharp increase and it's much higher than what the estimates were. So they are looking to increase the production by 4.11 lakh barrels per day from June, and this is almost triple the planned increase that they had indicated earlier. Now, why this would be negative for companies like, or say upstream companies like ONGC and Oil India? Because $1 fall that we see in the crude nearly impact its EBITDA, or say annual revenue, in the range of rupees 300 to 400 crore for companies like ONGC and Oil India. For ONGC, for FY25, they had set dollars in the range of $70 to 75 of crude for their net realization. Now, why it's positive for OMCs? If there is a $1 fall in the crude, it can improve the EBITDA for companies like HPCL, IOC and BPCL in the range of rupees 200 and 300 crore. Third, why it's positive for paint companies like Asian Paints and Berger, because up to 50% of a company's input cost is crude linked, and fall in crude reduces raw material cost and improve the margin of these companies. That's the reason these companies will be in focus in today's trade.
Okay, all right. Thanks a lot for that, sir. Well, here's a quick recap of all the top stocks that we're looking at. The ones with positive news flow: Marico, RR Kabel, Netweb Tech, and Tata Motors. The ones with negative news flow include SBI, Avenue Supermarkets, Kotak Mahindra Bank, CDSL, and AU Small Finance Bank. While we have crude sensitives as well that will be in focus, expect a mixed reaction out there. So let me do a short break. On the other side, we'll be joined by the management of Latent View. Stay with us. Welcome back. You're tuned into Bazaar Morning Call. As promised, let's get chatting with Latent View Analytics. They saw a 24% organic revenue growth in FY25, with their margins, for FY25 coming in within the guided 23 to around 24%. To talk about their performance as well as the outlook, we're joined by Mr. Rajan Sethuraman, the CEO of the company. Hi, sir. Good morning. Thanks a lot for joining in. Well, you ended FY25 with a revenue growth of around 32%. Out of that, around 22% was organic. The balance of it was a decision point contribution. How do you feel about FY26? What kind of revenue growth can you look at? And also, you were a little bit cautious about CPG. How did it fare in Q4? Was there a growth, degrowth? And how much does it contribute to the overall pie? Please go ahead, sir.
Yeah, no, good morning, and thanks for having me on the show. In terms of guidance for FY26, at this point, we have a good degree of confidence in getting to about 18 to 19% because we clearly see confirmed orders and extensions on that. We are shooting for a 25% growth, though. There is a pipeline that we have, which we are working on. I'll be able to give better guidance when we come to the end of Q1. We are expecting the margin profile to stay in the 23-24% range for the upcoming year as well. With respect to CPG and what is happening in that sector, yes, we did see some compression in Q4. In general, the CPG segment has been sluggish from a macroeconomic standpoint. Also, the current tariff-related issues that are going on, it could potentially have the most amount of impact in the consumer goods space because of consumer sentiment related to recessionary and other challenges. So we do need to wait and watch. However, we have, as indicated in the past, made investments in the CPG space, and we are continuing to double down on adding a Gen AI layer right into the solutions that we have in this space. So we are going to continue to push ahead with bringing new innovations and see what kind of traction we're able to build on that. I'm expecting that the first 2 quarters could still be a little subdued as far as CPG is concerned, and hopefully things will pick up in the second half of the year.
How much, Rajan, how much does CPG contribute to the total pie? And also this margin guidance that you're talking about of 23% ballpark, that's taking into account the investments you're looking at in Gen AI, right?
That's correct, yeah. The investments are going to be in 3 areas. Focus accounts that we have identified, about 25 plus, which we are going to double down on. The second is the data engineering, Databricks partnership, which I have talked about. We are making more investments around capability building and solution building and getting them more visible right to the Databricks ecosystem and our clients. And the third area is going to be the AI, Gen AI, agentic AI space, right, where we are setting up a COE, and we're going to be taking a look at a lot more R&D and experimentation with respect to that stack. CPG contributes to about 13-14% at this point with the integration of Decision Point right into the mix. We would like it to get to a 20% kind of a number, if not in this year, at least by the end of next year.
Which of these, Rajan, hi, good morning, Prashant here. Which of the service lines, core service offerings, will be most disrupted and impacted because of AI, according to you?
In terms of excitement and interest levels, obviously we see a lot more in the technology and the digital native space, but it's a lot more positive there because everybody is buzzing with action around how they can make use of the emerging technologies in driving not only productivity benefits and efficiency.
Rajan, the excitement is absolutely correct, and that's what we hear generally, but also, it's a constant topic of discussion with other tech companies as well. Will there be, will it lead to lower volume of work? Will it lead to, for example, these are all telltale signs, right? Salesforce, a couple of months back, essentially said that they will not hire any more engineers, any more programmers for the rest of the year. Because, Microsoft said recently that 30% of all code which is being written is through programmers. These are specific areas, and you may not be in those areas, but my point is slightly broader. Which of these, analytics, these are all areas where a lot of AI can be used effectively to increase productivity. So what would it mean for a business like yours?
Yeah, no, absolutely. So rather than take an industry perspective, I would say a type of perspective, work perspective is more appropriate. So a lot of the work that's being done in the diagnostic descriptive and maybe even data engineering pipeline building, that will get disrupted. We already see quite a bit of automation and solutions coming in that space. Clients are also starting to talk about productivity improvements and expectations that they have in that space. Our own strategy is really around how can we be a little ahead of the curve when it comes to, in some sense, building the kind of productivity improvement solutions, right? Using automation, Gen AI and agentic AI. And that's what we have been taking into the market, right, in the last year. Last year, if I look at the overall revenue, about 8 to 10% came from Gen AI solutions. Two-thirds of that is still POCs and pilots, but we already see things getting into the production space. I'm expecting that will double in this year based on the pipeline that we have. So the intent would be to stay ahead of the game in terms of building those solutions where we can go and demonstrate that we can do whatever work we have been doing even in diagnostic and descriptive analytics with 30% improvement in productivity, for example. If we stay ahead of the curve, then it will mean that not only will we retain the current book of work, of course, the volumes will come down because of the productivity improvements, but we will want to go after work that's being done by companies overall, right? And can we lead the pack in terms of how we therefore gain market share in that type of work as well? Of course, the big focus will be on the predictive prescriptive analytics and what we can do in that space. And that's what the AI COE is going to focus on.
Any deal delays you're witnessing or any kind of cancellations?
No cancellations. The protracted sales cycles continue, more so in the BFSI, in the CPG and retail space, a little bit maybe even in industrials because of the tariff-related uncertainties. But we are seeing progression in those areas also.
Okay, all right. And if you're saying that they're taking a little bit longer to close, normally what was it? And what has it moved to in terms of a time span? And BFSI, you were bullish on it, right? What kind of a number did you close out last year with? And what are you targeting for this year? Very quickly.
Yeah, so I think the sales cycles typically for larger ones, upwards of $500,000, $1 million, it used to be between 6 to 9 months. It is now taking maybe 12 to even 18 months in some cases, right? Just longer conversations. BFSI, yes, we are bullish. We did see really good growth, about 50% growth in BFSI for us last year. We continue to remain bullish because we have kicked off multiple conversations and we have signed a few MSAs also in that space. So we are expecting that all of that will start bearing fruit in this year. So I would expect a similar level of growth in BFSI as far as they are concerned.
Appreciate you joining in, Rajan. Thanks a lot for giving us all of those details. Wishing you all the best for the year. You're sounding optimistic, particularly about the second half of the year. We'll hold you to these numbers and we look forward to chatting with you as the year progresses. That's the one we're getting. Latent View, some on the street believe that maybe growth wasn't as much, but the management is promising for good times ahead as well in terms of the margins as well as the top line. Let's get in some fundamental views. Then we have Amnish Agarwal, Director Institutional Research at PL Capital, joins us. Hi, Amnish. Thanks a lot for joining in. Amnish, I wanted to ask you about DMart. You know, the margins are a bit of a shocker, actually, and they missed EBITDA estimates by quite a large deal. What's your view on the stock?
See, we have been very cautious on DMart from quite some time because the competition in the overall food and grocery retailing is increasing, as is reflected in the stance of many of these quick commerce players. And I think over the next 6 to 12 months, we see further increase in the competition over there. The second is whatever they had lost on your general merchandise and apparel, I think that share, if they are able to hold it static, that would be a great achievement, because today even the quick commerce companies are now going on the, you can say, non-apparel, general merchandise stuff. This coupled with, you can say, the increase in the labor cost, increase overheads due to store opening, I think that is all putting a pressure on the margins. So how far it has played out in the current year is yet to be seen, and I believe, and I don't rule out that there could be a little bit of more margin compression as we go into the next year. So I think from the current levels, while we might see some recovery in the profit growth, because from the last 2 years, the EPS growth has been hardly 5-6%, but definitely not a clear upside or not a very clear visibility at this point of time.
Amnish, hi, morning. Let's get your take on both the banks, SBI and Kotak Mahindra, because while the present quarter has been pretty good for most, SBI, it seems that the write-offs have aided the asset quality, and more importantly, I think growth is becoming a bit of a concern. I've seen some notes on Kotak as well, downsizing their overall expectations because of the growth parameters slowing down a bit. Your thoughts?
You see, if you look at Kotak, not now, from the past few years, the problem with Kotak Mahindra Bank has been the slow loan growth. Okay, so intermittently from past couple of quarters that had improved, But if you look at this quarter again, first of all, the growth rates are not encouraging. Secondly, even there is a bit of NIM compression also. And the third is your provisions have gone up. You can say partly because they have also increased the provision coverage ratio. So I think in the current year now, if you look at in this backdrop where the interest rates are going to come down, and Kotak is, for example, if you look at your benchmark rates, I think there is going to be a pressure on earnings for banks in general in the current year because of the NIM compression which is likely to be there. So in terms of earnings, I think the things are not looking that great, but simply because the sector has been an underperformer relatively. The valuations were on the lower side relative to what we have seen in the past few years. We have seen you can say, rally in financials. And I think in the near term, looking at the numbers, for example, you look at, say, even your SBI, the loan growths are not encouraging. Your LDR, yes, it has, you can say, improved a little bit. But I see very little probability of any major upside coming in some of these stocks because even in case of banks, I think where the numbers visibility is more strong and where I think the things are looking far better in terms of growth, I think the people will flock to those. And on a relative basis, I think banks like you can say an ICICI might look better than Kotak at this point of time.
All right. We'll take a quick commercial break here, Amnish. We come back with more questions on the other side, but also some technical trades. Mitesh and Sudarshan with us on the other side. Stay tuned. Okay, welcome back. There's a couple of minutes to go for the pre-open session. 5 minutes to go for the pre-open session. 130 points still on the index. GIFT Nifty, that is. Sudarshan and Mitesh are with us with what they'd like you to do in terms of specific trades. Gentlemen, good morning. Mitesh, Friday we actually took out the earlier high, the 61.8% retracement, and then we ended flat. So just the fizz completely leaked out. What's the prognosis now, Mitesh? What should one do?
Morning, Prashant. I've been calling for some kind of consolidation. We started from the 23rd of April when we made a high of around 24,300. And since then, we've not moved up very strongly. I think now that phase where the indicators have pulled off is coming. Today, if the market opens with a 120, 130 point kind of a gap up and sustains, and does not have a 30-40 point, more than 30-40 point kind of a profit booking decline in the morning, then I think we have a good chance of heading towards the next level, which is 24,750, 800 zones. The overall structure is positive, so I think now is a good time to see if with the hourly charts and 2-hourly charts indicating that the overbought situation has slightly cooled off, there is now more space for the price to move up on an immediate basis. And today, therefore, I would want to see that happen, and we'll trade with the long bias.
Okay, trading with a long bias, looking for some upsides. Got that point, Mitesh. Darshan, morning to you as well. What's your call for the indices?
Yeah, good morning. See, the trend is up. Within an uptrend, we are likely to enter into a prolonged period of consolidation. We have country-specific news, so we are going to be affected by that, the markets. It's not that the market will be immune. So while in an uptrend, when the markets go into a consolidation, as I expect them to do, the trade then is to buy on in sharp dips. Don't run after the open. Don't buy after the open. If you get a 100 to 150 point correction from the opening price, then we buy, that keeps our risk low. Till then, the trade is to wait patiently for that correction to come. And I think it will come. If not today, tomorrow morning.
Okay, so Sudarshan saying wait maybe to buy the dip and it will come. Gentlemen, stay on. We'll take a very quick break. Come back with your stock ideas. Okay, it's 9 a.m. and the rates will start coming in now. The expectation is it's going to be another positive start to begin with, and that's what the Nifty seems to be indicating right now, about 130 on the upside. Let's go back to Mitesh and Sudarshan for some stock ideas as well. Mitesh, what stocks will you go with today?
Morning, Supi. I have all buy list. The first one on the list is DLF, which I would recommend buying with a stop at 675 for a target of 715. IOC is a buy as well. Keep a stop at 140 or just below 140 and look for a first target of 150. A buy on Paytm, which has given a good pullback to its short-term averages, so could bounce back from there. So Paytm is a buy with a stop at 819 for targets of 865, and ITC is the final buy call. Keep a stop at 425, look for targets of 445.
And what about you, Sudarshan? Thanks for that, Mitesh. Sudarshan, what about your stock list for the day?
Well, I have a mix. Adani Ports is a buying opportunity, stop under 1243. Chambal Fertilizers, which now keeps on coming in my list, is a buy, the stop under 681. I also have two intraday shorts, Colgate, stop above 2590, and Crompton, stop above 328. So for me, a consolidation is giving a chance for buying and selling both.
Okay. All right, gentlemen, thank you very much for that. So we'll watch out for, of course, a lot of these stocks. In just a bit, we'll also have Lata joining in. And JSW Steel obviously is going to be a stock that continues to be in focus given the events that transpired on Friday. Nigel, I don't know, you might have gone through more notes that came over the weekend. Is the worst of it already perhaps priced in now? Or what else did you come across?
Well, a lot of the sell-side notes, they believe that maybe, in fact, with that 6% cut, those that are underweight on the sector as well as on the stock, they believe that maybe most of the bad news is priced in. But Amnish, what do y'all think at PL Capital? JSW Steel, valuation-wise, it never has been cheap, but it always gets that premium because you'll get growth. Now, that growth may not be as much as expected if in case Bhushan Power and Steel asset, doesn't ramp up as much. Stock was down 6% in Friday's trading session. It's showing another downtick of around 1.5% in pre-open. Most of the bad news in the price?
It is very difficult to say in the near term, but definitely it is going to put brakes on growth of the company. Okay. And moreover, I think it is not only JSW, there will be now question marks on whoever has purchased assets under the NCLT resolutions. So I think the full impact is yet to play out. I think over the next, say, few days or months, we will get more clarity on that. But definitely, in the near term, we believe that the stock may now remain slightly weak to range bound till the time we get more clarity on how the things are going to be, what is the exact impact, and how they are going to counter it.
Okay, so let's watch for this. The other chatter around this obviously has been what happens to all the money that was spent to buy the asset and the money that was spent then to revive it as well. We've got Lata joining in. Lata, what's the sense that you're picking up in terms of the money that banks also got?
Well, JSW paid the banks 19,300 crores to acquire the nearly 83% stake in Bhushan Power. They paid separately 350 crore to operational creditors. Now, in the judgment which I read, it's a 103-page judgment, in the last order, the Supreme Court says that payments made by JSW to financial creditors and operational creditors should be dealt with as per the statement of Abhishek Manu Singhvi, advocate of the bankers, in an order dated March 6, 2020. So we had to go back to the March 6, 2020 order. On March 6, Singhvi, on behalf of the COC, that is the Committee of Creditors, gave an undertaking that if in the Supreme Court, something happened and the case went against JSW, then all the money paid by JSW to the creditors will be returned. On that strength, that 19,300 has to be paid. In fact, JSW was not satisfied. They further said that that affidavit is not enough. We want all the 47 creditors to sign an agreement that they will repay us. Only then we will go ahead, because this court case was not completed. And the 47 creditors gave that undertaking. It took about a few months. So it was by March 31st, 2021 that the effective date got pushed. And then only the revival started. Now, what happens to the banks? Do they lose because they lose 90,300? Well, analysts are not taking a negative view on banks, because when the liquidation happens, who is to say that you may get a value better than 19,300 crore also? So it's not negative. But the important point is the deep negative that JSW went to perhaps was uncalled for, because they're going to get at least the money they spent. Now, Nigel raised a very correct point. what happens to the money spent on revival of the plant over and above 19,300? JSW sources told me they did not spend a penny. It was the EBITDA or internal accruals of Bhushan Power itself. They raised loans, commercial paper on the strength of Bhushan Power's balance sheet. All that JSW gave was a comfort letter. So they did not spend money on it. However, the value of the plant has gone from 2.5 million tons to 5 million tons. Number of workers from 8,000 to 20,000. That benefit they are not going to harvest, but they don't lose money.
Thank you very much for that. I spoke to a bunch of lawyers as well, and there's a lot of questions still about whether there'll be a review petition in the
There
court.
is going to be a review petition.
But the context to that is that a review can only happen. You cannot the clause says that the judgment has to be wrong in law. Technically, there has to be an issue.
Technicality,
you cannot
review on
argue
technicality.
And say that, well, I don't like it, so I'd like to.
No. I'm not qualified on the law at all.
Yeah, no, that's
all
what
I heard from the bankers and JSW is that they are going to file a review petition. They don't have much hope because if you look at the record, the reviews being carried.
The important thing also is that the petition goes back to the same bench. So,
they might file it, might get thrown out. Correct. I mean, they might not,
And then they have a second leeway. Yeah. They can file a curative petition if the review is rejected.
The only thing is the feedback I got from senior lawyers is very rare, extremely rare for we to sort of...
Curatives you get, but reviews are hardly ever carried, was what I was told.
On the bench, I was, some feedback that I got is, will there be a change in the composition of the bench as well?
So basically, one judge is retiring.
Yes.
No.
I think the lady judge is, retiring sometime.
No,
she's going to come back. So I don't know what time is allowed, etc. Sorry.
The person who is retiring is the Chief Justice, Sanjeev Khanna. On May 14th. The lady, Bela Trivedi, is retiring on June 23rd.
Correct.
So she will have to, the review will go to her only. You can't file the review after 2 months. You have to file the review within...
June 23rd is now.
No. It has to be filed before, within a month or something like that. So it does go to her. All those are very clear now. It goes to the same two people, Bela Trivedi and the other person. So, reviews don't have a record.
The point is that, reviews are extremely rare. I think you need to remember that.
Yeah, that's the point.
That's the bottom line, really. Lata, thank you very much for that. Amnish is with us. Amnish, just a quick word on Reliance Industries, if you will. And actually, two sets of questions. One is RIL, which is up about 9% last week, saw signs of life. And the other is defense. Mazgaon Dock, Garden Reach, you had data patterns and a bunch of others which were all up 15% and more Friday to Friday. That is the last week. So Reliance and these defense names.
Okay. So, Prashant, two things. First on Reliance, you see the stock, if you look at last year and a half, or rather 2 years, it has not gone anywhere. So that is one. Secondly, if you look at the various segments in which they are operating, now, for example, Jio, I think the outlook looks fairly decent even going forward. ARPUs might further increase, and people are also expecting some sort of, you can say, tariff increase to happen, maybe towards the latter half of the year. In retail also, we might have already seen the worst in terms of numbers, and the numbers can actually see some sort of a gradual improvement from there. In some of the other segments, say, for example, your petrochemicals and all, I think your prices are going to improve, and they might also get some benefit from the crude, which is now softening. But I think one big delta which can come in from Reliance is that no one is ascribing today any value to their new energy initiatives. And they have also, now they have started giving you some hint of where there you can say your solar, photovoltaic, this entire initiative goes, how many gigawatts of power they are going to generate, and then green hydrogen and all. So there is likely to be more clarity now as we go along, because I think 1 gigawatt is something which they are very close to commissioning now. I think all these actually makes Reliance more or less, I think the stock bottomed out. It is now trading at, I think, still lower than what it used to trade a couple of years back. So I think Reliance from here on also can give you reasonable returns if you look at in the next 6 to 12 months. Now looking at the...
All right. Amnish, thanks very much for that. Just running into market opening now. Thanks for that quick view on Reliance. By the way, both the large banks are down. That's what we've been flagging off since morning, that numbers are okay. Asset quality is fine. Growth is under a cloud. Kotak Mahindra Bank 3.5% down in pre-open, and SBI down 2.5%. More from the managements in just a bit, but before that, the 9-10 call. So Darshan, the stock you'd go with, and maybe just a quick level check on SBI and Kotak as well.
Well, SBI is a buying opportunity on every dip, and Kotak is a complete avoid. For 9-10, my trades are Adani Ports is a buying opportunity with a stop under 1243.
Okay, all right. And Mitesh, your 9-10 call?
I'll go with a buy on DLF for targets of 7.5.
All right. Okay, gentlemen, thank you very much for the calls and for giving us all of that perspective. Now let's listen into the commentary that's come in from Mr. C.S. Sethi, chairman of SBI. He spoke to us on the fourth quarter performance and the fact that they're a little cautious on the growth guidance going forward, especially on the corporate book as well as on margins given the rate trajectory. Take a look.
More than the tempering, I think what we are aligning with the nominal GDP growth rate. And last year we grew almost 3 to 4% more than the nominal GDP. And we expect now that there will be some slight moderation on the corporate growth side. Whereas SME, agriculture and home loans are doing very well. So I think these sectors will contribute to the growth, and there could be some moderation on the core sector. This is what our expectation is. So while we have good visibility on the corporate book, both on the pipeline for sanctions but not disbursed, and also the pipeline proposals which are in discussion aggregating to around 3.4 trillion rupees, we see maybe around 12% growth rate on that. Why am I moderating on the corporate growth is that we see an effort to deleverage further on the corporate side. And we are witnessing a great amount of prepayments and which is bringing down the growth rate. Otherwise, the mid corporate is growing well. Large corporates seem to be on the deleveraging spree.
Well, that is the commentary from the big banks which reported numbers over the weekend. There are some flashes at the bottom of the screen as well with regards to auto. The pre-open has come to an end. Let's just quickly run through, the Nifty Bank and some stocks as well, and take a look at what's happening. 70 points higher on the Nifty Bank will come up. So it's absolutely flat in the mid and the small cap indices. Maybe just a quick look as well. So a couple of stocks, right? I mean, so we should look at DMart at the end of the pre-open where we are starting. And of course, there is the earnings to react to 2.5% lower on DMart. Marico we should look at for a quick bit. And of course, again, earnings in focus from Marico. And that is up about 1.7%. Tata Motors resuming exports to the US, which Sudarshan highlighted in the morning. So that's about 1.7 higher at this point. And maybe just take a look at stocks like, ONGC, Oil India, which should be negatively impacted as the price of crude has dropped sharply. 1.5 lower on ONGC, Oil India. And I think you'll also have, the other side, the OMCs, HP, IOC, BP, the paint companies, etc. As again, Sudarshan highlighted, these are crude sensitives. And we've seen a very sharp move down 10% in about 10 trading sessions on as far as the price of oil is concerned. So Asian Paints is up about 0.5, and of course some other paint sensitives will also be doing well at this point. Just maybe 2-3 more names. RR Kabel, and you'll hear from the management, by the way, a little later. RR Kabel, CDSL, NetWeb Tech. So enough and more to track. It's RR Kabel is up 14%.
Yes. Solid numbers.
Wow, I mean, that's quite something,
this
right?
Fourth quarter. Yeah.
And as I said, coming up in a bit, NetWeb is another one, 10-11% higher. So actually, the moves in terms of earnings reactions are coming through in the smaller names and not the bigger guys, not the big banks, etc. But this is the part of the market where there is a fair bit of excitement on the back of these numbers which are coming. So I think we're about 1 minute out as far as the market open is concerned, less than a minute out, a few seconds actually. So we'll look at prices in terms of the indices, and we'll look at some of these individual stocks and how they start to react as we get into market open. What do we have? Should come up any time now. There we go. That's the opening bell, and we're up 1/3%. So 24,400 plus on the Nifty. Remember, we are still about 150 points off the high that we saw on Friday. Let's see if we are able to recoup some of that. 0.25% higher in the Nifty Bank. 52,200 is where we are in the Nifty Bank. But very quickly, I mean, we are back under it. So gains on the Nifty Bank need to be tracked. Mid-cap index is up 0.6, so that's much better. And the small-cap index is up about 0.12% as well. The heat map should give you a snapshot view of how we are starting this morning, and then we'll take it from there. So very few names are down. Bulk of what we have on the wall, at least on the Nifty, is up and about in the green. 100 points on the Nifty. Surabhi.
I was just looking at numbers for NetWeb, considering it was doing so well in the pre-open. I mean, it's astounding performance, top line, bottom line margins, and that stock's, of course, starting out solid in positive territory. But anyway, Nifty, let's look at what's moving here. The banks are slightly lower. Kotak is down 3% as the pre-open was indicating. The dip on SBI is indeed getting bought. That's exactly what Sudarshan was telling us, that could be a good trade. ONGC is down 3.5%. There's a massive decline, 4% drop on crude oil prices this morning. That's weighing. So it's lower quite a bit. JSW Steel is still down about 1% lower. SBI is trying to cut its losses. L&T is 0.5% lower. But the rest of the market up and about. So let's look at the upside of the screen then. You have Shriram Finance in leadership position, 2% on that stock. Adani Ports is up about 2%. Asian Paints is up about 2% as we speak. In fact, some of the smaller paint companies like Berger, even Kansai Nerolac, they're managing a small bit of green as well as crude oil prices come off quite sharply. M&M is reporting numbers today. Ahead of numbers, stocks up about 1.5%. Eternal, Titan, some of the discretionary consumption plays are seeing some buying. ICICI Bank is looking quite okay. It's a good counterbalance to the fall on Kotak. And Reliance is chugging along quite nicely, 0.5% up. ITC is also adding some weight. HDFC Bank is well up about 0.8%. So it's actually a very well-balanced market. ICICI, HDFC Bank offsetting some of the decline on Kotak or say SBI and other heavyweights also packing in a punch. So not bad, Nigel.
Well, that's right. Just keep an eye out on Force Motors. You know, they came out with their monthly numbers and the numbers look quite good. Keep in mind the stock was up close to 8 to 9% in Friday's trading session itself. But it's a bazooka move yet again. Force Motors is now up close to around 5%. So big move is what we're seeing out there. The focus on premiumization and the Urbania vehicle, that seems to be helping their case because realizations will be much better in comparison to the erstwhile Force Motor favorite that we used to see. So the Traveller, that is. Well, focusing on a couple of other names. V-Mart is down 6%. So quite a lot of selling we've seen out there. We're seeing Nuvama Wealth Management as well as down close to around 5%. Jindal Saw is another name that's down close to around 4%. Out there, the profitability, in fact, has come down a little bit. Even if you adjust it for it, it looks pretty much okay. 4% lower than what Philip was working with, and their order book has declined. So I think that's why the street is a little bit cautious on that name. But the stock of the morning has to be RR Kabel, bazooka move out there. NetWeb also, good move is what we're seeing out there. Prime Focus is another stock that's actually opened up in the green. We normally don't talk about that name, but it's up close to around 7%. So just highlighting that stock as well. And CDSL, taking it on the chin. That stock down 5%. Speaking of stocks taking it on the chin, look at Utkarsh Small Finance Bank. I mean, it's, I think, a disaster on every single parameter from margins to gross NPAs. Gross NPAs have gone from about 6% to 9% plus and big pressure on margins as well. Stocks down 4%. That's Utkarsh Small Finance Bank.
All right. So lots of stuff going on. And I think we'll have a fair bit coming through in terms of the action. We got, 90 points on the Nifty. We got about 24,440. The news flash at the bottom of the screen, the Adani Group, and this is from Bloomberg, Adani Group officials will be meeting with the Trump administration to dismiss criminal charges in the US. I mean, that entire process, etc., which was going on. So that is what Bloomberg is reporting at this point in time. Harish Krishnan is co-CIO and head of equity at Aditya Birla Sun Life Mutual Fund. Harish, good to have you with us here. Good morning. Thanks very much for your time. What is your and your team's assessment on the earnings so far? You know, it's a dichotomy, right? Macros, we find ourselves in very, very comfortable macro kind of situation, even given all the tariff noise, etc. I'm keeping the geopolitical stuff aside. You know, oil and the other usual stuff, which kind of defines the quadrant of what we kind of look at macro with regards to India. But on the other hand, earnings are still quite disappointing. They were supposed to be pretty poor for the fourth quarter, and I think they're following the script. Where does it leave markets, Harish?
Good morning, Prashant. Right, so of the 150-odd companies that have reported earnings, among the top 500, we've seen about a 5 to 6% growth at their top lines and a similar kind of a quantum increase when it comes to their bottom line profits. Of course, one needs to keep it in context as to the big reset moves that we've seen over the course of the last 3-4 months. Keep in mind that a lot of the slowdown in growth that was happening in India was a function of both significant fiscal consolidation that we had seen in FY25, as well as reasonable monetary tightening that had happened with slowing credit growth that had happened, about 6 months back. We've seen a significant pivot on both of these moves, with some amount of, fiscal spending coming back, courtesy the tax cuts that came through. Of course, we've subsequently seen a reasonable amount of correction in crude oil, which again should buttress a significant amount of fiscal position. Possibly it can lead to greater spending down the line. But the big shift has happened on the monetary side, where there is definitely an urging of the credit institutions to get back to growth. Now, both of these levers typically take anywhere between 6 to 9 months to show up. And therefore, we're not really so worried from a market level point of view of this slack in earnings that we currently are witnessing. Possibly in under 6-9 months, I would think the Diwali quarter, etc., we will be singing a very different tune when it comes to earnings. So I think the market and the way we are thinking about is to look at whether the delta change in that impulse is more likely to be positive going ahead. And to that mind, I think especially in a lot of domestic oriented sectors, we kind of believe that that's more likely to be the case as we get on to FY26 and possibly FY27.
Harish, hi, morning. So you're saying by Diwali, we'll be singing a very different earnings tune, like a more pleasant one. That's what you're saying, that the market is a little too bearish and earnings will pick up?
That's right. So, like we've discussed in the past also, we've got each of these two resets, which is one is as far as the fiscal impulse is concerned, second is the monetary impulse, third, and of course, there is also the currency angle. Typically, a depreciated currency typically leads to an earnings upgrade about 12-18 months from there. Of course, we've seen a lot of the currency depreciation kind of claw back thanks to the dollar weakness in the last month or so, but still that is still net positive for earnings. So I think a combination of these three, to our mind, will lead to a slightly higher earnings growth. Of course, we are not saying that, if it was a 6% earnings growth, it will become magically 20% earnings growth. But can there be a potential, say, 2 to 3% higher earnings growth than what is currently being penciled in? We would like to think that that's very much possible as we look at FY26 end and more importantly at FY27.
All right. Hi, Harish. Good morning. Good to see you, Ben. Harish, so going by what you're saying, bulk of the correction is already in the price. The worst could be behind for the Indian markets and things could look up from here. I hope I'm getting that correct.
We think so, Nigel. So, I mean, when we look at the numbers, right, the Indian market cap has seen a drawdown of about 28% in dollar terms. Now, if you run this analysis from 2001, generally the drawdowns typically peak or bottom out, however you want to look at it, at around anywhere between 30 to 35% in dollar terms. So that really seems to suggest that there's a reasonable amount of flush of that excessive valuations and fraud that was there, over the course of the last year or so, that's kind of got cleaned out. Another data point that may be of interest to the foreign allocators, because we've seen significant amount of foreign selling in those 6 months. If you were to look at India's share of the world GDP, that's currently tracking at about 3.75%. And in our assessment, over the course of the next decade or so, this 3.75% of the world GDP is anywhere likely to track between 6 to 8%. That's pure math. The fact that, on a nominal base, we're growing at a faster rate compared to the world economic activity. More importantly is India's share of the world market cap. That bottomed out at 3% in March of 2025. The key question that foreign allocators will start thinking about is, if in a decade from now, we're likely to see anywhere between 6 to 8% of world economic activity, is 3% of world market cap a good enough entry point to participate in that long runway? We certainly do think that that's a very good time frame for global capital allocators to come through, and which is why, in totality, we do think that the worst is likely behind. That doesn't mean that, the next month we're going to see another positive month, etc. But we are definitely thinking that, one needs to be constructive on markets and on Indian equities going ahead.
How do you talking about asset allocation, how have you all changed your allocation strategy? Say when we had gone into that, in a bit of a tizzy in the month of March, what was it at that point of time, exposure to equities? Currently, what is it and how do you see it moving ahead?
Sure. So if you look at our asset allocation products, let's take the Balance Advantage Fund. We were at about 38% in mid of October when, the carnage kind of started. As the correction happened and valuations became more attractive and the froth kind of died out, we went close to about 70% in mid of March. Currently, we are at about 68, 69%. So we're pretty much holding on to those levels, which we've seen in, mid-March. In terms of our asset allocation. Just in terms of context, this product broadly varies from 30% to 80%. That's the gauge of equity valuation. So we are close to the higher end at this point of time, given the reasonable attractiveness of Indian equities from a long-term point of view.
By the way, I just want to point out Kotak Mahindra Bank, worthy of a mention here, because stocks down 5%. And because of this downward draft, SBI is also down 1.5%. The upside or the counter that we were getting from HDFC Bank and ICICI Bank, suddenly it's not enough. The Bank Nifty slipped because of these two banks. 5% down on Kotak Mahindra Bank. And, just a revision here, Kotak's asset, or rather advances growth is about 13% year on year. And the market perhaps is feeling it's not enough. Even the quarter on quarter growth, perhaps not enough. Harish, comment on this. Growth concerns for lenders, given the fact that they've run up very nicely through April. What would you play here in large banks, and how valid are some of these growth concerns?
I think, the reaction of the results are more a function of the fact that they had run up quite well, going into these events. Many of these banks are up 20-25% year to date. And therefore, there is some kind of booking of those profits. Like I said, we do think that, the overall credit growth is likely to head higher as we look at over the course of the next year and two. We think that, the larger financiers are extremely well placed, primarily because they've got very good capital positions. The extent of competition which is there in the overall credit market is actually kind of come down quite significantly. A lot of fintechs, etc., were breathing down their necks. They're no longer there. Even a lot of smaller franchises, their access to capital markets is kind of starved at this point of time. So we think that the large banks definitely are in a very good position. Yes, we do think that India cannot do with just 4 banks or 5 banks. There needs to be a lot more credit institutions that need to thrive. And therefore, we are playing a barbell through a basket of the significantly undervalued private financiers, which are below book. So that's the other end of the basket that we are playing. But our core position is in our larger private sector banks, which, of course, today they've taken it on the chin. But I think, from a broader perspective, the trend that they've seen remains pretty much intact. And we do think that, the growth concerns are more a function of the past. And as we look at the year and beyond, we do think that growth will start inching upwards.
Absolutely. Harish, you're bullish, and you're bullish that earnings will pick up as well, right? Because we need that to happen. Otherwise, you kind of very quickly valuation problems. So earnings have to expand. What is your sense? I mean, by Diwali, as you said, things will look very different. So for 26 and beyond, what kind of earnings growth are you expecting, Nifty?
So again, just to kind of nuance it, it's not, like I said, we're not expecting a 20% earnings growth to come through anytime soon. It's still a muddle-through economy. Today, market is pricing in, a single-digit earnings growth kind of from a buy-side perspective. I'm not even getting into the consensus estimates. We do think that a 12-13% growth is quite possible as we look at the end of FY26, and that can further improve by 1% or so when we look at FY27. Of course, there are a lot of moving parts, notwithstanding the global part of it, which we haven't discussed. But even when we look at the global perspective, we do think that India is more favorably placed even amidst the global wars. Of course, if there is going to be a complete uncertainty, a phase of uncertainty that's going to cripple decision making, then of course, we will see some kind of a pressure. But the way the markets have reacted, and again, I'm not talking about the Indian markets, I'm talking about the US markets, where, they've kind of recovered almost all the losses that they did post-Liberation Day. It does seem to suggest that the market view is that, we will not be going through this prolonged phase of uncertainty beyond the next 3 to 6 months. If that really is the base case, we do feel very optimistic about earnings improving. Again, the trajectory and the rate of change is what we are talking about. We're not talking about a very significant magnitude of that delta change. But the rate of change is definitely, to our mind, looking to be far more positive as we end FY26 and as we get into FY27.
Harish, compliments to you. I think you are one of the most bullish voices that I've heard in the last several weeks. It really stands out. And that Diwali call we shall remember. We'll talk to you, of course, along the way and around Diwali as well. We really hope, for the sake of the markets and the economy, that what you're saying is really what comes through. Thank you for joining in. Have a great day. Thank you. All right, so let's get back to our corporate conversations. And the next management and the stock and the company on our radar is Bajaj Auto. The April sales came in slightly below street estimates. Domestic sales seem to be still under a little bit of pressure. Exports, however, continue to pick up. So let's discuss the demand environment. We have Mr. Rakesh Sharma, Executive Director at Bajaj Auto, joining in. Mr. Sharma, good morning, sir. Always a pleasure to have you on. So, I have to start with this, right? Because expectations are running tall. And it's been a tough last couple of months. Now, on the two-wheeler segment, I know three-wheeler sales picked up. But on the two-wheeler side, I think sales are down about 7% overall. Domestic sales were down a little more, a little over 10%. So what's happening in April? Is this pickup not coming through? What are the signs you're getting on the ground?
Good morning. Not last 2 months, but I would say post October, it's been a very choppy domestic motorcycles market. And if you recall, Q4 was almost -2 or -3% for the industry. And therefore, April, looking out for April was very important because it's also like a mini season in the north, which are the marriage markets, which, by the way, constitute almost about 45% of the industry, which is the marriage markets. And there has been a very smart growth over March in April. That is the metric we were looking out for. It's difficult to compare this April with the last one. It would be a flawed comparison because all the marriages last year in the north were, bunched in April. So April was a big spike. But this year, happily so, the marriages are evenly spread out over April-June period. So therefore, we were looking to understand the industry and to understand our relative performance in the industry. We were looking more at how April is behaving versus March rather than previous April. So both from an industry point of view, there has been a very good growth, which is very heartening because it shows directionally the industry could be getting back into some growth.
I take your point, sir, and absolutely no harm in looking at quarter to quarter, given that the base is different with the marriage season being different. But so slightly wider question, we've just seen the first month of this year. How confident are you about an overall recovery? So, monthly run rate should be back above, say, 4 lakh units. If April is the right litmus test, you just heard the analyst there, not the analyst actually, the stock investor over there from one of the mutual fund houses saying that he's penciling in big recovery by the time we're in Diwali. For your business, for two-wheelers, domestic specifically, what do you see ahead next few months?
Well, I didn't listen in to what was being said in particular, but I think there is, April is pointing towards a recovery. And like I said, it would be erroneous to just look at 1 month because that is the nature of the things right now. It was, when there is growth, it's wrong to extrapolate it and vice versa. But I think the industry delivered a 5 to 6% growth over the last financial year. And our estimate is that it should continue to do so. However, it may not be evenly spread across all quarters. We feel that Q1 should be a growth once we complete the quarter. And the right time to really understand the industry would be more around June or so. But at this point of time, yes, it is looking like basis April that industry over the financial year should behave very similar to what it has done last year.
Just a word on specifically on individual models, on Pulsar, maybe even others. Were there any price cuts taken in April?
In fact, it was a mixed bag. There has been some inflation, so we've passed on some pricing, and some of the models we have adjusted the pricing, particularly at the entry-level Pulsars, etc. Once we've got all the inflation costs, OBD2 costs, etc., and looked at competition, we have sort of calibrated the pricing. So it's a mixed bag. Overall, there have been some price cuts and there have been some price increases in domestic motorcycles as well as exports.
Could you tell us on the Pulsar particularly, Mr. Sharma, has there been a cut?
I mean, Pulsar has 15 or more than 15 models. So there has been a price cut in some and there has been price increase in some.
Okay, you want to talk about it?
Our sales is Pulsar. So it's a very, very wide spectrum.
So you want to talk about it on a blended basis? What was the pricing change?
I don't have that number readily in my mind, but these are very minor changes. They're within -2 to +2%.
Got it. Okay, all right. That would be a fair estimate. TVS in the earnings call, they spoke about the African market hitting rock bottom and they're expecting growth from here on. Could you tell us what is the run rate you did in Nigeria? Because that's a market that we normally talk about. Is there a recovery that we're seeing? How is the trend?
Well, this period in Africa, particularly Nigeria, is a low period after the highs of Christmas and immediately post-Christmas. The market sort of goes in Jan, Feb, March, and then into a decline. And then it sort of picks up again, I think, in August, September. So our retails are at about 15 to 18,000 units per month in this period. I would say slightly below expectation because we have sensed that the latest round of volatility caused by all the geopolitics as well as discussions on tariffs, etc., has dampened the sentiment a little bit from a currency point of view in Nigeria. You see, what happens is the currency appreciates also. It's almost a dollarized economy, so people start to hold back purchases, hoping that it'll become stronger and the prices will sort of steady. So there has been a little bit of uncertainty over the last couple of months. It is settling down now, and hopefully things should start picking up.
So, sir, to round it up, if we talk about, say, exports in this month, you did about 1.45 lakh units with a 4% growth. So if we talk about the near future, because I understand there's too many moving parts for long-term visibility, but let's say next 3-4 months, what should be a steady run rate on exports in terms of absolute units and also the domestic two-wheeler segment?
Well, I think the exports will, this month is in particular, again, a base effect, which is there because, there is shipping adjustments, etc., depending on how actually the sailings occur. And it's not 4% in real terms. I would say that we should be clocking between 10 and 15% growth in the next 3-4 months horizon, like you say, and which is the growth which we've been clocking over the last few months. And we expect the same to continue. So we are talking about 160,000-170,000 units per month.
All right, Mr. Sharma, thanks a lot for stopping by and filling us in with your take on how the industry is panning out as well as for Bajaj Auto. We look forward to having a chat with you as the month progresses. Let's focus on Godrej Properties. The numbers look pretty okay. The guidance to some analysts were a little softer than what was expected. To help us out with the numbers, we're joined by the MD and CEO, Mr. Gaurav Pandey. Hi, Mr. Pandey. Thanks a lot for joining in. Well, a pretty good set in Q4, but you have guided for deliveries as well as business development to be significant lower in FY26. What's the reason for this execution slowdown?
I mean, not not really slow down because if you go take a step back, right, we gave a guidance of 27,000 crores of sale for FY25. And when we're looking from a guidance perspective of this year, we wanted to do a 20% growth on the previous guidance, which meant we would like to guide the market at 32,500 crores of sales. And we did about 29,444 crores this year, which is the highest sales by any residential developer ever. And the idea was very simple that, we like to be very confident of our guidance and beat the guidance. If you see our track record, we always exceeded our guidance. So this is a number we want to really hold ourselves to. And from a collection metric, actually is even more stronger because, a lot of this business, the value gets created not just from sales, but how are you unlocking that value through great, asset management leading to great collections. So if you see our collections, previous financial year, which is FY25, was about 70,000 crores, which is like, massive growth over the previous high base. So like a 49% growth. In fact, our operating cash flows were like close to 7,500 crores, like a 73% Y-on-Y growth. And in spite of such a high base, we're looking forward to delivering 21,000 crores of collections over an actuals of 70,000 crores of last year. So I think the idea is to be very aggressive on our growth. And from a deliveries point of view, which is basically projects that will get into actual deliveries, we were able to bring some Q1 projects into previous financial year from an OC point of view. So against a guidance of 15 million square feet for last year, we did about 18.4, and some of which was preponement of these. And second was last financial year was also seeing a very high base effect of commercial, because we have a commercial portfolio. We saw almost 4.3 million square feet of commercial portfolio getting into occupancy certificates last year. And this is more of a, one-time event which happens once in a few years where you have suddenly a lot of OCs coming in. So yeah, again, in spite of such a high base, we're still looking at adding 10 million more square feet of deliveries next year.
All right, Mr. Pandey, let's get further into that detail then. Even if you take into consideration the fact that deliveries have exceeded FY25 guidance of around 15 million square feet by approximately 3.5 million square feet, there is still a decline of around 50% in the guidance what you're giving for FY26. What is the reason?
Finally, projects from a delivery happen because of the sales you've done 4-5 years back, right? Because you'd sell today, and because real estate is a place where you have to build tall story buildings, you have to get a lot of amenities ready. It's a 4 to 5 years and sometimes 3 years kind of a average cycle that you get to see. So the sales that you're seeing of last 2-3 years, that dramatic delivery you'll see in next 2 to 3 years onward, right? Whereas the deliveries you're seeing today is emanating from the sales done earlier, right? So each year we're trying to prepone. So try and see from a scale point of view, about 2-3 years back, our actual delivery was about 6.6 million square feet. So if you study our data, we were doing about 5,000 crores worth of sale and grew to about 7,850 crores. This is from FY18, 5,000 crore sales. We grew to about 7,850 crores by FY22. And then the exponential growth started, where the next year we did about 12,200 crores, then 22,500 crores, and this year 29,400 crores, right? But this exponential growth in deliveries will happen, like I was mentioning, 3 to 5 years from when the sales happen. Whereas from an actual OC delivery, we were doing about 6.6 million square feet, give or take 2-3 years back. Last year, we did about 12.5 million square feet, which was a huge, massive jump. Then we did about 18.4. So you can imagine there's a lot of execution efficiency, which has brought preponement of OC year by year. And then there'll be a lag of maybe a year or so when again the OC jump will happen.
Now, I take that point. Gaurav, you've guided for bookings growth of about 10% year on year for FY26. But last 3 years, we've seen significantly higher growth rates. And I think that was what we were trying to understand earlier as well, between 31 to 84%. So once again, I mean, what is the reason for the subdued guidance, if you can be specific? Are we seeing a bit of a slowdown in the overall sales as well?
Not on the contrary. I mean, if you see our Q2 and Q3 sale, they were about 5,000 plus crores. Our Q4 was a record 10,000 plus crores, the best ever number we've ever done. And if you see, in spite of very high base of 22,000 plus crores, in the FY24 cycle, we registered a 31% growth in last financial year, which is 29,444 crores. Our volume growth itself is been like 29% and 25.7 plus million square feet of volume that we've delivered. In fact, we were selling like 42 homes each day. That's the kind of scale we're achieving. Now, when you give guidance, right? I mean, what is the way you build upon guidance? So try and see our numbers from some context. We've grown about like 55% CAGR in the last 3 odd years, right? And when you have a very high base effect, you want to be very watchful that you guide the market in a way where you definitely deliver that and you tend to surpass that, right? On a very high base effect of growing so rapidly. So I think it's largely emanating from that perspective. It's not at all coming from a market risk perspective. I do feel there is an upside risk to that. And, the heartening thing for us, what we're looking from growth point of view is a slightly different strategy. If you see our numbers in FY20, we are under our economic interest in our projects used to be about 41%. And the economic interest in our projects last year is about 93%. The sales attributable to our P&L has grown by 11x in 5 years. So our focus a lot is going to be on execution and getting those into deliveries and accounting profit of the logged in profit and maintaining a very strong growth, which is about 20% on the FY25 guidance. So FY25 guidance was 27,000 crores. And we want to deliver a 20% on from a guidance to guidance perspective, about 32,500 crores. But yes, you're right. It's a 10% over a last year number. So I do feel we will have a good shot of kind of beating it. But like I said, we are a sort of an institution which has always over-delivered over what we say and do. And I'm very excited that with the kind of Q4 and the head start we're seeing in this quarter, there's no reason why we can't do better. But again, like I said, I just want to mention that we would like to guide the market on a sort of a more or less short number.
Okay, so let's talk about the expectations for FY26 in terms of the collections. How much of your collections will come in from existing bookings? How much would be from perhaps new bookings?
I mean, largely, we're looking at a growth from 17,000 crores to 21,000 crores worth of collections. If you just look at from a perspective, we did close to 7,000 crores of collections in Q4 and preponement of a lot of these milestones of deliveries helped us getting it. I think collection as a metric moves, basis the quality of sale you do than any other metric. So I think our quality of sale is very, very high. And because of that, we're very confident that we should be able to meet and exceed, hopefully, the guidance of 21,000 crores. And this, just to give an idea, fun fact is the kind of collections we did, to the best of my memory, maybe there will be only 2 developers who do sales more than in the last financial year. So the guidance we're trying to give you from a collections is for 99% of Indian real estate, sales don't happen at that particular sort of a number. So yeah, it's a very strong number and we're gunning towards achieving that.
We take that on board, Mr. Pandey, and we congratulate you on that feat as well. Well done to you as well as the team. But let's focus on another couple of aspects. How much of the land acquisition did you do in FY25? And how much are you planning to do in FY26? How much of this will be new land acquisition in comparison to joint development? Give us some clarity.
I mean, we did about close to 14 transactions last year. We in fact bought 3 land parcels in auction in Kharagar. Otherwise, if I count them into 16, but consolidating them into one project is 14 land parcels and logged in about 26,450 crores of revenue potential through that. And we've, mostly we like to have very conservative guidance for business development because this is one metric we don't like to put, like a pressure on us that we have to acquire this much. But there is no reason we can't easily exceed that, because of the opportunities. These are binary number. But yes, we've given a sort of a very conservative guidance of 20,000 crores of business development that we want to do. But yeah, I mean, this has an upside risk, but this is not one metric we lose sleep over. We have to buy land parcels at the right valuation, at the right time in the right micro markets. But yeah, fair to say we have enough and more pipeline to meet this guidance.
Okay, Gaurav, finally, your cash flows have grown significantly. I think you're at about 7,400 crores as of the end of last year. What is the utilization and, how's the position looking from a cash perspective?
I mean, this is the number which is a derivative of your cost of construction and collections. We really don't give a guidance on operating cash flow. But yes, like I was mentioning, we have a very healthy visibility of, collections. We will be increasing collections of 17,000 crores to 21,000 crores. So yeah, I feel we will continue to hit very good operating cash flows in this year and the years to come, because we've now got a vicious circle of good project churn and high quality of sales.
All right. Okay, Gaurav, we'll leave it on that note. Thank you very much for joining in, and good luck for the rest of the year. We have to take a very quick break right now, but we'll come back on the other side. Markets holding up 0.5% of the Nifty. Midcap's doing very well. We will be in conversation with the management of Kabel and talk about their performance in Q4.
Okay, welcome back. We have Kabel with us. Stocks up 13% as we speak on the back of strong performance for the fourth quarter. We have Rajesh Jain, Chief Financial Officer of the company, joining us. Mr. Jain, good morning. Good to have you back on the program. Could you talk to us about the quarter gone by? Because if you actually look at what you've done in terms of growth and volumes, it is below what you actually yourself guided for. But I guess what the market is taking heart from is that you've done much better than some of your peers, especially players like Havells, etc. Both on the top line front, there is a big sort of beat if I look at fourth quarter for you and fourth quarter for them, both wires and cables. Margins also have come up from on a quarter-on-quarter basis from about 7 to 10% for you. Could you run us through what were the drivers for this?
Good morning, and thanks for me having on your channel. Yeah, this was our best quarter and best year in our history, and this we could achieve through growth in volumes and margin improvement also, and product mix also. This was like we have seen a very good demand in domestic as well as export market also, and wire, which is our core segment, there also we have seen good uplift.
Yeah, but sir, the point is that absolutely, and we should pull up a one-year chart of Kabel, and today's stock price reaction is a study in how positioning is very important for the market. Can we get a one-year chart on Kabel, please? The stock, when the market correction started in October, used to be a 1,700 rupee stock. Today, we're talking 1,100. And then from muted expectations comes in this performance, which is blowing past those expectations. So, sir, the point is that, yes, your wires and cables margin has come to 9%. Your EBIT losses for your FMEG business, they're also reducing. But can you give us some further guidance? Wire and cables, what is the growth rate you're expecting in that business this year? And on this FMEG losses as well, do you see a break-even possibility maybe in some quarters down the line?
Yes, so we have come up with Project Rise, which is having 3 years, like our vision, how we'll grow in our wire and cable business and FMEG business. And there we are expecting to grow at 18% in wire and cable and 25% growth in FMEG. On margin front also, we are expecting to improve and want to see double-digit margins 2 to 3 years down the line. And in FMEG, like of course, this year we will have positive break-even.
Sir, can we get slightly more near-term? I know that's a big rise plan. That's your 3-year perspective. You're really, putting a lot of capex to work as well. But can we get some more visibility? Let's talk FY26. What is the improvement in margins that you can look at for wires and cables? You're at about 10% right now. So by the end of 12 months, where do you want to be? And for FMEG, that EBIT loss, will it completely get wiped out this year?
Yes, this year we will have a positive EBIT in our FMEG business. And even in wire and cable, like when we are targeting, say, 300 basis improvement in 3 years, it means like year on year, we are targeting 100%, 100 basis improvement year on year in wire and cable business.
All right. Mr. Jain, just to clear the air, on your wire and cables business, the EBIT margin has come in at the highest you have seen since Q3 FY23. at around 9.9%. You're saying you can hold on to this 10% EBIT margins for cables and wires for the coming year. Did we get that correct?
No, not like that. Like last year, we had EBIT margins in wire and cable around 7.4%, and
Yes.
this year we are targeting to have it between 8 to 8.5%.
Got it. So that clears out the air, because I was just looking at a trend, and the last quarter when I welcomed you, I said that it was the lowest margin in multiple quarters. This time around, it's the highest in multiple quarters, but you cleared the air 8 to around 8.5%. Yes. FMEG, you had told us that Q1 FY26, you're looking at breaking even in FMEG. Is that possible? The coming quarter, you turn positive?
Yeah, so we are quite near to that, maybe from slightly negative to positive. We are targeting almost it will be near break-even in this quarter.
Near break-even, but for the first half of the year, definitely it will break even, correct?
Yes, sure.
Got it. Okay, that's out of the way. You have a couple of challenges, Mr. Jain, and I like your optimism actually, because you have a new player that's lurking in the offing. The Birlas are eyeing this space, but as you told us last time around, the industry is big enough to take on, a new player. But you have also laid out some capex plans. So give us a few details on the capex plan first. What kind of an asset turn can we look at, margin profile, and how do you fund this expansion? Go ahead, sir.
Yeah, so we are coming with expansion at our Silvassa and Waghodia facilities, and this will be majorly focused on cable. So we are expecting to have a asset turn of around 3.5 times. And since this will be we are very small player in cable, and this will increase our cable capacity to great extent, and we'll have higher growth in our cable business. This will be majorly funded through internal accruals, and there may be some short-term requirement of term loan for this asset or expansion.
Mr. Jain, just to come back to the margin picture for a cable and wire company, right? I mean, I'm assuming it's all about copper prices, isn't it? More for wires than for cables. So wouldn't it entirely, almost 90-95% depend on the price of copper?
Not exactly for that. Yeah, of course, it has a huge impact on our profitability. And as you have seen in last quarter itself, we were more than 9.5%. But to some extent, it is majorly related with our volumes also. If we have greater volumes, then our margins will be always on better side. So, of course, it has some impact, but we have capability to pass on this impact to our consumers also with some lagged impact.
Correct. So volume. So I think, as you said, volume is what we should focus on really, because the value is really, about the price of the metal. So what should we expect? Volume growth in FY26?
It will be around 18%.
18% volume growth.
Yes.
Okay. Your guidance for 25 was 15%, right? You ended with about 7.5%, right?
Yes. So last year it was around 10% volume growth.
But that is FY25.
Yes.
And you're saying now it'll be 80. You're targeting 18%.
Yeah. So since we are adding some capacity in our cable also, and this will be operational in this year, so that's why it seems achievable.
Sir, talking about the capex, I believe your capex for the Waghodia facility is about 1,050 crores, and then your capex at Silvassa, I think, is about 400 crores. What's the total capex? Can you give us a number?
Yeah, these numbers are correct, but in this Silvassa capex, our 250 crore is impact of previous capex also, which is going to completed in this year. So net capex, new capex is around 1,200 crores, and 250 is carry on effect of previous. Yeah.
Got it. So new capex of 1,200 crore. How much is coming in from internal accruals? How much will you have to borrow? And just give us an update on the balance sheet position then. How much cash will you be left with, if at all? Will debt equity go up to what level? Just an idea for the capex.
So overall, even if you see our current leverage is very good, and our debt ratio is at optimum level, and right now we do not have any term debt, and it seems that out of this 1,200 crores, we may require a term loan of around 200 to 300 crores, and it also depends. If we have higher accruals, then it may reduce also.
All right, Mr. Jain, you have a fair bit of your mix comes in from exports, a fourth of your business. Could you help us out with how do you see traction out there? Is there, some resistance from your buyers? And how much of your, as a percentage of exports or as a percentage of your total pie, how much goes to the United States? Because President Trump, is on a roll with all these tariffs. How much do you all export there?
Yes, so like almost 26% of revenue is coming from our export, and within that also like almost 10% of my overall revenue is coming from US. Sorry, of export revenue is coming from US. So it will not have that much impact. Yeah, of course there is still uncertainty, but what we think we are on like positive side. India is on positive side, and even if there are some decisions, India will be in beneficial position. Apart from that, also since we are now making a big expansion in cable, and we have seen a very good traction in demand from our export market also. So we see a very positive growth on the even in coming year.
Okay, so no big signs of slowdown as of now is what you're telling us, and you believe India will ultimately come on top, and in that sense, Kabel as well will do well, correct?
Sure, yes.
The timing of this capex coming on is the same time that the Birlas are going to come on with their capex as well. Both of them come on stream, I think, at the similar time. Your outlook as well as theirs. How sure are you on terms of demand? Do you think it'll be a bit of a problem, or do you think you have got this covered?
No, it is a very good scenario in the India market, also in international markets. And as I explained in our previous meeting also, that we don't see any issue in growth of India, and particularly in wire and cable industry, and there is enough scope for everyone to grow. And since this capex was already planned, and we are firm on this with looking to the market scenario, and it is going to be a very good achievement.
All right, Mr. Jain, I remember the last time around you said you're not too perturbed. The stock, though, had seen a sharp correction. Your numbers are speaking, though, and they look good. And your confidence about the year ahead as well is quite good. The last year, though, volume guidance, what you gave and what you achieved, there was a bit of a gap. This year, we wish you well, and we'll hold you to all of these numbers. Thanks a lot for joining in, Mr. Jain, and filling us in with that. That's the management of Kabel. They're guiding for 18% volume growth. On the EBIT front for the wires and cables business, they're talking about 8 to around 8.5%. And the FMEG business that's been delivering losses, they say that'll turn around, and in fact, that'll deliver a positive number as well. Let's get in Mitesh Thakkar back on the show. Hi, Mitesh. Good to see you in as always. 10 a.m. and the Nifty bank that was showing weakness for around 30 minutes or so, that's almost moved into the green. So that buy on dip has worked out there. The Nifty as well up 150 points. Is today the day we go ahead and conquer the 24,500 mark?
Morning, Nigel. I think that's a real possibility. And, the idea was that last few days we were quite overbought on the Nifty hourly into hourly charts. And that's why, we were seeing supply and profit booking at higher levels. It could still happen, but I think given the fact that there has been some cool off on Friday, I think the odds are that we could possibly, get past and close about 24,500. Once that happens, 24,750, 800 is the next area to look at.
Okay, all right, got that. And individual stocks?
I have a buy on Ramco Cement. Keep a stop below 940 here. Look for targets of 995. And Polycab is the other one. We were just talking about RR cables. I think Polycab also has given some kind of a price and volume breakout on the intraday charts. So buy here with the stop below levels of 55.90. Look for a target of around 5800.
Okay, what about Trent? Trent is up close to 3.5%. The stock has been all over the place. Mangalam has been doing a lot of fundamental analysis. And various brokerages have, conflicting views out there. Today, it's moving up on decent volumes, 3.5% higher. Your view on Trent?
In the short term, Nigel, I'm positive. I think the stock has made a bottom around this 4,600 mark. And, since the 21st of April, it's turned sideways between 5,400 to about 5,100. A close above 5,400 should open the way for about 57, 5,800. I'm not sure of a long-term reversal, but in the short term, I'm positive.
Right. Mitesh, thank you very much for that. HP, by the way, HPCL is the biggest volume-led gainer on the NSE right now. It's got about 5% in gains. So it's finally coming through. And we should have IOC and BP as well, and take a look at what's happening with the oil marketing pack. So doing very, very well. And lots of other names with volumes moving around. We'll get to some of those in a bit. We'll take a break. We're back. More stock-specific action on the other side.
Welcome back. Let's focus on some interesting stocks. One of them that's finding a fair amount of green this morning is Marico. That's become a little rare when it comes to FMCG companies. Let's find out what's happening here. Manglam, volume growth, I think 7%, right? I mean, it's FMCG companies, 7% volume growth. It sounds phenomenal in one sentence.
It sounds phenomenal in one sentence. Revenue growth beating expectations, volume growth beating expectations. And that's exactly the kind of environment that we're currently in. You know, growth has been so anemic that people are willing to discount a slight miss on margins for a 7% volume growth. And all the numbers that have been reported so far, 7% volume growth is definitely the top quartile for Marico itself. And that's what the street is rewarding. So revenue at 2730 crores, mildly above street expectations, 7% volume growth, above street expectations of 5 to 6%. And the EBITDA at an absolute level is largely in line. But because revenue growth has surpassed street expectations, because the numerator is, the denominator is a lot higher, we have the margins at 16.8% below street expectations, but no worries on the bottom line as well. 345 crores versus our poll of 335 crores itself. What's good is that, the outlook is even better. They maintain their double-digit revenue growth momentum target with double-digit operating profit target in FY26 as well, and they expect margins to expand in the second half of this year. Over and above all of this, the biggest reason why the margins did come off over the last year was because of the rising commodity prices. And the company is looking to diversify away from the commoditized business. That's something that it's been doing. And now they expect share of foods and premium personal care in India to cross 25% by FY27. And this business, remember, is 300 basis points higher on gross margin as compared to the other parts of the portfolio. So things looking good, revenue growth coming by, margins expected to improve, and structurally as well, the company looking to diversify away from commoditized business has the street excited, and the stock up 4%.
Okay, all right. Nice and green on Marico. Thanks for that, Manglam. Something that's not too nice and green is CDSL stock. It started about 2%, 2 to 3% lower. Let's see where it is right now. We've got Vamakshi joining in. CDSL, I think, is still slightly lower. Vamakshi, so what happened here? I mean, overall slowdown and a miss?
Well, absolutely, Sudhmi. Quarter on quarter, definitely all the capital market players were expected to report a sequential downtake. But, for CDSL, it's a miss as far as revenue is concerned. Even it's a miss on the operational profitability as well. When you look at the revenue, that has dipped by almost 19% quarter on quarter. Keep in mind, the margins have come under a fair bit of pressure, down nearly 900 basis points to 48.7%. And this is largely being driven by an uptick in the computer tech expenses. The computer tech expenses have expanded by almost 14% sequentially. The net profit too, despite the sharp jump that we saw in the other income, has seen a dip of almost 23% quarter on quarter. Now let's look at how the company's segments performed. Depository activity saw a downtick of almost 18%. Data entry and storage saw a very sharp knock, down nearly 25% sequentially. But on the flip side, when you look at the repository business, that was up nearly 15% sequentially. As far as margins are concerned, it's a downtick across the board, with the hardest hit coming in on the depository activity, down nearly 1,000 basis points. Data entry and storage as well, down nearly 900 basis points. Operational metrics too were rather weak. CDSL net account opened were down nearly 30%. Demat custody also saw a downtick of almost 5% sequentially. So overall, not a great set for CDSL.
All right, Vamakshi, thank you very much for that. So stocks down about, almost 4% right now. NetWeb is going the other way, and sharply so. Again, a bombed out name. Vinny is here with details of the numbers. Vinny, over to you.
Hi, good morning. So in terms of numbers for NetWeb, a strong set of numbers that came in Q4 FY25 from the company. They met the full year guidance. What they'd spoken about achieving the revenue of around 10,000 crores, that is what they've achieved. It's about that. Profits of more than 100 crores, that is also what they have achieved as well. So yes, interesting numbers that have come in from the company in overall FY25 as well. Order book, when you look at it, sequentially, yes, there's a dip in order book. Mainly, there's a higher conversion rate is what analysts are highlighting. So because of that, there's a dip in order book sequentially. But overall, year-on-year basis, order book momentum has continued. They expect that to continue going forward as well. For FY25, the interesting trend that was there is that AI segment for the company that has done well. Now it contributes around 15% of their revenue versus around 11% that was there in FY24. Analysts also highlight that margins, a slight bit of a miss is coming in versus what their estimates were. So keep an eye out on that. But order book was healthy, strong performance in terms of revenues. Con call highlights what we'll await. That is happening today post-market hours. So key details will come out on that front as well.
Okay, all right, got that. Thanks very much for that, Vinny. We'll take a quick break on that note. Come back on the other side, and Lada will be analyzing the Q4 results of SBI. versus the top 4 banks with Shantanu Chakrabarti of BNP Paribas.
Welcome back. We are sticking with results. Two big banks, State Bank and Kotak Mahindra Bank, reported numbers and they are trading in the red right now. SBI's numbers were actually above street expectations. I mean, the profit higher by a good 3 to 4%. But the bank actually lowered its credit growth guidance. And that perhaps is responsible for the red. On the other hand, Kotak's profit itself was a tad below street estimates. But Kotak Bank importantly managed to hold its margins close to 5%. Now that most of the big banks have already announced their numbers, we thought that we can take a look at the overall picture with Shantanu Chakrabarti, the banking expert from BNP Paribas. Good morning, Shantanu. Thank you very much indeed for your time. First up, let's take a look at State Bank itself. It seems like good profit that NARCL's money has come in and maintained their margins quarter on quarter. You impressed?
I think the operating numbers from State Bank were fairly robust. I mean, there was a small negative surprise on operating costs. But the trouble with something like State Bank is because the fourth quarter, especially on employee gratuities and things like that, it becomes a little unpredictable. Their fourth quarter typically on operating costs. So we'll have to see how much of the increases are sustainable and how much is not. But broadly, on most operating parameters, it was a satisfactory set of numbers, if not exceptional. And one thing you have to keep in mind was that quite unlike Axis Bank, that NARCL release that you're talking about, the SRs, they have taken that through the other income line. I mean, you might have had a lower other income and a lower credit cost with the same profit outcome if they wanted. I think you absolutely nailed it, that the minor disappointment that the market is seeing relates to the fact that they guided for 12 to 13% kind of growth.
Yeah. Can we talk margins and treasury income a bit? How will margins pan out? Because the expectation now is that the end repo rate is either 5.5 or even 5.25. The possibility of RBI supporting a little more because inflation is coming in lower than expected. Then what happens to their margins? Contrary-wise, they should make money on treasury, isn't it, since yields are going down?
Right. If indeed rates come off in an accelerated manner, and even the movement in the rupee remains supportive of that fact, the fact that growth has softened in the US market means that the odds of a rate cut there also now become significantly more pronounced. Absolutely on board with that macro view that it might be slightly more accelerated now. But we have to keep in mind, Lata, is that that would probably mean that in the first half of the next financial year for all banks, earnings may see a small revision downwards, but you're going to get a concurrent expansion in margins, and therefore possible potential upgrades Q4 of this financial onwards, and definitely moving into 27. So it really
you're expecting earnings upgrades based on better margins
on the second half, or at least the last quarter.
Okay.
Because
would you worry about loan growth generally, Shantanu? But SBI clearly indicated that people are deleveraging, large guys are deleveraging, and therefore there can be a loan growth issue. But overall as well, growth could take a bit of a beating because of this uncertainty that the tariff picture has put in. Are you all changing the loan growth picture for banking as a whole?
As of now, no. And I'll tell you why, Lata. Because, we have a run with a 13% kind of system credit growth number. And obviously, most of the better private banks are somewhere above that. HDFC is an exception for reasons that that matches more or less what the system is delivering. And why I'm not changing this is because our prognosis around corporate loan growth was always pretty muted. We are basing this on some normalization in retail growth and the fact that SMEs continue to run at a very robust pace, which we expect will continue. Now, as far as tariff impact is concerned, yes, of course, economic uncertainties and overall slowdown has an impact on credit growth. But we have to keep in mind that the primary impact on the banking sector from tariffs, if I forget the second order effects around GDP growth itself, is going to be from capital inflows. And there, the foreign buyer at the margin seems to have turned positive. And the consequent liquidity implications of that for the system are also now visible for all to see.
Yes.
So in that environment, I don't expect credit growth expectations to shift downwards too much.
Okay.
See, 12 to 13, maybe, it is actually system growth. And for SBI to grow that isn't exactly a big change in view. Maybe it's a change in perception from what has happened in the last 1.5 years.
Okay. No, fair enough. Actually, my guess could be entirely wrong, and we could be a China +1 option, and credit growth may pick up as well. We at the moment, too many moving parts. But Kotak Mahindra Bank, your summary argument is that they just have to show growth or they are too capitalized. Can you just elaborate, explain that point of view?
Every time I tell anyone a bank is too well capitalized, especially to a European or American investor, they look at me like I'm from another planet. Like, what is that thing that you're talking about? But the point is you're putting, multiple on capital at the end of the day. And that's how you're valuing the bank. So it's not just about the robustness of the bank. You're not buying bonds of the bank. You're buying its equity. And high capital has two impacts. One is obviously it overstates ROAs a little bit. More importantly, your ROEs become limited by the fact that, there's too much capitalization. So the leverage number is low. Or if you want to take an earnings growth prism on it, what happens is as the bank levers up, all other things remaining equal, earnings growth actually trails what loans grow at. Because with every passing year, for the same spread also, your net interest margin and ROA will optically look lower. Because a NIM calculation costs equity at zero, right? So as the equity proportion goes down, your earnings growth actually trails what loan growth looks like. And that's the problem around Kotak. So it's not, I mean, first of all, you have to understand that there's much that we like within the business, and embargo removal, etc., have to be kept in mind when we gauge its, loan growth guidance and these things. And there's nothing fundamentally wrong with it. Trouble is the amount of capital and therefore the multiple that you're paying on it. And relative to where we see our upsides in the other large banks in HDFC, ICICI, Axis, this has remained underperformed. On the specific issue that we had mentioned, we had expected, effectively they're talking about 15-16% kind of loan growth, right? Which is robust, right? Yeah. 300 basis points above system, but not enough.
Okay, not enough given their capital, I take your point.
Yes.
They're in a specific situation. Okay, right. I'm running out of time, so I will have to put the entire banking picture in front of you. We now have all the top 5 or 6 banks. You also, I think, additionally cover AU and Federal. So now what is your hierarchy of picks and why?
Look, HDFC, ICICI, Axis has been our top 3 picks. I mean, HDFC and Axis both have higher upsides than ICICI, but on a risk-adjusted basis, ICICI still remains the best bet through any kind of turbulence within the sector. SBI, we are neutral. Kotak, we have an underperform. IndusInd, given the volatility, we have an underperform. And that's a development we would watch very closely. You know that I have downgraded AU to underperform recently. It was a 2-notch downgrade. Stock has actually done the other way around. But there are some concerns that I have regarding both their long-term compounding outlook as well as the volatility around it, which has led me to moderate valuations. And CUBK also, we have underperformed. But the thing is that for the last 2-3 quarters, numbers seem to be on the mend. Is it enough to change our view yet? Probably not, but we are watching it very closely.
Okay. Well, very quickly, a word on Bajaj Finance. Expensive stock still remains a buy for you?
Yes, definitely. I mean, in the beginning of the year, we had almost 55% upside on the stock. Then the stock did very well. And now, what might be seen as a 100 basis point 1-year growth outlook moderation, stock seems to have corrected quite a bit. So it still remains a healthy opportunity, definitely our best within the NBFC pack, and probably close to a 30% kind of return idea right now.
Yeah, expensive, but then it is at least 25% sustained growth. So, you have to give it a higher value. Shantanu, very quickly, what is your head of research or your strategist's view? Do banks come high in the hierarchy?
Yes, we are still running a small overweight on banks, it is not as large an overweight as we were running last year, but it's still an overweight nevertheless.
Okay. And very quickly, you wouldn't worry now about asset quality at all? The scare on unsecured is over?
Look, I mean, I'm not, let's keep MFI to one side of the table.
Yes.
But other than that, I'm not majorly worried about asset quality. Having said that, some of the credit cost numbers in things like SBI look absolutely pristine, have been doing so for all but the current quarter, right? So there's some degree of normalization that can happen, and which we expect to happen even without any major change in asset quality. Quite simply, prudence will call upon these banks to increase their provisioning, which, if you are a 1% ROA business, has significant implications.
Okay. Well, there are a few more questions, but I'll take a rain check from you for another day. We are out of time. But banking results so far have been satisfactory. What we have to check out is who are the banks that are going to gain from the new LCR rules. They will be able to perhaps show higher credit growth, but that discussion on another day. For the moment, wrap up on Bazaar. Chartbusters coming up after the break.
Kotak Mahindra Bank slips over 5% as business momentum slows to a 3-year low in the fourth quarter. Net interest income and profit also below expectations.
SBI also corrects close to 2%. Write-offs rise over 5 times to hit a 9-quarter high. The net interest margin is also at a 15-quarter low.
Oil marketing companies surge as crude prices slump 4% overnight following the OPEC's decision to raise production starting June. Also, the shares of other crude users increases.
Marico surges as the fourth quarter volume and revenue beat estimates. The company has also guided for double-digit operating profit in FY26.
DMart corrects over 2%, now down 2.5% following an operationally weak quarter. The company takes a hit on the margins as competitive intensity rises in the FMCG industry.
Hello and welcome to Chartbusters. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel. With me is Mangalam. And the rate should come up for you on the top of the screen. Well, the Nifty is trading in the green. And I'll tell you what, it's without its star performer. That's the Nifty Bank. That's still on the back foot. But otherwise, the bulls will feel good this morning because the Nifty is up 150 points, Mangalam. Almost moving into the green, the Nifty Bank.
All things considered, it's a very good start. Why does one say that? Because, the Nifty Bank, like you pointed out, is in the red. But, the Nifty is holding on to 24,500, a mark that it had given up from over the last few trading sessions as well. And the midcap index, that's doing a lot better. On Friday, we saw the midcap index underperform. The Nifty had given up all of its gains, consolidated, at the index level. But there were more stocks that were declining than the number of stocks that were advancing. Turn that around. On a Monday, we have nearly 1,800 stocks which are in the green for just around 644 which are in the red. And among all of that, a bunch of stocks which are doing well. We have, all the auto names. So we have TVS Motors, which has done well. We have, Eicher Motors, which is slightly higher as well. We have Trent. The consumer names are doing a lot better. So we'll keep an eye out on that. And then we have, a couple of these real estate names which continue to do well too. So we have Prestige Estates, which is higher. We have, couple of these Adani Group stocks as well, which are seeking some sort of gains in today's trading session.
And Kabel delivered a good set of numbers. The street believes that maybe, in fact, the other numbers as well will be good. Polycab, case in point, the stock is up close to 3.5%, and it's moving on rather large volumes. So I think you should get that one as well up for you on the screen. But let's get in Shivangi Sarda for a technical check. Hi, Shivangi. It's been a while since we spoke. I believe you're heading into a big day. That said, it's a big day for the markets as always. What would you do? The Nifty is up 150 points, running into the same resistance zone. What's the view from here on?
Very good morning, Mangalam and Nigel. Of course, celebrations are around the corner, both the markets. Now looking at, Nifty soaring higher, we've seen that there has been good support-based buying and, nevertheless, there is a little bit of a rub-off at the higher levels. But the put-call ratio has been sustaining above 1, which is an indication that, there are a lot of put writers making a good base here. So we are going for buy on decline strategy here. Of course, IndiaVix is slightly on the higher zone right now with all the geopolitical tensions rising, of course. But overall, bulls are quite active and they are buying even at these levels. We're looking at 24,750 as the next mark for Nifty, with a support of 24,350 marks. Talking about Bank Nifty, we've seen, of course, this has been a star performer from the last 1.5 series. But of course, there is slight bit of a profit taking from the last 1 week after we've touched a new lifetime high territory. But overall, the PSU banks, which had just started to move, they have been holding on to this index. And somewhere there is a little bit of an index management which is happening. But overall, the heavyweight should be back in stance soon. So overall, buy on decline texture would continue for Bank Nifty as well. And we're looking at 56,000 immediately in this index with a support of 54,650 levels.
All right, we take that point. It seems like ahead of the big day, there's a lot of jewelry shopping which is being done, Shivangi, because we have Kalyan Jewellers, which has moved to the high point of trade. You look at PN Gargil, that's higher. Titan reports its numbers this week. We already have the update. That's looking good as well. And obviously, last week was Akshaya Tritiya. So some bit of gold sales that would have taken place out there, also reflecting in the stock price right now. But a big surge is what we're seeing on Intellect Design Arena. That's the one that should come up for you. It's an unusual spike that we're seeing on the stock, up around 5% from the lows. and gaining just in the last 15 odd minutes or so up at the high point. Shivangi, individual stocks, what do you have on your radar?
Of course, Manglam, first up on my radar is Indigo. We've seen that this stock has been one which is very resilient despite the market volatility. Week on week basis, we've seen that there has been a good support-based buying. Stock is trading in an upward sloping channel overall at a higher time frame. And even on the daily basis, we've seen retracement exactly from its key exponential moving averages. Of course, crude oil price movements have had an impact from the last two sessions, but overall setup is quite positive. And we are looking at 5,800 as the next targets for Indigo with a support of 5,450 levels. Next up on my radar is IOC, which has been in action. The price volume surge from the last three trading session is adding to the momentum. We've seen that this stock is, of course, well positioned with the major refinery expansion, but there are near-term catalysts which have remained quite positive for this one, like, lower LPG under recoveries. And of course, there is a lot of, Russian crude intake, which is also getting an impact from there. So overall, stock is quite positive. Even technically, we've seen that the stock has been moving from the last few weeks, and month-on-month basis, we've seen a good recovery from the lower levels. So recommending a buy here. Now, the next targets that we're looking at is 155 for IOC with a stop of 145.
All right, Shivangi, thanks a lot for those calls on the stocks, and wishing you as well as your family and the special guy all the best. I think the countdown is there, maybe 10 or 12 days to go. So for the uninformed, Shivangi is going to be getting married, so we wish her well. Thanks a lot.
And we wish for a lot of sweets in our newsroom as well once the celebrations do happen, Shivangi. From all of us here, congratulations once again.
Thank you so much.
Thanks for joining in. Well, let's shift focus to our special segment there, where we get you a few ideas for profit from Money Control Pro. We have Varsha of moneycontrol.com who joins us to talk about a stock that she's tracking closely. Varsha, take it away.
Today's idea is V2 Retail, is a value fashion retailer offering a diversified range of affordable products including apparel for men, women, children, accessories. Operating under value and variety V2 theme, the company operates 189 stores across northern and eastern India. V2 Retail focus on price-sensitive consumers in Tier 2 and Tier 3 cities, capitalizing on increasing demand on stylish and budget-friendly fashion. In FY25, V2 Retail expanded by adding 60 stores, increasing its retail space to 20.27 lakh square feet. For FY26, the company plans to open 100 new outlets with 70 to 80% of the expansion in existing markets such as UP, Jharkhand and Bihar, while 20 to 30% with target high-growth regions such as Andhra Pradesh and Rajasthan. V2 Retail has consistently posted strong SSSG growth and high revenue per square feet. The company aims for double-digit SSG of 10% over the medium term. As India shifts from unorganized to organized retail, V2 Retail is well positioned to benefit its strong value brand, competitive pricing, effective sourcing and focus on private label offering. The company enhance margins. Investments in back-end technology and inventory optimization ensure scalable and data-driven growth. Valued at 37 times of FY27 earnings, V2 Retail represents an attractive investment opportunities in the mid-cap retail space.
Thanks a lot for that, Varsha. Well, on that note, though, we'll slip into a short break. On the other side, we'll focus on the banking names, Kotak Mahindra Bank as well as SBI. We'll also tell you about Avenue Supermart's numbers. Stay with us.
But just keep an eye on a couple of these broader market names. You have Parag Milk, which is now up around 11%. Reported its numbers over the weekend. Good growth is what we've seen in their operating profits. They've jumped from, 37 crores to 62 crores. And that's reflected in their bottom line as well, which on a low base of 10 crores has jumped all the way up to 26 crores. And milk prices are likely to go higher seasonally itself. The company has informed the exchanges, as have all the other dairy companies. So the milk cycle in favor of all these companies, these stocks doing extremely well. Parag Milk, the biggest gainer among all of them. But the stocks which are losing right now are Kotak Mahindra Bank and SBI. Abhishek joins in to tell us why Kotak Mahindra Bank is down 5% and why, despite decent set of numbers, SBI too is down about 1.5%. Abhishek.
Well, to begin with, in SBI, the other income has actually aided in earnings beat versus our poll. A 19-quarter high with respect to write-offs actually aided the gross NPA ratio to be one of the lowest that you are seeing in last 10 to 15 years. Take a look at the PNL. The NII is a beat on our poll. PAT, on account of higher forex income as well as treasury gains, has beaten our poll. So 19-quarter high write-off, more than 10,000 crore in this quarter versus less than 2,000 crore in the previous quarter. That's aided the gross NPA ratio. Net interest margin is at 15-quarter low at about 3% versus 3.01% in the previous quarter. The NII growth rate on a YY basis is at just 2.7%, which is one of the lowest that you are seeing in last 5 years or 20 quarters. Return ratios remain weak, 5-quarter low with respect to ROA at close to 1.7% and ROE below the 20% mark. Slippages, they have been stable largely. A 10-quarter low slippage ratio of 0.41%. CASA ratio has improved for them for the first time in last 12 quarters, coming in at close to 40% versus 39.2% in the previous quarter. Now, loan growth has been at 12% YOY, the lowest loan growth rate that you are seeing in last 12 quarters. For Kotak Mahindra Bank, the business momentum on a YOY basis is perhaps one of the weakest that you are seeing in last 3 years. That has led to NII and PAT being below our poll. Both the NII and PAT versus our poll are on the lower side. Deposit growth was at 11.2% YOY, which is one of the lowest that you are seeing in last 11 quarters. Although sequential growth has been one of the best in last 4 quarters, coming in at 5.4% quarter on quarter. Advances growth has been at 13.5% YOY, one of the lowest growth that you are seeing in 15 quarters. That has been impacted by the unsecured portfolio like the microfinance, credit card, as well as the fact that corporate portfolio declined by 4% quarter on quarter. Net interest income growth is at just 5.5% YOY, one of the lowest that you are seeing in last 14 quarters. Now, operating profit growth is really weak, just 0.2% YOY, the lowest growth rate that you are seeing in last 11 quarters. Even the core operating profit, that is the NII plus fees minus OPEX, that's been weak. It has declined by 0.9% YOY, first time decline in 13 quarters, and it has declined by 0.3% sequentially. PAT has declined by more than 14% YOY, the highest decline in last 9 years. Subsidiaries, some of them were really weak. Their PAT declined both YOY and quarter on quarter. That was for Kotak Mahindra Life Insurance as well as Kotak Securities. Asset quality, 3-quarter low gross NP ratio, while cost to income ratio was at 5-quarter high. Let's listen into the management of Kotak Mahindra Bank as to what they had to say about their Q4 FY25 numbers.
So, Abhishek, clearly there's been an easing of liquidity, which is a good thing from our perspective. Private sector demand has still been kind of muted. But we at Kotak have grown average loans at about 18%, kept good pace with deposits. And it's always been our mantra that we will try and go our deposits somewhere between 1.5 to 2 times nominal GDP growth. And we're continuing down that path.
So do you expect the loan growth in FY26 to be around the 15% mark?
So it's difficult to say that. It really, what we said, the way I kind of like to temper it is it within that 1.5 to 2 times GDP growth? That is really a risk appetite statement, right? Because if the economy is going at a certain rate and you're growing too fast, then obviously you're taking too much risk. If you're going too slow, you're losing money on the table. So what we like to do is kind of say, hey, if the economy is growing this way, are we growing in that kind of ballpark?
Well, recently many banks have started to cut their saving deposit rates. Also the fact that net interest margin has been healthy for all the banks. How do you see the net interest margin trajectory in a declining rate scenario?
So, Abhishek, obviously when repo rates get cut, that puts pressure. Some amount of that pressure is offset by cuts in rates. not only savings, but also in terms of TDs. Of course, TDs take a little bit more time. It's a matter of, fine balancing as to how much you can cut, the speed at which you cut, where you cut, and how you do it. Obviously, NIM management is a very, very important thing for the profitability of a bank.
Any guidance on net interest margin?
So it's hard to, because it depends on how the repo rates kind of move, how often, how many more cuts there are, and what is the quantum of cut. Depending on that, we'll have to respond accordingly.
Well, FY25 for the banking sector as a whole has seen pain in the unsecured portfolio, microfinance or credit cards or personal loans for many of them. How do you see the trajectory with respect to, asset quality panning out for you going ahead?
Yeah, so you're absolutely right. There's been a lot of pain, particularly in microfinance. We've seen a lot of pain. And in microfinance, while I think the industry, as well as Kotak, has shrunk the book quite dramatically, we brought our book down by about 33% on an average basis year on year. Just on a smaller book, the pain will kind of reduce. But I think it'll take a little bit of time, maybe Q1, Q2, before we start seeing that pain kind of come down. Credit cards, I think, have plateaued and I think will get better. Personal loans are kind of really back down to a very acceptable level of loss rates.
Well, your credit cost for FY25 was around 60 basis point versus 40 basis point in the previous fiscal. How do you see credit cost in FY26?
So, Abhishek, based on the existing book, I think we'll see a better trend. And you can see it in our slippage numbers, right? For the last 2 quarters, our slippage numbers are coming down, which is a clear indication that losses will kind of come down as well. There are other stuff in the horizon, which we'll see how it plays out. But generally, I'm cautiously optimistic that credit costs will be better.
Any upgrade or more details on the digital front that you're planning for the bank?
Oh, definitely. As you know, Abhishek, we've launched a new app for Kotak Bank. We've launched a new app for our 811 customers. We've done a new platform for payments for our corporate customers. So a lot of stuff happening on digital. And that is something which I think we're going to drive really, really hard. Better digital capabilities for our customers and better digital capabilities for our colleagues. That's the thing that we're really going to drive, because that's what I believe is how we're going to win.
Right, that's the word coming in from the top brass at Kotak. Just keep an eye out on Avenue Supermarts, though. That stock continues to underperform in today's trading session, and that's because the margins of the company in the fourth quarter disappointed the street. Revenues grew 17%, but that's something that was already in the price because the company had given their fourth quarter update, leaving the margins to analyst estimates. Analysts had expected anywhere between 1,020 to 1,050 crores. The company actually went ahead and reported EBITDA of close to around 955 crores itself, which implied a margin dip of nearly 100 basis points, and that's something that was weak, and as a result of which the net profit also declined by 2.2%. Why is it that the margins were under pressure? The company said increased competitive intensity in FMCG has impacted gross margins, but beneath that as well, there has been a surge in the wages of entry-level positions due to high demand. This is something that we heard from Eternal's commentary as well, where they said that availability of delivery staff for quick commerce was a problem, or it wasn't as easily available as expected earlier. They also are continuously investing in improving service levels, so that costs a little more. And they had a higher number of store openings during this quarter. In fact, all of last year, they added 50 stores, was about 40, 41 that they would do earlier annually. Gross margins, they believe, in matured metro towns will remain soft for a period of time, so dashing any hopes of further margin expansion from here on. And more importantly, on DMart Ready, which is their quick commerce vertical, they believe that business is growing extremely well in key metro times, but the profitability for standalone online segment could be some time away, and that has the street a little worried. The stock down about 3%. But the one thing is clear, Nigel, in quick commerce, while growth is coming by, profitability across the board because of competitive intensity is likely to be some time away. We've heard that from Eternal. We've heard that from, DMart Ready. Zepto is obviously not listed, so any commentary from them will be extremely crucial as well. And what happens with Swiggy is something that I'll be watching out for too. Swiggy, on the day Zomato shut its quick food delivery thing, actually put out a press release saying that their Bolt business is doing extremely well. The stock's spiked right now, but but all eyes will be in what happens with Instamart, the profitability out there we'll be watching out for.
All right, Mangalam, thanks a lot for that. So not too great news coming in for DMart, but we have got some good news for you, and let's take you through that as we slip into a short break. India's business news leader is now just a click away. Introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates. All of this at your fingertips. Download the CNBC-TV18 app now from the Google App Store, or in fact the Apple Store as well. Or you can simply just scan the QR code that's up for you on the screen. Welcome back. You're tuned into Chartbusters. Well, keep an eye out on the Nifty Bank. We just mentioned that one had moved into the green. It was up close to around 50 points, and wham! In the last 5 minutes or so, it's suddenly given up close to around 200 points in the high point of the day, down 120 points. One would say par for the course though, because the other stocks in the Nifty are doing the heavy lifting. Talking about Nifty stocks, well, Mahindra & Mahindra, that's one, will be reporting its numbers later today. Sudarshan joins us to run us through the expectations. Sud.
So in less than 1 hour, Mahindra & Mahindra will come out with its Q4 results, and we are expecting a strong set of earnings led by healthy volumes that company has reported for Q4. Both the auto volumes and tractor volumes were significantly higher. Auto volumes had surged 18%, tractor volumes were higher more than 23% in Q4. And even we are expecting realization to improve both sequentially and year on year on the back of the price hike that majority of the passenger vehicle companies had taken. Now, coming to the headline numbers, profit is seen rising 23%, revenue may increase by 20%, EBITDA too can increase by 26% to around 4,160 crore, and margin may expand to come around 14%, likely at 13.8% versus 13.1% in the same quarter last year. And realization may improve 1% year-on-year and 6% sequentially. And if you talk about both these segments, auto margin as per JP Morgan estimate is likely to come around 9% versus 8.8%, and even agri margin can improve and come around 17% versus 15.8%. But at the end, I would just mention there might be certain adjustments. Remember, for the agri business, there might be something related to impairment. Also, there might be adjustments related to electric vehicles. So while just looking at the numbers, keep an eye on adjustments as well.
Take that point, Sudarshan. Thank you so much for alerting us to what to keep an eye out on. You don't have to wait for too long. M&M numbers usually come around noon time itself. With that, what we'll do is wrap up on this edition of Chartbusters. You stay tuned to CNBC-TV18 as Trading Hour comes up next.
Good morning. Welcome to a brand new week of Trading Hour. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Reema Tendulkar. With me is Hormuz Fatakia, and the bulls are continuing with their dominance. So it's a positive start to the week. The Nifty is up 123 points. Benchmark indices higher by close to about 0.5%. So in the last 15 minutes, we've given up a bit of ground. So we were closer to 24,500, just moderated a tad bit, but still holding up pretty smartly. Look at the way we've bounced back. from our April low of 21,700, 21,800, it's been a rally of more than 12%. And now we're less than 7% away from our all-time high levels of 26,277. Mid-caps are charging ahead. The mid-cap index is a gain of more than 1%. The advanced decline ratio is positive. And while banks are dragging their feet on account of Kotak Mahindra Bank and State Bank of India to some extent, auto, FMCG, IT, metals, Reliance Industries, all these indices are up nearly 1% on an average. And then you've got so many individual mid-caps which deserve mention. So whether it's CDSL, a NetWeb, RR Kabel on the back of the numbers.
One player taking a step back and the others are stepping in to offset the pressure that is being created by the banks. Of course, the Nifty, well, the bigger question is whether these gains will sustain, as has not been the case over the last 3 trading sessions. We've come off the highs every single time we've tried making new highs. Of course, last Friday's high of 24,589 will be the important one, the important level on the upside to watch out for on the index. And of course, can't not talk about earnings reactions. Rima was just highlighting a few of them, and Jindal Saw is another earnings reaction as well. That too is down 6%, the top loser on the Nifty 500 index. And of course, on the upside, NetWeb, as Rima just mentioned, 16% higher now on NetWeb Technologies, and RR Kabel is now trading with gains of around 13.5%. So the top 2 gainers on the Nifty 500 are earnings reactions on the positive side. But of course, another earnings reaction on the positive side is Marico, and Mangalam is here to tell us how that fared in the 4th quarter. Mangalam.
Well, for Marico, the street was prepared for a decent set of numbers coming in on the revenue and the volume front, but the street's gone ahead and been positively surprised by the company. So if you look at it, the revenue that the street was working with was close to 2665 crores. They've gone ahead and reported 2730 crores on the top line with volumes at 7%, which is higher than all the other FMCG companies that have reported their numbers so far. The EBITDA at an absolute level has been in line with expectations, but because there has been a revenue beat on the margins, there has been a slight disappointment versus street expectations, but nothing really to worry about because the net profit too at an absolute level is in line with expectations. What stood out for the company this time around is the fact that their outlook is also fairly strong. They are expecting double-digit growth momentum to continue in FY26 with a double-digit growth in the operating profit led in the second half of this year. Their premium personal care, digital brands as well as foods business is likely to grow a lot higher, and because of which the share of foods and premium personal care will cross 25% of the overall revenue of the company in FY27, and they are expecting better margins to accrue from these verticals, so that will diversify their portfolio away from commoditized business. The other part that the street is cheering this time around for Marico is the reappointment of Saugata Gupta as the MD and CEO for a period of 2 years, starting from FY26 all the way up to March 2028. All these factors working positively for Marico. That stock higher in today's trading session.
Thank you very much for that, and we'll bring you our conversation with the management of Marico on their Q4 earnings today at 12:05. So stay tuned for that conversation. But moving on, RR Kabel is the other big mover today. The company reported their highest ever revenue in Q4 and FY25. Vamakshi is here with the details and what the management had to say in their interview with us.
Well, absolutely, Rima. When you look at RR Kabel, it's a very strong growth that the company has posted this time around. When you look at the revenue, that is up almost 29% on a year-on-year basis. A very strong beat coming out there. As far as the margins are concerned, they too have improved by almost 224 basis points to 8.83%. And the net profit too has seen an uptick of almost 64%. As far as volume growth is concerned for the entire year, that came in slightly softer than what the management had guided for. Volume growth stood at 7.1%, but going forward, they're guiding for nearly 18% volume growth. EBIT margin too came in slightly lower, 7.4% as compared to the guidance of 8%. Now keep in mind, let's also look at the segment-wise performance. Wires and cables saw a good uptick of almost 28%. They saw very good demand out here, which the management also alluded to, and they also foresee good demand going into the future as well. FMEG revenue also saw an uptick of almost 13%. As far as the margin performance is concerned, margins for wire and cable improved from 8.7 to 9.9%, and that is mainly on account of better realization and operational efficiency. While for the FMEG business, the EBIT loss was lower from 19 crores that we saw in the same quarter last year to around 9 crores this time around, and in fact the management has guided that the FMEG EG business will break even in the first half of FY26. So that bodes well for the company. Other than that, they've also announced capacity expansion plans at Godrej, Gujarat, which is where they will be making an investment of around 1,050 crores. As far as the Silvassa unit is concerned, they will be adding further capacity for which the investment stands at around 400 crores. Largely, it will be a mix of internal accruals as well as that, and the management has said around 1,200 crores of new capex will be capex investments will be done, and apart from that, nearly 200 or 300 crores odd would be financed largely through term loans. So overall, a good set of numbers, good commentary coming in from the management. Resultantly, the stock is trading higher.
The stock is trading higher, of course, and as Vamakshi was mentioning, right, the capex plans is what has buoyed the street, because at a time when competition is increasing, Ultratech, Adani, all of them foraying in, Kabel is going in, and all right, doesn't matter, we're going to increase capacity and we'll take the competition head on, and that is what is cheering. The street is cheering, of course, 13.5% higher on Kabel, from one top gainer to the other, and that is Netweb Technologies is the other one. Vinny is here to tell us how did that company fare in the quarter gone by. Vinny?
A good performance that has come in from the company in Q4 FY25, a beat in terms of the revenue front for the company. Margins was a slight bit of a miss versus what analysts were highlighting, but overall the performance has been very good in terms of order book, also pipeline. The analysts were quite happy with it. The street was happy with it as well. They met their full year guidance. That said around 1,000 crore revenue guidance is what they'd given for FY25, so it's about that. 100 crores in terms of profits, that is about that as well. So 100 crores is beat, 1,000 crores is beat in terms of revenue. Overall, order book is seeing a bit of a dip on a sequential basis, mainly due to higher conversions. But other than that, FY25, the AI segment for the company, that has seen a sharp growth coming in. 15% of the revenue comes in from AI versus just around 11% in FY24. And overall, analysts are quite positive on this one, though we'll wait out for the con call highlights that will come in today afternoon. So that will be key to watch out for there in terms of further guidance for FY26.
Thank you very much for that. And CDSL reported a miss in revenue while the net profit beat estimates due to higher other income. Vamakshi joins in with the numbers.
Well, a weak set coming in from CDSL. It's a miss, like you said, on revenue as well as operational profitability in the fourth quarter. Revenue saw a downtick of almost 19% sequentially. The margins too have contracted by around 900 basis points, and largely this pressure is coming from higher computer tech expenses. Computer tech expenses saw a growth of almost 14%. Keep in mind the net profit though saw a decline of nearly 23% sequentially, despite the kind of spike that we saw in the other income, which was up nearly 57%. As far as particular segments are concerned, the revenue has declined for the depository activity, which is down nearly 17.8%. Data entry and storage too saw a very sharp knock of almost 25% sequentially. But on the flip side, when you look at the repository business in terms of revenue growth, that has done well, up nearly 15% sequentially. Let's also look at the margins. The repository business has reported an EBIT loss, but when we look at the depository activity, the margins out here has declined by almost 1,100 basis points. Data entry and storage too is seeing a decline of nearly 900 basis points as far as margins are concerned. Let's also look at the operational performance. It was rather weak. CDSL's net account opened in the quarter was only 64 lakh. This is much slower as compared to the previous quarter, wherein we saw 92 lakh new accounts getting added. The demat custody in terms of rupees lakh crore also saw a downtick of almost 5%, now standing in at only 71 lakh crore. Number of issuers, on the other hand, is seeing an uptick of 14%. ISINs also are up nearly 7.4%. But overall, when we look at the operational as well as the numbers, rather weak set, the stock is resultantly tanking in trade.
4% lower on CDSL. So earnings reactions on both sides of the spectrum coming in. But moving aside of earnings reactions, of course, the other pocket that is the talk of today is the oil sensitives, be it the oil marketing companies, be it aviation stocks, paint stocks, all of them doing well today after the Brent crude prices fell below $60 a barrel earlier in the day. HPCL is up 6.5% now, ahead of its results tomorrow, and similar reactions also seen in BPCL, which is up 4.5%. Also stocks like Interglobe Aviation, which is also trading with gains of around 4% in today's trading trading session. A fall in crude oil prices beneficial for all of these companies. On the flip side though, it's not good news for stocks like ONGC and Oil India, as they result in a loss of around 200 to 300 crore annually for every $1 per barrel fall that the crude oil prices see. So there's some recovery from the lows of the day, but still trading in the red. Take a short break. On the other side, discuss market technicals with Somil Mehta of Mirae Asset Sharekhan, and also discuss his top trading ideas. Stay tuned. Welcome back. Around 24,500 is the index, continues to remain at those levels, 140 points higher. It'll be interesting to see if these gains sustain as the day goes by. But Somil Mehta from Mirae Asset Sharekhan is joining in for a quick chart check and some trading ideas as well. Somil, good morning. Thank you for joining in. You know, how important is that 24,600 mark on the upside? We've tried making multiple attempts to cross that. We have not managed to do so. So how important is that level? What's your call on the index and your stock specific ideas as well?
Sure. As you mentioned, that 24,600 has been very crucial resistance in the last couple of weeks actually. The entire fall which we have seen from 26,200, 300 levels, the highs, and the low of 21,700, 21,800 levels, the entire fall retracement of 61% is exactly at 24,550, 600 levels. So this zone of 24,600 or 24,500 will remain a very crucial resistance, a very crucial hurdle. Once we close above that, I think the next level should be much higher. 25,100 would be the next level to watch out for. So medium term still remains positive. However, in the very short term, I think the markets will remain range bound between 24,200 and 24,600. That will be the range I'm expecting. Probably it will go on for another 1 week and then we'll break out on the upside. Medium term still remains positive. I would like to stay with the large caps and the defensives when picking stocks. My first pick would be from pharma space, that is Lupin. Lupin is consolidating in a very small range. A small triangle pattern is being forming, and it has taken support at 200 daily exponential moving average, and now it is breaking on the upside. I'll be expecting a very good short-term up move for a target of 2,200, and the stop loss would be 2050. The second stock which I have chosen is Asian Paints, again a large cap stock, a defensive play, again a small consolidation which is expected to break on the upside. Today we have seen a good start for the week. I'll be expecting a target of 2650 and a stop loss of 2390 for Asian Paints. My third pick would be from the mid-cap space, a smaller space, a short-term trend for this stock, Aarti Industries. Again, a triangle pattern already broken on the upside. We've seen a very good up move today. I'll be expecting still the up move to continue for a stop loss of 429 and a target of 470.
Got that. Thank you very much for that. We will slip into a very short break. We'll come back and get chatting with more management and get you a check on the market. Stay tuned. Welcome back. Let's talk about the big banks. Kotak Mahindra Bank is down over 5% following the Q4 earnings. But now lots of the large banks are out with their numbers. So Abhishek now joins in with a report card on the large lenders and who did what. Abhishek.
Well, Rima, to begin with, large lenders have reported their Q4 FY25 performance. And if you take a look, at the comparison table, private banks have seen robust deposit growth on a sequential basis, anywhere between 5.5% to about 7%. 8% range. In fact, at a time, this has come in, at a time when deposit growth is a big concern in the industry. Seasonal in nature in Q4 for deposit growth to happen for SDFC Bank and Axis Bank. Now, SBI has seen the weakest deposit growth on a sequential basis at just 2.9% in Q4 FY25 amongst large banks. If you take a loan growth, and if you take a look at the loan mix, the corporate portfolio has actually been shunted down by private banks because of the unfavorable yields. That is what many managements have commented. So, the likes of ICICI Bank and Axis Bank and Kotak Mahindra Bank as well, they spoke that, unfavorable yields have led to corporate book not growing that much. On the other hand, if you take a look, SBI's, corporate growth of 5.5%, that is corporate loan growth, has been one of the highest amongst all the large banks. Now, net interest margin has improved quarter on quarter for most of the banks, especially ICICI Bank and SDFC Bank. They have seen the highest sequential growth in their net interest margin. However, for SBI, it's actually shrunk by 1 basis point on a sequential basis. Now, operational efficiency was another area of focus. It's been the highest decline for SBI. Their cost to income ratio declining by 184 basis point on a sequential basis. Axis Bank and Kotak Mahindra Bank actually saw an increase in their cost to income ratio. The meaningful part in any bank's result is the return ratios or ROA. So SBI saw a decline in its ROA, that is return on asset, on a sequential basis, while Axis Bank and ICICI Bank have seen the highest increase in their return on asset ratio on a sequential basis. If you take a look at the valuation picture with reference to price to book value, large banks like SDFC Bank, ICICI Bank on the private side trade between 2.7 to 2.9 times, while SBI is trading at 1.5 times price to book value on a 1 year forward basis. Back to you.
Indeed, so interesting comparisons there. Abhishek, thanks a lot for that. We'll take this conversation forward with Ruchit Mehta of SBI Mutual Fund, who is joining in now. Ruchit, good morning. Thank you for joining in. Sticking to what Abhishek was mentioning about the large private banks, what do you make of the numbers? Kotak is not seeing a very good reaction to its results, but HDFC Bank and ICICI Bank both surprised the street on the positive. So what's your call here on large private banks? Do you stick to the leaders? Do you find value in the smaller names?
I think traditionally we've been liking the larger private banks a lot better. I think even in the current environment that's there, we think that the private banks should see an improvement in their growth prospects. Particularly, I think from a margin standpoint, I think the private banks could do a little bit better than the public sector banks, given the way the pricing of the deposits and the loans would be. The public sector banks would likely see a bit more pressure on NIMs compared to what the private sector banks will do. So from a sectoral perspective, we like the banking space overall, but within that, I think the private banks could do better than the public sector banks. But even within the public sector banks, you have some of the larger names which kind of would do well going forward as well. We've not so positive about a lot of the tier 2 or tier 3 banking names. And there are a lot of individual challenges, be it with regards to overall growth prospects or in terms of management, quality, etc. So I think it's better off to stick to the larger names within the banking space overall.
Ruchit, you want to tell us the top picks in the larger banks? We've got a Kotak, SBI, if you add, the PSU heavyweight there, ICICI Bank, HDFC Bank, and Axis. Which one would you recommend now?
I wouldn't go name specific, but I think you can be more on the private sector and the larger public sector banks. Overall, we have been more positive on the banking sector per se. Growth has been fine. I think ROEs have been fine. The sector has underperformed over the last 3 years, and if you think of all of the metrics, the banks have been doing reasonably well. So I think this year they have seen a bit of an outperformance, and we think that they should continue to outperform the market overall.
The other big story, Ruchit, this morning has been oil, and it's been on the declines from almost around $75-80 at the start of April. We are now sub 60, and this has had a windfall for our own economy as well. But what about stocks in this oil sensitives basket? Where do you position yourself? You position yourselves among the OMCs, or you still believe that stocks like ONGC, Oil India will still recover from this, or would you find other oil sensitives, say paints or tires or even aviation for that matter? Where do you place yourself?
I think in a falling oil environment, you obviously want to be with the companies which are going to be using oil as an input. So, as you mentioned about whether it's the paint sector or the aviation sector, more so because they will see probably lower cost and, may be able to expand their margins. But in terms of the oil companies per se, I think, the oil marketing companies traditionally seem to have not seen material benefits either on the upside or on the downside when, oil prices have moved. They should be able to report reasonably okay set of numbers. Some of the profit expansion right now that could occur because of the fall in oil prices could help them recover some of the losses that they made previously with regards to, certain commodities like LPG, etc. So by and large, they should be okay. Players like ONGC, etc., will obviously see a decline in their earnings, considering that they are more directly sensitive to oil prices per se. So I think you're better off seeing the decline in oil prices to participate and look at investing into companies which are beneficiaries of the commodity rather than sort of the commodity producers themselves.
What else are you bullish on? I mean, if you had to construct a portfolio today, Ruchit, how would you go about doing that? What would your bias lie towards, and the sectors that you would avoid or themes?
So we've been positive on the financial sector per se.
You said that,
That's one area. The second is that anything to do with domestic consumption. I think in the current market environment, in a domestic place will do far better than any company or any sector that's more export oriented. Especially given the degree of uncertainty that's out there, right? If you are exporting to the US, right now there is a high degree of uncertainty whether you will have the ability to export or not, whether there's demand itself or not. So there's a lot of question marks on export-oriented names. So we've been a lot more cautious on that part of the market. I think you're better off being focused more on domestic-oriented names, particularly domestic consumption names, and more so on the domestic consumer discretionary side of it, right? And I think a variety of factors. You have modest, improving economic growth, some bit of early signs that perhaps the rural economy is doing a lot better. Income growth there has been fairly fine. You have these tax cuts which are now kicked in, so everybody is likely getting about anywhere from 90,000 or give or take on average as a tax cut that's there, and that likely could boost some of the domestic consumption that's there. So I think domestic consumer discretionary names per se look fine. I think some of the infrastructure names also look fine. I think sectors like cement, etc., they've faced a lot of input cost pressures. There has been some bit of demand weakness as well, but the sector started to consolidate quite a bit. You're seeing some bit of recovery in the demand. Government spending on capex has started to improve as well. So these are areas that could do well. Overall, infrastructure, capital goods, engineering, broadly they look fine. I think from a demand perspective, things look okay. Valuations are obviously expensive. They are factoring in a lot of growth that's there, and therefore one has to be cautious with regards to the mismatch between expectations versus what can actually be delivered by these companies.
All right, Ruchit, thank you so much for sparing time and joining us today. Looking forward to having you more often on the platform. That is Ruchit Mehta of SBI Mutual Fund. By the way, the Nifty slightly off the highs, now 120 points higher, now at 24,470. Take a short break. On the other side, we continue corporate conversations. Anand Agarwal, the CFO of V-Mart Retail, joins in to discuss the road ahead for the company. Stay tuned. Back and on to corporate conversations then. V-Mart Retail's fourth quarter revenue surged almost 17%. EBITDA was up 70% on a year-on-year basis. Meanwhile, the board has also announced a bonus issue of shares. To discuss this and a lot more, Anand Agarwal, the CFO of the company, is joining in on the show. Anand, good morning. Thank you for joining in. Now, how has sentiment been on ground? We are almost, 35 days into the first quarter of FY26, heading into another upcoming wedding season. How has sentiment looked on ground, and what are the kind of growth targets you are penciling in for FY26, be it on the revenue or the margin front?
Hi, Vivek. Good morning. And I think the sentiment on the ground remains positive. We are quite gung-ho on the underlying opportunity. And we keep building on, more momentum as we move forward. Footfalls have been quite positive. And I think while Eid, some part of the festivities this year shifted into March, but otherwise the wedding season is quite strong. And the expectation of a good monsoon also lingers on. So thereby, we are looking at a good quarter ahead. I'm not building in any, misadventures right now, but I think at an overall level, we are still looking at, a good growth going ahead.
So Anand, X of any misadventures, what could same-store sales growth look like for FY26? And you want to break that up in first half, second half?
Difficult to break it down, Rima, but definitely looking at mid to high single-digit same-store sales growth as we have delivered in the past as well. So last quarter, in fact, was the sixth straight quarter of same-store sales growth. And looking forward also, I believe we should be able to continue with a similar kind of growth story.
Sorry, wasn't FY25 in 11% same-store sales growth?
Yeah, for the full year, it was 11%, but it also came at a slightly lower base of FY24. Okay. So on a larger base and on a much stronger network, it will be difficult to deliver a double digit, but we'll definitely try for high single or mid to high single digit.
What will drive that same-store sales growth, Anand? Will it be V-Mart? Will it be Unlimited? Or will it be a combination of both, or one leading and the other following?
I think it will be a good combination of both. Primarily, what is happening is that we've been working a lot on our product, and we are trying to attract a much younger audience, much more youth, and that has been sort of working. And we've also worked a lot on our quality and on the replenishment side. So all of that is not happening only at one single brand level. It's happening at an entity level, and it's impacting the performance, and the benefits are accruing on both the brands. Apart from that, we're also doubling up on the expansion now that we have closed some of the unprofitable stores. So we're also looking at higher expansion, higher growth targets for all the, old stores where we need to do some facelift or upgradation, etc. So combined impact of all of that should continue to give us better results, as we also see some amount of tailwinds coming from the rural sentiment. So if you recall, last 2-3 years had been slightly subdued as far as rural was concerned. And we are seeing better, footfalls, better conversions, and better interest coming in from all these sectors.
Okay. What's the outlook on margins? You've ended Q4, I believe, with margins of 8.7%. Now, given your expansion plans, the refurbishment, the new products that you're adding, what could margins look like in FY26? And if you could break that up in terms of retail and digital, because digital is still loss-making.
So I think we should continue to build on the margins. I think a large part of the margin should come in from the kind of same-store sales growth that we are able to get. But largely, I'm not looking at a lot of margin expansion. I'm looking more at a top-line growth with stable margins. If at all there are margins expansion, I think it will come at the back of slightly higher like-to-like sales growth. But otherwise, we would want to, as a value retailer, want to give back to the customers as much as we can to drive higher volumes and grow more on rupee margins rather than percentage margins. So that's been our philosophy, and we will continue to build on that as well.
What about store additions, Anand? You had mentioned at the end of your fourth quarter update that you're expecting to add around 60 to 65 in FY26. How would you break that up between V-Mart and Unlimited?
So roughly 20% of that should come in South India under Unlimited, and the balance should come in V-Mart. While we remain quite optimistic on expanding the Southern India, expansion slightly higher. But the constraint around finding the right locations at the right cost remains a bit challenging. But otherwise, I think at an overall level, we should still look at around 12 to 13% net area addition, which should translate to around 60 to 65 net stores for the next year.
That's similar to what you did last year. I think last year was also 62. And this year also you're guiding for about 60 to 65 new addition in terms of store. Sorry, just getting back to that point about margins. You're saying margins will be stable. But the outlook on digital, where you're still making losses, what's the company planning to do about that?
I think the digital losses have consistently been coming down by almost 50% every year for the last 2 years. And we continue to look at that side of the business more as a omni enabler rather than a cost center. So basically what is going to happen is that the LimeRoad part of the digital part of the business will continue to invest in new technologies in upgrading the customer experience at an overall level, while not really expanding so much the loss-making e-marketplace business. So as a result, we should continue to look at the losses coming down by again 50% in this current fiscal. In any case, this business is around 1% of the total business, so it's not a material number, and even the losses there are very, very immaterial now.
That's true.
And so profitability still far off in this fiscal, Anand. So maybe by FY27.
So in the digital place, we are not looking at profitability in this year, but at an overall level, we have been profitable this year, and we should also be profitable next year. So I think that LimeRoad is a very, very small, insignificant, but important and critical part of the overall business.
What's your average price point of the apparel now? And how would it compare with what it was, say, last year or 2 years back? Just curious.
So average selling price for apparel is around 300 rupees. It's slightly higher in South India and slightly lower in North India. But otherwise, the pricing has remained stable. There have been a 2% reduction versus last year, but mostly due to mix variations. But otherwise, from a pricing perspective, we have not taken any price hikes or price reductions.
What about inventory days? Anand, one final question from my end. From around about 132 in September of 23, you came down to 92 in December, slightly higher at 102 in March. What do you expect to go on this trend? Where does this go?
I think on a moving average basis, we are happy with around 90 days of inventory. Currently at March end, we had slightly upstocked our inventory in preparation for the upcoming, the summer season as well as the wedding season, and also for the new stores that we plan to open. So in fact, we opened around 7 stores in the last 1 month itself. So today we stand at almost 503 stores. So we've been building up on that part as well. But otherwise, on the inventory front, we remain very comfortable. The inventory is very healthy. In fact, our inventory provisioning actually came down last year by almost 50 basis points. So that is a reflection of the health of the inventory. So we're quite happy with the inventory that we hold.
Thank you very much, Anand, for joining in, and look forward to more conversations with you as we begin this new fiscal year. That's the management guiding for mid to high single-digit same-store sales growth, lower than the 11% that they clocked in last year. Margins will remain stable. The stock is down 7.5%. Get into a break. On the other side, Dheeraj Singh, CEO of SIS, will join in to talk about the company's Q4 results.
Welcome back. The next management on the show is SIS after their fourth quarter results, which were largely in line with expectations. Revenue was up 9%. Margins also remained flat. To discuss the company's performance in the quarter gone by, Dheeraj Singh, the CEO of the company, is joining in on the show as of now. Dheeraj, good morning. Thank you for joining in. Undeniably, I think growth has slowed down, right? You grew 11% in FY20, almost 13% in FY23, 8% in 24, now 7.5%. What do you attribute that to, one, and what is the kind of growth that you are penciling in FY26? Do you expect this to return to double digits?
Absolutely. I think the focus for the group had been on the margin side. And if you see our margin percentage, that has consistently been improving over the past 4 quarters. So we had weeded out a lot of the lower margin contracts. We had focused on the kind of new contracts that we are taking. That had some impact on our revenue growth. But now that we've cleaned up to a large extent many of the older contracts, we do stick by our earlier guidance of about 14 to 15% CAGR over the next few years, which is what we've maintained. If you look at the past 7-8 years since IPO also, our CAGR both on EBITDA and revenue has been about 14 to 15%.
No, fair enough. While your long-term CAGR is 14-15%, but that's boosted by extraordinary growth seen in the earlier years when your top line was half of what it is right now. So I'm looking at F518, your top line was 5,800 crore. That year you grew 33%. The following year it was 21%, but now you're a much larger company. So, and last 2 years it's been a high single-digit kind of a top-line growth. Just for the near term, FY26, could you give us an indication of the kind of growth? Will it be double-digit? And 2, on margins, can you get back to 6% EBITDA margins for the India security business now that you weeded out some of the less profitable contracts?
So I'll answer your question in 3 parts. On the overall base, yes, we have a very large base now. But in terms of market share, security market share is only about 7 to 8% right now. As a market leader in Australia, our market share is 22%. While the overall market grows, our market share has enough scope to grow further. Our facility management business, though it is now the largest in pure facility management services, we are clocking 200 crores per month. But there we are only 4% of the market share. So there's ample opportunity in both our main business segments. In terms of the revenue growth for the FY26, yes, I'll be very comfortable in giving the mid double-digit percent growth. But
Dheeraj, sorry, we'll have to cut you in. The numbers of Mahindra and Mahindra flashing on your screens now. Net profit of 2437 crores compared to a poll of 2450. So in line with expectations, the revenue too higher than what the CNBC-TV18 poll was anticipating at 31353 crores. Poll was at 31337. So revenue is higher than expectations. The net profit too in line with what the CNBC-TV18 poll was indicating. So on the looks of it, at least it's a revenue beat for Mahindra and Mahindra for this time around. We'll see more on the margins front as to how the numbers have shaped up. So we'll await more details on that. But for now, the net profit figure at 2437 in line with expectations, and the revenue at 31353 is also higher than what the poll was expecting. And so Mahindra and Mahindra, of course, has been one of the outperformers in this year for the Nifty, at least ahead of the results. The stock is always down 4%, but ahead of its results too, the stock has zoomed up almost 20% in the last 1 month. So that is what Mahindra and Mahindra has done so far ahead of its results. We'll get you more details as they emerge for now, and there we can get more details on the EBITDA and margin front. There you can see the EBITDA at 4683 crores compared to the CNBC-TV18 poll of 1458. We'll get more clarity on that, and the margins too. We'll see how they have shaped up. Of course, clarity will be also awaited on their SUVs business as to how that has fared, the tractor business, how that has fared, and the road ahead for the tractor business as well. So they remain the SUV market share, as I can see from their press release, as at 22.5% in at the end of FY25. The tractors business too, the highest ever full year market share at 43.3%. So the stock too recovering after that initial dip that it had seen after the numbers, and is surging back towards the highs of the day. So, and at least prima facie, Rima, the numbers look good on the screen.
Oh, indeed. And it's been reporting such robust volume growth numbers, right? Quarter after quarter. I think in the quarter of Q1, the total volume growth was up 19% year on year. Break that up, you've got auto volumes up 18% and tractor volumes up 23%. So both engines for M&M have been doing very well, auto and tractor. And plus now for the tractor season, you are getting into the monsoon. Monsoon hopefully will be normal. The income tax cuts will boost spending. So that could be a benefit for perhaps, tractor sales. So the street has been very bullish on M&M. And now again, I remember even Q3 was a good quarter in line with expectations. And Mahindra & Mahindra has delivered on street expectations even in Q4. It's turned out to be a good quarter, a beat on the revenue, a beat on the margins to EBITDA, particularly significantly higher at 46,803, higher than the CNBC-TV18 poll of, I think, about 44,100 crores. So big beat on margins. Let's get in Prakash Diwan. He joins us on the show. Prakash, M&M has already had a good rally. It's outperformed many of its peers. Give us your initial take on these numbers.
So, Rima, to be honest, it has rallied, but it is still off its highs given the fear that people had with the Tesla and BYD possibilities of coming into India and all. But these numbers tell you that their leadership in SUVs, leadership in even the farm equipment is absolutely unchallenged. And the electric vehicle portfolio will only add to the salience and growth. So very, very positive on this. Even the new acquisition, the SML Isuzu acquisition is extremely positive for them. So I think it's a company that's on a roll. The business is matured enough. They've done whatever it takes to kind of streamline, and plug gaps where they used to be. So very, very well placed. And these numbers tell you that they have the ability to go against the tide and increase market share, increase margins. So that's really commendable.
Prakash, tractor volumes too in the fourth quarter have risen 23%.
Yeah.
And even on and heading into the monsoons as well. So with SUVs firing, heading into a monsoon, so things seem to be falling into place right now for M&M, isn't it?
Oh, absolutely. So, generally there is an expectation that farm equipment sales pick up only, monsoon and post-monsoon. But, what has happened is there's a shift in market share. If you realize a lot of the MNC players have actually not been doing very well on the distribution side. There are lots of dealerships that have got rationalized. And Scott's Kubota has moved itself into a different trajectory category. So their portfolio mix is going through a bit of an evolution. And I would believe till the Japanese get their way, are able to establish what they want to focus on, that's the time where when they blink, Mahindra has actually taken market share. So I was anticipating this, and I think going forward, even the EV side of the portfolio will contribute very significantly. So that's another vector that we've not yet penciled in. So hopefully it'll probably make its new highs, which it came down from. It came down drastically because of the Tesla news, but I think it's correcting itself in a very positive way.
It came down drastically. I remember underperforming, but it's climbed back up. It's still about 9% lower from its record high levels. But that's largely even where the market is. Even the Nifty is down about 6-7% from its all-time high levels. But Prakash, one final question. And the question is, can you buy Mahindra & Mahindra at this price?
Oh, certainly. Okay. And as I said, you just have, as almost also pointed out, the farm equipment peak season is yet to come. And if they've already seen growth there, that means, they're doing something right in terms of clawing back market share. And the SUV segment is something where a lot of the models that came in from competition have actually all kind of stabilized. So there's nothing new that's coming. Whereas these people have the EV portfolio and the Thar variants and all of that will keep them in the running. So definitely, I wouldn't be surprised. They'll probably outperform the market. Being a Nifty stock, it's important that money comes into the allocations start coming in vis-a-vis some of the other names. And that will actually take away a lot of the slack which is there.
All right, Prakash, thank you so much for sparing time and joining us today to decode the numbers of M&M. A strong beat coming in there, 39% higher the EBITDA on a year-on-year basis. Margins to expanding 150 bips from last year. The company has also announced a dividend of around 25 rupees a share for its shareholders. So a strong quarter for Mahindra & Mahindra. The stock remaining around 1.25% higher. Of course, mind you, it has surged around 20% before the earnings announcements over the last month or so. Take a short break. On the other side, we bring you more on the markets. Stay tuned.
Welcome back. What's changed in the last 30 minutes is that the banks are coming off now. Profit booking is setting in. The Nifty Bank is now nearly 500 points, 450 points from the day's high. And look at the fall in the last 30 minutes or so. And that's dragging the Nifty too. The Nifty had opened around 24,500 an hour back, and now it's closer to 24,425 in the green, but off from the session highs. And that brings us to a close in this edition of Trading Hour. From the entire team, thank you for watching.
Midcaps lead the markets higher with advances significantly outnumbering decline. Energy and consumer discretionary are the big gainers, even as financials drag.
State Bank of India trims its growth outlook and cautions on margins going forward, while Kotak Mahindra Bank misses expectations on business growth, slows to a 3-year low.
Marico springs up on delivering volume growth ahead of analyst expectations, also has double-digit growth going forward with rising contribution coming in from foods and premium personal care.
Crude oil prices drop after OPEC Plus decides to increase output by a higher than expected 4 lakh barrels a day in June. Stocks of oil marketers and other crude-sensitive businesses perk up.
Legendary investor and Berkshire Hathaway chairman and CEO Warren Buffett will step down as the CEO by year-end, even as he intends to hang around. Greg Abel, who leads the non-insurance business, will take charge.
Very good afternoon. You're watching Halftime Report on CNBC-TV18. I'm Ekta Batra and with me is Mangalam Malu. Well, it is definitely a good day for the broader markets and it is blue, all blue today, but nonetheless all green today except for the Bank Nifty, which is down around 0.4% at this point in time. We really have a lot of traction which is coming in for the broader markets. Let's see whether that sustains. Mid-caps up around 1.5%. The advanced decline ratio also sustaining at around 2:1. So that looks good in terms of the screen. Lot of stock-specific action. Kotak, SBI, those are the stocks that we're discussing. ONGC also down around 2% at this point in time. So a lot about the banks this afternoon. But besides that, a lot about the broader markets.
A lot about the broader markets, Ekta. You spoke about blue. It is a very specific shade of blue, which, coincidentally, both of us are in today. And we come to you live from the CNBC-TV18 Motilal Oswal studio as well. While we're talking about individual stocks, don't lose sight of M&M. The stock is up around 2% right now. So Darshan tells us that the business is a lot better. The results are a lot better than what the street was anticipating. And on the back of that, there is a spike in an otherwise outperforming stock in any case. We have the Adani Group stocks, which are doing well as well, and I see a peculiar uptick in Trent. Trent is up nearly 4% in today's trading session. This after having rallied 4% after the numbers and then fallen 4% post those numbers were reported in the next trading session as well. And start of the week itself, we have that stock higher by about 4%. But all of that in focus, we're also looking at Marico because it's good performing stock in today's trading session, an outperformer as the net profit and revenue beat street expectations, led by 7% volume growth, which is the highest that we've seen in the FMCG space so far. I spoke with Saugata Gupta, who's the Managing Director and CEO, who has been extended his term by the next couple of years as the MD and CEO until FY28. I asked him about the consumer sentiment and, more importantly, the expectations for the company from this year. Listen in.
I think we have been seeing a significant improvement in rural. I think rural, the demand seems to be good. It's far better than what it was. And I believe if the monsoon is, the overall monsoon forecast seems to be normal. So rural, demand should be okay. We are also seeing inflation cooling down a bit. Urban demand, I think, has been a little patchy in some kind of categories and certain section. It has been doing well. In certain, it has not been doing well. Having said that, I think what we have been talking about is that some of the organized FMCG players have lost share at the top end from some digital brands, at the bottom end from regional or smaller brands, which has become active in an inflationary condition. So I believe that the urban sentiment and the urban consumption will gradually improve, and therefore the volume growth this year should be better than what it was last year. Having said that, yes, there are some input cost pressures in the sector, which has been, I think, impacting bottom lines. But I think one needs to be resilient and manage that.
All right, so I'd like you to get a little more specific, because in your commentary, you've said a couple of things. You aspire for double-digit growth momentum in FY26, and also operating profit would be double-digit. I just wanted to understand what do you imply by double-digit revenue growth? How much of that would be volume-led? How much of that would be pricing-led? And when you are expecting double-digit operating profit growth, do you expect it to be in line with revenue growth, or do you expect some moderation in margins in the second year?
Maybe see it as follows. I think we have been now delivering, last quarter we delivered 6, this quarter we delivered 7. So therefore it will be important that we maintain this kind of a volume growth track record. yes, there has been inflation. We have taken around 30% increase in parachute pricing. There has been some increase in even Saffola pricing, which we have taken sometime last year, second half. When there was an increase in the table, a combination of input costs as well as the import duty. So I think there will be obviously inflation definitely in the first 2-3 quarters. So given the momentum we see in the digital brands and foods, we are extremely confident of food continuing to deliver 25-30% growth. Digital brands a little tad higher than that. So therefore, there is no. We are extremely confident of delivering double-digit revenue growth. As far as the bottom line growth, EBITDA operating margin growth is concerned, the operating profit growth, there are two factors. One is I think we believe that the copra prices, which is peaked and therefore it is going to move down. It will take a tad longer. We had earlier thought of a softening in Q1. We see the softening moving towards Q2. So therefore we will start picking up margins in the second half. The other thing that will happen is, as you know, that we have significantly improved margins in food, digital. Two of the brands are broken even, and Beardo is near to double-digit EBITDA. So we will push for accelerated growth in these two brands. So therefore, and of course, value-added hair oils, which has a higher margin, is expected to grow this time decently well. So all this mix change plus the fact that the second half we expect copra prices to correct definitely by Q2, and you will get the impact in the second half. We should strive to deliver double-digit operating profit growth this year.
All right, so if I had to break it down, basis what you've said so far, the first half of this year, high single-digit sort of volume growth is a possibility. Second half of this year, volume growth may move towards double-digit, with also margins between 19 to 20%. Would that be a fair estimate?
It's about volume growth moving towards double-digit. I think what we talked about is the revenue growth definitely delivering double-digit. Volume growth, what we are talking about is, I think we have delivered 6 and 7, and therefore we will strive to maintain this kind of a track record. As far as operating margin is concerned, as I said, that sometimes the percentage depends on the inflation. The numerator and the denominator effect, decides the percentage margin. Especially in high inflation, the percentage looks smaller. But the way to look at it is that I think as our aspiration is to deliver double-digit growth, growth in their operating profit.
All right. What about international? You said that international has done extremely well, double-digit, and you expect that double-digit to only accelerate going forward. What do you imply by that? What kind of increased run rate do you expect in your international business, and what sort of premium share do you expect? Because that has increased from 20% to 29%. How much does that diversify going forward?
I think international business, I think we are pretty confident about delivering double-digit constant currency growth. It's difficult at this stage to look at how the individual currencies of the countries will play out. I think Bangladesh has been extremely resilient, and we have been delivering double-digit growth for the last few quarters. I think our entire endeavor is, in our key markets, we should be one of the fastest growing, companies, as well as, aspiring to get what I call top quartile operating margin in each of the markets. I think we have done that in Bangladesh, South Africa. In Middle East, I think growths are high, and we continue to improve our profitability with scale. Vietnam is something which we have to get it back on track. There is some consumption headwinds, and also the fact that some of the categories we are there, penetration is high. So therefore, we have acquired certain brands in the last, and also ventured into some of the brands which are top end in female grooming. So they have to grow at an accelerated pace for Vietnam to get back into double-digit growth. So overall, I think we expect kind of a steady kind of a growth from the international business. As far as the diversification is concerned, I think two things have happened. Our dependence in Bangladesh continues to decline, although Bangladesh growing at double-digit, but the dependence going down. And the second thing is that our share of premium business, we expect that business to continue to grow at 20-25%, so that share grows rapidly. That is definitely has a less commodity dependence. It is far more premium and a higher gross margin.
All right. And finally, before we let you go on the diversification, you briefly did touch upon foods and digital brands along with premium personal care. You did say you're expecting food to grow between 25 to 35% this year, with the other parts growing a lot faster. What do you intend to end the next year with when it comes to this overall portfolio, when it comes to revenue run rate and the sort of margins that you're targeting this year?
I think we should be hitting 25% this part of the business by FY27. And I think it's extremely critical that this part of the business grows at 25% to 20 to 25% plus for us to continue this diversification. At the same time, I think as far as the digital brands are concerned, as I said, that the cohort of Beardo and Clicks, we expect that to hit 1,000 crore this year. This part of the business is already broken even, and therefore we have to drive accelerated growth. The second part, which is the Just Herbs and True Elements, there is still some bleed, although the bleed is marginal. Our effort will be to, while we grow at a sustainable pace of 20% plus, how do we accelerate the break even over the next 18 to 24 months? Food, I think we want to double in the next 3 years, and therefore at the same time, and food, the interesting thing, we have seen this with our oats and masala oats business, that at a certain level, today it's hit around 400 crore plus. We are almost near to our operating margin of the group, and therefore it is very important that we pick up 1 or 2 categories in food and get it to rapid scale, which will drive profitability.
And finally, any acquisitions on the anvil or any new category expansions?
I think we have enough on our plate, and I think it's important that we continue to grow. Yes, I think the 2 things we have done well. One is the total addressable, the TAM expansion of Saffola and the diversification international business. And there could be learnings so that we transplant into other countries some of the experiences.
All right, that is Marico, a confident-looking Saugata Gupta who expects a double-digit growth in the next year on both revenue as well as operating profits, with 6 to 7% volume growth sustaining. Large part of margin expansion comes in the second half of this year, led by their change in product mix and deflationary trends in some of their key raw materials as well. The stock doing well, up around 4.5%. We take a short break, come back, get you more on the markets and a lot of stock-specific action on the L side.
Welcome back. Just want to point out that there are a lot of stocks which are buzzing around in the broader market. So Sequence Scientific is showing a good amount of volume and price action. That stock is up around 8.5%. Shilpa Medicare is also showing good amount of traction on the upside, so up around 4.6% for that particular stock. Separately, just watch out for Trent, which is, had a rough year, but nonetheless, now it's seeing some amount of upside. So that stock is gaining up around 4% at this point. But let's talk about some big numbers which have come through. M&M reported a good performance in Q4, which was led by their tractor business. Sudarshan is here with a lowdown.
It's a strong set of numbers that M&M has reported, and both the segments have seen a healthy growth, and it's on the back of healthy volumes that even auto as well as sport tractor segments have seen more than 20% growth if you compare year on year. And the recent price hike that company had announced, it has helped company increase the realization both sequentially as well as year on year. So we'll start with the consolidated numbers. Their company has seen an increase of 20% each in both profit and revenue. Profit has increased 20% to rupees 3,295 crore. Revenue too has increased by 20% to, and it has come in at rupees 35,373 crore. Now coming to the standalone numbers which are being compared against our estimates. On the profit front, it has increased by 20%. Revenue was higher by 25%, and EBITDA has seen a sharp jump. It's an increase of almost 40%, and margin has increased to, and it has come in at 14.9% against our estimate of 13.8%. So auto margin has come at 9.2%. It's a minor increase from 9% that was in Q4 of FY24. But what has surprised very positively is the tractor segment, and their margin has come at a multi-quarter high levels. It has come in much higher than 19%. It has come at 19.4% against 15.8% that company had reported in the same quarter last year. It's an increase of 400 basis points, and that's on the back of the recent price hike that company has announced. And because of that, because tractor is a rich product mix, so tractor company basically gets higher margin in the tractor segment, and that helps in the improvement of realization as well. Now coming to the volume, it was an increase of 19%. For total, auto volume had increased by 18%, tractor volume had surged by 23%. Now in the commentary, what exactly we'll be looking, and we want to hear from the management what exactly it says on the demand front. Because if you remember, Maruti and SIAM had said that for passenger vehicle domestic growth, it's likely to be lower than FY25. So in FY25, passenger vehicle had recorded a growth in the range of 3 to 4%. But for FY26, SIAM has projected growth in the range of 1 to 2%. But for M&M, it's SUV. Majorly in passenger vehicle, they are in SUV, which continues to see a major growth. So inventory, discounts, and the domestic growth front, this is what we'll be looking in the commentary from M&M.
Take that point, Sudarshan. Thanks a lot for that. The stock up around 2% as their high margin business is doing well. But what's also doing well, once again, are the defense stocks. So pull up Bharat Dynamics, pull up Mazagon Dock Ship. All of last week, these stocks were surging, and start of this week, they continue to, move higher. So pull up on any of these stocks which are moving higher. So we have Bharat Dynamics, which should come up for you. Alongside that, we have Mazagon Dock as well, which has now moved to the high point of trade. But another stock which is surging right now is NetWeb Technologies. Winnie joins in to tell us how that company fared in the fourth quarter. Winnie.
Hi, good afternoon. So NetWeb, when you're looking at the numbers, a good set of numbers that's coming from the company in Q4 FY25. Strong performance overall. They've beat the revenue guidance that they've given for FY25 in terms of revenue as well as PAT. They've spoken about around 1,000 crore revenue guidance for FY25, much about that, as well as in terms of profit of around 100 crores, so much about that in terms of profitability as well. Order book sequentially, we're seeing a bit of a dip coming in, but that's mainly due to the higher conversion is what analysts are highlighting. Overall, AI as a segment in FY25 has done very well for the company. That's been a growth driver. And in terms of overall the contribution for AI, that has also seen an increase coming in. AI now accounts for around 15% of the revenue versus last year it was just 11%. A strong beat overall is what analysts are highlighting. Beside bit of a miss in terms of margins, but order pipeline continues to remain healthy. The order book in terms of L1 orders, that's also quite healthy. So keep an eye out on NetWeb today, trading almost near the day's highest point.
Okay. All right, Vinny, thanks very much for that. So a lot of stocks buzzing around today. Well, we need to take a short break, but here is some good news for our viewers. India's business news leader is now just a click away, introducing CNBC TV18's all-new app. Get instant access to breaking news, in-depth articles and financial world updates at just your fingertips. Download the CNBC TV18 app now from the Apple Store or Google Play Store, or just scan the QR code on your screen.
Investing.
Welcome back. You're watching us here on Halftime Report. The stocks which are not doing too well today belong to the banking space, and a large part of the contribution on the downside for the Nifty Bank has been coming in from Kotak Mahindra Bank, which is the top Nifty loser today, down over 5% as business momentum for the company slows to a 3-year low in the fourth quarter. Abhishek joins in with more on that. Abhishek.
For Kotak Mahindra Bank, the business momentum on a YOY basis is perhaps one of the weakest that you are seeing in the last 3 years. That has led to NI and PAT being below our poll. Both the NI and PAT versus our poll are on the lower side. Deposit growth was at 11.2% YOY, which is one of the lowest that you are seeing in last 11 quarters. Although sequential growth has been one of the best in last 4 quarters, coming in at 5.4% quarter on quarter. Advances growth has been at 13.5% YOY, one of the lowest growth that you are seeing in 15 quarters. That has been impacted by the unsecured portfolio like the microfinance, credit card, as well as the fact that corporate portfolio declined by 4% quarter on quarter. Net interest income growth is at just 5.5% YOY, one of the lowest that you are seeing in last 14 quarters. Now, operating profit growth is really weak, just 0.2% YOY, the lowest growth rate that you are seeing in last 11 quarters. Even the core operating profit, that is the NI plus fees minus OPEX, that's been weak. It has declined by 0.9% YOY. first time decline in 13 quarters, and it has declined by 0.3% sequentially. PAT has declined by more than 14% YOY, the highest decline in last 9 years. Subsidiaries, some of them were really weak. Their PAT declined both YOY and quarter-on-quarter. That was for Kotak Mahindra Life Insurance as well as Kotak Securities. Asset quality, 3-quarter low gross NP ratio, while cost to income ratio was at 5-quarter high.
Okay, all right, Abhishek, thanks very much for that. That's on Kotak. But let's in fact listen into what Ashok Vaswani, who's the MD and CEO of the bank, had to say about their Q4 numbers.
So it's difficult to say that. It really, what we said, the way I kind of like to temper it is it within that 1.5 to 2 times GDP growth? That is really a risk appetite statement, right? Because if the economy is going at a certain rate and you're growing too fast, then obviously you're taking too much risk. If you're going too slow, you're losing money on the table. So what we like to do is kind of say, hey, if the economy is growing this way, are we growing in that kind of ballpark? There's been a lot of pain, particularly in microfinance. We've seen a lot of pain. And in microfinance, while I think the industry, as well as Kotak, has shrunk the book quite dramatically, we brought our book down by about 33% on an average basis year on year. Just on a smaller book, the pain will kind of reduce. Based on the existing book, I think we'll see a better trend. And you can see it in our slippage numbers, right? For the last 2 quarters, our slippage numbers are coming down, which is a clear indication that losses will kind of come down as well. There are other stuff in the horizon, which we'll see how it plays out. But generally, I'm cautiously optimistic that credit costs will be better.
All right, that is the management of Kotak Mahindra Bank. But SBI is another stock which is slightly under pressure despite their numbers beating street expectations. The devil is in the detail, for which Abhishek joins in for more. Abhishek.
In SBI, the other income has actually aided in earnings beat versus our poll. A 19-quarter high with respect to write-offs actually aided the gross NPA ratio to be one of the lowest that you are seeing in last 10 to 15 years. Take a look at the PNL. The NI is a beat on our poll. PAT, on account of higher forex income as well as treasury gains, has beaten our poll. So 19-quarter high write-off, more than 10,000 crore in this quarter versus less than 2,000 crore in the previous quarter. That's aided the gross NPA ratio. Net interest margin is at 15-quarter low at about 3% versus 3.01% in the previous quarter. The NI growth rate on a YY basis is at just 2.7%, which is one of the lowest that you are seeing in last 5 years or 20 quarters. Return ratios remain weak, 5-quarter low with respect to ROA at close to 1.7% and ROE below the 20% mark. Slippages, they have been stable largely. A 10-quarter low slippage ratio of 0.41%. CASA ratio has improved for them for the first time in last 12 quarters, coming in at close to 40% versus 39.2% in the previous quarter. Now, loan growth has been at 12% YOY, the lowest loan growth rate that you are seeing in last 12 quarters.
All right, Abhishek, thanks very much for that. So that's on the largest bank of India. And in fact, let's listen in to the management talking to CNBC-TV18 on the quarter gone by.
More than the tempering, I think what we are aligning with the nominal GDP growth rate. And last year we grew almost 3 to 4% more than the nominal GDP. And we expect now that there will be some slight moderation on the corporate growth side. Whereas SME, agriculture and home loans are doing very well. So I think these sectors will contribute to the growth, and there could be some moderation on the core sector. This is what our expectation is. So while we have good visibility on the corporate book, both on the pipeline for sanctions but not disbursed, and also the pipeline proposals which are in discussion aggregating to around 3.4 trillion rupees, we see maybe around 12% growth rate on that. Why am I moderating on the corporate growth is that we see an effort to deleverage further on the corporate side. Sure. And we are witnessing a great amount of prepayments and which is bringing down the growth rate. Otherwise, the mid-corporate is growing well. Large corporate seem to be on the deleveraging spree.
All right, with that, we'll slip into a short break. On the other side, Manish Athiramani, prop trader and technical analyst at Deen Dayal Investments, joins in with some trading strategies. Stay with us.
Welcome back. You're still tuned into Halftime Report on CNBC TV18. M&M reported its Q4 numbers some time ago. Let's get you what the company is saying from their press conference.
3 to a 4.5% or lower number is a difficult one, but the business has done that very well and puts itself on the path of much stronger growth going forward. What we'll talk about also is our scalable growth gems and the foundation that we are building to ensure that they can be profitable and strong businesses for us in future. But all in all, a growth of 20% from a profit standpoint, and we continue to maintain an ROE of 18%. That's what you see here. While revenue is up 14%, profit is up 20%. Profit does exclude the mark-to-market on KG Mobility, which is SsangYong. It really has no impact from a cash standpoint or an operating standpoint. But we had seen profits in the prior year and losses in this year, which essentially offset each other. But in the percentage numbers, you see that impact, and which is the reason why we've taken that out. And 20% profit growth in the current environment is clearly very strong execution, and you'll see that across multiple businesses. Standalone is up 17%, both revenue as well as profits. And with that, we'd like to share a chart on the positioning of our various businesses. And you see this in terms of competitive position on the y-axis and the scale of the business on the x-axis. As you would expect, auto and farm are in the top right, a very strong competitive position, and both scale businesses. Mahindra Finance and TechM have scale, but aren't quite at the level of where we'd like them to be from a competitive standpoint. And there's more work to be done to take them higher on this graph. And then we have our growth gems, and we are now categorizing them into what we call scalable growth gems that have a strong competitive advantage in their industries, and emerging growth gems, which have some competitive advantage, but there's more work to be done to be able to get them higher again. And we are defining valuation targets for them, 2 to 3 billion for scalable growth gems, and getting to 1 billion, which is where we start getting a lot more competitive in that industry for emerging growth gems. Let's look at the performance across businesses. I'll cover auto and farm fairly quickly, as Rajesh is going to cover that in a lot more detail. Key highlights for auto. Number one, SUV player. Very strong electric vehicle order pipeline. Deliveries have begun, and we have very quickly gotten to the number one share from a revenue standpoint already. And disciplined execution with high margins. You see that in the numbers. Farm, new products, a strong geographical focus to drive growth outside India. Margins up 210 basis points, and you see that in the numbers as well. Mahindra Finance has seen a 17% growth in assets under management, despite pivoting to a business which is much less volatile, much more stable. And you see GS3 under the 4% threshold, as we outlined earlier. We have deprioritized disbursements last year to make sure we can transition the business to a more stable GS3 level. And you see that in the numbers as well, which is a very strong profit growth at 16%, and a very good outcome in terms of that transition. TechM, good deal wins, strong pipeline, bringing in more customers from a consumer and a BFSI standpoint, continuing well on the margin trajectory, and therefore positioning the business very well on the path that it has outlined already. Let's talk a little more about growth gems. Hospitality. 5 years ago, we had 3,700 room keys. Today we have 5,800. And we're moving to a target of 2 to 3 times that, which we'll cover in more detail later as those plans are finalized, which will effectively give it a 5x growth in terms of room keys alone. Logistics, we see revenue as a key metric there, up from 3,500 to 6,100. And they're targeting, again, close to a 3x growth in the next 5 years. And there also, we will come back to you with further details on that as those plans are outlined. With the new CEO, Hemant Sikka, coming in, we see that business on a very strong growth trajectory. Life Spaces, these are the numbers that have been presented by the Life Spaces team publicly. We have grown significantly from 670,000 in pre-sales 5 years ago to 2,800 crores today. And the target there that the business has outlined is actually 9,500 crores, which we're taking the liberty of rounding up to 10,000. And that is really a 14x growth over this decade and positions this business extremely well. More importantly, again, has been shared by the business. Everything that's required in terms of pre-sales in the next 5 years, 70 to 80% of that has already been acquired in terms of land, and it's only execution from here on. There's also a very strong focus on profitability, and which is the reason why we are going ahead with the rights issue, putting more capital into the business and enabling its growth. Sustain, up 5x, our renewables business. Last mile mobility, up greater than 10x, possibly even 15x by the time we are done with it. Up from 14,000 to 78,000 already. So you see a significant growth over the last 5 years. And we are still, again, trying to target 2 to 3 times that growth over the next 5 years.
Okay, so that is the management of M&M addressing the numbers that they reported. The stock, as you can see, is up around 2%, indicating that the SUV revenue market share is currently stable, and the LCV market share is at around 52.3%, up around 450 basis points plus on a year-on-year basis. Tractor market share also stands at around 41.2%. We'll keep getting you more updates. As of now, we need to take a short break. We'll get you more on the numbers as well as some technicals. Stay tuned. Welcome back. Well, for the markets, it's holding steady. So we have the Nifty, which has gained around 100 odd points at this point in time. We have the Bank Nifty, which is sulking, so down around 0.5%. And that's really the sore point in today's trading session. No incremental gains for the midcap index, but it's holding steadily. So that's a good thing to see. Watch out for Biocon. It comes out with its numbers this week. It's holding up quite well ahead of that. So up around 4 odd % currently for Biocon. But Manish Hatiramani joins in to discuss the technicals of the market now. Manish, hi, welcome to the show. Well, it's definitely a very lively market except for the financials. What's your approach today? First for the index as well as for specific stocks.
Good afternoon, Ekta. Thank you so much for having me on the show. Starting with the Nifty, I feel 24,600 has a stiff resistance. If we can get past this 24,800 and then 25,000 would be the next target levels. Since this can prove to be a bumpy ride like we are seeing for the last few days, even the target levels have now reduced. We have a short-term support at 24,150, breaking which we could slide down to 23,850 to 23,900 levels. Bank Nifty, this is the index really which is playing spoil sport. And that is what is not allowing the overall sentiment to be fully bullish across. We are close to a very clean support level of about 54,650 to 54,700. If we break this, the index could drop down to 53,850. On the upside, we are going to battle a resistance level around 55,600. Having said that, since we haven't really broken down, I'm working with 2 buy calls. The first one is on an ITC. For a target of 450, stop loss of 420, 390 to 400 was a strong base for this stock, and we have broken out of this after a significant period of consolidation. The second one is a buy on Adani Ports for a target of 1450, stop loss of 1200. This stock was in a sideways zone between 1000 to 1200. We have seen a burst of volume thereafter, and that is positive for the stock.
All right, all right, Manish, thank you so much for joining in and giving us your call on the index and a lot of individual stocks. The Adani Group on top of your list, all those stocks out there doing extremely well. But the FMCG stocks are actually doing well in today's trading session, led by Marico's numbers. We'll take a short break. On the other side, we'll get you excerpts from our exclusive conversation with the management of Tata Consumer. Stay with us. Welcome back. You're watching us here on Halftime Report. I recently spoke with the management of Tata Consumer Products, the MD Sunil D'Souza. He spoke about a couple of things, of which three things stood out. One, they're launching a Korean range in the Ching's portfolio. Secondly, they're making a foray into the sports drink space. And thirdly, they are looking at a big brand ambassador for Organic India. Let's listen in to what they had to say about the consumer sentiment, the innovation pipeline, and growth going forward.
The good part is over the past 5 years, I think top line double-digit, 13% revenue, 14% EBITDA, 23% net profit. I think it's been a good run for the last 5 years. Going forward also, we're continuing to target an aggressive growth rate, double-digit top line. Again, EBITDA margins, we're extremely aware, saying we're one of the lower this thing. So that will grow far faster than top line. And yeah, I mean, the aim is to double TCPL in double quick time.
Okay, so, one of the things that you had said also in the past, that you were 15 minutes into a 2-hour-long movie. How far along have we gone since then?
I would probably be 30-35 minutes.
30-35 minutes?
Yeah, so we've still got a long way to go.
I remember you telling me that, at a business case level, Capital Foods could actually do 30% margins versus the 20-24% that when you acquired it. Even Organic, you were hoping of a manifold growth out there, largely because of, one, its quality of product, and secondly, the distribution mismatch. How much of that has already happened right now? In how many outlets are these products available? What can we expect in the next couple of years?
It took us a bit of time, both for Organic India and Capital Foods, because understanding the categories, the category dynamics, the outlets which mattered for weighted distribution, and the kind of back-end stuff that we had to do to make sure that we maintain the margins. We probably took around 4 to 5 months.
More than...
we probably thought we will get it in a quarter. It probably took us 5-6 months to understand the base stuff. So roughly half the year. And from then on, it has been an acceleration, right? Now you will see an expansion of two things. One is you'll see an expansion of distribution.
Yeah.
And more importantly, you will see a portfolio expansion happening, right?
330 crore was this quarter. 500 crore per quarter run rate happens sometime in the middle of this year or start of
We should be getting. The second half of this year should be peacefully that kind of run rate.
What about, you increasing the TAM in these? You spoke about Soulful, you spoke about Organic. There's a lot more that they can stand for as well. Are there any thoughts of increasing, the positioning of expanding the positioning of Organic India and Soulful beyond what they are right now?
So absolutely, Mangalam, the whole theory was that very strong brands with very strong propositions and therefore could leverage into adjacencies very, very quickly. And let me give you some examples, right? Soulful, we've just entered Rusk. Rusk is a huge, huge segment across the country. We're in the process of right now identifying plans to expand that. That's example number one. Example number two, when you said Capital Foods, right? In Capital Foods is Desi Chinese. And one of the big TAMs which was not tapped aggressively in the past was noodles, right? Now, noodles, we were only playing in the multi-pack segment aggressively. But the bigger segments, if you look at it, is the 10 rupees and the 5 rupees.
Yes.
The 10 rupees, there is money to be made, very decent money. You have to just get in there and get this thing. And I've got a differentiated product. I will never play mainline noodles,
yes,
right? With Ching's. But there is a differentiated play to be had, and we're just about starting off expanding on that route. That's number two. Capital Foods, the other thing, I think we talked about it briefly, is the Korean craze.
Korean, yes. Can Desi Chinese also turn into Desi Korean?
Absolutely. It has got every right to enter that very simple.
Korean, gochujang and all of that is...
So you will see a range of Korean cuisine launches coming out under Ching's portfolio very shortly.
Let's talk about Narishko now. Start of last year, you said it'll be 1,000 crores last year. You didn't anticipate the competition that came in. You ended about 850 crores. So it's a given that 1,000 crores happens in FY26. What's the growth path here? Because, there is strong competition. And I was reading a note that came in from Varun Beverages, which said that 59% of their volumes are actually generated from no or low sugar products. Functional beverages are doing extremely well. Are you considering entering the sports drinks, what, say, the others are doing right now?
So Mangalam, in Narishko, we've consistently maintained that we will not go up against the majors, right? We will do a differentiation.
So no fizzy drinks.
So we will not get into carbonated drink. We are, I would say in the next 15 days, you'll see a sports drink come out.
Okay, and that's a headline.
We
entered energy, but we didn't get it right. You're in the process of rezigging it. You'll probably see a relaunch pretty quickly. You will see a slew of functional drinks. I mean, we're back on the growth path. Overall, for the last quarter, I grew 17 on volume, 10 on value. But I exited March as a 38 on volume and 26 on value.
Got it.
So there's no reason I will not grow 30% consistently here on.
Electrolytes in your drinks, or what's the scene?
We're looking at that category very, very closely. Actually, I was in Chennai and Hyderabad, and I did see a plethora of offerings out there. But it's a very fragmented space. So I do think there is an opportunity to play out there.
When you look at Tata advertising, it's not a Pepsi, it's not a Whirlpool, it's not aggressive in your face, this is my brand and this is what it stands for sort of product. Are you looking to change that?
Capital Foods, you will see advertising ramping up. We've just signed up, I would say, one of India's biggest icons for Organic India to come out and talk about Organic India. You'll see that playing out.
Who's that?
You'll see that playing out, Mangalam, shortly. Or we're looking at another famous celebrity, because we've done a whole relaunch of Tekli. People drink green tea. One of the primary reasons consumer thinks it aids weight loss. So we've added L-carnitine onto the green tea, and we're backing it up with a celebrity to endorse it. So it's not across the board this thing, but targeted advertising, we will ramp it up.
Right, insightful conversation coming in from Sunil D'Souza of Tata Consumer Products. You can catch excerpts of that all through the day. With that, we wrap up on this edition of Halftime Report. Thank you so much for watching.
Markets come off opening highs weighed down by banks. Midcaps are outperforming. Energy and consumer discretionary are the big gainers, even as financials are the big drags. State Bank of India trims its growth outlook and cautions on margins going forward, while Kotak Mahindra Bank misses expectations as business growth slows to a 3-year low. Mahindra & Mahindra's fourth quarter revenue jumps 25% from last year, boosted by healthy volumes, realizations and margins also expand on a year-on-year basis and beat expectations. Crude oil prices drop after OPEC and allies decide to increase output by higher than expected 4 lakh barrels a day in June. Stocks of oil marketers and other crude-sensitive businesses perk up. And legendary investor and Berkshire Hathaway chairman and CEO Warren Buffett will step down as CEO by the end of the year, even as he intends to hang around. Greg Abel, who heads the non-insurance businesses, will take charge. Good afternoon, you're watching Business Lunch live from the CNBC-TV18 Motilal Oswal studios. I am Harish Krishnan. It's a good start to the new trading week for our markets. We are looking to go past last week's high, but of course the question is whether these gains can sustain as we head into the second half of the trading session. As you can see on top of my screen, on top of my head, the Nifty Bank is the big drag, and that is keeping the index gains in check as well. But for now, 125 points higher on the index, and that's fairly doing well for itself after it had come off significantly from the highs of the day. So that dip, that marginal dip that was seen, is trying to be bought into as of now for the index. But of course the big drag is the Nifty Bank, and that is because it is weighed down by results of Kotak Mahindra Bank. That remains among the top losers on the index, 5% lower on Kotak Mahindra Bank. And of course, there are other earnings reactions as well. Jindal Saw, 5.5%, continues to remain the top drag on the Nifty 500. But on the flip side, there are a lot of gainers and positive earnings reactions at that. Kabel up 15%, Netweb Tech up 14%. And another earnings reaction is Parag Milk Foods. That too is up 15% in today's trading session. So earnings reactions largely towards the positive side in today's session. Gravita is another one, and the other theme, of course, are the oil sensitives that are doing well for themselves in today's session, be it HPCL, be it BPCL. HPCL, of course, reports results tomorrow, so keep an eye out on that. And the other oil sensitives, be it the paint stocks, be it the aviation names, they too are faring well for themselves after Brent early this morning fell below the mark of $60 a barrel. But the big story of the day is the large banking results, and Kotak Mahindra Bank, of course, is the talk of the morning, and that's down 5% as we just mentioned after its fourth quarter results. But how did the overall fourth quarter numbers look for all large lenders that have reported results so far? Abhishek is joining in to tell us exactly that. Abhishek.
Well, Rima, to begin with, large lenders have reported their Q4 FY25 performance. And if you take a look, at the comparison table, private banks have seen robust deposit growth on a sequential basis, anywhere between 5.5% to about 7% range. In fact, at a time, this has come in, at a time when deposit growth is a big concern in the industry. Seasonal in nature in Q4 for deposit growth to happen for HDFC Bank and Axis Bank. Now, SBI has seen the weakest deposit growth on a sequential basis at just 2.9% in Q4 FY25 amongst large banks. If you take a loan growth, and if you take a look at the loan mix, the corporate portfolio has actually been shunted down by private banks because of the unfavorable yields. That is what many managements have commented. So, the likes of ICICI Bank and Axis Bank and Kotak Mahindra Bank as well, they spoke that, unfavorable yields have led to corporate book not growing that much. On the other hand, if you take a look, SBI's corporate growth of 5.5%, that is corporate loan growth, has been one of the highest amongst all the large banks. Now, net interest margin has improved quarter on quarter for most of the banks, especially ICICI Bank and HDFC Bank. They have seen the highest sequential growth in their net interest margin. However, for SBI, it's actually shrunk by 1 basis point on a sequential basis. basis. Now, operational efficiency was another area of focus. It's been the highest decline for SBI, the cost to income ratio declining by 184 basis points on a sequential basis. Axis Bank and Kotak Mahindra Bank actually saw an increase in their cost to income ratio. Meaningful part in any bank's result is the return ratios or ROA. So SBI saw a decline in its ROA, that is return on asset, on a sequential basis, while Axis Bank and ICICI Bank have seen the highest increase in their return on asset ratio on a sequential basis. If you take a look at the valuation picture with reference to price to book value, large banks like HDFC Bank, ICICI Bank on the private side trade between 2.7 to 2.9 times, while SBI is trading at 1.5 times price to book value on a one-year forward basis. Back to you.
Abhishek, thanks a lot for that. And speaking of Kotak Bank, there are multiple downgrades that have come in for the lender as well. And Abhishek, in fact, earlier spoke to Ashok Vaswani, who is the MD and CEO of Kotak Bank, to understand the bank's FY26 outlook. Listening to what he had to say.
So it's difficult to say that. It really, what we said, the way I kind of like to temper it is it within that 1.5 to 2 times GDP growth? That is really a risk appetite statement, right? Because if the economy is going at a certain rate and you're growing too fast, then obviously you're taking too much risk. If you're going too slow, you're losing money on the table. So what we like to do is kind of say, hey, if the economy is growing this way, are we growing in that kind of ballpark? There's been a lot of pain, particularly in microfinance. We've seen a lot of pain. And in microfinance, while I think the industry as well as Kotak has shrunk the book quite dramatically, we brought our book down by about 33% on an average basis year on year. Just on a smaller book, the pain will kind of reduce. Based on the existing book, I think we'll see a better trend. And you can see it in our slippage numbers, right? For the last 2 quarters, our slippage numbers are coming down, which is a clear indication that losses will kind of come down as well. There are other stuff in the horizon, which we'll see how it plays out. But generally, I'm cautiously optimistic that credit costs will be better.
Well, the other major lender that reported results over the weekend is State Bank of India, and that is, of course, here. Let's also hear out what the management of India's largest lender had to say.
More than the tempering, I think what we are aligning with the nominal GDP growth rate, and last year we grew almost 3 to 4% more than the nominal GDP, and we expect now that there will be some slight moderation on the corporate growth side, whereas SME, agriculture and home loans are doing very well. So I think these sectors will contribute to the growth, and there could be some moderation on the core sector. This is what our expectation is. So while we have good visibility on the corporate book, both on the pipeline for sanctions but not disbursed, and also the pipeline proposals which are in discussion aggregating to around 3.4 trillion rupees, we see maybe around 12% growth rate on that. Why am I moderating on the corporate growth is that we see an effort to deleverage further on the corporate side. Sure. And we are witnessing a great amount of prepayments, and which is bringing down the growth rate. Otherwise, the mid corporate is growing well. Large corporates seem to be on the deleveraging spree.
India's largest lender, State Bank of India and Kotak Bank, both reacting to results in today's trading session. And of course, just as we mentioned a few minutes earlier, the other big theme of today's session is that the crude oil prices have now slumped below $60 a barrel, and this is after the OPEC and allies have decided to further increase production from the month of June after already having approved an increase in output for the month of May. So Brent is exactly at $60, currently recovering some of the lost ground from early morning, and NYMEX is currently trading around 57 a barrel. But Sudarshan is here to tell us the impact that it could have on India's listed companies. Sudarshan.
So we are seeing a big move in crude sensitive names, while upstream companies like ONGC and Oil India are lower in trade. But there is a big move that we are seeing in downstream companies of, or say oil marketing companies of IOC, BPCL and HPCL, and even other crude sensitives like paint companies, even Asian Paints, Berger Paints, or say airline companies, Indigo. All the stocks are higher in trade and trading with healthy volumes. So it's on the back of first crude has slipped today. In the intraday, you saw crude falling below $59 per barrel, almost at the levels that we saw last in 2021. Now, why did we see a sharp fall in crude? It's on the back of OPEC Plus, which is led by Saudi Arabia and Russia, has decided to increase the production, and this increased announcement has been higher than expectations. They have decided to increase the production by 4.11 lakh barrels per day, and this is for the month of June. Now, on the back of this, why this is negative for ONGC? So basically, once we see a fall of $1 in crude, it impacts annual revenue of these companies like ONGC and Oil India in the range of rupees 300-400 crore. But in contrary, it's positive for downstream companies or say oil marketing companies like IOC, BPCL and HPCL. If there is a fall of $1 in the crude, it impacts positively to their EBITDA in the range of rupees 200 to 300 crore. Now, why this is positive for paint companies? Because for paint companies, up to 50% of their input costs are linked to crude. So if there is a sharp fall, it will have a positive impact on all the on the margin of all the paint company, and that's the reason you are seeing a big move in these names.
Indeed, Sudarshan, thanks a lot for that. An important analysis there on the impact of the fall in crude oil prices. Take a short break. On the other side, legendary investor and Berkshire Hathaway chairman and CEO Warren Buffett will step down from the helm after 6 decades. More takeaways from Berkshire Hathaway's AGM after this short break. Stay tuned. Welcome back. Still 100 points higher on the index, continuing to hover around that 24,450 to 24,500 mark is the index. But it is the end of an era at Berkshire Hathaway, as Warren Buffett has announced that he will retire as the CEO by the end of the year, ending an iconic 6-decade leadership tenure. In the 60th annual shareholders meeting, he recommended Greg Abel as his successor. The Oracle of Omaha also commented about tariffs and American exceptionalism at the event. Listen in.
Greg should become the chief executive officer of the company at year end, and I want to spring that on the directors effectively and then give that as my recommendation. Let them have the time to think about what questions or what structures or anything they want, and then at the meeting following that, which will come in a few months, we'll take action on whatever the view is of the 11 directors. I think they'll be unanimously in favor of it. And that would mean that at year end, Greg would be the chief executive officer of Berkshire. The main thing to do is not use, trade should not be a weapon. And the United States, we've won. I mean, we have become an incredibly important country starting from nothing. 250 years ago, there's nothing been anything like it. And it's a big mistake, in my view, when you have 7.5 billion people that don't like you very well, and you got 300 million that are crowing in some way about how well they've done. And I don't think it's right, and I don't think it's wise. I do think that the more prosperous the rest of the world becomes, it won't be at our expense. The more prosperous we'll become, and the safer we'll feel.
Staying with global updates, following US President Donald Trump's first 100 days of administration, in a conversation with NBC News, he commented on lowering China tariffs at some point.
At some point, I'm going to lower them because otherwise you could never do business with them. Yeah. And they want to do business very much. Look, their economy is really doing badly. Their economy is collapsing. No, I think the tariffs are going to be great for us because it's going to make us rich.
But you said some dolls are going to cost more. Isn't that an acknowledgement that some prices will go up?
I don't think a beautiful baby girl that's 11 years old needs to have 30 dolls. I think they can have 3 dolls or 4 dolls because what we were doing with China was just unbelievable. We had a trade deficit of hundreds of billions of dollars with China.
When you say they could have $3 instead of $30, are you saying Americans could see empty store shelves?
No, I'm not saying that. I'm just saying they don't need to have $30. They can have 3. They don't need to have 250 pencils. They can have 5.
Is it okay in the short term to have a recession?
Look, everything's okay. What we are, I said, this is a transition period. I think we're going to do fantastically.
And President Trump continued to call for lower interest rates and said that he has no plans of removing Fed Chair Jerome Powell anytime soon. Listen in.
Do you rule out removing Fed Chair Jerome Powell?
I'm not, I get to change him very quickly anyway. It's in a very short period of time.
In 2026. You're not going to remove, you don't have plans to remove him before 2026 when his time's up?
That was a total, why would I do that? I get to replace the person in another short period of time.
Donald Trump on a very important clarification on what he plans to do until Jerome Powell's tenure ends. But to take a short break, just before that, some good news for our viewers, and that is India's business news leader, which is now just a click away. And that is CNBC-TV18's all-new app, which brings to you in-depth articles, breaking news and financial world updates right at your fingertips. You can download the app from the App Store or the Google Play Store, or scan the QR code that comes up on your screen. Take a short break. Back with more on the other side. Welcome back. Now shifting focus to the fallout from the Pahalgam terror attacks following the suspension of the Indus Water Treaty. Sources say that India has now reduced the flow of water to Pakistan from the Chenab River. Parikshit is joining in with more on this. Parikshit, good afternoon. What are you picking up?
So we're now seeing an unveiling of India's strategy on clamping down on the Indus Water Treaty. Now, we had suspended it, announced it publicly. Now, India is utilizing all the rights available at its disposal, all the measures at its disposal to slow down the supply of water to Pakistan. Now, you have the Baglihar Dam in Jammu and Kashmir, in the Ramban area of Jammu and Kashmir. This is on the Chenab River. What India has done, it has exercised its right to conduct a desilting or a flushing of the reservoir. But what it has gone on to do, it has closed down the gates, which ensures that the water does not go towards Pakistan and stops considerably. So this is what India has done, and we hear from sources that the water supply to Pakistan via this route has gone down significantly. Next, we believe a similar measure could be also taken at the Kishan Ganga Dam. Today, there's a very important meeting of the Ministry of Home Affairs, Ministry of Jal Shakti, and more such measures to reduce the flow of water to Pakistan under the Indus Water Treaty is being contemplated. Now, these are top officials of the government meeting daily to review the actions that are being taken as well. Now, apart from this angle, we are also seeing a lot of economic pressure being built. We've cut off all trade relations with Pakistan. All shipping ties have been broken down. Postal services have been suspended. And every day, the Prime Minister is actually meeting defense chiefs. Today, he's meeting the Defense Secretary to look at different options and India's preparedness altogether. So clearly, a lot of pressure building on Pakistan.
Indeed. Keep an eye out on that. Parikshit, thanks a lot for joining in. Turning our attention to Israel now, where a missile strike by Yemen-based Houthi rebels struck the Tel Aviv airport, injuring 8 people. The attack was a result of Israeli forces failing to intercept the missile fired from Yemen. Now, this led to the airport shutting down for about 30 minutes. Moreover, a number of international flights have been cancelled until the 6th of May. And with that, we call time on this edition of Business Lunch from me and the team that put this show together. Thank you so much for watching. We leave you with the Nifty still 100 points higher. Midcap radar takes the action forward.
Good afternoon and welcome to Midcap Radar live from the CNBC-TV18 Motilal Oswal studio. I'm Mamakshi Doria and with me is Vivek Iyer. Vivek, well, it's the beginning of a new week and the markets so far are doing quite well. They're holding on to the gains that we saw early morning.
That's right. Good afternoon, Mamakshi. So we're starting off the week, on a strong session. Remember, global markets, quite a few of them are closed on account of the Labor Day holidays. But here, mainly reacting to earnings, and earnings so far have not been very disappointing. The only laggard today is the Bank Nifty on the back of slightly muted loan growth coming in both from Kotak as well as SBI. So Bank Nifty is the only laggard in today's trading session. Broad end of the market is doing quite well. We have quite a lot lined up on the show, so let's start off on the top headlines. Markets off the morning highs, weighed down by banks. Midcaps outperform. Auto along with oil and gas are the big gainers, even as banks drag.
Crude oil prices drop after OPEC Plus decides to increase output by a higher than expected 4 lakh barrels a day in June. Stocks of oil marketers and other crude-sensitive businesses perk up.
Parag Milk gains after Q4 revenue and EBITDA surge on year-on-year basis. The company says they took a price hike of Rs 2 per litre effective May 1 due to rising procurement prices.
IGL in focus after company increases CNG prices in Delhi NCR area by 1 rupee per kilogram to 77.09 rupees per kilogram. Stock surges over 4%.
Kabel surges after achieving their highest ever revenue in Q4 FY24 as well as FY25. EBITDA surged 68.7% on a year-on-year basis. Also, the stock gains on positive management commentary coming in from the company.
Well, 24,450, that is where the Nifty is at, and contributing to the gains is Nifty Auto. Motherson is up nearly 3.9%. So is Bosch as well as M&M after its numbers. The Nifty Bank, clearly the laggard in trade dragged down by both Kotak as well as SBI. But the mid-cap space, that is doing quite well. When we look at the advanced decline ratio, that will also come up for your screen. That is holding firmly in favor of the advances, and lots of stock-specific action playing out in the mid-cap space. And to take us through just that, we now have our special segment, Mid-Cap Movers. Hormaz is across the wall to take us through the mid-caps that are moving around in trade. Good afternoon, Hormaz.
Good afternoon, Vamakshi, and plenty of them moving around in trade. And you'll start off with Swiggy. And interestingly, that stock is going to be in focus over the first fortnight of this month, reporting results later this week, a shareholder lock-in ending next week. So plenty of action awaited in Swiggy, 8% higher now on the stock. And Motilal Oswal is the other one as well, 7.5% higher there as well. Vari Energy is having a good day in the office today, nearly 5% higher. We've been pointing out that earnings reactions today have been on the extremes, but on the positive side in today's trading session. Take a look at this. Kabel is up 15, and that is off the highs of the day and is still up 15%. NetWeb is up 13, Gravita is up 7. All of them are off the highs of the day, still holding on to substantial gains. CDSL, though, has recovered from the lows of the day, but still down 3%. But take a look at what Kabel's results have done to the other wires and cables companies. Look at Phenolex Cables, that's up 6.5%, nearing the highs of the day. KEI Industries is at the highs of the day, 5.5% higher. Polycab is up 4.5%. Most of them reporting results tomorrow, so it'll be interesting to see how they fare going forward as well. So good day for these wire and cable companies as well after Kabel's results. The other big talking point has been the fall in crude oil prices, and that has impacted all the oil sensitives. Look at HPCL, another one reporting results tomorrow, 6.5% higher here. Interglobe Aviation, another positive impact. Tire stocks too seeing a positive impact as a result of this. And lastly, stocks that are doing well and not so well on the back of volumes. JBM Auto 5.5% higher. Ircon after the order win is up 3.25%, but off the highs of the day. And Jindal saw another earnings reaction down 5.5%, but on high volumes. Back to you guys.
Thank you so much, Hormaz, for taking us through the list of movers, mainly earnings dominated, but quite a few stocks also from the broader end of the markets reacting to the kind of macro developments, especially crude oil price movements. But it's a good time to welcome Ruchit Jain from Motilal Oswal Financial Services for a tech check on the market. Good afternoon, Ruchit. Thank you so much for joining us. First up, what do you make of the markets at current levels, Nifty as well as Nifty Bank? Do you see further upside?
Yeah, hi, very good afternoon, Vivek. Well, in last few trading sessions, we have seen some signs of some consolidation coming in on the index front. Because if you look at the levels of around 24,500, 24,600, then this is the zone of 61.8% retracement resistance of the entire correction that we had seen from all-time high to the recent swing low. And also, if you look at the market breadth, today it's positive, but if you just look at last 5 or 6 trading sessions, it has been just 1 or 2 days where the market breadth of NSE 500 has been much on the positive side. So we believe that on the index front, we are likely to see some sort of consolidation where 24,600 would continue to act as a resistance, whereas 24,200, 250 would be a support level. So no, we are of the opinion that on the markets, one should keep a buy-and-dip approach as far as index is concerned, not expecting a run-up rally immediately soon, but rather if we get any declines, then the risk-reward ratio should become favorable at lower levels.
Thank you so much for that, Ruchit. This is Mamakshi Dhuria now joining in. You're expecting some consolidation at that 24,600 mark, but what are some of your top picks as far as stocks are concerned?
Yeah, good afternoon, Mamakshi. Definitely, even if the index consolidate, I think the stock-specific opportunities would provide a good momentum. And a couple of names that are on our radar from here on. One is HAL. In fact, the entire defense theme, we believe in the month of May could do really well. April was a month where we witnessed very good price volume action for many of the defense stocks. So here it seems that the trend continues to be positive. So HAL has also recently given a breakout from its falling trend line, higher top, higher bottom structure is there. So HAL can be bought at current levels with stop loss below 4440 for potential near-term targets around 4850. And Marico is another name which after numbers, I think today if you see, then the stock has resumed its uptrend and has given a breakout from a bullish flag pattern. So also if you look at compare Marico with other stocks within the FMCG space, then it has shown that relative outperformance within the sector also. So I think this should continue its uptrend. So Marico can be bought even at current levels with stock below 700 for potential targets around 760.
Thank you so much, Richard, for joining us, giving us a sense of market technicals as well as your individual stock calls, Marico being one of those particular stock calls. But as we now slip into a short break, here's some good news for our viewers. India's business news leader is now just a click away. Introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates at your fingertips. Download the CNBC-TV18 app now from the Apple Store or Google Play Store, or just scan the QR code on your screen. Welcome back to Midcap Radar. Well, this is our special segment, Midcap Spotlight. Mangalam today is joining us and focusing on Parag Milk, which is surging in trade on the back of a good Q4. Mangalam, what's the earnings fine print? What is it that the street likes so much?
Well, a couple of things that the street likes for Parag Milk and the dairy sector in general. The first part is that they reported their numbers during the weekend, and in that, while there was a 16% jump in their revenue, there was gross margin stability at around 25.1%. Importantly, the EBITDA surged by 68%, and the EBITDA margins themselves grew by almost 200 basis points from 4.7% to 6.8%, which is a massive jump given the commodity nature of this business. And the net profit on the back of that and a lower base jumped all the way from 10 crores to about 26 crores itself. What is it that led this growth? The volume growth this time around was 13% for them, and 57% of their revenue came in from core categories, which is, ghee, etc. 6% came from new age premium businesses, which grew 29%, and these are margin accretive for the company on the whole. Over the last 4 quarters, if you've seen, the milk procurement prices have increased from 31 rupees in the first quarter to 33 rupees, 34 rupees, and in the fourth quarter itself is 37 rupees. And as we've heard from players like Amul, Mother Dairy and Parag Milk itself, now they've gone ahead and taken a price hike of almost 2 rupees per litre to mitigate the challenges of higher procurement prices, so which means that the dairy cycle is on the upswing for the next couple of quarters as well, with increased value-added products, new age products, and higher procurement prices being passed on to the consumers by virtue of price hikes. The street likes all of this, and that explains why the stock is up around 14% after having taken a beating over the last few months. Now the stock has recovered from lows.
Well, thank you so much, Mangalam. Definitely keeping an eye out on Parag Milks. But, there's one more counter that is surging in trade after its Q4 earnings. That stock is Gravita India. We now have Nigel joining us with some of the key takeaways from the numbers. Nigel?
Well, hi, Vamakshi, and good to see you there. That's right. I'm going to tell you about Gravita. The stock had fallen close to around 30% from the top, and it's higher in today's trading session. The reason is that their operating performance is quite good. So the way they look at the revenues, they include other income because they believe it's part of their operational income, and they've clarified on the channel numerous times. So revenue growth of close to around 21%, but the EBITDA number grew by close to around 32%, which meant that the margins did expand to around 11.9%. That compares with around 10.9%. So that's 100 basis points higher on a year-on-year basis. The PAT number as well did spike up by close to 37%. Couple of elements out here. Finance cost was lower, but effective tax rate that they paid was relatively higher. So that's what explains the PAT performance. Operationally, though, things look good. Segmental, well, lead is the bulk of their business, and the lead revenue growth was good. The EBIT number was very, very good. Came in at around 114 crores. That compares with around 80 crores on a year-on-year basis. And just take a look at it on a unit basis. The margins were at around 13%, which is a sharp improvement both on a year-on-year as well as on a sequential basis. And the EBITDA per unit, well, that clocked in 20,500 rupees per ton, which is much better than what we have seen in the previous quarter as well as on a year-on-year basis. Gravita doing well in trade today. Maybe it fell a little too much from the recent peak, and the performance of the lead business looked quite good. Back to you.
Thank you so much, Nigel, for joining in and giving us a sense of how exactly the results of Gravita India panned out. But one stock that's in focus from the broader end of the market is Apollo Microsystems. This is after the company acquired a 100% stake in Ideal Explosives. Ria from the research team joins in with more details.
Well, yes, Apollo Microsystems has been in focus today after they've announced that they're going to acquire a 100% stake in a company called Ideal Explosives for rupees 107 crores in an all-cash deal, which is expected to be completed within the next 2 to 3 months. Now, Ideal Explosives, which is a subsidiary of Hinduja Group's GOCL, is engaged in the manufacture and supply of packaged and bulk explosives, which is used in mining and infrastructure projects. And the revenue for FY24 for this company was around rupees 623 crores. Now, overall, this acquisition is expected to give a lot of benefits for Apollo Micro. It's going to lead to the consolidation of core high-value defense assets and know-how, and it will also unlock access to adjacent high-value domains such as precision-guided munitions, loitering systems, warheads, and autonomous weapon platforms as well. In fact, it is also expected to drive margin expansion for the company going ahead, and it will enhance their ability to pursue large-scale, high-value projects. Furthermore, it is also expected to increase the TAM of the company and extend reach into international markets across East and West Africa, the Middle East and Southeast Asia as well. Even if you look at the overall market size for explosives, that is expected to increase to around $9.37 billion in 2029 at a CAGR of 8.8%. So overall, this is expected to be very beneficial for Apollo Micro. In fact, even before this acquisition, the company had given a guidance for FY26 for revenue growth of around 45 to 50%. So a lot of positive triggers for the stock, and the stock was up around 7% early in today's trading session.
Well, thank you so much for that, Riya. Before we slip into a break, let's look at Motilal Oswal. The stock is up almost 9.5% today, 9%. Keep in mind that the stock had taken a very sharp knock in the last few trading sessions, especially after the company reported its numbers. But today, that stock is seeing a very sharp recovery. So on that note, let's now slip into a break. We'll get you more on the markets and stock-specific action on the other side. So don't go anywhere. Stay tuned.
investing.
Welcome back. You're watching Midcap Radar on CNBC TV18. As we've been highlighting, the broader end of the market is holding very strongly in the green. And one counter also in focus is Kalyani Steels. The company just reported its numbers a very short while ago. That stock has surged by almost 9% as of now. Look at the spike coming in on the counter. The margins have improved to 20.99%. They've also declared a dividend of 10 rupees per share. So definitely boding well for Kalyani Steels. But moving on then, IGL shares are also in focus after the company has hiked prices in Delhi. Sudarshan is here with more of those details. Sudarshan?
So it's the second price hike that IGL has taken in last 1 month. In April, we saw that IGL had announced a price increase of ₹1 per kg for CNG segment. And also again on 3rd of May this month, it has announced that it has increased basically price by ₹1 per kg, not only in Delhi, but also in the other areas that are surrounding Delhi. And this price increase is important for IGL because Delhi forms more than 68% of its total volumes, and it's going to help in margin. If you remember in the con call of Q4 FY25 earnings, company had mentioned that if it's required, it would not hesitate in taking price hike to maintain margin, because there was an expectation that company might reduce its margin expectation from earlier target of ₹6 to 7 in the near term, and in the long term ₹7 to 8. So if for FY26, if you consider for the first 2 quarters, its target is to maintain the margin, that is EBITDA per SCM, in the range of 6 to 7, and for Q3 and Q4, it's expecting that to move higher and to be in the range of ₹7 to 8. And that is one of the main reasons that company has decided to take the price hike. And the most important part is it has decided to increase the price even for the Delhi, which forms nearly 70% of its total volumes. And because of the price hike taken by IGL, even you are seeing an up move in other city gas companies like Adani Total and MGL as well.
Thank you so much, Sudarshan. So after the hit that the companies took on account of the APM gas allocation decrease, a lot of companies have resorted to price hikes in order to go ahead and protect the margin, as Sudarshan just explained. Well, Winnie now joins in, and she's going to tell us about how NetWeb fared in Q4 FY25. Winnie, take it away.
So afternoon, in terms of NetWeb's Q4 FY25 numbers, a good set of numbers came in from the company in terms of revenue growth, sequentially 24% growth, year-on-year basis around a 58.7% growth. Margins also are seeing a decent bit of an improvement there. But overall, the full year guidance of the company, that has been met. So yes, not to worry on that front in terms of revenue as well as profit guidance. Order book side bit of a decline on a sequential basis, mainly because due to the higher conversion is what analysts are highlighting. Now, AI as a segment for them has done very well. It's a growth driver during FY25, and in terms of contribution that has come in for AI segment, that is around 15%. In FY24, it was 11%. So seeing a growth on that front as well. Analysts also highlight that there's a strong beat coming in terms of overall sales of the company. Margins were slight bit of a miss versus analyst expectations, but order pipeline is very healthy. And even though we have seen a good Q4, order pipeline continues to be healthy. So that will be interesting to watch out for from NetWeb. As of now, seeing a sharp spike up in today's trading session.
Well, thank you so much for that, Winnie. Indeed, a very sharp spike in NetWeb on the back of a strong set of numbers in the fourth quarter. Now, as we wrap this edition of Midcap Radar, here is some market opinion. We spoke to Harish Krishnan, CIO and Head Equity at Aditya Birla Sun Life Mutual Fund earlier today. Listen in to on his call.
150 odd companies that have reported earnings, among the top 500, we've seen about a 5 to 6% growth at their top lines and a similar kind of a quantum increase when it comes to their bottom line profits. We're not really so worried from a market level point of view of this slack in earnings that we currently are witnessing. Possibly in under 6-9 months, I would think the Diwali quarter, etc., we would be singing a very different tune. Reasonable amount of flush of that excessive valuations and fraud that was there, over the course of the last year or so, that's kind of got cleaned out. And the data point that may be of interest to the foreign allocators, because we've seen significant amount of foreign selling in those 6 months. If you were to look at India's share of the world GDP, that's currently tracking at about 3.75%. And in our assessment, over the course of the next decade or so, this 3.75% of the world GDP is anywhere likely to track between 6 to 8%. That's pure math. The fact that, on a nominal base, we're growing at a faster rate compared to the world economic activity. Even when we look at the global perspective, we do think that India is more favorably placed, even amidst the global wars. Of course, if there is going to be a complete uncertainty, a phase of uncertainty that's going to cripple decision making, then of course, we will see some kind of a pressure.
Hello, good afternoon. You've tuned into Your Stocks coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala and thank you so much as always for tuning in. Today we're surely seeing a great Monday that's turning up for the Indian markets. Nifty is managing to hold on to gains of almost 0.5% in at today's trading session. As of now, almost near the day's highest point. Not exactly there yet again, but 138 points up as of now is what we're seeing coming in for the Nifty 50. Broader end of the market is also managing to outperform the benchmark indices today. So yes, look at the Nifty mid-cap, small cap, we're seeing a good performance coming in on that front. Nifty mid-cap is also trading at the day's highest point. Small cap similarly is also at the day's highest point, up 0.8% in today's trading session. Other than that, we have all these Adani group stocks that are buzzing in trade. So Adani Power, Adani Green, Adani Enterprises managing to hold on to very, very sharp gains. And oil and gas names, we did hear Sudarshan a short while ago also was talking about IGL specifically in terms of a reason why IGL was buzzing in trade. So IGL is buzzing on the back of a specific reason coming in. Other than that, we're seeing MGL buzzing, HPCL, BPCL, all these in the oil and gas space, which are buzzing in trade. We could see on the bottom of your screens as well, Ethos. That was the one which came out with its numbers. It is managing to hold on to 1.5% gains as of now. Margins 15.3% versus 14.2%. Improvement in terms of margins. Net profit is up by 8% on a year-on-year basis. So yes, surely managing to see a spike up in the trading session. Then again, it's coming down. But as of now, holding on to gains of around 1.5%, not a bad set of numbers seems like coming in from the company, 23% in terms of revenue growth as well. So yes, that's how the market setup is looking like. We're seeing good moves coming in the mid and small cap side of the market. Specifically, a lot of earning movers in today's trading session as well. RR Kabel, Netweb Technologies are among some of these names that are buzzing in trade on the back of earnings. So surely earnings is going to be an important mover. M&M also had reported their numbers, but it's an interesting set coming in there. But let's get started with this show, because this is a show where we solve all your stock-related queries. And we do have our experts joining in with us for today. Ashish Kayal of Wave Strategy Advisors, as well as Gaurang Shah, Senior Vice President at Geopolitical Financial Services, to answer all your stock-related queries. Good afternoon, gentlemen, and happy Monday to all of you all. Not a bad Monday. I could clearly say it's a happy Monday. We have not had a bad week as well last week. So not a bad week to start. Not a bad way to start the week as well. On that note, let's get started with queries for today. No complaints coming in on the market front. So queries is all we have to solve today. Let's move on to the first query. Lakshmi Narayan Rao, who is writing to us from Bangalore, holding 25 shares of Adani Green. This is at a price of 2,435 rupees, and 25 shares of Jyoti CNC also, which is at a price of 1,450 rupees per share. So she's making a loss on both these. Gaurang, what is your view coming in on Adani Green as well as Jyoti CNC? What should the viewer be doing? Today we're seeing all these Adani stocks buzzing in trade, but I don't know if that's a trend that we're watching out for right now.
Well, trend for Adani is going to be very volatile and choppy, according to what history we have seen, Vinny. Thank you so much for having me on the show, and good afternoon to all of you all. So again, no specific comments as far as Adani Green or Jyoti CNC is concerned, because we don't have coverage. But let me just give a little bit of view in terms of Adani Green. So, after a series of ups and downs, we've seen some stability coming into Adani Group companies, though we don't have coverage on any of the Adani Group, barring, of course, some kind of stake that they have in ACC and Ambuja. Adani Green, I think this is a sector which is evolving. And it will take some time in terms of performance to start reflecting upon the numbers, and thereby, of course, translating into price movement of stocks on the higher side. It is looking one of the promising contenders in the sector. But since we don't have specific coverage, Vinny, I won't be able to give a buy, sell, and hold.
Okay, surely, thanks for your view coming in there on Adani Green. Ashish, your view coming in for Adani Green as well as Jyoti CNC. Currently, both these stocks are trading below the buy price of the viewer. So, specifically, what are the levels that they should keep an eye out on this stock? And should they continue to hold or sell? What is the view?
Yeah, afternoon to you and all the viewers. If you look at Adani Green, the stock is up by nearly 7.67% in today's session. It's managing to form a very strong bullish candle after a long time. And that's a sign of positivity. We can expect the stock to reach towards the level of around 1130 on the upside. And on the downside, the support comes to around 921. So I would suggest continue to hold on. It's forming a good bottoming pattern and breaking out today. As far as Jyoti CNC is concerned, the stock has again formed a bottom at around the levels of 895, managed to show some smart recovery on the upside. Overall trend looks to be bullish. We can expect it to go towards the level of around 1300. It's forming an inverted head and shoulder pattern, giving a breakout from there. The volumes are picking up, so the overall undertone is bullish. We can expect 1300 on the upside, and on the downside, one can maintain a stop loss of around 1110 levels.
Okay, keep an eye out on those levels over there. Let's move on to the next query for today, and this is on M&M. Shankar Das is writing to us from Hyderabad, holding 200 shares of M&M. Price is 2,647 rupees, so they're making profit on this one. Wants to know whether to continue to hold or sell. Gaurang, we did have the results that were reported by M&M today as well. Better than what the street was estimating. Healthy volumes, realization, also something that boosted the revenue. What are you watching out for now in terms of M&M, and should the viewer continue to hold M&M?
Well, Vinny, so I think in some areas the numbers were much better than what we had penciled down. And in terms of the outlook as far as business growth going into the future is concerned, the commentary was very, very strong. We've been maintaining a buy on Mahindra & Mahindra for quite a while now, for quite some time. And of course, the numbers were just out, so we'll need some time. But whatever numbers we've seen thus far, we had set a target of somewhere close to about 3,400. And I'm quite sure my team will do a deep dive in terms of breaking down the numbers and revising the target upwards. But as of now, buy, hold from a long-term point of view.
Buy, hold from a long-term point of view. That's the word coming in from Gaurang on the fundamentals for M&M. On the technicals, Ashish, M&M continues to be a good bet.
I think so, because if you look at the entire auto space, M&M has been the stock which has outperformed. If you compare it with many other stocks like Tata Motors or any other stocks, it has outperformed. It has not given positive returns, maybe if you are holding it for almost 6 months now, but I think that trend should be changing now. We are seeing some economic cycle turning, where the interest-sensitive sectors should start outperforming. Financials have already done that, and now auto should catch up. On the upside, the target that can come around is the previous peak level, which is around 3,300. On the upside, that can be the target over short term. And from medium term, we can even expect it to reach towards 3,600 levels. And on the downside, the support for the stock is 2,838. So continue to hold on over here.
Okay, continue to hold on over here. Let's move on to the next stock for today and next query for today. Dinesh Sharma is writing to us from New Delhi. He's holding 35 shares of SBI. Price is 700 rupees per share. Wants to know whether he should continue to hold or look to sell this one. Gaurang, SBI also reported its numbers, not today, but we've seen it over the weekend as well. We're seeing some bit of a reaction coming in the stock price. What is your view on SBI? Obviously, it's India's largest lender in terms of the public side. So what should one do? Continue to hold this no matter what?
Well, it was Saturday over the weekend. Vinny, you're absolutely right in terms of delivery of fourth quarter numbers. Looked quite good in terms of profitability, in terms of margins, in terms of gross net NPA coming down, provisionings coming down. And of course, in terms of loan book growth. We've had 2 rate cuts this year. We expect 2 more rate cuts of 0.25, 0.25 by the time we say goodbye to the calendar year 2025. That is, we expect by December 2025, we should have 2 rate cuts, 0.25, 0.25. And that will also give a push to the loan book growth. We expect the credit line or credit demand to grow slowly and steadily, which will enable, higher interest margins and income. So, and it's one of the largest banks, as you rightly mentioned. We have targets somewhere close to about 920 approximately from a long-term point of view.
Okay, keep an eye on those levels over there for SBI from a long-term point of view. Ashish, your view that is coming in for SBI, what should the viewer do? Currently also, it's not in terms of the price that the stock is trading at, it's about the buy price of the viewer. So should he continue to hold, sell, or maybe even can look to add some bit more?
See, I would suggest he can possibly add a bit more. The reason being, the stock has given an inverted head and shoulder pattern breakout, now retesting the neckline and getting ready to reverse. So it has been still yet to make the lifetime high that the bank Nifty has done. And there's a lot of catch-up to be done by the PSU bank. So overall outlook is positive. I think SBI can move towards the level of 840 on the upside in near term and eventually towards 900 levels. So we can continue to hold on or add more here. And on the downside, the support for the stock is going to be around 760.
Okay, keep an eye out on these levels over there for SBI. Let's move on to the next query then. Gentlemen, we have Balaji who's writing to us from Tamil Nadu. He's holding 300 shares of Inox Wind. This is at a price of 178 rupees per share. He's a long-term investor. Currently, the stock is trading at around 171. Wants to know whether to hold or sell this one. Gaurang, your view coming in for Inox Wind?
Well, I think the sector looks to be a little bit in terms of sideways move, and the stock overall is, according to me, a rather sideways performer. We don't have any specific coverage, Vinny, on Inox Wind, so I won't be able to give buy, sell, and hold. But I think there are better options to look at within the price category where the stock is trading right now. For example, if you're looking at an alternative investment idea, I think Ashok Leyland or L&T Finance looks quite good. Even as a matter of fact, if you have to look at banking, then something like Federal Bank looks very, very exciting.
Okay. Keep an eye out on Inox Wind, but Gaurang is saying some other names that you could look at as well. Federal Bank is also something that looks interesting to him. Ashish, your view coming in for Inox Wind, what are the levels for the long term that the viewer can hold on to?
See, Inox Wind made a recent low just about yesterday at around the previous trading session at around 165 levels, from where it's showing some kind of an attempt to bounce back. So I think we can expect it to go towards the level of 190 on the upside. That can be the target for Inox Wind. And on the downside, maintain a stop loss of 165. So it can be a near-term, short-term play for 190 as the target.
Short-term play, 190 is the target. That's a view coming in from Ashish. But on that note, viewers, we're going to slip into a very short break. And here's some good news coming in for our viewers. India's business news leader is now a click away, introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth news articles, as well as financial world updates at your fingertips. Download the CNBC-TV18 app now from the Apple Store or the Google Play Store, or you can just scan the QR code on your screen. Welcome back to Your Stocks on CNBC-TV18. We still have with us our experts for today, Ashish Kyal as well as Gaurang Shah. Let's keep it going with the queries then, gentlemen. This one is coming in from Khushbu Gupta, who's writing to us from Rajasthan. She's holding 20 shares of Tata Motors. Is at a price of 600 rupees per share. Wants to know whether to hold or sell this one. Gaurang, your view coming in for Tata Motors. What should the viewer be doing? We did have a view on M&M, but now Tata Motors and M&M, if we're comparing them also, what should they be doing?
Well, so very prudent disclosure. First of all, we've been maintaining a positive view on Tata Motors for a long time on the positive side. We continue to have that even now as I speak to you. I think a lot has happened from 1100 plus to almost about 600, and then a recovery process building up. Our sense is that large part of the negativity is already there in the price now. Don't see much of a downside. The good part about this investment is the level of investment at 600. The unfortunate part is the number of shares is just 20. But nevertheless, I think, like I said, you should make a beginning. Having done the beginning, in case if again we get some kind of a correction in the market because of the uncertainty, maybe closer to 625, or again, if it comes closer to 600, don't be content by just having 20 shares. You can add to it closer to 600 or 625 and hold on to it from a long-term point of view.
Okay, that's the view coming in from Gaurang on Tata Motors. Can look to add some more also at the levels that he mentioned. Let's move on to Ashish, actually your view on the technicals for Tata Motors.
Just as a disclosure, we do have a holding in Tata Motors on the long side, and I think the stock has underperformed for quite some time. But as I said, the overall auto sector is cyclical, and we are possibly entering into the positive phase of it. And I'm expecting Tata Motors to outperform. Maybe it can go towards the level of around 725, 726 over short term. And on the downside, the support for the stock is going to be around 630. So add more is what I would also concur with the view of Gaurangji, and the overall trend is bullish for the entire auto space and Tata Motors.
Absolutely, trend is bullish, and also do not forget today we did have some news flow also coming in where it was said that JLR has restarted shipments of vehicles to the United States. The first shipment of JLR vehicles for US was done on Wednesday, so that's something that we'll keep an eye out on. Obviously, those were issues that were coming in for Tata Motors in terms of the tariff side as well, and concerns were there previously when we'd spoken as well. But let's move on to the next query. AB Capital, that's the query coming in on. Deep Shah is writing to us from Mumbai. Holding 6,000 shares of AP Capital, price is 181 rupees per share, holding it since 2017. Now wants to know he can further continue to hold this one for a long term. He's saying 15 years. Gaurang, your view coming in on AB Capital?
When you honestly, with that kind of view, you need to literally, revisit your investment time and again. Because you often say on the fundamental side you have long term. But unfortunately, we don't have coverage on AB Capital. So I'm not in a position to give any comments. I'm sorry about that.
Okay. But your view coming in on the technicals then, Ashish?
I would say on AB Capital, since he's holding for, I think, almost a decade or more, the stock has not given, the opportunity loss has been enormous. If we would have been holding on to any other stock that has given a lot of positive return. Having said that, over short term, I think if he can get move towards the level of 220, get out of this stock, better invest in other names or the auto stocks or the private banking that are outperforming at 220 level. So that's an exit at that level. He's making money right now also. So continue to hold on. It's forming a triangle pattern, and the support on the downside is around 193. So hold on with 193 for 220 target, and then diversify into different stocks.
Okay, let's move on to the next query. We have Rupesh who's writing to us from Pune, holding 10 stocks of Paytm. Average price is 800 rupees per share. Wants to know whether to hold or look to sell this one. Paytm is one of those candidates reporting their numbers this week also, so that'll be interesting to watch out for. But Gaurang, your view on Paytm?
I think this stock, honestly, Vinny, has seen the best time, then bad time, and then now a recovery time as I see it. So we've been maintaining a positive view. I think it's one of the best enablers of difficult times of post-COVID. There are news flows which had caused concern, but I think all that is now in the past. We have a positive view from a long-term point of view on Paytm, so hold on to it from a long-term point.
hold on to it from a long-term point of view. On the technicals, Ashish, what's your view coming in? Because Gaurang started by explaining it well, saying it at the best time, then the bad time, and now the recovery time is coming in. So what are the levels that we're watching out for now?
Yes, absolutely, because the stock went all the way up. We can see all the way declined towards 300, recovered back again to about 1,000. Again, the decline to 700. So a lot of volatility in that stock. But the overall view is positive. I think the stock can again achieve that 1,000 mark on the upside, which is the resistance level. It has formed higher high, higher lows. So the trend is positive. And we can expect it to move towards 1,000 and on the downside, maintain a stop loss of around 808 levels.
Okay, keep an eye out on those levels over there. 808 is the stop loss as well. Upside, we could see 1,000 is what Ashish is saying. Both our experts are positive on Paytm in terms of the long-term story and recovery that's coming in there. Let's move on. Next query. Jayashree Swaminathan is writing to us from Chennai. She's holding 100 shares of MOIL. This is at a price of 338 rupees per share, making some bit of a loss on this one, currently at 332. Wants to know whether she should continue to hold or look to sell this one. Gaura?
Well, this is a challenging one, honestly, Vinny, given the performance of the sector. But, when you are looking at investing in a sector like this, we always maintain that you need to have at least 1.5 to 2 year plus kind of time horizon. We've been maintaining a positive view, but it will be a long wait with a lot of patience.
Okay, long wait with a lot of patience. And Ashish, just a quick word because we're going short on time now. MOIL, what is your view? Hold or sell? And level?
I think it should be a sell. It's underperforming sharply. It's a sell from my side.
Okay, sell from your side as well. Okay, thank you so much, Ashish as well as Gaurang today for joining in with us on the show, helping our viewers solve their stock-related queries. It's always a pleasure having you both on the show. But that's all the time we have on this edition of Your Stocks on CNBC TV18. Thank you so much for tuning in. And up next, your closing bell.
beyond market headlines. To understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Cut that has come in today's trading session. 1.31% downtick is what we're seeing for the Taiwan index.
At some point, I'm going to lower them because otherwise you could never do business with them.
We should find support at the 30th of April low, which is 24,198.
Sectors you look at paints, you look at these OMCs as well. I'll keep an eye out on a few of these names in today's trading session.
Craig would be the chief executive or officer of Berkshire.
Up a third of 1%. So 24,400 plus on the Nifty.
Big shift has happened on the monetary side, where there is definitely an urging of the credit institutions to get back to growth.
IT, metals, Reliance Industries, all these indices are up nearly 1% on an average.
You can see the EBITDA at 4683 crores compared to the CNBC TV18 poll of 1458.
TechM, good deal wins, strong pipeline, bringing in more customers from a consumer and a BFSI standpoint.
24,450, that is where the Nifty is at, and contributing to the gains is Nifty Auto.
That was the day so far. Hello and welcome to Closing Bell. We're coming to you live from the CNBC TV18 Motilal Oswal studio. I'm Reema Tendulkar. With me is Surbhi and Nigel. And all in all, it's a good day. We're holding up in the green, gains of close to about 0.5%. Yeah. Some loss of momentum from the top of the trading session. The Nifty even crossed the 24,500 mark, but given the fall in banks, ONGC, etc., it's not bad. And midcaps, look at the way they're going.
Which is why I was going to say good seems to be an understatement when you're looking at the broader markets. A near 2% rally on the midcap index, looking good. We have lots of earnings analysis coming up, including a conversation with Mahindra & Mahindra. Another superlative quarter from M&M. You just can't find any fault.
Well, indeed, and if you're looking at the index, we have been spending time in this range itself. And the sense you get is if things are not going to blow up on the border, the longer we take at these levels, we continue to hold onto the range and protect the lower levels, maybe the bounce will be even more ferocious. So let's see how that goes. But for today's trading session, without the big batsman, that is, the Nifty Bank, yet the Nifty is holding strong and the breadth of the market as well, firmly in favor of the number of stocks that are advancing. In just a short while from now, we'll have the management of Mahindra & Mahindra joining us. For the time being, let's hop across to Mitesh, who joins us to help us out with the trading call. Well, Mitesh, we're talking about the session not being so bad. From a macro perspective, we have got this tailwind because we have Brent crude prices that have cooled off, and that's where select sectors are firing. But on the index, where do you see us heading? And fill us in with a couple of trading picks.
Good afternoon. I think it's the Bank Nifty which is showing slight lack of momentum. Otherwise, the Nifty is doing pretty well. And the key here is to see if we can, recover in the last, add on to the strength in the Nifty in the last 1 hour and close about 24,500. But the structure remains positive. So in case you get a dip before that, I think, that will be a buying opportunity. On the stock side, I have a RBL Bank, which is a buy. Keep the stop just below levels of around 201 here and look for targets of 218. And Varun Beverages, that's another stock which, after a good pullback is trying to recover and is changing the direction. So buy here with the stop just around levels of 528 and look for target of 560.
Okay, those were some trading ideas. The Nifty is now at 24,462. The high today was 24,526. So we've slipped about 60 points from the day's high. And we're still not able to conquer Friday's intraday high, 24,589. So that is an important level to track. But after consolidating over the last 3 trading sessions, that's 3 days of last week, today at least markets have managed to grow. But let's get our conversation straight away going to Mahindra & Mahindra. Stock is up close to about 3%. All-round performance very strong. Both auto and tractors firing for the company, gaining market share, improving their margins too. Rajesh Jejurikar, ED and CEO of Auto and the Farm sector at M&M, is now with us on the show. Rajesh, great to see you in person. Yeah. Thank you very much for joining us.
Thanks, pleasure to be here in the studio.
And let's start by congratulating you on another good quarter. And Rajesh, we were just discussing this outside the studios, right? kudos. And I don't know, from the outside, I sense the pressure because you folks are delivering quarter on quarter on expectations that are rising more and more. But pretty phenomenal. Maybe let's start with the margin picture, because not only have volumes gone up, and that we see on a monthly basis when the numbers come, but you've managed a good show on the margins as well. So
yeah, I think we're particularly, Surabhi, firstly, thanks for having me on the show. And it's, of course, much easier when the quarter's been good. so we are happy to talk
do
about
come in case you have a one or bad one, do continue to come.
Then we definitely have to come.
Go ahead.
So what's particularly gratifying, I think, are the tractor margins. Because normally quarter four, market share is stressed for us, but we gained very strongly on tractor market share. And it's been one of our best quarter four tractor. So what we call core tractors without farm machines and other things was as high as 20.8% PBIT margin on core tractors, which for a quarter four volume was really good. So I think that was a really strong number to put out. The auto margins have been also very strong, and it's the best peer margin by far. In quarter four. So, we I think have had a good margin performance on both the tractors and auto.
The question is, can you build on that from here on? Because commodity inflation seems to be benign. Is that your own assumption going into FY26? And plus then you have operating leverage coming in. On the tractor side, your exports are firing. And then even autos, you've got so many new launches. So what's the expectation on margins from here on?
Yeah, so remember, we don't put out a margin expectation.
No.
We have put out a volume expectation for SUVs just now. So on SUVs, we are saying mid to high teens for SUVs, including electric. And for tractor industry, we are saying high single digit. And for LCV less than 3.5 ton, we are saying high single digit. So in a way, the volume momentum should be good. So commodities, to your point on commodities, is very hard to say. I mean, it's a very volatile world, but right now our sense is it will be reasonably benign. We're not, unless something geopolitically goes totally awry.
So directionally, can margins go up to your mind, at least for the first 2 quarters?
Yeah, the way I would answer that question, and Surabhi was talking about rising expectations.
see what I mean?
Yeah. So the point is focus on the right metrics. As long as you're focusing on the right metrics, outcomes come. If we start focusing on how to take margin up, normally the answer to that question is going to reduce volumes. Just to finish that, Surabhi, I think our focus is how do we keep volume momentum going up while keeping costs under control. And if you do that, then margin does tend to improve in most situations. But if you put the horse before the cart and say, how are we going to increase margins, then you start taking a set of decisions by which you start affecting demand. And then when you start affecting demand, anyway, you don't gain margin because, it's such a volume-driven industry.
But is this sustainable? I mean, we're talking 9.2% for auto and 19.4% for tractor. Are these margin levels with your current volume mix, is it sustainable?
Again, without giving guidance, let me give an input on how to think about it. So, we will next year start seeing a much higher EV proportion in the mix. And we've said EV margins as a percentage will be lower even when EVs will make the same unit margin as ICE. Right? Just because of the denominator effect. So, whenever we look at a blended margin, we are going to see the margins lower than what they've been in the past. But on a like-to-like basis, we would want to, without losing volume momentum, look at how do we sustain margins. But that's going to be not a guidance, but an effort by way of how management would like to make it work. The standalone margins also now have the contract manufacturing we do for electric vehicles within M&M.
Okay.
And that does dilute margin because that just has a conversion cost on the total value. So M&M Auto Division makes electric vehicles and sells it to Mahindra Electric Company. Okay. And that's only on a additive conversion cost. So the percentage margin there is much lower. So that we will show that separately in the analyst call separately in the afternoon.
Okay. Okay. All right. Hi, Rajesh. Welcome to the studio. Congratulations on a good showing. And congratulations on the new wheels. I saw you driving that nice, sleek new car the other day. So good on you. Let's talk about business, though, and market share. What's the updated market share on SUVs, EVs, and tractors? what did you end FY25 with? And since you're sounding so optimistic, I'm guessing that you'll want to, perk up those numbers. Where do you see that headed?
So let's look at the three segments. Let's start with tractors.
Yeah.
Tractors this has been our highest ever tractor market share at, I think, 43.3% for the year. We've gained market share 2 or 3 years in a row, which is uncommon in a market which is not easy to gain any market share. And, we always say that the strength that we have in tractors is entry barriers are low and it's actually very sticky, which means it's not easy to gain market share. So having gained tractor market share 2 years in a row and we are at a level of 43.3. So that's very, very reassuring and feels very good. The auto, we look at revenue market share for SUVs. The reason we do that is our average selling price is significantly higher than any of our competitors. For that, I think we crossed 22% revenue market share, and again, we've gained 1.8 share points in the year on the SUV side. Even though we don't measure volume market share in SUVs, we have been the number 2 volume player consistently for many quarters. Again, that's not a metric that we want to chase because we don't want to start doing things which is not part of our brand DNA. And we are very clear that there are some segments we will not play in where we don't have a right to win. So really, every time we put out a set of wheels, we want Nigel to say, wow. And if many more like you say, wow, then, that's going to lead to market share gain. But we don't want to be seen as one more car on the road, which nobody knows what's the brand on it. So when they see our car, they should feel good. So that's on the SUV market share. I think the really strong story is the LCV less than 3.5 tons, where we've again gained a lot of market share this year. We are more than 50% market share now. South, which was an area we were not so strong in, again, we've gained a lot through that. We've launched Vero, which is a new product 6 months back. That's helping us gain market share in that segment too. What we're doing with our core product, Max City. So really, I think across the 3 segments we play in, all have seen very good market share gain. The last mile mobility, which is the electric 3-wheelers, we continue to be number 1 through last, which is we're at about 40%, 39-40% market share there.
Rajesh, just coming back to the guidance for the coming year. On tractors, I think it's high single-digit growth for
the industry. Yeah.
For the industry, okay. Because you last year grew at 12%. So you're confident about outpacing the industry. Your growth for tractors and auto in FY26, since the focus is on volumes, will it be better than FY25 to your mind?
Surabhi cautioned me before coming in. Don't let people raise your expectations when you walk into the studio.
Expectations are already elevated.
You've given us the
industry. The questions, which encapsulate those elevated expectations.
How should we look at your volumes versus last year for tractors and auto?
I think from where we are on tractors, the first objective has to be to sustain this level of market share. It is a very good market share. Also, we wouldn't want to start discounting to increase market share. I mean, that's the one thing that we've been very focused on, that tractor market share has to be product and reach-led growth and not pricing-led growth. We can gain market share very rapidly if we start diluting margins. I think what we've been able to do well is get the balance between market share gain and margins. And we would want to keep that balance. So we don't want to again, set ourselves to say, yeah, we're going to gain tractor market share and then start getting into price discounting. That's not how we want to do it.
I have one last question. Nigel, you have one before that?
Yeah, I want to just ask about the stress. We're seeing some bit of stress in the urban demand, right? While rural looks pretty good. Give us some more details on that, because that's a little bit worrying from an industry perspective, obviously not for y'all.
Yeah.
We continue to say, wow, but what about this stress that we're seeing in urban demand? If you could throw some color.
Yeah, so I think there has been some stress in urban demand. We haven't seen it in our portfolio, and we've been able to get good growth, including in April, where our SUV portfolio grew 28%. I think several things will help improve that over the next 3 to 6 months. One is the change in the income tax slabs, which starts in April. So there will be greater cash that will get released.
Yes.
The interest rates are going to be on a downward trend. So I think that will again improve cash flow, improve borrowing costs for car loans, etc. So that will enable urban demand, because both of these points are more significant in the urban context than they're in the rural context. So both of these will be positive enablers. It's good to see the stock market stable, and that does drive urban demand. You know, there is a sentiment issue in buying cars, and when the perception of wealth being eroded, personal wealth being eroded, starts coming in, then the car buying tends to get discretionary, and then people start postponing it. So it's good to see the stock market kind of come back to a healthy level. So I think all of these will help urban demand.
All right, just one thing, just one factor. Even though demand is a little bit sticky, you know, being a media professional, you get a lot of you know, queries or favors saying, is it possible to get a Mahindra vehicle sooner? So tell us, what is the current waiting period on your vehicles? Because I recall it was a few months actually the last time.
For the EVs, I just asked him. He's saying 4 months for the EVs, right? 4 months?
Yeah.
And
around that.
I mean, and how do you expect that to kind of shape up?
So first, let me answer Nigel's question and then connect it to yours. So the product on which we right now have most waiting period is ROX.
Okay.
And that is a few months. We are increasing the capacity somewhat, but overall Thar demand, including the 3-door, has been really robust. We've ramped up Thar. Now Thar as a portfolio in April actually crossed 10,000 for the first time. So 3-door and 5-door together, we sold more than 10,000. Now that's quite a journey for a product like Thar, which is to 5 years back sell 600 a month. So it's, you know, moved to selling more than 10,000 a month, which is really what we've ramped up to. On the question of EVs, we're going to follow a very calibrated approach to ramping up for 2-3 reasons. One, we always knew that on the production side, a lot of new technologies, software, new features, and we have to ramp it up slowly as we stabilize the quality. But what we're also learning is from a customer experience at time of delivery. A delivery event in an electric vehicle takes at least 2 hours. In ICE, it was literally a puja, key handover, and you drive off. But here, customers come in with entire families, so many questions, a lot of explanation to be done. Then we need a follow-up visit to the customer again to, you know, walk them through all the features and how they're to be used, setting up the charging. So, you know, we don't want to be messing up on the customer experience in our desire to get lots of vehicles out in a hurry.
Fair point. You know, I dare say, I don't know, maybe a couple of years down the line, when histories are written, M&M, Mahindra and Mahindra, through this phase, I think the last 2 years, perhaps ends up becoming a case study in business schools. I mean, how to do everything right, whether it's product positioning, maybe it's branding, maybe it's the customer experience you're talking about. How do you get into that sweet spot?
And you know, there's a topic we didn't touch upon, but last year they generated 10,000 crore of cash. Isn't that correct?
Yeah, that's correct.
Yeah.
Yeah, I mean, if you could just quickly tie it in, quick update on SML as well and when that sort of integration happens. And I have to ask you this, because during the quarter, when, you know, this whole global environment is playing out and the market gets the worries, now whether it's Tesla, whether it's some other US policy that makes it easier for Ford to come back in a big way in the country, any of these American automakers, could that disrupt the M&M story in any sense, even if it's a small sense?
You know, if you look back at the Indian story over the last 20 years or more, I think the Indian customers are probably the most sensible and the hardest to fool. They will not buy anything that does not make sense. And when I say that, the price has to be right, it has to have everything, it has to work well on Indian roads, it has to last long, it should give a good resale price at the end. So there's every parameter which goes in, including demand, brand, and all of, I mean, the aspirational value and all of that, but that has to be well calibrated. So any player who wants to just bring in a product which is doing well anywhere else in the world and then, you know, kind of say, yeah, it's going to naturally do well here because it's done somewhere else, I don't think we've seen a story like that play out in India at all. Not in tractors, not in commercial vehicles, and not in cars.
Okay, all right, Rajesh, we thank you for coming down. I'll tell you what, I'm the one who appreciates the vehicles, but I think if you look at prospective buyers, the other two are most. Thanks a lot for coming down.
They're the more aspirational customers for us, let me tell you that.
Admiring from a distance. Well, thank you so much. A pleasure having you in the studio.
Thank you so much.
Bye.
Okay, all right. Well, let's get on with the chat then. We have Deepan Mehta who joins us. Director Alexa Equity is on the show. Hi, Deepan. You heard that chat. Rajesh is sounding very, very optimistic and confident about the way ahead. Give and take a little bit of near-term blips. What's your view on the stock? I think that's the stock that you've liked, right?
Yeah, Najib, good afternoon and thank you for having me on your show. But the key question we didn't get the answer for is that how do we get an M&M vehicle out of the queue? You should have pressed on further over there because really the waiting period for the top models is quite incredible. And that clearly shows the hard work which they've done on new models. They've captured the imagination of a lot of customers as well. And that's reflected in the numbers of M&M. So generally very positive on the stock. As a disclosure, we and our clients are invested in it. And I think that maybe at corrections, you could look at getting into this particular company. And overall, I do expect auto industry to start doing well, considering that crude oil prices have fallen and interest rate costs also have come down.
Stocks crossed 3,000 as we're speaking, and now it's just about 7 or I think 8% away from its 52-week high. The high was around 3,200, a little over 3,200 for M&M, back to 3,000.
You know, I remember when there was that fear that Tesla is coming in there. Yeah. I remember Jefferies had put out this note. They said that the stock fall is exaggerated on the downside. The segments that they cater to, the pricing is very, very different. And they believed it was a good time to buy. I think if I remember correctly, the stock went down.
2,500?
Yeah, it went to around 2,500. So from there, you know,
what a journey. What a quick bounce back, snap back for Mahindra & Mahindra, sub 2,500. Was that a month back?
I think a little more than that.
January. I think it was just around when Trump inauguration was happening, and there was a fear about, you know, now Tesla is rolling in. But in hindsight, for those who bought it, you know, it was a dip to buy, perhaps.
And stock is now up more than 35% in the last 1 year. Dipan, what about Kabel? Again, here the stock had fallen on concerns that, you know, large players are coming in, setting up capacity. So there is going to be a lot of disruption, pricing pressure. But now Kabel itself is getting aggressive. They've announced a capacity expansion plan. The street likes it. And plus the numbers are good. Now, this is a stock which is also about 37% away from its recent highs. Is this a stock to buy?
Well, Rima, I think markets are rewarding good set of numbers, and really Kabel's numbers are very impressive. The kind of growth rates which they have got, I think they will be industry beating. And from that point of view, I think stock has rallied. But, you know, valuation-wise, it is pretty expensive. I would say fairly valued. If you consider that there's new players coming into the market, and that's going to cause a squeeze on existing players. From that point of view, I think there's a layer of uncertainty as well. And what has happened is something which is in the past, the quarter which has gone by, and the competition is going to come going ahead also. So I don't feel, you know, that enthused to buy into Kabel, or that for that matter, any cable company at this point of time. I think that it's better to go for the appliance companies. That's where I think a lot of action will take place, considering that we have such a warm summer. And overall, I think consumption also will improve post these income tax relief coming into place and lower interest rates as well. So that's, I think, my strategy as far as consumer-oriented stocks are concerned.
Deepan, you wanted to know how to jump the queue? Deepan, you wanted to know how to jump the M&M queue, right?
Yes, that's the question.
Let's just a minute, hold on. Let's get in Mitesh back onto the show. Mitesh, I believe you've got lucky. You've already booked your new Mahindra & Mahindra vehicle. Well done on that. Deepan, if you're interested, Mitesh is the man to go to, because I believe he's driving the new Mahindra & Mahindra vehicle. So congrats, Mitesh, on that. And I'm sure Deepan's going to give you a buzz post-market hours, or maybe sometime in the next few minutes or so. But tell us, what's the view on the stock, Mitesh? We were just talking about the way the stock bounced, and I just managed to pull out the old Jefferies note. They had written sometime during February 23rd, where they believed that dip on Mahindra & Mahindra was a good buying opportunity. How's it looking on the charts?
It's looking quite positive, Nigel. I think that correction which happened on the stock happened along with the market decline, and now I think that correction is over. My sense is that the first target should be closer to about 3,200, which is where the stock had peaked out. You know, in fact, if you look at the last a year of kind of history, we have got about 5 or 6 highs, tops being made around the 3,200 mark. So that's the first target I'm looking at. Once we start getting past that, then I think we're getting into new correction, and then we should even look at 3,500% of that.
Okay, and congrats on the vehicle, Mitesh. We're not asking for sweets, but, you know, congrats on that one.
Yeah.
Okay, all right. Well, let's get back to Deepan. Deepan, I want to ask you about, JSW Steel. That one's pulled back a little bit. There was an asset that they acquired, Bhushan Power and Steel. They managed to turn it around, but now the courts have struck that down. Could possibly go in for liquidation. What's your call on the stock?
Yeah, I would view it as a setback, of course, for JSW. And now with so much of uncertainty around steel prices and steel volumes as well, and the entire Trump tariffs is causing a lot of uncertainty as far as commodity prices and commodity volumes are concerned. And keeping in mind the valuation of JSW Steel, that is trading at very rich valuations as compared to its historical averages in the past and compared to some of the other steel companies. And the volume growth also has been quite tepid for the entire steel industry. So no doubt, I think it's a very well-managed steel company, great linkages, backward linkages into raw materials, and very aggressive expansion plans as well. But on a risk-reward basis, I would give steel a pass. In any case, Nigel, you know that we're not that hot on commodity stocks per se, perhaps with the exception of cement. So I would not like to go overweight on JSW Cement.
Dipan, okay, got that. Dipan, just before we let you go, this rally that's playing out on the entire Adani group, let's just get the stocks up. Adani Green, Ports, Power, everything's up. Total Gas, 11%. This, I think, started with that Bloomberg report that came in the morning suggesting that the group has some meetings lined up, perhaps with the Trump administration, to work out some of the legal issues that they are embroiled in. I don't know if it's just a flash in the pan, if it's just sentiment, but what would your advice be on any of these group stocks?
So, I think that the Adani Group companies are trading more based on their fundamentals, and all the controversies are more or less been put to rest. By and large, I think the numbers are decent. And what I've noticed is that over a period of time, these stocks have remained flat if you take a long-term average, and earnings have improved. So the P multiples, which were excessively high, now have come somewhat into a manageable, or I would say reasonable level, although not exactly cheap. And I think a few more quarters and numbers will grow and stock price remains where it is. These stocks also will come into a reasonable value zone. So I think investors can wait for a situation where the P multiples make sense for these companies and then look at these companies on merit and on fundamental basis. There's no doubt that all of the Adani Group companies are sitting on very, very, I would say, great assets, good ROIs, and some of the concerns around debt also have come down. So I would put them on the watch list and wait for an opportune time when you feel comfortable with the valuations.
Dipan, thank you very much for joining in. Need to get into a short break. As we do that, here is some good news for all our viewers. India's business news leader is now just a click away, introducing CNBC TV18's all-new app. Get instant access to breaking news, our articles, financial world updates at your fingertips. So don't wait. Download the CNBC TV18 app now from the Apple Store or the Google Play Store, or you could just scan that QR code on your screen. Welcome back. The Nifty slowly trying to inch back towards that 24,500 mark. The gainers list include the Adani Group stocks, Adani Enterprises, Adani Ports right on top. Look at that 7% up move on it. Adani Ports has crossed the 200-day moving average comfortably and now inching towards that 1350 mark. M&M, of course, is higher, 3.2%. TVS Motors, Tata Motors also up nearly 2%. Trent is a big mover. And then you've got oil marketing companies on the back of the plunge seen in crude oil prices as OPEC plus says that they will be accelerating production. So IOC, BPCL up. On the way down, you've got ONGC sulking in trade. Rahul Veera, fund manager, equity investments at Nippon India, AIF, is now with us on the show. Rahul, thank you very much for joining in. So how are you going about navigating this market? April, we saw markets snap back, though towards the end, we've started consolidating a tad bit. You all had a cash position of about 14%. Have you started deploying it? And if yes, where?
Yeah, hi, good afternoon to everyone. Yes, so we have started deploying the cash. We remain positive on the markets going forward. So almost last 1 week, we saw $570 million of FII flows coming in. So very clearly the indicators from the macro front, right, all the peak pessimism that was playing out gave us a good opportunity to deploy in the past 1 to 2 weeks for sure.
Now, what is the cash on the books?
Will be less than single digit.
Single digit now?
Yes.
Versus about 14% towards the end of...
We deployed almost 7% itself in the past 1 or 2 weeks.
Oh, okay.
Yeah.
And do you want to tell us where you deployed? What are the, we can see that you like M&M, HDFC Bank, Reliance Industries. These are all stocks that you are overweight on. But broadly tell us, incremental money, that 7%, where is it gone?
Yeah, so the names that you took, but incremental will be looking forward to add some mid-cap and small-cap names in the multiple sectors as well.
All right,
so
Rahul, hi.
The sector that we like, yeah.
Okay, which is the sector you like? Sorry, missed that?
Cement is the sector that we like. We are incrementally positive on the cement sector.
Indeed. Okay, Rahul, good to speak to you and thanks a lot for joining in yet again. Let me quiz you on both those 2 points. Last number that we have is your cash was at around 14%, which you're telling us has come down now to single digits. And your large caps accounted for around 59%. Now, given that the incremental money you'll start deploying in mid as well as small caps, what is the mix you're looking at between large caps, mid and small caps? If you could help us out with that. And the second point on cement, since you like cement, what are you going for? The big boys who are ruling the roost or the smaller names that will have to come to the table and probably sell out?
So we are trying for a mix of both. We are going with the large cap names. So higher allocation will go towards the large cap name. And some of the mid cap, small cap names where there is a potential acquisition target remains there.
Okay, all right. So that's about cement, mix of names. You want to give us a hint? Between the large cap names we know, but in these potential targets, which segment are you looking at? I mean, is it the south-based guys? Is it some guys in the north-based?
So one of the south-based guys are having a very large debt. They're going for probably group-level restructuring. There could be some decent alpha generation. Also, if you see that for the past 2 months, the maximum price rise in the cement prices has happened in the south region. We believe this will help in your deleveraging exercise as well. Plus, the debt to EBITDA ratio that we are expecting over the next 2 to 3 years will come down very significantly. Will help one of these south region players for sure.
And overall, in terms of your, in terms of your allocation, what are you looking at? Large, mid, and small cap?
So broadly, from 59% of large cap will come down to 53 to 54. So incremental allocation is going to go towards mid cap and small cap.
In the last 1 month, you're also brought down your holding in IT names. I think TCS, Infosys were stocks where you've lowered your holding or weightage. We know the reasons, but how are you thinking about IT now at this juncture?
See, they remain a value buy, but at 4 to 6% growth for the large cap names, right? Giving a 20-25 times multiple. They largely are like dividend yield stocks going forward now, 4 to 5% of yields that are coming through in these names. But incrementally being an alternate asset investment manager, we look for alpha names, pure bottom-up stories. These are more of allocation names going forward. So we believe that they will not be very high alpha generation in these names as of now.
Okay, got that sense. Rahul, hi, good to have you on the show. On financials, because it's a very, very wide and diverse basket and stock reactions are also so different, right? Wherever there are growth concerns today, Kotak, or SBI, stocks are falling. Wherever NBFCs were showing any sort of issues with margins, again, there was pressure. What are you liking and what are you avoiding here?
Yeah. So see, from a broader allocation perspective, we prefer NBFCs over banks, right? As I discussed last time, that the credit growth in the system, although the overall sell side is managing close to 14 to 15% of credit growth, we are working with 11 to 12% on the broader PSU as well as the private bank baskets. So when you see those numbers, the kind of valuation we are seeing is slightly on the higher zone going forward. So we prefer the NBFCs over banks. And within NBFCs, again, home financiers is where the compounding will happen, and some of the MFI names where some of the alpha generation will happen from a bottom fishing perspective.
Okay, Rahul, how are you approaching pharma? I can see Mankind Pharma as part of the pack. I don't think it has much global exposure as of now. It will be reasonably protected from Trump's tariffs. So that's the way you're going?
Yeah, so that is one way to look at it. CDMO plus domestic pharma is the overall allocation that we are looking forward to. From the larger branded generics on the global side, we are avoiding the bigger names as of now.
Since Mahindra & Mahindra is an overweight for you, you would be tracking it very closely. For fresh investments at this juncture, at this point after the kind of outperformance and the expectations that are set in, will it be able to beat and generate alpha?
Yes, we are positive on the name. Going forward, see, it has a little bit of rural exposure as well via the tractor exercise, right? Almost 40% of the EBITDA comes from the other rural exposure that they have. We believe the kind of EV plus UV plus the tractor exposure, I think it's a very good combination to have in the portfolio.
So even at these levels, risk reward is fairly favorable.
Yes, absolutely.
All right, Rahul, what about Swiggy and Zomato? I'm guessing you will be using the apps. But what about allocating money? Do you like any of them? As we speak, Swiggy is actually up close to around 10%. They had put out a filing regarding Bolt, which is their quick food delivery platform. They are saying that is doing very, very well on a day that Zomato went ahead and said that they are looking at shutting that down. So it seems the street has, grabbed onto that piece of news. We need to see how the quick commerce delivery itself does pan out. But at least in this vertical, the quick food delivery platform, they are talking it up. Any exposure to these platform companies? Do you believe that Swiggy should be catching up with Zomato, or do you think it's going to get far too competitive? You'll stay away.
Yeah, in the seed over the next 6 to 12 months, we'll see the outcomes, right? Where Zepto in the quick commerce is playing out their best. The recent update that we got from the management of Zepto that they had to raise funds at the personal individual level, right? At a 16% credit that they've seen. So we see that competitive intensity may like for 1 or 2 quarters more, but going forward in the industry, we believe it's going to be medium-term positive. So from allocation perspective, we are looking at these names, but at least for 6 to 12 months, we'll have to take we'll be in the watch list, and probably then we may relook at the names again at that point of time.
eClerx? I mean, eClerx is a stock that you track, right? And I think you own it in one of the portfolios. Now it's underperformed, 28% down so far on a year-to-date basis. If I look at it from its 52-week high, the stock is down 35%. What makes you bullish? Is it the fact that its stock is corrected and therefore it's now attractive? And it's also an industry which generative AI can disrupt.
Right. So see, if the diversification that the management is focusing, right, away from the proper BPO services to moving towards KPO services, they are diversifying from that. So even they are well aware of the AI disruption can get, but the management, we are very confident that they will be able to diversify going forward. Now, in terms of valuations also, some of these names in this pack, in the KPO, BPO pack, are relatively better off than the IT pack that we saw in the large cap names. So we're seeing some growth here, and the multiples are also relatively better in some of these names.
Okay, all right. Final question before we let you go, Rahul. Wanted to ask you on this renewable energy theme. Solar, people were talking it out. Suddenly you had Vari Energies that came out with a brilliant set of numbers. The stock saw a sharp spike up, then everyone said the lock-in is ending. So now the stock will come under pressure. As we speak, the stock is up close to around 5.5–6%. They have guided for very good numbers in the remainder of this fiscal. So it seems for the time being, the sun really hasn't set on the sector.
Right. So see, for solar energy, right, almost the guidance from the government is close to 50 gigawatt per year for the renewables, but the execution has been close to 22 to 24 gigawatts per year basis. So incrementally going forward, we believe the growth will be there in the industry, but what are the valuations that we're paying for, right? So we have been on the sidelines for this sector. We believe post FY27, FY28, without any government incremental regulations which are supporting the industry, we believe the ROE ROCs may not sustain. So we have a little bit of concerns around this sector. We've been on the sidelines for the names.
Thank you very much for joining us, Rahul. Great chatting with you. Need to get into a break. On the other side, we'll come back and talk market technicals. We'll get in a few BTST calls from our technical experts.
Welcome back. You're watching Closing Bell and we are coming to you live from the CNBC-TV18 Motilal Oswal newsroom. Well, the markets have come off a little bit from the top. Mitesh is back with us. Mitesh, give us your trading picks.
I have a BTST on CESC. Keep a stop below 163. Look for targets of 169 for tomorrow. And the other one is RT Industries. Keep a stop just below levels of 445. Look for targets of 458.
Okay, all right. Thanks a lot for that, Mitesh. Well, let's focus on a couple of other stocks. Then we have the Nifty banks. That continues to trade in the red on the back of the quarter 4 earnings coming in from key lenders, SBI as well as Kotak Mahindra Bank. But how did the overall quarter 4 numbers look like for all large lenders? Abhishek is putting out an exciting piece on that. Abhishek, tell us more.
Well, to begin with, large lenders have reported their Q4 FY25 performance. And if you take a look, at the comparison table, private banks have seen robust deposit growth on a sequential basis, anywhere between 5.5% to about 7% range. In fact, at a time, this has come in, at a time when deposit growth is a big concern in the industry. Seasonal in nature in Q4 for deposit growth to happen for HDFC Bank and Axis Bank. Now, SBI has seen the weakest weakest deposit growth on a sequential basis at just 2.9% in Q4 FY25 amongst large banks. If you take a loan growth, and if you take a look at the loan mix, the corporate portfolio has actually been shunted down by private banks because of the unfavorable yields. That is what many managements have commented. So, the likes of ICICI Bank and Axis Bank and Kotak Mahindra Bank as well, they spoke that, unfavorable yields have led to a corporate book not growing that much. On the other hand, if you take a look, SBI's, corporate growth of 5.5%, that is corporate loan growth, has been one of the highest amongst all the large banks. Now, net interest margin has improved quarter on quarter for most of the banks, especially ICICI Bank and HDFC Bank. They have seen the highest sequential growth in their net interest margin. However, for SBI, it's actually shrunk by 1 basis point on a sequential basis. Now, operational efficiency was another area of focus. It's been the highest decline for SBI, their cost to income ratio declining by 184 basis point on a sequential basis. Axis Bank and Kotak Mahindra Bank actually saw an increase in their cost to income ratio. Meaningful part in any bank's result is the return ratios or ROA. So SBI saw a decline in its ROA, that is return on asset, on a sequential basis, while Axis Bank and ICICI Bank have seen the highest increase in their return on asset ratio on a sequential basis. If you take a look at the valuation picture with reference to price to book value, large banks like HDFC Bank, ICICI Bank on the private side trade between 2.7 to 2.9 times, while SBI is trading at 1.5 times price to book value on a 1-year forward basis. Back to you.
All right, well, let's hop across to Vamakshi. She's here to tell us about RR Kabel, NetWeb, as well as Gravita. They're buzzing in trade. Vamakshi?
Well, absolutely, Nigel. RR Kabel, the stock is up on the back of a very strong set coming in from the company. It has come in much higher than what the street was expecting. Revenue saw an uptick of almost 26%, out of which largely the growth was contributed by wires and cables, which saw an uptick of 28%. The FMEG business also was up nearly 13%. The margins have improved substantially for RR Kabel at 8.7%, and the net profit too is seeing an uptick of almost 64%. As far as FY25 volume growth is concerned, it came in at 7.1%. This is much below what the company had guided for. But the management joined us on the channel and they said that they're expecting volume growth of nearly 18% in FY26. They also believe that wires and cables margins would be around 8 to 8.5% this year, and FMEG business, more importantly, will be breaking even in the first half of FY26. Along with that, they've also announced capex plans at units in Gujarat, and they say that this will require fresh investments of nearly 1,200 crores, out of which 200 to 300 crores will be on from the term loans. NetWeb is the next counter that we're watching out for. Very strong numbers here as well. When we look at the company's full year revenue and PAT numbers, they've managed to meet their guidance. Revenue saw an uptick of nearly 24% sequentially. The EBITDA margin too has improved substantially to 23.8%, and the net profit is up nearly 42%. The order book, on the other hand, has seen a bit of a dip on a sequential basis, and that could likely be on account of higher conversions. But nevertheless, the analysts say that the order pipeline going forward is very healthy. And lastly, let's also look at Gravita India. Revenue out here saw an uptick of almost 21%. The margins have improved to 11.9%. The lead business is doing very well for the company. Margins at 13%. The EBITDA per ton is also, seeing an uptick of almost 6%, and the net profit resultantly is seeing an uptick of almost 37%. So strong numbers from all these three counters.
Okay, all right, Vamakshi, thanks a lot for that. But I think the stock you need to focus on right now is GAIL. That's the one that's seeing a bit of an uptick, and that's because PNGRB will hold an open house on gas pipeline tariff review on May 14. Basically, this means that things are moving in the right direction. A tariff hike could possibly come out rather soon, and that's where we're seeing a bit of an uptake. Remember, CLSA, they have upgraded GAIL just a few sessions ago to outperform from hold. They raised the target price as well to around 210 from 175 rupees earlier. And they had mentioned that a 20 to 25% tariff hike is possible by June. So that's the reason why, in fact, the street is excited. The next date is going to be May 14th. But in short, things are moving on expected lines. And that's why, in fact, the stock is seeing a bit of a spike up. Let's get in Anand Tandon, who joins us now on the show. Anand, any view on GAIL? There's a bit of a tailwind that's coming in terms of this news flow. We'll have to wait for the outcome, but it appears a hike could be on the cards.
Well, that is true. And if that happens, obviously it will be positive for GAIL. But you have to remember it's a utility, so there will be a one-time adjustment, and after that, it will then go back to business as usual. So for the near term, I think the likelihood of a price hike is in your favor as an investor.
Got that point. By the way, I'm looking at some of the stocks that are moving in the mid-cap market because it's such a big day for mid-caps. The index is up almost 2%. And look at the advanced decline ratio. You've got almost, more than 1,850 stocks, 1,850 stocks that are advancing right now. By the way, Kabel's performance seems to have rubbed off on names like Polycab as well. Polycab is up 6% as we speak. Anand, hi, good afternoon. On Kabel and this entire space, the wire and cable guys, the management today sounded very, very optimistic about improving margins. They're putting a lot of money to work, adding capacity, and almost unfazed by the heavy-duty competition that's coming into the space. What would your advice be on stocks like Polycab, Havells, Kabel and others?
These companies have done very well over the past several years. But I think, as you pointed out, one, the competition is more. And I think cyclically, I would argue that from here, you are probably seeing the best in terms of real estate development behind us. That is not to say that these companies only deal with real estate, because they will also be providing inputs into industrial products. But by and large, I would imagine that the large part of that also comes from real estate development. And to my mind, I see that sector at least kind of peaking out from here and perhaps not doing so well over the next 24 to 36 months. You also have to remember that, the management does tend to be overly bullish. If you look at their own commentary over the last 1 year, it has been a lot better than what they have actually managed to achieve. So at this stage, I think, you have to keep in mind some of the valuations. So while there is a kind of cyclical euphoria in the market right now, and one is looking for newer sectors to look for, I would argue that the good old sectors are probably more likely to perform over the medium to longer term. And it is not necessarily to try and invest in every new kid on the block.
All right, Anand, I wanted to ask you about Swiggy. A stock is bursting away. It's up close to around 13%. And the reason we understand is that they made a notice on the exchange, they disclosed in a filing that Bolt, which is their quick food delivery platform, that in fact they're talking that one up at a time when Zomato, spoke of shutting down Zomato Quick or Zomato Everyday, which is their quick food delivery platform. So because of that, Eternal now, we are seeing Swiggy spiking up. But just want to caution our viewers as well that their lock-in period will be ending later this week. So that's when the real test will come in for Swiggy. For the time being, moving higher on very, very large volumes. Anand, what's your view on the stock? When it listed, it went dancing away. It gave a quick 25-30% return. But from there, now it's sharply below its issue price.
Well, I think people are now looking for opportunities to do some bottom fishing, and I would imagine that Swiggy falls in that category. But as you pointed out, what Zomato has said in their commentary is something that one should be looking at carefully. A company which has executed exceedingly well in terms of deliveries and in shortening times feels that it is not viable if you don't control the entire value chain to be able to deliver within less than half an hour. Now, that's a problem that Swiggy can't be facing differently. I mean, they must be also having the same kind of problems. And if one large player, which has, like I said, executed exceedingly well, seems to find that that is a problem, it cannot not be a problem for Swiggy as well. For most of the other categories anyway, you also now have Amazon throwing its hat in the ring. So I think if nothing else, competition too will pick up. So if you think one side is going down, of course, they will not be in the food segment, but for everything else that they have in their inventory, they will also be competing with all these players. So overall, I think, one has to be a little cautious about companies which are in this space. There is no doubt the space is growing very fast, but I think so are the valuations.
Early days, multiple strategies, different contrasting views coming in from both Eternal and Swiggy on this. Anand, do stay on. Need to slip into a short break. We'll come back. Welcome back. The mid-caps are going to end with a 1,000-point gain at the index level, 1.85% higher on the mid-cap index. And look at some of these stocks. IGL, where the company has increased prices by 1 rupee per kg effective the weekend, increase for both Delhi and the regions around Delhi. IGL is ending with a gain of nearly 7%. Gravita, strong number, stock up 7-8%. Parag Milk, we've been talking about it. Profit after tax surging 167%, and that's going home with a double-digit gain. And Bajaj Consumer numbers appear to be disappointing. The stock initially, took a downtake on the back of the profit, sliding about 13%, but now it's managed to recover. There you have it. From that fall, post numbers, the stock is now back in the green. So buying coming in at the lower end. And NetWeb is another big mover today. Strong numbers, stock is up 13%, and it's also pulled up some of the other data center businesses. So I think the last time I checked, some company called E2E, Black Box, these companies are also, have come in on the investors' buying radar today. Anand, any mid-cap, small-cap whose numbers you've liked and you would like to purchase or you would recommend buying?
A wide range of themes out there, so it's a little difficult, and I don't want to name particular names. But by and large, I think you're still looking at, the delta from here can be in those areas where you have to assume that we strike up a good trade policy with the US, which is good for Indian manufacturing. And therefore, the traditional areas of focus should be textiles, chemicals, and so on, where we already have a strong manufacturing base, which can cater to a market which requires some of those products in the absence of China or any of the other producers. So that, to my mind, would be the safest call. If the trade deal doesn't happen, of course, all bets are off. But for now, you have to assume that the trade deal in some form or shape will come through.
Okay, all right. So that's some perspective on a couple of these stocks. Anand, just a quick question again on auto. When we were discussing this earlier, M&M, you wonder when stocks are rising, when they keep rising, and the numbers keep looking so good quarter on quarter. You sometimes wonder if it's if it's too much of a peak. But then the numbers are adding up. What are your thoughts? What would you say? The stock is still not at its all-time high. It's still about 7-8% off it. Would you advise buying, or is it too late if you haven't bought the dip?
Well, if you look at the entire auto space, that's probably the only company which is worth looking at, because the two-wheelers aren't doing anything. The heavy commercial vehicles aren't doing anything. You are basically then looking at tractors and the cars. Among the passenger vehicles, the only segment which is growing is SUVs, and there Mahindra & Mahindra has an excellent portfolio and is doing very well. Tractors, they have an indomitable lead, and that is doing exceedingly well as well. Some of the other areas, for example, in terms of hotels and related properties, is also something they have a play on. The only part which is a little weak would be, I imagine, the IT sector. And they haven't done much in the finance so far, which it hasn't actually kind of, rocked anything. So if those two areas were also things which could come back into shape, you would imagine that, there is considerable upside that may still be possible. But with the 2 or 3 areas that they are actually dominant in, which is the auto, tractors, and the autos and the tractors, they are already well positioned to be able to move up and at least continue to be in the portfolio. So at this stage, I would imagine, from a lack of anything else, you might want to be in M&M, forget the valuation.
By the way, watch for Coforge, comes out with numbers later today. And this is a company which has also been delivering very strong numbers. And this quarter, the street is anticipating a more than 3% constant currency revenue growth in Q4. And just to reiterate what the management said, in October, they said FY25 will be a standout year for the company. And last quarter, they said next year promises to be very solid. So they've been delivering solid numbers, and the commentary will be awaited very closely. We're just counting down to the close now.
Yeah, that's right. Well, let's wind down the markets. Anand, request you to stay with us. Let's do a quick recap of what went on today. The Nifty goes home with a gain of around 120 points. Remember, it was without its star performer. That's without the Nifty Bank giving any kind of support, which was down close to around 200 points. What went home with losses? Well, you had SBI and Kotak Mahindra Bank. Both of them were on the losing end, and that restricted some of the up move in terms of the Nifty. Otherwise, on a closing basis, we could have very well got past the 24,500 mark. What did well? Adani Group stocks, Adani Ports, Adani Enterprises, both of them zipping away, up 6 to around 7% in trade. You had Trent as well that bounced back today. That was up close to around 4.5%. And Shriram Finance and Bajaj Finserv, well, both of them found their firm. Mahindra & Mahindra came out with a solid set of numbers. We had the management telling us that they're bracing for a bright FY26 as well. So that one was up close to 3.5%. Eternal and Swiggy, both of them did well in trade today. Swiggy, in fact, outperformed because of that disclosure they put on the exchanges. So that one, in fact, was up and about. And ITC, the big boy in there, was up close to around 1%.
Okay, that's the large cap screen. Let's talk about the mid caps because mid caps have had a stellar day. Like we've been pointing out, look at Motilal Oswal, 8.5%, 9%, KEI Industries, 6.5%. Of course, stocks like Polycab and RR Kabel having a field day. RR Kabel, 13% on the higher side. That's what we've got. JBM Auto, 7%. Lots of names. And of course, let's not forget HPCL, BPCL and IOC, 4% crack in crude oil prices. Brent below $60 a barrel. That spelled good news for many of these oil refining companies. HPCL up 7%. That's BPCL 3.5%. Let's pull up HPCL as well. Really a tall gainer in terms of today's trading action. Losers really, apart from the large banks like Kotak and SBI, not too much to talk about. KFin, Novama, some of these capital market players, they've seen a little bit of profit taking, and V-Mart Retail ended about 7% lower. But overall, a very good day for the broader market. Well, the bell has gone, so first day of the week is over. That's it from the closing bell team. But do stay tuned. Vinny and I will take the action forward on Markets Forward.
Market ends in green but off morning highs. Nifty closes near 24,400 while Sensex ends at 80,800 levels. Mid and small cap outperform. Auto, FMCG and energy stocks charge ahead while private banks dip in trade.
M&M shares gain after the company reports a strong fourth quarter boosted by healthy volumes and realizations. SBI and Kotak Mahindra Bank shares under pressure after SBI trims its growth outlook and remains cautious on margins going ahead. Kotak Mahindra Bank misses expectations as business growth slows to a 3-year low.
Adani Group stocks perk up in trade over Bloomberg report claiming talks between representatives of Adani Group and Trump administration officials. The Adani representatives have sought dismissal of criminal charges levied against him in an alleged overseas bribery case. The outcome of this is expected in the coming months.
Hello and welcome to Markets Forward, your go-to show where we aim to get you all the highlights of the day gone by and gear you up for the next trading session. I'm Surabhi Upadhyay. With me is Vinny Motiwala. And Vinny, not a bad day for the market. There was some red on, on the bank Nifty, but otherwise not too bad.
Not a bad day coming in for the markets, right? At least the first day of the week, when you start on a good footing, you're happy with that situation, right, Surabhi?
No, absolutely. And I think the market was just gently building along. And it's anyway been, we're the best performing market if you look at the global backdrop after the Liberation Day tariff issue played out. And that simply continued. The Nifty continued to chug along. The bank Nifty was under pressure because of what we just told you. This slight caution that some of the large lenders are throwing up, whether it's State Bank of India. The Big Daddy itself talking about how, credit offtake, particularly on the corporate segment, maybe could be a little impacted because of tariff uncertainties. And Kotak Mahindra Bank. Growth really was the reason why these stocks were down. And they pulled down some of the peer names as well with them. But let's not, get too perturbed because there was plenty of other pockets of the market, including mid-caps that more than made up for this banking loss.
Absolutely, more than made up for this loss. That's why that advance decline ratio was also a bit more in the favor of advances versus decline. And when you look at the mid and small cap, that saw an outperformance coming in the trading session as well. So that is something interesting to watch out for. Other than that, autos, Nifty Auto also gained more than 1%. M&M, obviously good set of numbers. So that was something leading to and supporting the up move in terms of Nifty Auto. FMCG is another sector that was holding on to green as well. Third, after 3 days of losing streak, we've seen FMCG coming back in action today. Marico, good set of numbers coming in from that front. So that is also something that we're watching out for. So it'll be an interesting day today in terms of the trading session. While there was some bit of a red coming in from the banks, we did have autos, FMCG supporting some bit of that up move. Well, here's what we're going to start on with the show, and here's what we have for you all in store on today's edition. What we start with is going to be with the top movers and shakers of the day with Vivek. Well, the stock of the day is going to be Mahindra & Mahindra. We will give you the key reasons why the stock was buzzing in today's trading session. And last but not the least, we'll tell you which are the key market events to watch out for in tomorrow's trading session. Okay, and starting on with our first segment for the day, Vivek is joining with us from the big wall to tell us the top stock movers of the day. Vivek?
Well, thank you so much for that, Vinny. Another session where you actually managed to end in the green. Advance decline ratio, like you mentioned, was very much in favor of the advances. List of top gainers, well, you have to start at M&M. Results came during market hours. Operationally, a very strong performer. The BEV segment actually turning a bit positive. This is something that the street liked, ended high by almost 3.5% today. The other stock that did very well was actually the cable and wireless pack top pick, which was RR Cable. Almost 13% higher, good set of numbers. Guidance as far as FY26 was concerned was quite strong. Street really liked those numbers over there. And when you're talking about the oil and gas pack, they were in focus today, especially IGL, the gas pack. IGL went ahead and did a second successive price hike as far as the key geographical area of Delhi was concerned. The margin that the company is trying to protect is something that the street liked, almost 7% higher. And you have to look at the crude oil sensitive stocks today. So the OMCs did very well in the session, along with that airlines too, managed to end at the green. HPCL, one of the top gainers. Now, on the other hand, you also saw a name like Gravita, good set of numbers coming in from the company company this time around, almost 7% higher. Laggards, some of the names that you did mention, you have to talk about Kotak Mahindra Bank. Despite the consolidation and the acquisition of the Stanley portfolio, growth there was quite tepid. Street didn't like that, almost 5% lower. SBI, like you mentioned, loan growth guidance trimmed lower. That's also something that the Street really didn't like. And lastly, one name from the broader end of the markets, that was Jindal, saw a muted Q4, one of the top laggards as far as the NSE 500 was concerned today, almost 4% low. Cooled off, or some of the losses were trimmed towards the later half of the trading session, however, still down by over 3.5% today.
Okay, all right, Vivek, got it. Thank you very much for that neat summary of how the day was eventually looking. Well, let's bring in our guests. We have Anand Tandon joining in to talk about some of the fundamentals and sort of how we should be positioned on this market. Anand, in a bit, I think we'll have Sudeep Shah as well. I don't think we have him now, but on technical, Sudeep is going to join in. Anand, just overall, the earnings that have come through, do you think there is enough steam in Q4 numbers in the commentary to take this market higher? Because the rebound from the April lows has been very swift.
Well, that is true, but I don't think that we've seen any major surprises per se. And if you look at the estimates of earnings for the year that was there, let's say a year ago, for where we thought March 25 would be and where it is today, in fact, it has been a steady decline in terms of earnings expectations to the stage that you have now got into single-digit earnings growth. So now really that earnings is not going to be the driver. What you have to look for is the future earnings growth. Here again, we start with almost 14% expectations of earnings. I would argue that this year again, we will see some disappointment. You will actually bring the estimates down closer to maybe 10%, if not lower. And that would mean that it could be a bit better than last year because the last year base was fairly low. But you would still find that, maybe overall the numbers will still remain somewhat muted. So you are still looking at a market which remains relatively expensive. And you have to be careful about the choice of sectors that one is looking for.
Yes, absolutely, Anand. But, let's talk about Mahindra and Mahindra as well, because those shares were gaining in trade. They reported a strong fourth quarter number boosted by healthy volumes as well as realizations. Sudarshan is joining in with us now to give us more details on this front. Sudarshan.
So M&M has reported a strong set of numbers for Q4 of FY25, led by strong tractor margin that company has seen in Q4. Both auto and tractor have done better, but especially tractor margin that has come in at a multi-quarter highs. And on revenue front, it was led by healthy volumes that company has seen year on year. Auto volumes was up around 18%. Tractor volumes were up more than 23%. And recent price hike that company had announced, it has helped realization improve 5% sequentially and 11% year on year. And overall, on consolidated basis, both revenue or profit were up 20% each. But if we talk about the standalone numbers to which we are comparing with our estimate, we saw EBITDA improving by almost 40% year on year, and even margin rising to 14.9% at multi-quarter highs, and this was against our estimate of 13.8%. Now coming to the volumes front, both auto and tractor segment have seen healthy volume growth. And what about the outlook? Company for FY26 for tractor segment, it's seeing a growth in high single digit, and as far as SUV plus electric vehicle segment is concerned, it's saying that in FY26, it's likely to see a growth in the range of mid to high teens. So even for FY26, company is bullish as far as growth for the entire, both the segments are concerned. So overall, it's a very good set of numbers by M&M, as well as the outlook looks positive.
We've spoken about quantum growths. We haven't quite got to where we would have wanted to, but crossing 1,000 crores is a critical milestone, and we've accomplished that in the year F25. The farm margins have been very, very strong, and for the full year, the margins in farm have been at 19.7%. That's for the core tractors, and for the farm standalone has been at 18.4%. To clarify, core tractors is all domestic tractor sales plus tractor exports from India. That's what we call core tractors.
Okay, that was Mr. Jejurikar of Mahindra and Mahindra. Let's talk about the big bank earnings now. SBI and Kotak Mahindra Bank, both those stocks under pressure after Q4 numbers. The street concerned with growth. Let's go to Abhishek for more.
Well, to begin with, the comparison shows that, amongst private banks, they have seen robust deposit growth on a sequential basis. For some of them, it's seasonal in nature, like HDFC Bank as well as Axis Bank. But this has come at a time when the industry is facing deposit crunch. However, we need to take that also into factor. SBI has seen the weakest deposit growth on a sequential basis in Q4 FY25 amongst large banks. So if you take a look, while private banks are shunting growth in corporate portfolio due to unfavorable yields, SBI is massively growing the book on a sequential basis. It's up about 5.5%. Now, net interest margin has improved sequentially for most of the banks. ICICI Bank and HDFC Bank seeing the most improvement in their net interest margin. However, for SBI, the margin has declined on a sequential basis by 1 basis point. Now, operational efficiency was the other area of focus amongst these banks, wherein the highest decline was seen for State Bank of India. Axis Bank and Kotak Mahindra Bank saw increase in their cost-to-income ratio on a sequential basis. Now, SBI saw its ROA, that is return on assets, decline quarter on quarter. Most of the banks have actually seen an improvement in their ROA on a sequential basis. Axis Bank and Kotak Mahindra Bank saw the highest improvement in their return ratios, that is return on asset on a sequential basis. Take a look at the valuation picture. Large private banks like HDFC Bank and ICICI Bank are trading at 2.7 to 2.9 times 1 year forward, while SBI is trading at around 1.5 times price to book value on a 1 year forward basis. Back to you.
Okay, Abhishek, thank you so much for that. Today we have seen both these banks in focus and under pressure as well. But we do have Sudeep Shah also joining in with us now for a check in terms of the technical front. Sudeep, we've discussed a couple of stocks. One is M&M as well as the other two banking names as well. So any view that you have in terms of M&M or SBI? What are the charts indicating for this? What are you watching out for?
Good afternoon. M&M, if you see on charts, it has given us a very strong reversal today. So what we feel is reversal backed by strong volumes, as well as there was a consolidation that was witnessed right from the month of February. So this the breakout has come about 2900 levels, and now sustaining above that level shows that the stock is now headed up to 3200, 3300 in the coming few weeks. And we feel that this stock should be added at the current levels, as well as on dips with a stop loss at 2940. So we are quite positive on this stock, as well as a few other auto names, and auto index itself is now showing signs of a credible rebound.
Right, and Anand, your view specifically, if I'm asking in terms of the banking side, Abhishek was talking to us about the banking sector, large banks, performance coming in as well. How are you viewing it? When you look at SBI, Kotak, nothing sort of an excitement that we've seen so far. So anything exciting that you're finding in this large banking space or the earnings that are reported so far?
Well, actually, if you find banks exciting, it's very bad news. So banks are best when they are boring. SBI has reported, to my mind, a superb set of numbers. They have perhaps, to my mind, over-provisioned because they already were doing so well in terms of the overall YOI growth that they perhaps didn't feel the need to actually report much higher kind of profit growth. The outlook for this year also remains somewhat benign, because you are looking at a cut in interest rates, perhaps sovereign debt getting into the index globally, etc. So you should see a softening of interest rates, and with the credit growth, with the deposit growth again coming back, you are looking at a situation where NIMs may not be very stressed. So I think stocks like SBI should be in part of your core portfolio and not to be fiddled with. Kotak, of course, is overcapitalized, so that is the only challenge that they have. They have also grown reasonably well. The only thing is that they are somewhat overcapitalized, and therefore their ROE tends to be a little lower. But that's only a matter of time before that also comes back into shape. So I would argue that all the top-rung banks with a good deposit franchise are companies that you want to have as part of your portfolio.
All right, got that point, Anand. Let's quickly move on and look at another pocket of the market that was up and about, and that was thanks to the drop in crude oil prices. Now, prices created almost 4% today after OPEC Plus decided to increase output by a higher than expected 4 lakh barrels a day in June. We saw lots of OMC stocks react positively. In fact, HPCL was rallying as much as 7%. So Darshan is here with more details.
So crude sensitive saw a big move on both these sides. So first, why there was a big fall in crude? Crude over the last 2 to 3 sessions has fallen nearly 6 to 7%, and today intraday has fallen to lowest level, almost lowest levels the last time that we saw in 2021. So why there was a big fall? So over the weekend, OPEC Plus, which is led by Saudi Arabia and Russia, have decided to increase the production, and the increase is higher than expected. So increase for the month of June would be of 4.11 lakh barrels per day. Now following that, crude has fallen. Now what impact it would have on all these companies? So first, talking about upstream companies like ONGC and Oil India. If there is a fall of $1 in crude, it impacts annual revenue in the range of rupees 300 to 400 crore for these two companies. Now coming how this impacts positively to downstream companies or say oil marketing companies like IOC, BPCL and HPCL. So on the fall of $1 in crude, it impacts positively to EBITDA in the range of rupees 200 to 300 crore for these downstream companies. Now last is why it's positive for paint company. So for paint companies, up to 50% of their input costs are linked to crude. So if there is a big fall in crude, it might have the positive impact, especially on the margin. So now the last question is, will there be a drop in retail fuel price after seeing a big fall that we have seen in crude? Last week, IOC in our interview had said that is very unlikely in near term.
Okay, Sudarshan, thank you so much for that. And Anand, coming to you, this is surely exciting, right? For banks, when you don't see excitement, it's fine. But crude prices falling is something exciting for a lot of companies, whether you look at paint companies, aviation, 40% of their cost comes in for fuel as well. What are your thoughts on any of these names? And do you think, is this a play or a story to look at right now, given that sharp fall in crude prices?
So let me give you a statistic which is a little, which may throw some water on this, that leaving aside the last couple of years where, after the Ukraine war especially, where there is, because of various disruptions, by and large, whenever oil price goes up, the market does well and vice versa. So actually, the underlying economic demand being robust, which is a sign which also reflects on the prices of oil, is more important than the price itself. But having said that, as you pointed out, many of those companies will actually benefit. Of course, as consumers, we are unlikely to, because the government will find clever ways of making sure that you and I don't get any more money in our hands, and it goes to the government's coffers. But most of the companies are, which are in the refining space, etc., will see some benefits. Marginal industries like paints will also benefit, but there the level of competition is so high that I wouldn't put, you will get some relief from them, but I don't think that you should be looking to, till the market shares get settled out, I don't think that's a great play yet.
Okay. All right. Got it, Anand. Thank you very much for that, to you and to Sudeep as well, for joining in and giving us perspective on the show. We do have to take a very quick break. Come back on the other side. We'll get you the top corporate voices and the key events to watch tomorrow. Welcome back to Markets Forward. Let's get you the key corporate voices through the course of the day. The management of Bajaj Auto said that April has seen a smart growth in two-wheeler sales as against March. The company also adds that FY26 domestic growth should be in the same range as FY25. Also, Bajaj Auto has taken a price cut in some entry-level models of the Pulsar, but then it has also hiked prices of some of its other models. So net-net, not too much of an impact. Export growth should be more than 10%, says the company. And next on our radar is Kabel. That stock shot up almost 13-14%. The wire and cables company saw its shares surge after Q4 numbers came through. The management said that it has seen good demand in domestic and export markets. It expects double-digit margins in 2 to 3 years. The company has guided for good growth in exports in FY26. It also believes that entry of new players is a good sign and there is enough space for everyone to grow in. It's expecting its FMEG business to break even this year.
And moving on to some of these FMCG names on the corporate corner front, where Tata Consumer Products are also on our radar today. The company is targeting to grow top line in double digit and faster EBITDA. That's not all. It aims for 500 crore rupees per quarter run rate from Capital Food and Organic India in H2 FY26. The company will be launching sports drinks in the next 15 days. We also have the management of Marico on our channel as well. The company has seen a significant improvement in rural demand. However, urban demand remains patchy. The management sees marginal cooling down of inflation, which is likely to improve demand. It maintains volume growth in the range of 6 to 7% in FY26. And before we wrap up, we bring you some of the key events to watch out for in tomorrow's trading session. Mangalam is standing by with that. Mangalam, over to you.
Well, some of the important results that there are tomorrow, we have Godrej Consumer, HPCL, as well as Mahanagar Gas reporting their numbers. But alongside that, some other numbers which will also be very crucial to track. We have a bunch of them. So we have something like a Radico Khaitan reporting their numbers, Polycab, after especially what Kabel did today. Paytm reports its numbers, and Bank of Baroda is the PSU bank that we will be watching out for too. But apart from that, we'll keep an eye out on Hoodco. Their board meets to consider fundraise. What is the manner and the amount of that fundraise is something that we will be tracking very closely. And moving abroad, we will keep an eye out on the FOMC meet that starts tomorrow. Obviously, the outcome day after, and we react to it 2 days later. So that's something we'll watch out for. What we'll also keep an eye out on is, the Treasury Secretary Scott Bessent testifying before the House Appropriations Committee. The outcome of that is something that the global markets will most definitely keep their eye out on.
Okay. All right, Mangalam, got it. Thank you very much. So packed day, as always, coming up tomorrow. But for now, from the entire team that puts this show together, many thanks for watching. And we have lots of other news and updates coming up right after this break.
Hello and welcome to Business 360. I'm Shireen Bhan. The top stories that we're tracking for you this evening. The Sensex and the Nifty ended the highest closing level in 2025 so far. Mid-caps outperformed the blue chips. Bank stocks underperformed. Brent crude briefly drops below $60 a barrel. OPEC nations decide to increase output much higher than market estimates. Oil prices now near their 4-year lows.
Any trade deals coming this week? It could very well be. Can you tell us more about it? Nobody understands. We're negotiating with many countries. But at the end of this, I'll set my own deals.
President Trump hints that some trade agreements could be signed this week, but doesn't provide further details. Says his main priority with China is to secure a fair deal. President Trump orders a 100% tariff on foreign-made movies, saying Hollywood is dying a very fast death. The move is likely to impact Indian films that release in the U.S. Filmmaker Shekhar Kapoor says the new tariffs may encourage Hollywood to move outside the U.S. M&M beats estimates in Q4. Strong tractor sales drive growth with margins hitting multi-year highs. Revenues up 25% thanks to healthy volumes and a boost from realization. Private banks post robust deposit growth of nearly 6% in Q4, outpacing PSU banks. Private banks also report strong margin expansion, even as SBI's margins contract. Government sources say authorities have emptied the Baglihar Dam reservoir on the Chenab River and closed the gates, claim that water from the Chenab River will not flow into Pakistan's Punjab province via the dam until India refills the reservoir. Adds that similar steps may be taken on the Kishangang project on the Jhelum River. Israel's cabinet approved the plan to capture all of Gaza and remain there for an unspecified amount of time. The plan includes displacing thousands of Palestinians to southern Gaza. A 10-minute standing ovation for legendary investor Warren Buffett as he announces his retirement from Berkshire Hathaway at the age of 94. Longtime Berkshire executive Greg Abel will take the reins. Buffett promises he will not sell a single share in the company and will stay as chairman. Well, let's start with the market action for the day. No Monday blues on Dalal Street. The Sensex and the Nifty gaining in trade, ending at their highest level seen so far in 2025. Now, mid-caps did outperform, and the mid-cap index was up by almost 2%. Banks today in the red, closing about 200 points lower. The Sensex up by almost 300 points and 114 points, a 0.5% higher on the Nifty. In the money market, the rupee gained over 33 paise as it continues to strengthen against the dollar. The rupee has been gaining steadily over the last few weeks after President Trump's tariffs led to a weakening of the US dollar. The 10-year bond prices have gained in trade and yields softened. That's the money market snapshot for you. And in the commodity market, gold prices also continue to gain on the back of a weak dollar. Prices of 24-karat gold surging by 220 rupees from its previous close in today's trade. And price of spot gold in the international market up marginally to $3,257 an ounce. Meanwhile, crude prices have eased. This after OPEC Plus agreed to surge production for the second month. The group has decided to boost output by over 400,000 barrels per day in June. Sudarshan is standing by now on what this could mean potentially for oil marketing companies. Sud.
So crude sensitive saw a big move on both these sides. So why there was a big fall in crude? Crude over the last 2 to 3 sessions has fallen nearly 6 to 7%, and today intraday has fallen to lowest level, almost lowest levels the last time that we saw in 2021. So why there was a big fall? So over the weekend, OPEC Plus, which is led by Saudi Arabia and Russia, have decided to increase the production, and the increase is higher than expected. So increase for the month of June would be of 4.11 lakh barrels per day. Now, following that, crude has fallen. Now, what impact it would have on all these companies? So first, talking about upstream companies like ONGC and Oil India. If there is a fall of $1 in crude, it impacts annual revenue in the range of rupees 300 to 400 crore for these two companies. Now coming how this impacts positively to downstream companies or say oil marketing companies like IOC, BPCL and HPCL. So the fall of $1 in crude, it impacts positively to EBITDA in the range of rupees 200 to 300 crore for these downstream companies. Now, last is why it's positive for paint company. So for paint companies, up to 50% of their input costs are linked to crude. So if there is a big fall in crude, it might have the positive impact, especially on the margin. So now the last question is, will there be a drop in retail fuel price after seeing a big fall that we have seen in crude? Last week, IOC in our interview had said that is very unlikely in near term.
As of now, consumers should not really expect some kind of a relief, so to speak. Am I right?
For the health of the companies, we have to hold on.
Well, that was last week, the chairman of Indian Oil Corporation saying that a fuel price cut was unlikely, but let's see how this plays itself out. Remember, it is, of course, a political call, finally. US President Donald Trump hinting that some trade agreements could be signed this week, however, has not provided any details. In an interview to Fox News, Trump also ruled out the possibility of lowering tariffs on China to negotiate a trade deal. But he did add that securing a fair trade deal remained a main priority for him. While addressing reporters at Air Force One, Trump further said that he has no plans of speaking to Chinese President Xi Jinping, but negotiations are ongoing with US officials. President Trump also said that the US is having discussions with several countries, but a trade deal will be solely set on his terms. This comes just a day after the president said he won't be seeking a third term as US president.
Well, I want a fair deal with China, but China's been ripping us off for many years, so maybe something should be thought about. A little bit of retribution. China's been ripping us off for many years, ever since they started. To me, I think it was the worst thing that Richard Nixon never did.
Is there enough?
And it was Washington. He's the one that got it started. Nobody understands. We're negotiating with many countries. But at the end of this, I'll set my own deals because I set the deal. They don't set the deal. I set the deal. At some point in the next 2 weeks or 3 weeks, I'm going to be setting the deal. I'm going to say that such and such a country has had a tremendous trade surplus their way with us, and they've taken advantage of us in various ways. And we fully understand what they were doing. We were being led by people that were not very smart. They were able to be taken advantage of, but I can't be taken advantage of. So at a certain point, I'll be just setting a certain tariff number.
Well, that's President Trump. Back home, Mahindra reporting a strong set of numbers in the fourth quarter, beating street estimates across most fronts. Net profit up nearly 20%. Revenue grew over 24% in the quarter. Tractor margins hitting multi-quarter highs, while healthy volumes have boosted overall revenue. The company's management says they expect mid to high teen growth for the SUV and EV segments in the current fiscal year. Private banks have continued to post robust deposit growth of nearly 6% in Q4, outpacing PSU banks. The banks also reported strong margin expansion, even as SBI's margins contracted. Abhishek is standing by with more on how banks fared in Q4. Abhishek.
Well, to begin with, large lenders have reported their Q4 FY25 performance. And if you take a look, at the comparison table, private banks have seen robust deposit growth on a sequential basis, anywhere between 5.5% to about 7% range. In fact, at a time, this has come in, at a time when deposit growth is a big concern in the industry. Seasonal in nature in Q4 for deposit growth to happen for SDFC Bank and Axis Bank. Now, SBI has seen the weakest deposit growth on a sequential basis at just 2.9% in Q4 FY25 amongst large banks. If you take a loan growth, and if you take a look at the loan mix, the corporate portfolio has actually been shunted down by private banks because of the unfavorable yields. That is what many managements have commented. So, the likes of ICICI Bank and Axis Bank and Kotak Mahindra Bank as well, they spoke that, unfavorable yields have led to corporate book not growing that much. On the other hand, if you take a look, SBI's corporate growth of 5.5%, that is corporate loan growth, has been one of the highest amongst all the large banks. Now, net interest margin has improved quarter on quarter for most of the banks, especially ICICI Bank and SDFC Bank. They have seen the highest sequential growth in their net interest margin. However, for SBI, it's actually shrunk by 1 basis point on a sequential basis. Now, operating operational efficiency was another area of focus. It's been the highest decline for SBI, their cost-to-income ratio declining by 184 basis points on a sequential basis. Axis Bank and Kotak Mahindra Bank actually saw an increase in their cost-to-income ratio. Meaningful part in any bank's result is the return ratios or ROA. So SBI saw a decline in its ROA, that is return on asset, on a sequential basis, while Axis Bank and ICICI Bank have seen the highest increase in their return on asset ratio on a sequential basis. If you take a look at the valuation picture with reference to price to book value, large banks like HDFC Bank, ICICI Bank on the private side trade between 2.7 to 2.9 times, while SBI is trading at 1.5 times price to book value on a one-year forward basis. Back to you.
Abhishek, many thanks. That's the bank report card for you. Now, nearly 2 weeks after the Pahalgam terror attack, India has curbed the flow of water to Pakistan through the Chenab River. Sources say that authorities have emptied the Baglihar reservoir and shut the gates. India has already suspended the decades-old Indus Water Treaty with Pakistan. The Prime Minister met J&K Chief Minister Omar Abdullah over the weekend to discuss the situation in the Union Territory post the attack that claimed 26 lives. Meanwhile, Pakistan continues to violate the ceasefire along the line of control in Jammu and Kashmir for the 11th day. The Indian Army said it responded promptly and proportionately. Russian President Vladimir Putin called Prime Minister Modi and strongly condemned the Pahalgam terror attack. He emphasized that the perpetrators of the heinous attack and their supporters must be brought to justice. The United Nations Security Council is holding closed-door consultations after Pakistan urged a meeting on the rising tensions with India. Earlier, Pakistan's Prime Minister Shehbaz Sharif accused India of falsely attempting to link Islamabad to the Pahalgam attack and demanded a neutral probe into the incident. Parikshit standing by now with more. Parikshit, India has sent a water warning to Pakistan. Take us through what has been done.
Well, now India has started implementing its options as far as restricting or slowing down the flow of water to Pakistan is concerned. We suspended the Indus Water Treaty. That was the first step. Now we believe that the Indian government has halted the flow of water to Pakistan from Baglihar Dam on the Chenab River.
Right, Parikshit, unfortunately, there is a problem with the audio. We'll reconnect with you in just a second. We'll head into a break, but up next, President Trump orders a 100% tariff on foreign-made movies, saying Hollywood is dying very fast. The move is likely to impact Indian films that release in the US. A detailed report coming up. Nearly 2 weeks after the Pahalgam terror attack, India has curbed the flow of water to Pakistan through the Chenab River. Sources say that authorities have emptied the Bagliha Reservoir and shut the gates. India has already suspended the decades-old Indus Water Treaty with Pakistan. Parikshit is standing by to explain to us what exactly has been done. Parikshit, a water warning being sent out to Pakistan. Take us through what this means exactly.
Well, these were options on the table when India suspended cooperation under the Indus Water Treaty. India has now said that it will maximize the use of the Indus water system to its own advantage. It will construct dams wherever necessary. There will be some short-term measures and long-term measures. Among the short-term measures was restricting the water flow through the Bagliha Dam. Now, India has carried out a desilting process which is allowed under the Indus Water Treaty. We have flushed out the reservoir and we have put down the gates. Now, what this means is that the flow of water through the Chenab River into Pakistan's Punjab province will be reduced significantly. Now, there is a window till which this can happen. It remains to be seen what happens after that. But we're told that the Indian government is also considering doing the same at the Kishan Ganga Dam location. So these are measures that India is taking. We're still waiting for an official confirmation from the Indian government. There is another high-level meeting of the Indus Water Commissioners, the Jal Shakti Ministry, the Ministry of Home Affairs. In fact, all the actions around the Indus Water Treaty are being monitored very closely by Amit Shah and the Home Minister on a day-to-day basis.
Parikshit, many thanks for joining us. President Trump has said he will impose 100% tariffs on movies that are produced outside the US. Now, in a post on Truth Social, Trump said that the state of the American movie industry is in dire straits and dying a very fast death. Trump added that other nations offering incentives to draw American filmmakers and studios away from America. He went as far as to call the crisis a national security threat. Now, Shilpa joins us with more on what this could potentially mean. Shilpa, President Trump turning his lens on films now, how is this likely to impact the Indian film industry?
Well, Shireen, as things stand, details remain very unclear, right? Whether the levy would be on production costs or on revenues, whether it would extend to both theatrical releases or streaming content. But Trump's announcement of plans to impose this 100% tariff on foreign-made films has already had the global industry talking. More importantly, Indian film producers that we've been talking to say that they're yet to get full clarity on what this could mean for their business models going forward. But one thing is clear, that the United States is a major overseas market for the Indian cinema. Industry insiders estimate that 30 to 40% of the overseas box office collections for Indian films come from the United States, and it is much higher for films in the South. For Telugu cinema in particular, the US is second only to Telangana in box office collections. Big budget films often collect up to a quarter of their total revenue just from the US markets, and here releases typically are spread across 700 to 800 locations nationwide, and on day one most of them are sold out. And titles like, if you see Bahubali 2, Kalki, Pathan, RRR, all of these have seen massive success, grossing anywhere between like 15 to 22 million each. And in 2024 alone, Indian films grossed roughly about 160 to 170 million at the US box office, and all of this could stand impacted. But the concern here also goes beyond box office numbers. If the new policy extends to streaming platforms also, that a possibility that hasn't been ruled out yet, industry insiders are saying that it could discourage platforms from, acquiring or commissioning Indian content aimed at the US viewers as well. And that could be a setback for the growing international footprint of the Indian cinema. Now, if you look at the broader context, Hollywood itself, that's grappling with rising production costs at home. In 2024 alone, US production spending stood at $14.5 billion, which is actually 26% down from 2022, as studios increasingly chose international locations for production, like Canada, the UK and Australia, and all of these because they have been offering attractive tax incentives, and also local crew is more skilled. Now, the US Commerce Secretary Howard Lutnick had responded to Trump's post saying, "We're on it." So for now, studios and producers across the globe are waiting for further details on how and when the tariffs might be applied, and what categories of content it could fall under them, and what the potential impact could be. Back to you.
Yes, we're all waiting to hear more on the implications of the Shilpa. Many thanks for joining us. But here's the latest in the online gaming case, a matter that's being heard in the Supreme Court. The central government has told the court that it's not concerned if real money online gaming is classified as a game of skill or chance. The government argued that such a distinction is immaterial and the taxes will be paid equally on both. Ashmit standing by with the details. Ashmit, the government making it clear, skill or chance, it doesn't matter, 28% GST it is.
Indeed, no shifting there, no change of course. 28% levy is here to stay. That's the government's position. And this is important given as how the government is laying down the gauntlet. Bear in mind, this is the first detailed hearing that's taking place in the GST issue regarding online gaming companies. First time that we're seeing this before the highest court of the country. And here, the government's rationale is that, look, we understand, the government says we understand that there are games of chance, there are games of skill. The distinction, however, that the government is trying to draw is that irrespective of the games of chance or skill, when there's a money component involved, when there's staking, when there's wagering involved, that necessarily, irrespective of game of chance or skill, then translate into a case of gambling. So here, the government's rationale is that irrespective of the nature of the game involved, it is inconsequential when it comes to the computation of the GST demand. And this is where, in fact, we also have the Council for the Government draw the attention towards state-specific legislation, citing the example of Nagaland, saying that Nagaland is one state that makes a distinction, games of chance and skill, but even Nagaland, which protects games of skill, goes on to charge them, treat them as gambling when there's a case of money wagering. What is also important is that this is the first time that we've seen a direct position being taken by the government against fantasy gaming. Here, in fact, giving the analogy of the famous football player Messi, the Gaming Council, the Council for the Government went on to argue that there are bets, there's wagering done on how many goals Messi might score in a match, saying that there is absolutely no control. Any of the players have any control over how many goals Messi will score. And citing that as an example, said that even in case of fantasy gaming, even there, any money wagering will be classified as a case of gambling and therefore subject to the 28% GST levy. So clearly, just the day one of arguments, the arguments we understand will continue tomorrow as well. Another key question that the industry, however, will be watching for is whether or not this August 2023 amendment, which gave the clarification of the 28% levy, will it apply retrospectively? That's another question that many will be looking to answers for.
And that is an important question. Ashmit, appreciate you joining us. Air India's flight to Tel Aviv diverted to Abu Dhabi following the missile attack at the airport. The airline cancelled its flights till the 6th of May, and the suspension could now be expanded for a longer period. This disruption comes amidst an already tense airspace situation. For Indian carriers, as India and Pakistan continue to restrict each other's airspace, foreign airlines are also now growing cautious, increasingly avoiding Pakistan airspace. Let's go across to Madiha. She's standing by to take us through which airlines are now opting for longer alternative routes. So it's not just the Indian carriers, Madiha, even foreign airlines trying to avoid Pak airspace.
Absolutely, Shireen. The impact of Pakistan's airspace closure isn't just limited to Indian airlines. Several foreign airlines are also choosing to avoid flying over Pakistan, even though the restrictions officially apply only to Indian carriers. So as we have been reporting, the international flights from North India are the most hit, as they now have to travel to Mumbai and Ahmedabad and then proceed to their journey. We learned from airport officials that Mumbai ATC is handling nearly 135 more flights every day, which are both Indian as well as foreign airlines ever since Pakistan closed its airspace. Now, many flights operated by foreign airlines like Lufthansa's Delhi-Frankfurt flight, British Airways' Delhi-London flight and Air France's Delhi-Paris flight have chosen the longer route avoiding Pakistan airspace. There are others like Etihad's Delhi-Abu Dhabi and Oman Air's Lucknow-Muscat flight that sometimes avoid the Pak airspace, meaning there are days when they fly over Pakistan and then there are days when they don't fly over Pakistan. Instead, they fly over Mumbai and Ahmedabad. Now, interestingly, not all foreign carriers are avoiding Pakistan. American Airlines, United Airlines, KLM are mostly using the Pak airspace to enter India. Now, the question here is, why are some foreign airlines taking longer routes even when they are not allowed, even when they are allowed to use Pakistan's airspace? So, as expected, when we asked these airlines, they said that this is a precautionary measure, keeping in mind passengers passenger safety. There are two main concerns behind this rerouting. First, since tensions continue between India and Pakistan, any sudden retaliation from either side could leave these foreign airlines stranded in the sky if they don't have enough fuel to divert to another airport. And the second, in case they are forced to do an emergency landing at a Pakistani airport, then that could jeopardize the safety and security of Indian passport holders on board and lead to a risky diplomatic problem. So to prevent these unwanted consequences, some foreign airlines that we mentioned have voluntarily decided to take a longer route for Indian flights, although it will have an impact on their cost of operations.
All right, Madhiya, appreciate you joining us. And with that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC-TV18. Stay tuned. We're back in a moment.
Presented by Policy Bazaar.
CNBC-TV18, the Policy Bazaar Insurance Show.
India is a very unique consumer market, and the insurance case makes it very, very interesting. Why? On one hand, the insurance density, penetration as well as coverage in India is considerably low. But the same leaves a great deal of interest around how insurance industry scripts the catch-up towards the goal of insurance for all by 2047. Now, to understand any market, the most crucial aspect is to understand the consumer. For insurance space, it's the policy holder. Policy Bazaar, through its second edition of the flagship survey, How India Buys Insurance, attempts to do exactly that. Now, to speak about this particular survey and break down the nuts and the bolts of it, we are joined by, first of all, Anand Roy, the MD and CEO at Star Health Insurance. After that, Venkatachalam Iyer, Managing Director and CEO at Tata AIA Life Insurance, as well as Saravir Singh, the Joint Group CEO at PB Fintech. Saravir, I want to understand something from you. According to you, even today, do you think claims, settlement or denial of claims is still the single largest factor that, prompts a policy holder to go ahead and buy an insurance policy or not? What are the findings of your survey, of your report that threw up in terms of what is the single largest factor which sort of, tell a policy holder that he needs a policy and goes ahead and buys it?
Sure. So yes, we surveyed over 3,500 consumers across 30 plus cities in India, across income classification, town strata, etc. And one of the things that we have consistently found, this is the second edition, is that there is still concern or skepticism about the real moment of truth, which is a claim. So insurance is a very simple product. You pay a premium and you pay that in the hope that if there is some problem or if something happens, you will get your claim. And what we find is that now the discussion has got a bit more nuanced. It's not just about whether my claim is settled or not. It's also how my claim is settled. Was the process cashless? Was the process smooth? Did I get 100% of my claim or not? And people are also concerned about the time it takes. For instance, in health insurance, there is concern around discharge, like how long will it take to leave the hospital. Now, that is the story on the health insurance front. In term insurance, interestingly, what we find is that more people hear about successful claim stories. See, the claims are very less frequent in term insurance, as one would expect. So, those stories are not that well known. But when somebody hears that somebody has actually got 1 crore rupees or 2 crore rupees from an insurance company, right, that is a very powerful motivator. So, in our report, we find that last year, 15% of people bought term insurance based on having heard a claim story. This year, that number has gone up to 30%. So, I think, for us in the industry, I think it's very clear. We need more claim stories. We need to convince or show customers that yes, they actually gain by buying insurance.
Okay. Venki, I want to come to you. As Saravir was also pointing out, if indeed the story around successful and transparent claims is so strong right now and it's improving every year, do you think it can actually work in the favor of insurance sales and coverage as well, where policyholders do get encouraged in the best way that they could through actually these successful claim stories?
Firstly, let me compliment Policy Bazaar on this news survey. Not just on the survey, but I think the demonstration of great purpose in bringing protection to almost every part of India today. And we've been very closely partnering with Policy Bazaar for several years now. Now, to your question, you're absolutely right. I think each time we have a story about successful claim settlement, we've seen consumers really feeling great about it. And I'm not really surprised at this 15% going to 30% plus. What we have realized is there is more. We need to really capture this a lot more. Today, there is a Policy Bazaar at the forefront. As an industry also, we should make awareness about this even more pronounced. What we have seen is the choice of an insurance company based on its efficiency in terms of claim settlement comes after the decision on buying the product. Absolutely. Okay, the choke point lies in coming to the decision of buying the product first. So, that's part of the report also as to why there is so much more to be done when it comes to creating awareness about protection and term insurance. Once that happens, you go to a Policy Bazaar screen today, you have the claim settlement ratios also very clearly listed out for choice.
from a claim settlement standpoint, let me also assure our listeners, our viewers today, that most insurance companies today have a claim settlement ratio north of 95-96%. So most claims are definitely settled in term insurance. These are also very clearly regulated by IRDAI in terms of turnaround times and so on. So unless there's a disclosure issue, unless there is some kind of a fraud issue, really, most claims get settled.
Having a health insurance, of course, is one thing, but the bigger thing here is to have a health insurance which is enough for you and your family. Now, I want to come to Anand for this question, and these are three questions, but all related to each other. As you come across multiple cases, Anand, of individuals, is the trend encouraging in terms of are people getting enough insurance for themselves and their family? If not, do they acknowledge the fact that there is some bit of vacuum? Do they know that there is vacuum? And is there an effort in life to sort of cover that gap that they see in terms of enough insurance and insurance?
See, first, let's understand that health insurance, speaking from the perspective of health insurance, it is absolutely a necessity. And I think it is incumbent upon all of us here to promote the cause of health insurance, because after roti, kapda and makan, I think health insurance has become something which is absolutely a necessity, and it's for all segments of the society. I think when people are trying to buy health insurance, they have to evaluate maybe three items which they should consider. Which city are they living in? And we are very happy to tell that we are seeing people now buying higher limits of health insurance itself in the bigger cities, especially where earlier 5 lakhs or 10 lakhs was a norm. We are seeing now coverages going up to 50 lakhs and 1 crore even. And, the cost of treatments in the larger cities are obviously higher. And so people are recognizing that and buying those kind of products. But most importantly, as you mentioned, the penetration of insurance in India is still very low. And people who have health insurance also need to evaluate what is their coverage. And almost all companies today offer various add-on products where they can bring their coverage up to the current market standards, whether it is in consumables or in robotic surgeries and so on and so forth. So not only while buying a new product, the consumer should evaluate which is the best of benefit for them, but also existing consumers of health insurance should continuously evaluate their coverage according to their lifestyle and their current stage in life, and move the coverage higher and higher, which insurance companies do allow as well.
Saraveer, I want to come to you, and this is on an age-old problem that we are speaking about, that is awareness. Do you think even today that remains to be a single largest deterrent which comes in the way of people taking the step towards buying a health insurance policy, towards buying a term insurance policy?
So I think, yes, there are, I would say the glass is half full, as in most things in life. So on one hand, in health insurance, we find that awareness now is quite high. So over 80% of people say that they are aware about health insurance. Now, that's the good news. The not so good news is that only 20% people actually buy. So the gap between awareness and action is still very, very high in the case of health insurance. In the case of term insurance, unfortunately, even the awareness is very low. Less than half the people actually understand what term insurance means. And then of those 45-50% people who are aware, only 10% people are buying. So I think in term insurance, our job is very well cut out, that we need to promote awareness also about the product, about the fact that you can pay X and you can get up to 500 times the premium that you are paying. I think the one thing that the industry needs to move, see, we focus a lot on products. We talk a lot about features, this thing, that thing. But consumers don't think like that. Consumers, as a consumer, I like to think in terms of stories. If you explain to me what happens, who has benefited from this thing versus, someone who has not benefited, those are the stories that I think we as an industry must tell more often. That what are the benefits of having the insurance, who benefited, so that I can also identify with that person. I think the second thing, which again the industry has been on this path, but we need to do more of, is simplification. I think products should not be made more complex. I think products need to be made more simple, and they should be very straightforward, that you will pay this, these are the conditions, and you will get this. And I think the third thing which we all always have to do is to make the process of claims, etc., again simple, and in my opinion, sometimes we can make it just transparent. many times if you can explain to people what happened and why it happened, I think that helps a lot, and it just builds trust. See, insurance is a business of trust. We need to build trust in the product, in the process, and the more we can do about that through stories, I think the better off we'll be.
Anand, I want to come to you with a very interesting finding from Policy Bazaar survey also in terms of how India buys insurance 2.0. I was reading it in the report that just about 28% of the respondents ranked health insurance above equities, mutual funds and government bonds. What would you say, how dire is the situation when you read something like this? And how can it be changed in terms of awareness and people understanding what health insurance policy does and how important it can get?
Yes, I think as Sarabjit mentioned, the awareness factor has been quite high as far as health insurance is concerned, especially after COVID. People do understand the need for health insurance, and the unfortunate situation is that typical, tendency is that nothing is going to happen to me. Things may happen to my neighbor or my friend, but nothing's going to happen to me. And then the reason why you buy insurance is to save yourself from some kind of unfortunate incident in the future. And health insurance has to be purchased when people are otherwise healthy and not when an incident happens. So I think that kind of mentality does exist, but over time, and I think over communication by all insurance companies, all stakeholders, I think this is changing. And I would say that we are seeing that health insurance has already become the largest segment in the general insurance industry. It is also the fastest growing. Partners like Policy Bazaar have also contributed significantly to make this happen.
Coming to you, Venki, and a large space, term life insurance, to be honest, very, not so well understood even today by policyholders. And I think that's the reason why we still point out many problems here. What are the big problems here when it comes to term life insurance? A completely different ballgame. And how is the industry thinking about addressing those problems?
Yeah, I think the point about awareness has been very clearly put forth. One other thing on awareness I see is, in our industry there's a large value of claim that is still unpaid. People who have policies maybe have not spoken to the nominees honestly about the policies. So these claims are also, lying without getting paid. The other thing is we all over time, during the early years of life, invest for anything that has a benefit for the person also. We think about family, legacy, etc. usually later on in life. And term life is all about leaving something for your family. I think data on health records or income documentation to make the process more seamless would be according to me some choke points. So I think we have a long way to go, and the effort is well and truly on.
Saravi, to end the first part of the discussion on the survey, on the report which Policy Bazaar has released, according to you, single largest problem in terms of findings of the survey that comes in the way of adoption of health insurance and life insurance? And let's end this discussion on a positive note. What is the single largest encouraging thing that the survey throws up in terms of, which gives you a lot of optimism for the next 10 years in terms of insurance in India and for the goal of insurance for all by 2047?
Yeah, so I think, Yash, the first part is that there is awareness in health insurance. We need action, right? So the awareness to action gap is high. We need to do that in health. In term insurance, we need to improve both. The single biggest reason I feel the barrier, if you think about it from the survey, is that people underestimate the cost of not having insurance. So I think that lack of awareness is the single biggest, awareness of your financial outcome is the single biggest challenge. The positive side, like you said, is the fact that people who have got claims, as those stories spread, people are able to appreciate the value of insurance. What we have seen is once you've got a claim, you really value the insurance. And I think as we go forward, that gives me a lot of hope. The industry is very focused on paying claims. And as those, people, positive examples spread through and we can tell more stories, then I think we will be in good shape.
Well, I guess that's the perfect, conclusion when it comes to the first segment of this discussion on the Policy Bazaar Insurance Show. On the other side of this very short break, we discuss something which bothered me about, what happened to a policyholder very recently I came across, and, what are the do's and don'ts in terms of ensuring that this unfortunate incident does not happen to you? We discuss all of that on the other side of this very short break.
CNBC-TV18, the Policy Bazaar Insurance Show. CNBC-TV18, the Policy Bazaar Insurance Show.
Hello and welcome to the Policy Bazaar Insurance Show. Now, as promised in the first segment, we discuss this very unfortunate incident. Just last month, I came across an insurance accident. A 67-year-old lady was missold 61 life insurance policies. This was sold through 6 life insurance companies within a period of 5 years. Now, this had some ULIP policies, some long-term policies, all of which practically had nothing to do with what the individual required. This was all done by the lady's relationship manager, who first gained her trust and then, despite the insured's denial to have any insurance policy with any kind of lock-in, sold her exactly that. The relationship manager went to the extent of forging signatures to sell more insurance policies, and when the cover was finally blown, she had already left her financial planning firm and fled the country. Now, fortunately, all life insurance companies, acknowledging this as a case of mis-selling, returned the premium which was paid by this individual. But there's a lot to learn and understand here for policyholders who let their financial planner take decisions for their investments. Not saying that there's anything wrong to have a financial planner through whom you plan your finances, but all I'm saying is that it is very important for you to acknowledge your role, understand what should you cross-check, what should you understand, and what should you let the financial planner decide. Venki, as I said, I mean, when you hear such stories, it does create a lot of deficit in your mind. Though here it wasn't the insurance companies, but at the end of it, a part of the ecosystem which sort of left you in distress. According to you, in a situation like this where you have a financial planner, you yourself are not being able to plan your investments, your insurance, your personal finance needs, what should an individual be careful of not taking those things lightly when somebody is taking the decision on your behalf?
Let me, yes, firstly acknowledge insurance products are slightly complex, right? And the responsibility lies with A, the insurance companies, of course, and B, the advisors as well. In some distribution, in some parts of our distribution, we are very clear to not be selling investment-linked policies to people who are age 60 years and above. And for such senior citizens, the onboarding process becomes one where on a video we have the policy features being validated, spoken about, recertified, okay, reconfirmed before being issued as a case. It's important. So, and then comes the responsibility on part of the customer as well. Now, insurance policies come with a 30-day free look period during when the terms and conditions of the policy can be re-looked at, and then the decision can be made against continuing with the policy or not. But I think it's not, while it, like you rightly said, it's good to be trusting your financial advisors, but it's always, each time you sign a check, look at the fine print, see what the documentation is saying. On our part, I think the need to simplify all of this is definitely there. One idea that we at Tata AI are going to be doing is like in airlines, where you have a list of items that are not supposed to be carried. We are talking about features that the policy is not going to be covering, more importantly, than the long list that it covers, because people do not go through that long list.
Sarabhi, to you, like we say, do not share your OTP with any unknown individual, right? What is that one complete no that you should be careful of as policyholders when trusting someone with your decision to buy a policy or a financial product?
So, yes, I'll just make it 2-3 points. I think the first thing, as Venki also explained, is that whoever may be suggesting the policy to you, do your own research. It is not very hard in today's day and age. There are platforms like Policy Bazaar. There are other platforms where you can go and just research. You don't need to, buy, but you need to research. Second thing I would say is that if something is too good to be true, then it's most probably false. Third thing I would say, buy from an advisor who is licensed. There are regulated intermediaries directly from insurance companies you can buy. So, I think both you should be the advisor should be trustworthy. Then good news is that the regulator has thought a lot about customer protection. So, when you get the policy, you can check the policy. Now, there is a CIS, which is a customer information sheet, where you can see the salient features of the policy. So, you can again check against what you understood versus what is written over there. And finally, there is a free look period. The free look period has now been extended to 30 days. So, within 30 days, you can cancel the policy, no questions asked, you can get your money back. If one thing I would just advise consumers, if something is too good to be true, don't believe it. All financial products have a risk return spectrum. Long-term products will take time before they deliver returns to you. So, just be wary of that, of buying something which sounds too good.
Anand, final question to you. What are certain red flags that individual companies should place within the system when something like this is happening? How do you reach out to the individual directly and at least inform them, get a consent from them and a reconfirmation whether they are giving consent to the financial advisor to take any particular decision which is termed as a red flag for the insurer? How should that practice evolve amongst insurance companies and within insurance companies?
Yeah, absolutely, Yash. I think, mis-selling and some amount of suppression is a constant issue in this industry, and I think that has to be solved through technology. Just like when one is visiting a doctor, one intends to disclose every health parameter which one has. Similarly, when buying a health insurance plan, it would be ideal if the consumer can disclose all kind of health related issues he or she or the family members have. And do not leave it to the distributor or the advisor to fill in the proposal forms. Please do fill up the proposal forms personally and sign them yourselves. And on the policyholders' protection, the regulator has done multiple things in the last couple of years, and I think that just goes to strengthen the ecosystem, where consumers should check once they receive the policies and the customer information sheet that whether everything has been properly understood. And also in health insurance, there is this concept of pre-existing ailments. So if the pre-existing ailments disclosed by the consumer has been captured in the policy or not, these are some of the small checks that has to be done while buying this product, so that at the time of claim, there is a good experience and there is no to and fro. I think this is something which is very critical and is a very important thing for everyone to understand. Yeah.
It's been a good episode today. We've spoken about what is India thinking when it comes to insurance, in terms of buying, in terms of not buying, in terms of what should be done to get an individual to the doorstep of the insurance company and make him buy the right product. Also, we've spoken about what should you do if somebody is taking the decision on your behalf when it comes to your financial investments. What are the do's, what are the don'ts, and how to protect yourself in such situations. But with that, it's curtains down on this episode. We will return with another interesting topic, another interesting set of guests from the industry to break that down for you, our policyholders. Till then, stay safe, stay insured.
CNBC-TV18, the Policy Bazaar Insurance Show.
Presented by Policy Bazaar.
Hello, welcome to News Center. I'm Parikshit Luthra. India continues to turn the screws on Pakistan weeks after tensions between two nations flared up on the back of the Pahalgam terror attack. India has already downgraded its diplomatic ties and cancelled all kinds of visas. The Atari border, the only land trade crossing between the two nations, has already been shut down. Over the weekend, India announced a full trade ban on goods originating from or routed through Pakistan. Pakistani ships have been banned from entering Indian ports. India is also evaluating its defense options. Prime Minister Modi reportedly met the Air Force and Navy chiefs over the weekend. That's not all. India is also gearing up for water wars with Pakistan. The decades-old Indus Water Treaty has been suspended. Government sources have said that authorities have emptied the Bagliar Dam reservoir on Chenab River and closed down the gates. They claim that water from the Chenab River will not flow into Pakistan's Punjab province via the dam till India refills the reservoir. Global ratings agency Moody's has warned that escalating tensions between the nations could put a strain on Pakistan's economy. In a note, Moody's said that sustained escalations in tensions with India would weigh on Pakistan's growth and hamper the government's ongoing fiscal consolidation efforts. We have with us former Indus Commissioner for Indus Water Treaty, P.K. Saxena. Mr. Saxena, how do you see this move to restrict the flow of water, that we are stopping the flow of water through the Chenab to Pakistan?
Yes, the government has actually undertaken the flushing of the reservoir of Bagliar Dam and Salal Dam. So in this particular process, we empty the dam and then start filling it again. So till that time it is filled, there will be no water downstream of the dam. This is what we are undertaking. This was prohibited in the treaty. Under the treaty, we can only refill during the month of August or so. But once the treaty has gone, we can start filling even now. So for till that time, for next maybe around 10 to 15 days or maybe even more depending on the flow, there will be no water downstream of our dam. And as a result of which the sowing in Pakistan, which is undergoing, will be badly affected.
Right. So currently we can say that the flushing process began over the weekend and the reservoir right now, basically we are putting down gates over there so that the water cannot flow through the Chenab River. Is that what you're saying, sir?
Exactly.
Okay. What are the steps
that includes, fast tracking our projects? We have number of projects on Chenab. At least 3,000 megawatt of projects are under construction or under planning. So government is going to fast track that. This is point number one. And secondly, as I have mentioned just now, government has decided to flush the reservoirs. So next online maybe Kishanganga on Jhelum, we may be going to flush that also. So that will also affect the flush, these discharges downstream of Kishanganga badly. These are the immediate steps that we are undertaking. And you are already aware that data supply to Pakistan has already been stopped.
How do you think all these measures put together, some of these punitive measures, will hurt Pakistan's agricultural economy in the short run? And how long can this process continue? Till how long can we actually stop the flow of water to Pakistan? Or do you think it's only a temporary period till the reservoir is filled up?
Yes, this is a temporary period, but timing is more important. If you see, the flow may be stopped for 10-15 days, but these 10-15 days are very crucial for agriculture economy like Pakistan, because if they get the deficient water during this time, their agriculture production is going to affect badly. Maybe if we do that, say 1 month or 2 months from now, it may not be affecting them much. But present, the timing is very important. Government has chosen the time when it hurts the most.
All right, we've chosen a time that hurts us the most. Thank you very much, Mr. Saxena, for joining us with that important perspective. Let me also take this conversation forward because it's not just the Indus Water system. There are a series of actions that are being taken. We're joined by former Commerce Secretary Anup Vadhavan, former diplomat Ashok Sajjanar, Manjeet Kriplani of Gateway House. Thank you very much for joining us. Manjeet Kriplani, you heard the former Indus Waters Commissioner saying that we're taking a series of steps to hurt. Now, Gateway House has been talking about a sanctions policy, an India sanctions policy vis-a-vis Pakistan. Now that we've stopped trade, we've stopped postal services, shipping services, what more do you think can be done on the economic front?
First, the most important business element in Pakistan is the military, and it's called Milbus, the Milbus business. They occupy more than 50% of the Pakistani economy. So we have to target those entities directly, and it's everything, including cornflakes, that is called 4G cornflakes, that is made by the Pakistani military. Secondly, we have to stop everything that comes through Pakistan into the international supply chains. So India being a very large market, even international companies, should they have any element of Pakistani, say, cotton or Pakistani soya in their supply chain of goods, those should not be allowed to be sold in India. We must use the power of our market to use that to sanction Pakistan, because that will really create a problem. The army will be answerable to its people, and I don't think, it doesn't seem to me that they really thought that India would be capable of blocking the water and therefore holding up their harvest year, their sowing season.
Right. Let me also get in Mr. Vadhavan. Mr. Vadhavan, our trade with Pakistan is small. We're not dependent on Pakistan in any sort of a way. How does this measure? Would you call it symbolic, or do you feel that it will hurt the Pakistani economy to stop shipping lines, to stop postal services, to stop trade altogether?
Well, I think it certainly will impact the Pakistani economy. As you're saying, trade between us is minimal since 2019 when we put those 200% duties, and we are not really dependent on Pakistani goods and services to the extent, Pakistan has been dependent on imports from India. So certainly all these steps will impact the Pakistani economy, and perhaps, convey a lesson that, greater responsibility has to be shown by the army and all other players in ensuring peace at the border and ensuring India's security. Of course, there are, maybe conjectural or somewhat anecdotal stories of huge amount of smuggling that happens into Pakistan of Indian goods, and then, export from third countries. There's a Dubai channel. So, to the extent we can look into those channels and in a targeted manner block certain critical items that may be getting exported, that could be an additional step. But certainly, it's unfortunate that we have to resort to all this, but then an element of responsibility has to be shown by Pakistan that India's peace and security are extremely important, and without that, nothing else can work. No other aspect of the relationship, economic or cultural or whether it is sports, can be in place.
Right. Let me get in Ambassador Sajjanar. Ambassador Sajjanar, today there was a note from Moody's which said that escalating Pakistan-India tensions would weigh on Pakistan's growth. They went on to say that Pakistan is in the process of fiscal consolidation, and any kind of tensions or prolonged tensions, even if this eyeball-to-eyeball conflict continues, this would set back Pakistan's progress in achieving macroeconomic stability, and the macroeconomic conditions have been improving, and this would receive a setback. Do you feel that the economic measures that India is taking, also by restricting supply of water under the Indus Water Treaty, do you feel that this would serve India's purpose in the long run than any immediate military operation?
Thank you very much, Parikshit. I don't think that there is an either-or situation as far as this is concerned, that you take economic action and that is in lieu of any military action that you might be contemplating, or you take some diplomatic actions, and they might be painful that they are. I think the country wants retribution, the country wants retaliation, and the ghastly manner in which, this terrorist attack was affected, by singling out Hindu men from the crowd and butchering them mercilessly. I think the message has to go out very strong, in my view, in a disproportionate manner, so that Pakistan, for a long, long time doesn't ever contemplate. So, if it is just off on sort of, a situation where we act against them and then let it go so that it is allowed to recover, I don't think that is going to have much of an impact. We did do the, after the Uri, we did some surgical strikes. We hit out at Balakot in 2019 after Pulwama. I think this time it needs to be much more. Otherwise, this problem of terrorist actions from Pakistan will continue to haunt us. It happened in 26/11. After that, so many others, Pathankot, Uri, etc. So for how long can we, continue to deal with it by taking it on our chest, so to say, that, okay, we'll take some action, proportionate action. I think we'll really have to do something very significant. I think the Indus Water Treaty, putting it in abeyance, is a very significant step, because you see, after 1960, although it is now, 65 years, so many wars have taken place, so many terrorist actions have taken place, but we never really came down to putting it in abeyance or suspending it. We've done it today. I think that should give out a message, very clear message to Pakistan, particularly the Pakistan Army Chief, that this is, this action of theirs on the 22nd of April will not go unresponded. Parikshit.
Right. Manjeet, coming back to you, do you now see an actual shift in India's stand when it comes to taking action or retaliating against Pakistan? This time, the strategy seems to be more holistic. It's economic, it's diplomatic, it's military. And do you also feel that, as Ambassador Sajjanar is saying, we can only hope that this time the policy is more long-term and there is complete focus in implementing that policy, and that is India's foreign policy. That becomes India's foreign policy approach towards Pakistan. That's how we're going to treat them.
Well, one thing we've done this time is that, yes, India's very good at adopting asymmetric warfare. We did that with China during Galwan, and now we're doing it with Pakistan. This is asymmetric warfare. We've also stopped online, movies and shows coming in from Pakistan, the newspaper reports, etc. This is quite interesting. I think this is the first time we've brought in the technology and the online. So you're right, it is a whole of government approach. The one thing we have not done, Parikshit, is we are not able to win the public relations war. The Pakistanis are absolutely masterful at this. They know how to, they've been hard at work already in Washington and all the capitals, doing a war is us, what do we do to deserve it? This is not us, typical India. We really have to win the PR war, in addition to the asymmetric warfare and maybe some military action. I don't know whether we'll do it, but the asymmetric warfare should take care of it. We have to win the PR war, and unfortunately, that is not happening.
All right. We're going to take a short break at this point, but I'll request Mr. Vadhavan, Manjeet Kriplani, Ambassador Sajjanar to stay with us. We'll be right back. This discussion is getting very, very important, very interesting. We'll be right back with more.
this time of global uncertainty, Australians have chosen optimism and determination. Australians have chosen to face global challenges the Australian way, looking after each other while building for the future. Australians have chosen the Australian Labor Party as their government. And our government will choose the Australian way because we are proud of who we are and all that we have built together in this country. We do not need to beg or borrow or copy from anywhere else. We do not seek our inspiration overseas. We find it right here in our values and in our people.
Welcome back to News Centre. We still have with us former Commerce Secretary Anup Vadhavan, Manjeet Kriplani of Gateway House and former diplomat Ambassador Ashok Sajjanar. Mr. Vadhavan, let me ask you about how do you see Pakistan being hurt economically in terms of their growth, in terms of their plans over the next few years? Do you think the manner in which India is trying to isolate them economically and diplomatically is going to hurt them over the next 1 year or 2 years?
Yeah, you see, the Pakistani economy is already in shambles and has been in that shape for a long time now. Their balance of payments is under huge stress. They've borrowed money to, stay solvent in terms of their global obligations. So this will certainly, add to that. Although, as Ambassador Sajjanar said, I don't know whether this will be the tipping point which will make them see sense. I don't think that is going to happen. But the economic actions, we've taken will be a significant part of conveying the right message. But then you have to adopt a comprehensive approach. And I think we've adopted that this time. We brought in the river water aspect to it. We've brought in all the data flow aspects to it. And as Manjeet said, you need to win the PR war and go beyond that, win the diplomatic war in terms of, conveying all these facts to the global to the world and win their support. Ultimately, all these actions should, invite UN sanctions. They should invite, action from the world community coming together. So I think we need to go beyond the economic steps. Yeah.
The way US goes and imposes sanctions on nations such as Iran or Russia for that matter, can India work out a sanction strategy either alone unilaterally or in collaboration with some other nations? Is that going to work for India?
I can understand the difficulties in getting UN sanctions in place, but you can have a coalition of significant countries which can come together, and because India has always opposed sanctions outside the UN platform, but then you have to deal with situations that emerge, and you can have a coalition of countries which can come together and put appropriate pressure collectively, whether it is sanctions, whether it is threat of sanctions, or whether it is some selective economic actions taken by a group of countries which are like-minded, which are concerned about this. So all those options have to be explored. And I think it is something that can work. So I can see, a lot of support for India in terms of, people being very upset by these things.
Okay, let me get in Ambassador Sajjanhar. Ambassador Sajjanhar, what more do we need to do diplomatically? There are two guests on our panel today who are saying that we now need to win the PR war. What do we need to do in order to isolate Pakistan in the long term?
Yeah, I think that's a very important question, but let me sort of, respond to it in two ways. Number one is, the PR war is important. We need to reach out. We have good friends, in all the important places, US, France, Europe, etc., etc. I think we have a good understanding with them, so we can definitely get them on our side. But that having been said, a PR war, whether we are winning or not winning, that should not determine the course of action that we have to adopt. If we have to do something, we have to do something irrespective of the international support or not. And once we do it, the international support will be forthcoming. We shouldn't wait that, we are getting this international support, that's why we are going ahead. We are going ahead because we are the aggrieved party, we are the victimized party, so we have to sort of, get retribution as far as Pakistan is concerned, not because, the world is behind us, the world is egging us on, etc. The second thing is, as far as economic sanctions are concerned, I think there are other avenues also available. For instance, the FATF. We can go to the FATF. We have heard Khwaja Asif saying that, we've been supporting terrorism for the last 3 decades. Bilawal Bhutto has also come and said the same thing. Of course, everyone knows that Osama bin Laden was found there in Pakistan. So I think there is clear evidence, and here the manner in which, connecting what the Pakistan Army chief said and how the attack took place here within a week. He, I think, made the statement on 16th of April and 22nd April, this attack took place. So, there is definitely a connection. Also, I think as far as IMF disbursal of its loans is concerned. So I think there are other ways, Parikshit, that I would like to suggest, which we can take. We will not operate outside the UN system as such as far as sanctions are concerned. But there are other ways, I think, through the normal channels like FATF, IMF, etc., that we can go forward. Parikshit.
All right. We're also joined by Abhay Kumar Singh, former chairman and MD of NHPC. Mr. Singh, thank you very much for joining us. A lot of steps being undertaken as far as restricting the flow of the Indus Water river systems towards Pakistan. Almost on a daily basis, there are high-level meetings taking place. Two significant actions. We're talking about the Baglihar Dam and the action on Kishan Ganga, which may also happen. Give us a sense of the significance of what's happening at Baglihar Dam in terms of flushing the reservoir.
Good evening, everyone. Actually, for the Baglihar, the flushing, it's not only Baglihar, rather for all the projects like Salal also. And for many years, we have been unable to flush the water still during the monsoon period because it was not allowed during the treaty. And it has resulted a huge deposit of silt in the Salal river. That is also just reducing the life of the reservoir also. So now it is really free hand given to us for the Salal project or even the Baglihar to flush their water during the monsoon at the peak time when the discharge is more and the silt content is more. This will facilitate in increasing the life of the reservoir and the storage capacity as well. As far as the Kishan Ganga is concerned, it is an intervention project. We are putting water of Kishan Ganga through almost a 23-kilometer long headage tunnel in down near Badipura, and it goes to the Wooler Lake, then Dal Lake, then finally to the Jhelum. So that water is already put in some other river like Jhelum, and we allow, as per the treaty, minimum 9 cubic of water to Pakistan. That water can be totally closed, and that can be used for power generation and diverting of water from Kishan Ganga to Jhelum. And if you do like this, there will be no much water in Neelam because say around 5 to 6 kilometers downstream of Kishan Ganga, it enters into Pakistan, and that river calls Neelam in that area. So a lot of things are there, and I can say only one thing: the land is ours, water is ours, dam is ours. But the way they were behaving due to the treaty, they behave like a boss. So that thing is the first time that every engineer has got the free hand to do the flushing and regulate the water as per their will.
Right. That's an important point, sir. You were saying that the land and the water was ours, but Pakistan was behaving like a boss. My final question to you would be, in the long run, what are some of the infrastructural changes that we will have to make if we want to make a strategy to probably maximize the use of the Indus water rivers to India's advantage and also restrict supply to Pakistan?
Yes, because you see a number of projects are coming in the Chenab River, like Salkot, then Kirthai 2, Kirthai 1, and so this project we can redesign and put at the as a storage project. And at the same time, we need to develop some water conductor system for taking the water to the Punjab, Haryana, Delhi, or some other parts of the country. And that infrastructure, we have to make a DPR and start the work immediately so that we can take the water of this Chenab River. As far as this Rabi is concerned, you know, the Chenab comes from Himachal, and the two rivers like Chandra and Bhaga, it meets and then it's called Chenab, are entered into the JNK area. So we can take some water from one of the upper reaches project directly to the Rabi by making a tunnel of 3 to 4 kilometers. That water can be put in the Rabi river, which will further increase in hydrogenation in Chemera 1, Chemera 2, Chemera 3. And this water can be taken to the Ravi through the other parts of our country. So a lot of development can take place since the treaty was there. So we have not been allowed to make any DPR for the storage project. So now that it is open for us, and the country can go for a bigger dam, bigger reservoir, and take the water to other part of the country.
All right. Those are important points. Mr. Singh, thank you very much for joining us. I'd like to thank Ambassador Sajjanar, Manjeet Kriplani, Anup Udhavan for joining us on the program. So clearly, India exercising all options and now working with a long-term strategy against Pakistan. That's all we have time for here on the show. Goodbye and thanks for watching.
Obviously, the immediate focus is on this global economic uncertainty, particularly the US and China part of that and what it means for us. And so I was able to be briefed on that, what's happening in markets and what it means for the Australian economy. So clearly that's the immediate focus. And again, I think one of the reasons why we got this big majority last night is because people recognised that if you wanted stability while the global economy was going crazy, then a majority Labor government was the best way to deliver that.
are committed to take firm and decisive action against terrorists and those who support them. We thank Angola for their support in our fight against cross-border terrorism.
Angola foi das primeiras a reagir.
Angola was one of the first countries to react after the sad events that happened in Kashmir region, killing
Let's talk money.
Hello and welcome to a brand new edition of Let's Talk Money. I'm your host Surabhi Upadhyay. FY26 has brought with it several tax changes. Yes, this is the new financial year, and the biggest of these tax changes is the huge sweetener in the new income tax regime that has been offered this year. Now, this, along with major capital gains tax changes that were announced in the July budget in July 2024, mean that you need to look at your financial planning with perhaps a new sharp tax lens. To help us do this, we have with us today Mayur Shah of EY India and Mohit Gang of Moneyfront. Gentlemen, thank you so much for joining in. Great to have both of you on. So I thought it's a good idea to, get the house rules out on the table so we know. Of course, tax, all experts will tell us. I'm sure, Mohit, you'll agree, right? Tax is not the only reason we decide where to invest and how to invest. But it's a very important part. We can't ignore it either. So welcome to the show. Mayur, first thoughts.
Thank you. Thank you so much for this. And yes, you are right. Absolutely right. When we are really looking at it, we should look at net return which a person gets, return on investment. And especially when you are looking at, say, something which is getting taxed at regular rate, something which is getting at a concessional rate tax, then, the difference, the value, our money in the pocket is much larger than what we expect. So therefore, I think tax will also play an important role.
Absolutely. Mohit, smart tax planning. And this year, the finance minister has told us that if you're in the new tax regime, you can save up to 1 lakh rupees. So what do you think? Is this 1 lakh going in investments? Where should it go? Or should it go in spending?
Thank you very much, Surbhi. Look, I think I'm a firm believer that all that you earn should not be put to savings. Some things should be actually spent in a wise manner, spent for your personal necessities, spent for your experiences in life. So, of course, by all means, save much more than what you were saving previously. But yes, I think some portion has to be spent also, and that has a different kicker and a different multiplier for economy.
Oh, absolutely. All right, so get your paper and pens out, or your tablets or your digital devices out to take notes, because this is Tax Planning 101. Mayur, my first question to you is going to be, we need to understand and illustrate what this means. Because one thing we know is now that if you have income of up to 12 lakh rupees, you don't have to pay income tax thanks to the rebate in the new regime, right? And also what the finance minister said, that you end up saving 1 lakh rupees. So just do the math for us, help us understand, how do we arrive at this? What is happening in the new regime?
Yeah, so what happens is that when income is up to 12 lakhs, probably you will calculate tax, but then you will claim rebate as a benefit. And therefore, effectively, you will land up paying no tax on that income. Okay. And that's where, you will be saving up to 1.5 lakh just because, your income is above approximately 12 lakhs.
So the rebate is 60,000 in the new regime now. And that's why you don't have any tax liability.
So this is rebate from income itself. So if your income is up to 12 lakhs, 7 lakhs is what you get additional rebate. And as a result, your income tax really goes to zero.
Okay. So that's how it is. And what about this 1 lakh rupee saving? I mean, is it for all taxpayers? Anybody with income above 12 lakhs? But how do we arrive at this number?
Correct. So what happens is that what has happened, that if you look at slabs, which was earlier, which was moving up to every 3 lakhs. And now it has changed to 4 lakhs. Earlier it was ending, so maximum marginal rate came at 15 lakhs. But now it is coming at 24 lakhs. Right. As a result, the slab benefit has increased a lot and new rates has been added. Sure. As a result, you will be able to save around 1,43,000. And this applies across the board. It does not mean that it is only for the low income or high income or middle income. It is for everyone.
Everybody ends up saving a minimum of 1 lakh rupees.
Absolutely, because of the slab change.
Because of the slab changes. Got that point. So we'll come down to the math in just a minute. But Mohit, I remember when the budget was announced, I remember doing conversations and shows on this. So the rough rule of thumb that was coming out was that if your total deductions are very high, I think if they're higher than say 8 lakhs or 9 lakhs, maybe you're still better in the old regime. But what did the numbers throw up for you?
Yeah, I think, Surbhi, there are certain calculators which are floating across all the social media handles, and I'll just give you a rough texture and flavor of this. So my sense is if you earn up to 12 lakhs, then you are better off, always better off in the new regime. If you earn anywhere upwards of 13 odd lakhs, and then the number changes every lakh onwards. If you're earning upwards of 13 odd lakhs, and if you are claiming deductions of around 4.44 lakhs or anything higher than 4.4 lakhs, then you might perhaps still want to be in the old regime. But if you don't have deductions totaling up to 4.5 lakhs, then you might want to take a switch to the new regime, and new regime will actually work better for you. The moment you go upwards on the salary band, which is from 13, you move to 14, 15, so on and so forth. This band of deductions, which is for 4.44 or something, will keep moving up a little. It will go up to, let's say, around 5 lakhs, 25 or 1,000 if you're earning 20 odd lakhs.
Okay. I think we.
So yes, a short answer to your question is be in the new regime if you can't claim deductions more than 4.5 lakhs.
Got that point, and which is why, viewers, please note that whatever deductions you are claiming, that becomes the single biggest reason that will determine whether the old regime is better for you or the new regime is better for you. Mayur, now let's take this with an example. I want to take an example. We've got some numbers on the screen as well. Let's assume someone has 30 lakhs of income.
Correct.
Now let's take different scenarios with low deduction, medium deduction, very high deductions. How does the comparison change between old and new?
Sure. So as rightly pointed out by Mohit, what happens? It's a combination of level of income and level of deductions which you intend to claim. Basis which whether new regime is better or old regime. Let's take an example, as you rightly said, let's take an example of 30 lakhs. And if my deduction is 2.5 lakh, the total tax liability which needs to be paid under old regime is around 6 lakh 63. But if we look at new regime, then it will come to 475, whereby you are saving around 1,87,000.
So if your deductions are as low, we have the numbers on the screen. If your deductions, you can see the table there. If your deductions are as low as just 2.5 lakhs on an income of 30 lakhs, then you are definitely better off in the new tax regime. Now let's move on. Let's talk about someone who has higher deductions than 2.5 lakhs.
Let's say that 30 lakhs is the income and the deduction is around 8.5 lakh. Then I think it will be neutral whether you follow old regime or new regime. Okay. Then the dependence is are there any other additional advantage which you are able to claim if you are going in the old regime? The advantage is that if you have any carry forward losses, then you will be able to carry forward if you are following old regime. Then your dependency will be based on what other additional thing which otherwise I would have lost if I would have gone with the new regime. So those aspects needs to be considered to arrive at whether I should go with the old regime or new regime.
Okay, so this is really important. Now what you see on the screen is extremely clear that if, again, 30 lakh rupees is the income level we have assumed, if the deductions are as much as 8.5 lakh rupees, then both the regimes are the same, old and new. But old may still be better because you can claim certain set off of losses, etc., certain other deductions. Got that point. So is there any scenario in which the old regime is still beneficial versus the new regime?
Correct. See, old regime would be beneficial where deduction is below 8.5 or when it is 8.5. So if 8.5 is a break-even deduction, in that situation, if you have say house property losses which you need to carry it forward, then all this will be beneficial to follow old regime. But otherwise, new regime is better.
Now let's talk about someone who has even higher deductions. 10 lakhs as deductions.
Correct. Then the old regime becomes very easy.
Okay.
So I think I would like to correct what I have said in past, that when the deduction is lower, new regime is better, but when deduction is higher, the old regime is much better in those situations.
Got that. So that's the thumb rule. Higher your deductions, maybe there are chances that the old regime is still suitable for you. But if you have very low deductions and exemptions that you're claiming, then just move to the new regime, which then brings me to the point we need to quickly recap. What are these deductions? How does someone claim as much as 10 lakhs or 8 lakhs as deductions if you count all the chapters?
Correct. So, the deductions are multiple. I mean, for salaried employee, the biggest one is house rent allowance. So when a person is paying rent, HRA seems to be exempted. That is the biggest one. Then, we look at, leave travel assistance which is being provided, which can be claimed as an exempt. Along with that, especially technology persons, when they travel, they don't get a reimbursement of the expenditure incurred. But what they get is per diem allowance. And if they follow new regime, then exemption of per diem allowance is not applicable. And therefore, they tend to lose a lot of value there. So you need to consider even that as well. Apart from them, income from, losses from house property.
Like you explained,
Yeah. So that's another one which you are likely to lose. So if I'm not a salaried employee and if I'm having a business, then I may tend to lose depreciations or carry forward of depreciations. And so likewise, I don't get deductions under Chapter 6A as well. Which is, insurance premium or PF contribution or PPF contribution.
The lovely 80C, which is 1.5 lakhs of, deductions that we get there.
Absolutely. Apart from that, what you also don't get is that premium paid for medical insurance.
Yeah, 80D, Section 80D. So you don't get that in the new regime.
And any donations, charitable, or any philanthropic activity which you have done, you don't get deductions for that either.
Sure. So, well, that's the rule of thumb. Keep this in mind. Look at all the deductions you can claim very, very carefully. Total all of them up. And HRA would be a big component of that if you're living on rent. And then do the math and decide whether the old may still be better in some cases. All right, we have to take a very quick break on that note. We'll come back on the other side. Now that we've understood the income tax part of it, the question is, what about investments this year? How have tax rules changed? Where should we invest? What is tax effective and what is not? Back with that in just a bit.
Let's talk money.
And in due time, the Angolan authorities sent to the Indian people and authorities the heartfelt condolences due to that event of terrorism. And terrorism is something that Angola condemns wherever it happens, no matter where it happens, but Angola does condemn.
Terrorismo e Angola, obviamente, que condena qualquer tipo de terrorismo, não importa onde ele seja cometido.
Let's talk money.
Welcome back. You're with us on Let's Talk Money, and this week we are talking taxes. It is the new financial year. April has just gotten over, and we need to understand if we've chosen the right income tax regime and if we're planning our investments in a tax-efficient manner. Mohit, I'm going to come to you on this one. Now, pure equity is fine. I mean, we were all living with it, dealing with it. That long-term capital gains is not 10%. It's 12.5%. My question to you really is that, and this is a year where equity markets have been very volatile, right? So people will look beyond equities to diversify their portfolios. So when we get to the hybrid fund category or things like maybe REITs or InvITs, things to diversify, which of these options looks a bit tax efficient to you?
Absolutely. I think, Surabhi, this budget actually has ushered a lot of good news for investors in multiple categories of mutual funds. So if I were to just point out a few categories which have really benefited, I think the number one category and which is shining the brightest is gold, silver, the commodities category. Previously, the taxation out there was not as favorable. It was long-term was defined as 3 years. Now the long-term has been redefined as 2 years. And the long-term capital gains is 12.5%. Obviously, there is no indexation any further, but 12.5% after 2 years is a pretty good and a pretty neat deal for anyone who is willing to invest in commodities. So that's, to my mind, the biggest advantage. The second biggest category is the international funds category. There's a lot of interest, a lot of money which has been of late going into US funds, other, let's say, global funds, global themes. So those were all taxed like your debt funds previously. But now again, on those international fund of funds and international funds, the taxation is very clear. Long term has been defined as 2 years and the taxation is 12.5% out there. And similarly, fund of funds category is also something which is benefited and the taxation is same as gold and international funds on that.
So let me ask you this, that's the tax part of it, right? That this is where these categories have become tax efficient. But now also let's, add the investment advice to it. International funds, and not too many are open right now for investing. Gold, after a huge 40% run, is it still advisable? Would you look at these categories for investments this year?
So that's a tricky one, honestly. I think, look, as a diversification tool, both international and gold, I think always merits an allocation in any kind of portfolio. Whether that allocation is 10% to international and 10% to gold, or 10% to international and 20% to gold, silver put together, I think that will completely depend on the nature of the investor, his appetite, risk appetite, and few other parameters. But my sense is, as a portfolio asset allocation, these are core parts and cannot be missed. One needs to have it. However, at this juncture, would I advise anyone to invest more in gold and go over allocate out there? Honestly, not. I think it's not the time to over allocate into commodities right now. Perhaps if you're sitting on some allocation, yes, make the most of it. But it's not the time to add further at these levels. And if you are any which way is over allocated as per your asset allocation, then you might just look at taking something off the table as well.
Okay, all right. So don't get carried away in the gold rush. That's the advice coming in from Mohit. Though there are people out there on the street, targets are ranging up to $4,000 in gold. But that's a debate for another time. Mohit, now back to this whole question of fixed income or hybrid funds or arbitrage funds. I'm going back to the point of asset class diversification. We can't have only equities in our portfolio. We've discussed gold, we've discussed foreign funds or global funds. How to take tax-efficient fixed income sort of exposure in the portfolio?
So honestly, I think finding a tax-efficient fixed income mutual fund option is like finding a needle in a haystack. But you have few needles out there if you are like really keen to find one. So I think there's this new category which is ushered in, which is called income plus arbitrage category. I think the category very smartly plays around 35+% composition into arbitrage, and the remaining portion is treated is into fixed income investments, which could be short maturity fixed income papers or long maturity fixed income papers. All fund houses have their own modus operandi to deal with the fixed income paper. But that category effectively gives you a 2-year long-term capital gain taxation, which is 12.5%, and absolves you from the fixed income taxation, which is at your slab rate. So that's one category. The second category, which is not exactly fixed income by definition, but the return profile is fixed income and the safety profile is also closer to fixed income, is arbitrage category, which has been extremely popular of late, and that gives you a proper equity taxation, which is 1 year long-term capital gains at 12.5%. And the third category is equity savings category, which is a composition of arbitrage plus naked equity in the portfolio. Again, will give you a pure equity taxation in the portfolio. So yes, in pecking order, pure fixed income, then you go with income plus arbitrage category, and otherwise you have arbitrage and the equity savings categories.
Okay, great. So those are some examples of maybe some fixed income funds which are not entirely, taxing, so to speak, on our returns and our investments. But otherwise, Mayur, do you want to add to that on fixed income or quasi-fixed income plays? Some people say REITs are like quasi-fixed income, steady income generating plays. So maybe not pure debt. I'm not saying FD or strict fixed income fund, but anything else, stable, safe, and where tax will not bite too much.
Yeah, so if you look at AIF investment in category 1, category 2 are completely tax free in that sense. So there is no tax incident on the earner, the investors. So if you are investing which has such kind of benefit, then definitely you can really look at, because that is purely tax efficient. The reason for that is tax is paid by the fund itself. So there is no tax which has to be paid by the investor then. If you look at category 3, it's a flow through. There also you will have advantage of whatever is being earned by the fund.
Yeah.
So there by default you get advantage because taxation is only at a one stage, then multiple stage.
But
so
you have to invest in big ticket sizes.
That's right.
Minimum threshold I think is 10 lakhs or higher, much higher for many of these funds, right?
That's right.
But that's where the tax advantages are. So for the HNI, ultra HNI or the affluent category, they could be considered.
Absolutely.
So we've covered a lot of asset classes. This has been a breathtaking rush. We've done equities, fixed income, we've done gold, real estate very, very carefully. Because even in real estate, Mayur, last couple of years, we've seen changes. I think even that reinvestment, if you're selling your house, I think you can now split it across 2 properties, house properties, if I'm remembering correctly. So just again, revisit for us, from a tax perspective, if I want to buy a house this year, is there anything new? I don't think there is. And if I want to sell a house or sell a house property, then how can I plan it effectively?
So when you are selling a house, if it's a long term, there are 2 things. One, with indexation, you want to consider in that situation, you will the tax will have to be paid at the rate of 20%. But because of indexation, if you are suffering any losses, that will not be allowed to be carried forward.
Okay.
And that will be foregone then. But if you are if you are getting tax at 12.5%, then there is no challenge.
Okay.
Now, how do you really save tax when you have sold one property? If the entire gain is reinvested.
And before we talk about that, I just want to, because there was a lot of debate when this was announced, whether you pick 12.5% without indexation or 20% with indexation. Again, what is the final thumb rule that the calculations showed up? When should you consider 20% with indexation and when is 12.5% better? Is there some math to it?
So it's still an iteration process as of today also, but there is some guidelines around it. And let me explain those guidelines. What happens is that if your gain is much bigger than the expected or inflation rates or in index number, in that situation, I think going for 12.5 without indexation is much better.
Okay.
But whereas if your a value increase is not much, then going with the old method is much better, where you will be not paying any taxes thereon, though the losses will not be allowed, but you will not be able you don't have to pay any tax thereon.
Okay.
It is like when we are looking at new regime, old regime, the same 2 rules will have to be applied here as well now.
Okay, got it. So that's the rough rule of thumb. But you were saying that if someone wants to save on these capital gains, they can reinvest the gains as well, right?
Correct.
What are the options there?
So there are 2 options. One is that either you invest gain in another property, and here I am talking about gain and not sales proceeds. But you can invest up to 10 CR and you will get the benefit in that.
Okay.
So if you are investing more than 10 CR, then you will not get proportionally, those benefits will get diluted.
Sure.
Now, when we are really looking at another thing is that you invest in infrastructure bonds. But the investment or gain in their sales proceed invested can be up to 50 lakhs.
Right.
And it does not offer larger advantage. Another disadvantage of that investment will get locked in for 5 years. Whereas in property, investment will get locked in for 3 years.
Okay.
So that is that is how you have to analyze. But more often than not, infrastructure bond does not give you good yield. And I'm sure Mohit will be able to answer that.
Okay. Mohit, so last word with you then. Now we've understood the full tax maths for this year, all the rates for this year. So any advice in terms of which asset classes look better, where to book some profit, where to keep, where to increase exposure in general, to wrap up?
Look, Surbhi, as long as real estate is considered, I'm a proponent of REITs and InvITs, and I think the taxation out there is also pretty favorable, which is 12.5% with a 24-month kind of an holding. So my sense is that's a 12-month kind of an holding at long term. So my sense is that's a great way to invest in real estate. But overall, I would still at the pecking order, in spite of the taxes going up from 10 to 12.5, I would still rate equity by far the most coveted asset class, and by far the one which should demand the highest proportionate allocation in any portfolio, followed of course by commodities and fixed income. Depends on the risk profile and the nature, and fixed income can be made tax efficient in a portfolio depending on the outlook of a portfolio, right? So there are multiple ways to do all this. So.
Fabulous, fabulous, gentlemen. I think this has been a very, very helpful refresher, a great crash course, stepping stone to how we can plan our investments and our sort of income streams better from a tax lens this year, FY26. Thank you so much for joining in. Great talking to both of you. Well, viewers, we hope you found this session useful. I certainly did. Keep sending us your feedback, queries, comments. See you next week with another theme.
Let's talk money.
Hello and welcome to Business 360. I'm Shireen Bhan. The top stories that we're tracking for you this evening. The Sensex and the Nifty ended the highest closing level in 2025 so far. Mid-caps outperformed the blue chips. Bank stocks underperformed. Brent crude briefly drops below $60 a barrel. OPEC nations decide to increase output much higher than market estimates. Oil prices now near their 4-year lows.
Heady trade deals calling this week. It could very well be. Can you tell us more about that? Nobody understands. We're negotiating with many countries, but at the end of this, I'll set my own deals.
President Trump hints that some trade agreements could be signed this week, but doesn't provide further details, says his main priority with China is to secure a fair deal. President Trump orders a 100% tariff on foreign-made movies, saying Hollywood is dying a very fast death. The move is likely to impact Indian films that release in the U.S. Filmmaker Shekhar Kapoor says the new tariffs may encourage Hollywood to move outside the U.S. M&M beats estimates in Q4. Strong tractor sales drive growth with margins hitting multi-year highs. Revenues up 25% thanks to healthy volumes and a boost from realization. Private banks post robust deposit growth of nearly 6% in Q4, outpacing PSU banks. Private banks also report strong margin expansion, even as SBI's margins contract. Government sources say authorities have emptied the Baglihar Dam reservoir on the Chenab River and closed the gates, claim that water from the Chenab River will not flow into Pakistan's Punjab province via the dam until India refills the reservoir, adds that similar steps may be taken on the Kishangang project on the Jhelum River. Israel's cabinet approved the plan to capture all of Gaza and remain there for an unspecified amount of time. The plan includes displacing thousands of Palestinians to southern Gaza. A 10-minute standing ovation for legendary investor Warren Buffett as he announces his retirement from Berkshire Hathaway at the age of 94. Longtime Berkshire executive Greg Abel will take the reins. Buffett promises he will not sell a single share in the company and will stay as chairman. Well, let's start with the market action for the day. No Monday blues on Dalal Street. The Sensex and the Nifty gaining in trade, ending at their highest level seen so far in 2025. Now, midcaps did outperform, and the midcap index was up by almost 2%. Banks today in the red, closing about 200 points lower. The Sensex up by almost 300 points and 114 points, or 0.5% higher on the Nifty. In the money market, the rupee gained over 33 paise. It continues to strengthen against the dollar. The rupee has been gaining steadily over the last few weeks after President Trump's tariffs led to a weakening of the US dollar. The 10-year bond prices have gained in trade and yields softened. That's the money market snapshot for you. And in the commodity market, gold prices also continue to gain on the back of a weak dollar. Prices of 24-carat gold surging by 220 rupees from its previous close in today's trade. And price of spot gold in the international market up marginally to $3,257 an ounce. Meanwhile, crude prices have eased. This after OPEC Plus agreed to surge production for the second month. The group has decided to boost output by over 400,000 barrels per day in June. Sudarshan is standing by now on what this could mean potentially for oil marketing companies. Sud.
So crude sensitive saw a big move on both these sides. So why there was a big fall in crude? Crude over the last 2 to 3 sessions has fallen nearly 6 to 7%, and today intraday has fallen to lowest level, almost lowest levels the last time that we saw in 2021. So why there was a big fall? So over the weekend, OPEC Plus, which is led by Saudi Arabia and Russia, have decided to increase the production, and the increase is higher than expected. So increase for the month of June would be of 4.11 lakh barrels per day. Now, following that, crude has fallen. Now, what impact it would have on all these companies? So first, talking about upstream companies like ONGC and Oil India. If there is a fall of $1 in crude, it impacts annual revenue in the range of rupees 300 to 400 crore for these two companies. Now coming how this impacts positively to downstream companies, or say oil marketing companies like IOC, BPCL and HPCL. So the fall of $1 in crude, it impacts positively to EBITDA in the range of rupees 200 to 300 crore for these downstream companies. Now last is why it's positive for paint company. So for paint companies, up to 50% of their input costs are linked to crude. So if there is a big fall in crude, it might have the positive impact, especially on the margin. So now the last question is, will there be a drop in retail fuel price after seeing a big fall that we have seen in crude? Last week, IOC in our interview had said that is very unlikely in near term.
As of now, consumers should not really expect some kind of a relief, so to speak. Am I right?
For the health of the companies, we have to hold on.
Well, that was last week. The chairman of Indian Oil Corporation saying that a fuel price cut was unlikely, but let's see how this plays itself out. Remember, it is, of course, a political call, finally. U.S. President Donald Trump hinting that some trade agreements could be signed this week, however, has not provided any details. In an interview to Fox News, Trump also ruled out the possibility of lowering tariffs on China to negotiate a trade deal. But he did add that securing a fair trade deal remained a main priority for him. While addressing reporters at Air Force One, Trump further said that he has no plans of speaking to Chinese President Xi Jinping, but negotiations are ongoing with U.S. officials. President Trump also said that the U.S. is having discussions with several countries, but a trade deal will be solely set on his terms. This comes just a day after the president said he won't be seeking a third term as U.S. president.
Well, you know, I want a fair deal with China, but China's been ripping us off for many years, so maybe something should be thought about. You know, a little bit of retribution. China's been ripping us off for many years, ever since they started. To me, I think it was the worst thing that Richard Nixon never did.
Is there enough?
And it was the worst thing. You know, he's the one that got it started. Nobody understands. We're negotiating with many countries. But at the end of this, I'll set my own deals because I set the deal. They don't set the deal. I set the deal. At some point in the next 2 weeks or 3 weeks, I'm going to be setting the deal. I'm going to say that such and such a country has had a tremendous trade surplus their way with us. They've taken advantage of us in various ways. And we fully understand what they were doing. We were being led by people that were not very smart. They were able to be taken advantage of, but I can't be taken advantage of. So at a certain point, I'll be just setting a certain tariff number.
Well, that's President Trump. Back home, Mahindra reporting a strong set of numbers in the fourth quarter, beating street estimates across most fronts. Net profit up nearly 20%. Revenue grew over 24% in the quarter. Tractor margins hitting multi-quarter highs, while healthy volumes have boosted overall revenue. The company's management says they expect mid to high teen growth for the SUV and EV segments in the current fiscal year. Private banks have continued to post robust deposit growth of nearly 6% in Q4, outpacing PSU banks. The banks also reported strong margin expansion, even as SBI's margins contracted. Abhishek is standing by with more on how banks fared in Q4. Abhishek.
Well, to begin with, large lenders have reported their Q4 FY25 performance. And if you take a look, at the comparison table, private banks have seen robust deposit growth on a sequential basis, anywhere between 5.5% to about 7% range. In fact, at a time, this has come in, at a time when deposit growth is a big concern in the industry. Seasonal in nature in Q4 for deposit growth to happen for SDFC Bank and Axis Bank. Now, SBI has seen the weakest deposit growth on a sequential basis at just 2.9% in Q4 FY25 amongst large banks. If you take a loan growth, and if you take a look at the loan mix, the corporate portfolio has actually been shunted down by private banks because of the unfavorable yields. That is what many managements have commented. So, the likes of ICICI Bank and Axis Bank and Kotak Mahindra Bank as well, they spoke that, unfavorable yields have led to corporate book not growing that much. On the other hand, if you take a look, SBI's corporate growth of 5.5%, that is corporate loan growth, has been one of the highest amongst all the large banks. Now, net interest margin has improved quarter on quarter for most of the banks, especially ICICI Bank and SDFC Bank. They have seen the highest sequential growth in their net interest margin. However, for SBI, it's actually shrunk by 1 basis point on a sequential basis. Now, operational efficiency was another area of focus. It's been the highest decline for SBI, their cost to income ratio declining by 184 basis points on a sequential basis. Axis Bank and Kotak Mahindra Bank actually saw an increase in their cost to income ratio. Meaningful part in any bank's result is the return ratios or ROA. So SBI saw a decline in its ROA, that is return on asset, on a sequential basis, while Axis Bank and ICICI Bank have seen the highest increase in their return on asset ratio on a sequential basis. If you take a look at the valuation picture with reference to price to book value, large banks like SDFC Bank, ICICI Bank on the private side trade between 2.7 to 2.9 times, while SBI is trading at 1.5 times price to book value on a 1 year forward basis. Back to you.
Abhishek, many thanks. That's the bank report card for you. Now, nearly 2 weeks after the Pahalgam terror attack, India has curbed the flow of water to Pakistan through the Chenab River. Sources say that authorities have emptied the Baglihar reservoir and shut the gates. India has already suspended the decades-old Indus Water Treaty with Pakistan. The Prime Minister met J&K Chief Minister Omar Abdullah over the weekend to discuss the situation in the Union Territory post the attack that claimed 26 lives. Meanwhile, Pakistan continues to violate the ceasefire along the line of control in Jammu and Kashmir for the 11th day. The Indian Army said it responded promptly and proportionately. Russian President Vladimir Putin called Prime Minister Modi and strongly condemned the Pahalgam terror attack. He emphasized that the perpetrators of the heinous attack and their supporters must be brought to justice. The United Nations Security Council is holding closed-door consultations after Pakistan urged a meeting on the rising tensions with India. Earlier, Pakistan's Prime Minister Shehbaz Sharif accused India of falsely attempting to link Islamabad to the Pahalgam attack and demanded a neutral probe into the incident. Parikshit standing by now with more. Parikshit, India has sent a water warning to Pakistan. Take us through what has been done.
Well, now India has started implementing its options as far as restricting or slowing down the flow of water to Pakistan is concerned. We suspended the Indus Water Treaty. That was the first step. Now we believe that the Indian government has halted the flow of water to Pakistan from Baglihar Dam on the Chenab River.
Right, Parikshit, unfortunately, there is a problem with the audio. We'll reconnect with you in just a second. We'll head into a break, but up next, President Trump orders a 100% tariff on foreign-made movies, saying Hollywood is dying very fast. The move is likely to impact Indian films that release in the US. A detailed report coming up.
Well, that's right. Let's talk about a little bit more about the FI flows, because it seems that the FIs, they are in love with India yet again. The last couple of months, they've been showing us some love, and that's encouraging, right? So just to rewind first, between October 2024 and February 2025, the FIs sold $26 billion. That's the kind of outflows that we saw. But in the last 2 months, we have seen some inflows. So in April, they pumped in close to around $230 million approximately. And, in March, that is, beg your pardon, $230 million. And they followed that up with close to around $1 billion in the month of April itself. Why is this important? Because the FI flows, they have turned positive for the first time in the secondary market. Remember, we are looking at these numbers as primary and secondary together. But in the secondary market, this was the first month that we had a buy number in the last 6 months. So 6 months of sell flows in the secondary market, and that turned into a buy.
Not just that, India was one of the only markets where you saw FI inflows. You just pull up some of the other markets, whether you pull up South Korea, Indonesia, Brazil, all of them saw outflows in the month of April. And India, well, we were the lone one in there, seeing $1 billion of inflows, so not a small amount coming in there. What are the factors that have played out? Why the FI is falling in love again? Well, in fact, a few factors have played out. One is their holding in the Indian markets had fallen to the lowest levels you've seen in the last many years. So earlier in January, it was down to around 17% approximately.
Nearly 2 weeks after the Pahalgam terror attack, India has curbed the flow of water to Pakistan through the Chenab River. Sources say that authorities have emptied the Baglihar Reservoir and shut the gates. India has already suspended the decades-old Indus Water Treaty with Pakistan. Parikshit is standing by to explain to us what exactly has been done. Parikshit, a water warning being sent out to Pakistan. Take us through what this means exactly.
Well, these were options on the table when India suspended cooperation under the Indus Water Treaty. India has now said that it will maximize the use of the Indus water system to its own advantage. It will construct dams wherever necessary. There will be some short-term measures and long-term measures. Among the short-term measures was restricting the water flow through the Baglihar Dam. Now, India has carried out a desilting process which is allowed under the Indus Water Treaty. We have flushed out the reservoir and we have put down the gates. Now, what this means is that the flow of water through the Chenab River into Pakistan's Punjab province will be reduced significantly. Now, there is a window till which this can happen. It remains to be seen what happens after that. But we're told that the Indian government is also considering doing the same at the Kishan Ganga Dam location. So these are measures that India is taking. We're still waiting for an official confirmation from the Indian government. There is another high-level meeting of the Indus Water Commissioners, the Jal Shakti Ministry, the Ministry of Home Affairs. In fact, all the actions around the Indus Water Treaty are being monitored very closely by Amit Shah and the Home Minister on a day-to-day basis.
Parikshit, many thanks for joining us. President Trump has said he will impose 100% tariffs on movies that are produced outside the US. Now, in a post on Truth Social, Trump said that the state of the American movie industry is in dire straits and dying a very fast death. Trump added that other nations are offering incentives to draw American filmmakers and studios away from America. He went as far as to call the crisis a national security threat. Now, Shilpa joins us with more on what this could potentially mean. Shilpa, President Trump turning his lens on films now, how is this likely to impact the Indian film industry?
Well, Shireen, as things stand, details remain very unclear, right? Whether the levy would be on production costs or on revenues, whether it would extend to both theatrical releases or streaming content. But Trump's announcement of plans to impose this 100% tariff on foreign-made films has already had the global industry talking. More importantly, Indian film producers that we've been talking to say that they're yet to get full clarity on what this could mean for their business models going forward. But one thing is clear, that the United States is a major overseas market for the Indian cinema. Industry insiders estimate that 30 to 40% of the overseas box office collections for Indian films come from the United States, and it is much higher for films in the South. For Telugu cinema in particular, the US is second only to Telangana in box office collections. Big budget films often collect up to a quarter of their total revenue just from the US markets, and here releases typically are spread across 700 to 800 locations nationwide, and on day one most of them are sold out. And titles like, if you see Bahubali 2, Kalki, Pathan, RRR, all of these have seen massive success, grossing anywhere between like 15 to 22 million each. And in 2024 alone, Indian films grossed roughly about 160 to 170 million at the US box office, and all of this could stand impacted. But the concern here also goes beyond box office numbers. If the new policy extends to streaming platforms also, that a possibility that hasn't been ruled out yet, industry insiders are saying that it could discourage platforms from, acquiring or commissioning Indian content aimed at the US viewers as well. And that could be a setback for the growing international footprint of the Indian cinema. Now, if you look at the broader context, Hollywood itself, that's grappling with rising production costs at home. In 2024 alone, US production spending stood at $14.5 billion, which is actually 26% down from 2022, as studios increasingly chose international international locations to for production like Canada, the UK and Australia, and all of these because they have been offering attractive tax incentives, and also local crew is more skilled. Now, the US Commerce Secretary Howard Lutnick had responded to Trump's post saying, "We're on it." So for now, studios and producers across the globe are waiting for further details on how and when the tariffs might be applied, and what categories of content it could fall under them, and what the potential impact could be. Back to you.
Yes, we're all waiting to hear more on the implications of this. Shilpa, many thanks for joining us. But here's the latest in the online gaming case, a matter that's being heard in the Supreme Court. The central government has told the court that it's not concerned if real money online gaming is classified as a game of skill or chance. The government argued that such a distinction is immaterial and the taxes will be paid equally on both. Ashmit standing by with the details. Ashmit, the government making it clear, skill or chance, it doesn't matter, 28% GST it is.
Indeed, no shifting there, no change of course. 28% levy is here to stay. That's the government's position. And this is important given as how the government is laying down the gauntlet. Bear in mind, this is the first detailed hearing that's taking place in the GST issue regarding online gaming companies. First time that we're seeing this before the highest court of the country. And here, the government's rationale is that, look, we understand, the government says we understand that there are games of chance, there are games of skill. The distinction, however, that the government is trying to draw is that irrespective of the games of chance or skill, when there's a money component involved, when there's staking, when there's wagering involved, that necessarily, irrespective of game of chance or skill, then translate into a case of gambling. So here, the government's rationale is that irrespective of the nature of the game involved, it is inconsequential when it comes to the computation of the GST demand. And this is where, in fact, we also have the Council for the Government draw the attention towards state-specific legislation, citing the example of Nagaland, saying that Nagaland is one state that makes a distinction, games of chance and skill, but even Nagaland, which protects games of skill, goes on to charge them, treat them as gambling when there's a case of money wagering. What is also important is that this is the first time that we've seen a direct position being taken by the government against fantasy gaming. Here, in fact, giving the analogy of the famous football player Messi, the Gaming Council, the Council for the Government went on to argue that there are bets, there's wagering done on how many goals Messi might score in a match, saying that there is absolutely no control. Any of the players have any control over how many goals Messi will score. And citing that as an example, said that even in case of fantasy gaming, even there, any money wagering will be classified as a case of gambling and therefore subject to the 28% GST levy. So clearly, just the day one of arguments, the arguments we understand will continue tomorrow as well. Another key question that the industry, however, will be watching for is whether or not this August 2023 amendment, which gave the clarification of the 28% levy, will it apply retrospectively? That's another question that many will be looking to answers for.
And that is an important question. Ashmit, appreciate you joining us. Air India's flight to Tel Aviv diverted to Abu Dhabi following the missile attack at the airport. The airline cancelled its flights till the 6th of May, and the suspension could now be expanded for a longer period. This disruption comes amidst an already tense airspace situation. For Indian carriers, as India and Pakistan continue to restrict each other's airspace, foreign airlines are also now growing cautious, increasingly avoiding Pakistan airspace. Let's go across to Madiha. She's standing by to take us through which airlines are now opting for longer alternative routes. So it's not just the Indian carriers, Madiha, even foreign airlines trying to avoid Pak airspace.
The impact of Pakistan's airspace closure isn't just limited to Indian airlines. Several foreign airlines are also choosing to avoid flying over Pakistan, even though the restriction officially applies only to Indian carriers. So as we have been reporting that international flights from North India are the most hit, as they now have to travel to Mumbai and Ahmedabad and then proceed to their journey. We learned from airport officials that Mumbai ATC is now handling nearly 135 more flights of Indian as well as foreign airlines ever since Pakistan closed its airspace. Many flights operated by foreign airlines like Lufthansa's Delhi-Frankfurt flight, British Airways' Delhi-London flight and Air France's Delhi-Paris flight have chosen the longer route, avoiding Pakistan airspace. There are others like Etihad's Delhi-Abu Dhabi and Oman Air's Lucknow-Muscat flight, sometimes avoiding the Pak airspace, meaning there are days when they fly over Pakistan and then there are days when they fly over Mumbai and Ahmedabad. Now, interestingly, not all foreign foreign airlines are avoiding Pakistan airspace. American Airlines, for instance, then United Airlines, KLM, these three airlines are mostly using the Pak airspace to enter India. So why are some foreign airlines taking the longer routes, even when they are allowed to use Pakistan's airspace? That's the question. So as expected, when we asked these airlines, they said this is a precautionary measure keeping in mind passenger safety. There are two main concerns behind this rerouting of flights. First, since tensions continue between India and Pakistan, any sudden retaliation from either side could leave these foreign airlines stranded in the sky if they don't have enough fuel to divert to another airport. And second, in case they are forced to do an emergency landing at a Pakistani airport, then that could jeopardize the security of Indian passport holders on board the flight and lead to a risky diplomatic problem. So to prevent these unwanted consequences, some foreign airlines that we mentioned have voluntarily decided to take a longer route for Indian flights, although it will have an impact on their cost of operations.
All right, Madhiya, appreciate you joining us. And with that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC-TV18. Stay tuned. We're back in a moment.
The weight on India, they're looking to turn that around. Trump's tariffs have taken center stage, but India's exports to the US account for just 2% of the GDP. So India is relatively, protected on that front. Next up, the economy is expected to grow at around 6.5% to around 7%. So that's encouraging, and it's a faster clip in comparison to other economies. And the Reserve Bank of India, what a beautiful job they've done, right? A perfect balancing act. Pivoting towards growth, they have infused some liquidity and taken care of the deficit situation that we had. And also they changed their stance. The Indian rupee, well, it's breached the 84-odd mark this week itself, so that as well was the outlier. And finally, earnings are expected to grow in double digits for the next few years. But you need to keep in mind that the first half of this fiscal itself could be a little bit subdued, just going by what we have seen.
The eternal bounce back, is the worst over or not? There are two things that play out for Eternal. The first part is the food delivery business that continues to slow down when it comes to the growth part. Quick commerce losses expand, and the company is cautious on competition. So if you look at the food delivery gross order value, over the last few quarters, it's been coming down, right? So look at Q4 FY24, it was 28.5%. It's come down all the way down to 16%. And this quarter, the most important part was it was not only down year on year, it was down quarter on quarter as well when it comes to growth. And quarter on quarter, there was a decline out there. And the company has given multiple explanations for that. They've said it's sluggish demand environment. There've been shortage of delivery partners. They've delisted about 19,000 restaurants this quarter. But most interestingly, they said cannibalization of restaurant delivery coming in from quick commerce. Why is that? Because if I can get something packaged in 10 minutes, why should I wait for 20, 25 minutes for it to be delivered to me from a restaurant? So that was something which I found very interesting. And because growth hasn't come by, the contribution margins also for the last couple of quarters have stayed stable. Now, here's what Zomato's thesis was. You grow the food delivery, which is a mature market. You expand its margins, use that cash to fund the losses on Blinkit and keep growing it. Well, that hasn't happened. Why do I say that? Because while Blinkit's gross order value has increased 134%, much higher than what the street was anticipating, quarter on quarter also it's up 21%, its losses have expanded and ballooned. Close to around 178 crore is the EBITDA loss on Blinkit, which was 103 crores in the third quarter, a negative 8 crore in the second quarter itself. It's ballooning. Why is it that it is ballooning? Because one, there is high competition. Secondly, the company...
Hello and welcome to Startup Street. I'm Ritu Singh and with me is Shruti Mishra. Here are the top headlines from the startup space. Battery tech startup Volt 14 secures $1.87 million in a pre-Series A round of funding led by Bloom Ventures with participation from Beyond Next Ventures, Spectrum Impact, Super Morpheus and previous investor Cocoon Capital. It is set to utilize the funds for scaling up manufacturing of its anodes and to strengthen the team.
LifeChart, a health tech startup focused on gut wellness, has raised $360,000 in an extended seed round for its gut health brand, Gutify, led by Prajay Advisors, the family office of the founders of Unichem Labs. The startup is aiming to bring precision diagnostics and targeted gut wellness to India's urban masses, starting with Tier 1 and Tier 2 cities.
Evara Cabs has initiated the possession of 500 electric cabs that were formerly operated by Blue Smart. This after Blue Smart suspended operations in key metros. With 220 vehicles already acquired, the remaining 180 sets will be reclaimed in the coming days.
The government informed Supreme Court that it is not concerned if real money online gaming is classified as a game of skill or chance. Government argues that such a distinction is immaterial and taxes are required to be paid.
Google tells employees it is making changes to its performance review and bonus structure, and for most staff, that means slightly smaller bonuses. John Casey, Google's global head of compensation, in an internal email said the company is making the tweaks to better reward the top performers. Well, those are the headlines that we're tracking for you today. But in what's brewing, B2B SaaS fintech company Perfios has announced the acquisition of IHX, which is a Bangalore-based healthcare information exchange platform, to strategically expand its tech stack in the health insurance claim ecosystem. Now, this marks Perfios' third acquisition in the last 3 months and 5 strategically, and the company has said IHX currently processes more than 40% of all cashless health insurance claims in India. That represents more than 10 million transactions and 1 billion claims annually. For more on how this acquisition is going to boost Perfios' growth and the synergies it brings, joining me now is Sabyasachi Goswami, who is the CEO of Perfios. Sabyasachi, thanks very much for your time here on CNBC-TV18. You know, a spate of acquisitions recently, including the last 2 ones that you did in the last 3 months. What made IHX the next strategic fit, and how does it boost your broader vision of becoming this full-spectrum tech fin platform?
Thanks, Ritu. So first, yes, this is our third acquisition in under 3 months with Clarify, strengthening our fraud and risk, Trade Nirvana, enhancing our capabilities on debt management, and now IHX powering our health claims engine. Now, from fraud to collection to claims, ideally we are stitching together the full fabric of BFSI intelligently. Now, our goal is very, very simple: to continue to evolve as the operating system for BFSI. And if you understand, the BFSI has 4 alphabets, and in that BFS is not only important, but equally we give importance to I as well, which is the insurance. So we are building for all the 3. Now, yes, it is 3 decisions, 3 acquisitions, but with one clear direction. And the direction is to become the operating system for BFSI, an integrated, intelligent platform that can span across the full financial services spectrum, that work across the verticals and across borders. So in this ecosystem, let me talk about IHX a bit, where every claim matters. The trust, transparency, and seamless coordination are going to be the real game changers. And in this, while the health claim,
Yeah, go ahead. Quickly, if you could wrap that answer, we'll move on to the next.
Yes. So actually, the what we have studied in the health claim space, the fragmented system that don't speak to each other only adds to this challenge. And the answer actually doesn't lie in the patchwork systems. So what we have done, what is needed today is the unified intelligent framework, exactly that IHX is building.
Got that.
And we thought we will aid that in this overall ecosystem.
Quickly, any financial contours of this deal that you could share?
Not at this point, but yeah, I mean, because there are a lot of work that's happening. So once that is done, probably you all will be the first persons to know.
And immediately, as far as the integration plan is concerned for IHX, will it retain operational independence or be folded into Perfios' platform?
No, it will retain operational independence. It's a strong brand by itself. What we will do is we will cross-leverage the products. We have built a very strong data analytics platform. They have built a very strong tech and distribution. So when these two integrates together, ultimate beneficiary is the end consumer, which are you and me, the patients, the providers, which are the hospitals, and the payers, which are the insurers. So when all of these 3 comes together, actually it will become the backbone of the India's health claim ecosystem. That's the objective.
And, Sabyasachi, do you foresee any synergies between IHX Hospital and the payer network and Perfios' existing BFSI clients, particularly insurance and health tech space?
Yes, absolutely. Absolutely. That's what I'm saying. This is not going to be merely a tech integration. It is, you will see, it is a system-wide upliftment and upgrade that is designed to build confidence, improve experiences not only like common man for you and me, who are the patients at the patient's party, but also will bring improvement in the experiences of the insurers and hospitals and bring long-term sustainability to the overall sector of the ecosystem. You can imagine it like building the pipes of trust across India's health claim ecosystem.
So then let me ask you, if you're building these pipes of trust across the healthcare ecosystem, beyond insurance claims, are there other areas you're looking at? Will you look to enter these areas through more acquisitions, or, what is the plan?
So, first of all, InsurTech itself is such a large space, and we are not only focused in India, but even in Southeast Asia, Middle East, and Africa. In Southeast Asia, we are a dominant player, so as to say, from InsurTech perspective. We work with globally large players there. So the focus remains to be on becoming dominant and in the BFSI space. In that process, as earlier I have communicated always, that if it fits our ecosystem from a product roadmap perspective, cultural fitment, technology and architecture fitment perspective, we are always open.
All right, so there could be more. Briefly before we let you go, the last 30 seconds, what next for Perfios in this journey? Give us what plans you have for the coming year or so.
So, from particularly this transaction perspective, we are solving two sides of the same problem, and we are aligning the ecosystem. But what we are from a future-ready perspective, I think what we are building is, as I said, the operating system of BFSI, in which we will solve the end-to-end pain points for our consumers, which is the BFSI clients, but also how they can deliver their services seamlessly, frictionless to the end consumer, which means driving the agenda of the financial inclusion through different products and solutions that we are there to offer at scale and speed. So in one word, transforming financial services at scale and speed, driving the financial inclusion.
And we'll wait to hear more. Thank you very much for your time today, Sabyasachi, and we wish you the best. Thank you.
Thank you, Ritu.
Well, also on what's brewing, solar financing platform for rural MSMEs and households, Metafin has raised $10 million in a mix of equity and debt for its Series A funding round. The company says the fresh capital will help accelerate its mission to drive clean energy adoption across rural India. The round was led by Vertex Ventures Southeast Asia and India, with participation from existing investors, prime venture partners, and Varanium Capital, along with financial institutions including Northern Arc and AU Small Finance Bank. To take us through what's next, joining me now is Metafin's founder and CEO, Sandeep Chopra. Sandeep, welcome to Startup Street. Let's start with the core of your business. Tell us what sets Metafin's model apart from other solar financing or clean tech startups, and how do you ensure creditworthiness and manage risk, especially in rural areas where traditional underwriting models often fall short?
First of all, thank you, Shruti, for having us on the show. And this is a very relevant question that we are being asked. I think I'd like to answer this question in three parts. I think the first thing that stands us apart is that we are 100% focused on servicing rural customer, and that too in clean tech domain, which then allows us to look at the risk management much deeply, and we don't end up applying, principles across the board as others do. What is required here is an effective mix of managing project risk at a retail level and then the credit risk, cash-based income, right? And we believe that we are, over the last 2 years, we've developed a proprietary mechanism around doing that. And last but not the least, very early in our journey, we realized that, look, if we have to penetrate and scale rural lending business, especially around clean tech, fintech is not the way to go, right? And therefore, we something called Phygital. So we follow a Phygital model where we've got a good mix of feet on street, where we touch every customer that we lend to and check every installation that is installed with smartness of digital processes, right? So a combination of both, we believe, is required for anybody to be successful in this domain.
All right. All right, Sandeep, you financed over 3,500 solar projects across 2,500 villages so far. What are some of the tangible impacts you've seen, for example, on local businesses or livelihoods?
So I'll just give you one simple example. I mean, this was early in our days when we were scouting for these opportunities. What we realized was that the tractor financing in these areas was fairly prevalent. And the reason why people took the tractors was not only for agriculture. They used to use tractors for agriculture in the day and use the motor of that tractor in the evening to run their daily businesses. For example, an atta chakki or a flour mill, etc., etc. Because of which the working day of that guy would extend to about 14 to 16 hours. And the moment we got solar in the mix, those 18 hours are reduced to about 8 hours because of, parallel businesses that they could run.
Sure.
People could, or kids could actually study more because there was no diesel genset noise. So there are a lot of, benefits that we are seeing over and above the aspect around this.
Okay. Sandeep, you claim to have helped customers save $10 million in fuel costs and cut over 16 million kilograms of carbon dioxide emissions. How does your tech-first approach to credit and energy monitoring enable this? Walk us through the technology that powers your operations and customer experience.
So I'll just give you, it's important for us to understand who the customer is. This is a typical customer where 80% of his input cost is energy, and today he's 100% dependent on diesel, right? So what we are doing is we are giving them a promise of moving to solar so that they can save that 80% and pay us back and also become more affluent. Now, one of the core principles around this business is for this promise to be true, the projects have to run. Now, the question is, if you've got such a diverse set of borrowers, which are spread out so much, it is important for us to monitor these plants on an ongoing basis, which is where we developed a proprietary IoT platform. We can monitor the plants real time. Anything that breaks, we can get into preventive maintenance up and very quickly, which means higher the uptime of these plants, more the money they save, more the diesel they replace. That explains why you've got these savings and 16 million kgs of CO2 reversal.
Okay, let's quickly now talk about the fundraise. You plan to expand beyond UP, Bihar and Jharkhand. Which new states are on your radar and what's the broader roadmap for deeper rural penetration? If you could quickly answer that.
See, I think there are two fundamental, criteria that we are using to build our business. One is solar penetration. So we are going after states where penetration is low today of solar. And two, agrarian societies, right? If you put these two lenses together or two axes together, I think our next three states that we are looking at are MP, Odisha and Chhattisgarh in no particular order. And the idea is by the end of the year, we would have seeded these three states, which will then get accelerated over the next couple of years.
Okay. One final question before I let you go. You've got a goal that is to empower 1 million rural solar users by 2030. What will it take to reach that milestone?
So I think in terms of the opportunity, there's no dearth in India. You've got 900 million people staying in rural India.
Yes.
And we just scratched the surface. We are only looking at project financing today. We would be looking at other, categories of product. And of course, the geographical spread, which will be pan-India as we go along. So if we are able to deliver on both these axes, I think a million is certainly achievable in the medium to long term.
All right, Sandeep, wish you the very best for that goal and for that milestone and appreciate your time. Thank you so much for joining us on Startup Stream today.
Thank you so much. It's a pleasure to be here on the show.
Well, it's time for us to take a short break on that note. But up next, AB Coffee, the grab-and-go coffee chain founded by Abhijit Anand, has scaled from 15 to 77 outlets within 10 months. And now it is eyeing deeper market penetration and a potential fundraise in this year. We'll get you the conversation with the founder on the other side.
are committed to take firm and decisive action against terrorists and those who support them. We thank Angola for their support in our fight against cross-border terrorism.
Angola foi das primeiras a reagir.
Angola was one of the first countries to react after the sad events that happened in Kashmir region, killing a number of human lives. And in due time, the Angolan authorities sent to the Indian people and authorities the heartfelt condolences due to that event of terrorism. And terrorism is something that Angola condemns wherever it happens, no matter where it happens, but Angola does condemn.
Terrorismo e Angola, obviamente, que condena qualquer tipo de terrorismo, não importa onde ele seja cometido.
Welcome back to Startup Street. Up Coffee, the grab-and-go coffee chain founded by Abhijit Anand, has scaled from 15 to 77 outlets within 10 months of raising $3.4 million in funding last year. Now, the company is eyeing deeper market penetration and potential fresh fundraising in 2025. In a chat with my colleague Aishwarya Anand, the founder breaks down how Up Coffee is deploying capital, keeping operations lean, and setting itself apart with a tech-first approach. Listen in.
So Abhijit, last year you guys raised $3.4 million. I want to understand, we are well into 2025. Where all have the capital been deployed till now? Are you left with anything in the bank? And are there plans to go for another round of fundraising this year?
First of all, thanks a lot, Aishwarya, for having me. Yeah, we did that around April, May last year. We were 15 outlets then. We have now scaled up to 77 outlets pan-India. We are the largest coffee chain inside business parks, second largest in Mumbai, largest in Gurgaon. We have scaled a lot of our footprint across, increased revenue by 6x in this period of just 10 months. And in addition to this, we built an entire tech stack, the entire app experience. Our app percentage is 42% of takeaway, which is 3x of the next competition or the next F&B player. So a lot of these capabilities is what we have built using the capital that we had raised last year. And we have money in the bank. And, and we are still expanding, we are still building. And there are future plans to go ahead with the fundraising plans, yeah.
Elaborate on the future plans. I mean, by the end of this year, what are the new things that we'll see Up Coffee doing?
Right, so in the last year, we expanded Delhi market. We went from 3 outlets to 28 outlets. Mumbai went from 10 outlets to 34 outlets. We opened Hyderabad and Bangalore market. So this year, we'll be going further deeper into the cities that we operate.
You know, you've been known for being to have a very capital efficient model. Tell me what goes behind it. I mean, how do you ensure that you're running very profitably without burning cash? How does that work?
Great. So to give you an idea, right, there have been a lot of coffee peers who have raised almost 85 million with a run rate of around 42 million. Up Coffee is 4.5 million raised, 4.5 million run rate in just 2 years. It's one of the fastest growing, fastest revenue scale that we have reached in a very short span of also doing a lot of mistakes. I mean, I have to acknowledge that. And obviously, knowing what not to be done and definitely continuing on what to be done, right? What goes in a business model is pretty evident, right? So one of the things is how to be process and efficient in the entire operations that we run. We say we are an F&B company, we're a process and ops company, right? The way we manage inventory, the entire supply chain is self-indented into the back end, right? When we say that we use app, we don't use app just for the purpose of using app. It reduces the manpower at the store. It's cost saving, it's EBITDA for the store, right? So a lot of these capabilities have made sure that your capex is low, your operations costs are lower, hence your outlet profitability is much higher. This is the reason that, our outlets which are aged 12 months and older operate at 26% EBITDA. One of the industry best in the category. Right? Now, this all happens because of the DNA that's built into the organization as a grab-and-go coffee chain and not a experience or a luxury-heavy table and chair kind of company, which is real estate heavy. Right? So that gives us the benefit to be operation light.
To help us understand the kind of SKUs that you have currently, how many do you have? And if I have to ask you, what are your top 3 selling products?
So we do cold coffees, hot coffees, international coffees like Vietnamese, Spanish, Taiwanese. We do Indian filter coffee. Then we have recently launched slushies, which are, if you remember the ice golas, we have transformed them into a modern way. So it's slushies. Mango Mania is going live. We do coconut range of entire beverages. We're the first company to launch entire 13 range of coconut beverages. In addition to beverages, we do food. So basically finger foods.
Okay, tell me the anatomy of an UP coffee cup.
So see, if I have to say a cappuccino, right? So it's espresso, which is coffee beans, and then your milk, and then foam, right? And when you look at the cup of coffee beans that we source are actually more expensive than the milk. However, in most of the normal cafes, milk is more expensive than the beans itself.
Okay.
A lot of people don't know that because you use 200 ml of milk, and that's fixed cost.
New information.
Right? But that's for commercial coffees. For a brand like us and every brand who does specialty coffee beans are definitely more expensive. And costing can vary. In a normal cafe, a cup of cappuccino could cost them 30 odd bucks.
30 odd
Just. Which can be sold to you for 300. Which is being sold to you for 300.
And how do you do it then?
Coffee at Up Coffee is 1/3 of the market. A cappuccino is 97, an Americano is 87, a cold coffee is 117.
What does an average order cart value look like?
208 rupees.
208 rupees. Okay. So considering that you're playing, in terms of pricing, you're playing in the mass premium range. I think
That's
I can call you
correct.
that, right? What is the kind of demography mix that we are seeing from the urban cities, from the Bharat market? Because that is the next big frontier for any D2C startup going forward. Are you looking at that space? What are the plans there? Or are you already getting a lot of customers from that space?
So again, a lot of our business is hinged to where we are located, right? And we are as of now located in NCR, Bombay, Bangalore, and Hyderabad. So still all tier 1, right? But to answer your question, I do see that there is an incredible depth in the market when it comes to Bharat market. But again, for us to strategize, how do we expand? We look at depth more than the width. And hence we are right now focusing on the cities that we were located in.
All right, on that note, we're going to wrap up this edition of Startup Street. Thank you very much for watching. Stay with us. More news and updates will come up on the other side.
In this time of global uncertainty, Australians have chosen optimism and determination.
Welcome to Indianomics. Today's debate stirs or questions the very heart of Indian policy and Indian economy. A 60-year-old trend of greater globalization is set to take a U-turn because of President Donald Trump's tariff war. So far, state-of-the-art consumer products like, say, iPhones or iPads or semiconductor chips were designed in the West, manufactured in emerging economies, and marketed again in and by the West. Now every country, including India, has to produce for itself, and accordingly, India's laws and policies need to change away from global scale and focus on domestic demand. Tax laws should encourage consumption and not savings. Airlines should connect not Bangalore with Boston, but Coimbatore with Kanpur. This is the thesis put forward by Jahangir Aziz, the head of emerging market economics with JP Morgan and a veteran India watcher. Is such a dramatic change called for in India's economic policy? That's the debate in today's Indianomics. I have with me Jahangir Aziz himself to present his thesis, and two other well-known Indian economists, Latent Roy, who's a distinguished professor at the Kautilya School of Public Policy, and Pulapre Balakrishna of the Centre of Indian Economics. Thank you very much, professors, for joining me. Let me start with Jahangir himself. Jahangir, please restate your theory as briefly as you can, and what exactly needs to change in India's policy.
Morning, Lata, or good evening. So there are two ways of looking at the world the way it stands today. So one way of looking at the world is to say that, look, the largest economy of the world most likely will go into a recession. The second largest economy of the world is going to not have a technical recession, but likely will have a severe slowdown in the economy. And all of this is happening in the midst of a tariff war that is no longer confined to US and China, but has spread to other countries. If that's the way in which you want to look at it, or one wants to look at it, then what happens to the rest of the world is by and large going to be governed by the spillovers that happen from these two economies slowing down onto the other economies. And over the last 50 years, we have gone through at least 5 US recessions. The world has survived, and we've come out of those recessions. The alternative way of looking at it is that this is a broadside against a 80-year-old global trading system by the very country that built that system piece by piece, and that the damage that we are looking at, or we are fearing is going to happen to the US economy or to China or the rest of the world is just a spillover from that breakage in the global trading system. The problem with this view is that if that is the origin of the shock, that this is a resetting of global trading system, then over the last 8 years, every country, whether it's an advanced country or whether it's a developing country or an emerging market country, has been built around this global trading system. The economic structure therefore needs to change if the global trading system has to change. And that was basically my point, that the economic structure of almost all economies in the world, including India, is built in some way or the other on the basis of this global trading system continuing with all of its unfairness and all sorts of concerns, but broadly continuing. But if that no longer is going to be the case, then the economic structure itself has to change.
Okay. Well, let me question that thesis first. Latent Roy, would you agree that it changes so dramatically that every country becomes inward-facing? Or is it going to be an incremental change where the US perhaps extracts some mileage, some production and, trade surplus from other countries, but basically we all still play to our strengths, and we will do it through, FTAs with like FTA UK, India UK, India EU. Will it be really such a dramatic change that everyone produces for themselves?
Well, there will definitely be more autarky in the world. And if you're asking me whether every country will produce for itself, probably not. In the sense that, as Jahangir, I don't think even Jahangir was saying that. I mean, there are small open economies which really have no choice but to produce for other people. Many of them don't produce goods, although countries like Singapore do have a very high manufacturing share. And they will have to navigate these headwinds somewhat more carefully than India. India, of course, has another great advantage. It's a busted flush when it comes to world trade. India's share of world exports is piffling. India cannot even compete with Bangladesh and Vietnam, especially Vietnam, forget China, for many of those things that we ought to be producing. Our share in manufacturing is anyway declining. So I rather hope that Jahangir is right, in the sense that if he is right, then India will do what I've been urging all along. Mahatma Gandhi once said about Western civilization, it would be a very good idea. When people talk about India exporting, I say it would be a very good idea because I've been hearing that line since I achieved puberty. And India has not been an exporter since then. So if we then turn inward finally and stop dreaming these pipe dreams about being a global manufacturer based on a relatively small shift in where iPhones are manufactured, that can only be a good thing for India. If we focus on home market demand, which is huge, that can only be a good thing for India. I'll leave the consumption point for later. I do slightly want to nuance what Jahangir said in the Indian context. But otherwise, I think Jahangir is probably right when it comes to large countries. But large countries anyway, like India, especially India, which is a busted flush globally, should have been always focusing on domestic markets. And I think Trump has done us a favor if he impels his government to do that systematically in a more disciplined way than it has been doing in the past.
I am not sure of the end game of this trade war. My guess still is that it is going to be incremental changes. But Dr. Balakrishna, your first thoughts. There is clearly a challenge called to globalization. But is it complete deglobalization, or is it just going to be some stalling and plateauing with perhaps the US extracting some advantages? What's your best guess?
Well, let me start by saying that I do agree with Mr. Aziz that we are seeing some serious disruption here. Now, what will be the magnitude of that disruption is certainly uncertain. The only thing that we can be certain about is that there's going to be some uncertainty. So that's the first thing that I'm going to say. Secondly, I would say that India certainly does not have the luxury of producing for itself for the simple reason that about 80% of its oil consumption is imported. So jolly well export in quite a big way if it wants to at least take care of its balance of payments. But exports as a means of actually growing the economy has not been part of India's history ever, not even after 1991. So I'm not sure if the disruption in world trade is going to make a great difference to India's growth prospects. But there's certainly going to be disruption. And the United States is a major trading partner of India's. So how we come out of all of this is also going to be related to what sort of trade agreement we are able to negotiate with the United States. So I'll say that for a start and keep everything else for later.
Okay. Okay, then Jahangir, I'll come back to you with the same question I'm asking the other two. Is it going to be such a big U-turn? For instance, do you think seriously that iPhones are going to be made in the US, even for the US?
No, iPhones may not be made in the US for the US, but as you asked the question, what is the intention of this, these trading moves? If you look at the manner in which the reciprocal tariffs were imposed, these were not imposed based on, okay, India has these amount of tariffs and these amount of non-tariff barriers, these amount of other things, and therefore the non-tariff barriers have costed X billion to the American taxpayers, and therefore the US will reduce its reciprocal tariffs by this amount if India reduces its non-tariff barriers.
Jahangir, they are based on trade deficits. That was very clear.
That's correct.
Higher the deficit, higher the punishment.
Right. So let's look at the trade deficit. It's 1.1 trillion is a trade deficit. Let's say even 1.1 trillion goes to $500 billion. So I'm not being as dramatic as you were being, Lata, and I'm glad that Rotin pointed out I wasn't being that dramatic.
Okay.
All I was saying is that if you take away from the largest economy in the world, their trade deficit going by $500 billion every year, and let's say that leads to a significant reduction in their imports. US imports about 4.1 trillion every year, which is larger than India's GDP. If that economy is turning autarkic, whatever the reason may be, if that economy is turning autarkic, it will force every other economy that trades with it to turn autarkic.
One minute, Jahangir. I'm not denying that it is turning autarkic. What I'm saying is that they can't take away 4.1 trillion of imports in 1 year, 10 years, 100 years. It will only be a little less than 4.1 trillion incrementally.
So the little less was done in global financial crisis. So go back to the global financial crisis. Look at the period before the global financial crisis. Those were, quote unquote, the golden years of emerging market, including India. Why was it the golden years of emerging market, including India? It was because globalization was surging at that point in time. We were establishing supply chains. That was what was driving our investment. That was what was driving our growth. If you look at what happened to the world since the global financial crisis, across the world, the potential growth, the medium-term growth of every economy has actually ratcheted down. And that is because global trade has ratcheted down. Now you're telling me that let's look at another small ratcheting down. I have no idea whether it's going to be a small ratcheting down or not. In the global financial crisis, there was some opposition to deglobalization. I will grant you that, but it was a political opposition in Europe and the US. It wasn't that the opposition was on the policy front. This is an opposition that is taking place against globalization, not just politically, but also actually in actions. And you are not even looking at the retaliation that will happen. We are assuming that the 90 days you will actually get trade deals with the Europeans and other countries. We haven't seen any of the trade deals apart from the India trade deal is being talked about. And as Rotin said, India doesn't really matter in the global trade. What matters is Japan. What matters is Mexico, Canada, and Europe. And we haven't seen anything of that sort. We don't even know what retaliatory steps these countries will take. So the ratcheting down of global trade can be significantly larger than the ratcheting down of global trade that occurred in global financial crisis, where the only thing that happened, by the way, was that trade financing was frozen.
Yeah. Okay.
So my point being that you can see another ratcheting down of trade and therefore another ratcheting down of medium-term growth because we in the emerging market world continue to believe that being part of the globalization world or being part of the global trade is our ticket to greater prosperity. And that was what I'm questioning.
Okay. Well, I have to take a commercial break. Let me come back and ask you, professors, what should be India's policies going forward? Back in a minute. Welcome back to this all-important Indianomics, where we are discussing whether the challenge by President Donald Trump would mean that most economies will start having to become domestic demand-based, especially India. I've been speaking with Jahangir Aziz, who wrote this excellent edit in the Indian Express. I have also been speaking with Professor Ratin Roy and Professor Pullapre Balakrishnan, both prominent Indian economists. Gentlemen, thank you very much for your patience. Ratin, Jahangir had a say. What is your best guess of how this challenge to globalization will turn? Will it mean that US imports reduce from, say, 4.1 trillion to, say, 3.5 trillion? Is that the end game, or is it much more dramatic?
If I may respond to your question from a purely Indian perspective.
Yes.
My trade surplus with the US is a little north of $100 billion. I think it's 120 or 130. Let me assume that halves. Worst case scenario. Responding to what Pullapre said, that we have to worry about the balance of payments. So I now have to find $70 billion to close my balance of payments deficit. Now, the good news for India is we have never managed to close that by increasing exports. The way we close our balance of payments deficit is that our total foreign inflows, which is remittances plus FDI plus FII, exceed our current account deficit.
Yes.
That excess is more than financed by these three things. So the question here is, will this trade war in any way inhibit that process from happening? That is where I think our policy needs to focus. Let me give you one very good example. I have been working on this with the state governments here where all the Indian action really is south of India. Nothing much happens up north. There's a Darbar and that's it. The interest of the main hit that's going to come to American service producers is going to be the more or less abandonment of the H-1B visa policy and the entire green card pipe dream route. that could seriously affect the fortunes in the South. The reason it may not is that the response I'm seeing, and you can look at this by looking at rental yields in South India and Hyderabad, which have gone up by 45%, Bangalore by 40% in anticipation of the last 6 months, is that global capability centers of various types, not just IT. We're looking at services, we're looking at Accenture, we're looking at knowledge industries, we're looking at banks. There's a plan for a rapid expansion in that. Now, what that would mean is we'd get in FII, and that would become part of domestic GDP almost, because the FIIs would then produce these global capability things which we would sell to the US. Now, if that trade in services is interrupted, that would be a serious blow. But that itself should take care of about 80% of our balance of payments deficits.
Yeah.
Then with a little bit of smarter, with slightly smarter import strategies, we should be okay. So and here I'm looking at a pretty non-marginal impact like you are. I'm saying the US, our trade surplus with the US on goods halves. Even that, I think we can manage fairly smartly over the next year or two. Now, the only thing we have to do with Trump, because he's not a stable person, is what the Indian government, to its credit, has been doing against its normal track record, which is to talk too much. We mustn't talk too much. We should quietly try and engage with the US and get what we can out of them while making sure that our strengths, which are services, etc., those grow in India. And I agree with Jahangir, we also have to come up now, like all other countries, major countries will do, not Switzerland, but certainly the UK or France will be forced to do, which is focus more on home market demand.
Okay. Ratin, this is exactly what the Indian market is also going with. Our trade surplus with the US is only 42 billion. Our total exports to that country is $130 billion, but the surplus is only 42 billion. If that has to be halved, it's only 21 billion. That's not a great deal of money.
No,
and as you say,
we lose our
services,
trade surplus.
services
We lose our trade
exports,
surplus, and our trade with the US halves too. Our exports to the US halve to about 70 billion. We can even manage that.
Yes, and in any case, the GCCs or services exports is not in Trump's radar at this point in time. So both the market and I were of the assumption, or seem to be of the assumption, that it is going to be an incremental problem that India has to deal with. But Jahangir seems to be saying that we could be impacted much more. Let me first get Dr. Balakrishnan to respond. Dr. Balakrishnan, how seriously should India change? Jahangir says that even tax concessions given to savings need to go away, and we have to actually start encouraging consumption because domestic demand will become much more important. Does it get that far, sir?
I think that is a very important point, and I generally agree with that. But I just want to say something about part of the discussion that went on a minute ago, which is that we can't do the calculation entirely in terms of how India's trade with the US will be affected. US's actions are going to affect global trade, and therefore India's exports are going to be affected by much more than what is going to be part of the Indo-US trade agreement. So I just want to keep that in mind. Now, the other thing that I want to say is that the general point about domestic demand is absolutely correct. And this is not the first time we're talking about it, or if I might say so, I have been talking about it. I think this became apparent even after the global financial crisis of 2008-9. Even international bodies like the Asian Development Bank were already talking about the importance of domestic demand for Asian economies. Now, the question, however, is that how do you spur demand? You can't say that this can be done by raising consumption alone, because consumption is a function of income. So you must increase income to start with. And one way of doing that, of course, is via investment. And here I want to say that, as you very well know, private investment as a share of GDP in India has been stagnant for over 10 years. And I don't see very much happening on that front. So really, all that we have left is public investment, which, despite the noises that the government has been making and some increase in roads and ports, etc., has increased only by 1 percentage point or something in the past 10 years, from 7% of GDP to 8% of GDP. So clearly, public investment is part of the story. And the other is something which cannot be fixed very easily, which is that there is shrinking demand in the economy for anything other than food, mainly because of inflation. Inflation is shrinking household budgets, which is being directly reflected in manufacturing output. In particular, manufacturing, as you know, has slowed despite a kind of aggressive policy by the government for over 10 years in terms of Make in India, for about 3 years now. In the
Dr.
form of
Balakrishnan,
production-linked incentives.
That is a larger debate, sir. We will not have time for that. We have to have concluding points from all of you since we are out of time. Well, Jahangir, what Ratin is also arguing is that this is going to be incremental in terms of the trade surplus we have with the US. But as Balakrishnan agrees with you, that it is not just a question of our deficit with the US. We are going to see a shrinking global economy. So do you still think we have to go that far? That, you have to stop encouraging savings and go to encouraging consumption. Does it get there?
So first, let me just tee off from Professor Balakrishnan's last 2 points. The first point, thank you, Professor Balakrishnan, for mentioning that it is very narrow. You'd be missing out the forest for the trees if you only focus on Indo-US trade. It's that the US moving out of the global trading system is going to affect global trade. The second point, which is the point that you made, which is about investment, and I completely agree with it. And obviously, for many sessions I've had with Lata, we've talked about the languishing of investment. So there's a very easy chart, and you can do that one of these days, Lata. Whether you look at growth rate of exports with growth rate of investment, or growth rate of investment as a share of GDP versus exports as a share of GDP in India. And I'm not talking about other countries. In India, it is true also in other countries, but India, there is no daylight between the two lines. The reason in the pre-global financial crisis period that we had that rapid expansion in investment is that the investment directly or indirectly was related to the expansion of supply chains and export markets. Since global financial crisis, that has come down. And that has come down because we are no longer expanding supply chains to get more become more connected to the global global trading system, because the global trading system itself is pushing back.
I agree. Jahangir, unfortunately, out of time. Tell us one key change you want to see in Indian economic policy.
For example, I would really want to see, the entire basis of our discussion, that India is a supply-constrained economy, and therefore we need to keep on easing supply constraint, simply being changed to India is no longer just a supply-constrained economy, but a demand-constrained economy. Okay. If we just accept that as a starting point, I think the rest of the policies will actually come through.
Okay, well, unfortunately out of time. Gentlemen, thank you very much for starting this conversation on how Indian economic policy needs to change in a changed global order. That's it on this edition. Thanks for watching. The newly appointed chairman of SEBI on March 1st outlined 4 key objectives for SEBI: trust, transparency, technology, and teamwork. And today we have a 5th T to elaborate on this. The author of all these statements, Mr. Tuhin Kantapande, the new SEBI chairman. Thank you very much, sir, for your time. Well, let me first start with the trust and the transparency part. The previous chairman had already set in motion the controls on F&O. We saw the first tranche of controls came in, only 1 expiry per week per exchange. We are eagerly awaiting the second set of rules. When do you think we will hear of it, and what will be the main, constraints, if any?
I think the SEBI had put out a consultation paper, yes, and we received about 800 comments. Yeah. Some supporting the position, some suggesting some alternatives, something in between. So we will take a considered view and it will come. Basic premises that we should make systemic improvements and also provide, while the F&O market is very important market for price discovery, for hedging, we also don't want it to be, like reduced to one single problem that we were facing on index options on the expiry day. That was our key problem area. So therefore, we need to, clearly define the risk metric, and we are trying to, we'll bring the delta in terms of, the options.
Yeah, I thought it was more, besides the risk metric, the end of day counting of options or intraday. And it is now, look, I mean, there were enough articles written on it that the intraday positions are so high that some limits need to be put, and the limits should not only be on end of day. So should we expect that there will be intraday limits? Because that's where the HFTs seem to be taking the game away.
I think we will have to take a clear call on not really exactly what we had proposed in the paper, but exactly what will be more practicable, and taking into consideration all factors. So we will bring about necessary changes accordingly.
Okay, you can't give us any clue on whether it would be intraday or end of day limits?
Not at this moment.
Okay. All right. Let me come to the other issue that is rankling the market on this trust transparency issues, and that is this SME IPOs, sir. I mean, we have seen Gensol is now. Just before that, we had that, I think it was what, Trifactor Technologies. There are enough number of SME IPOs. Are there some new rules being written? There is an inherent conflict. When you ask the exchanges to control them, they make money out of them. So it doesn't seem to be an effective, they don't seem to be functioning as a first line of control.
I think one of the objectives of bringing SME IPO or a little light touch regulation for them was exactly to facilitate the SMEs to access capital markets, where the cost of accessing we have to see the cost is relatively down, and it is easier for them to access capital markets. So I mean, we have a very large number of SMEs, and so therefore in order to enable them to do that, whether we could have the same onerous requirements as the main board was the issue. And it was, so I think we are watchful if there are certain aspects where, we have, for example, brought in some changes in terms of profitability criteria, in terms of usage and deployment of funds post-IPO. Also on the fact that, this money cannot be simply used by loan repayment of the promoters. But I think the merchant bankers, they need to do a better thing on this, and we expect
But do you expect it to remain with the exchanges because there seems to be a conflict of interest?
I don't think that is, in a way, in anything, even if it is approved by the SEBI, the exchanges will have to be paid their fees. So therefore, the transactions will have to be carried out in the exchanges. Okay. So only the processing part, like, clearing the document, that was something which was SEBI passed it on to. But we will be watchful of the situation, and if we find that, if we find that this is a very widespread phenomenon, even after whatever the changes that we have anticipated, then we will review it.
The second tranche of F&O rules, when should we expect it?
Well, I can't give you the deadline, but...
No, I mean in a month, even a broad ballpark.
I mean, I think very shortly, yes. Within a month, I think we should be able to arrive at, yes.
Okay. Now let me come to the other issue that you have already announced as one of your first announcements, this conflict of interest disclosures for SEBI's own officers. Do you notice any gaps in the current disclosures?